All right, so now we're going to talk about some of the common forms of legal organization when it comes to your business. And we're going to talk about each one of these in depth, but first I just want to kind of chart them out so you can kind of get an idea of the different options and ways of organizing your company from a legal entity standpoint. So when we look at legal, I'll kind of do it as a branch diagram here. So legal entity formation, and these are all options. We're going to talk about all of them in just a moment and go through them. But the first one is going to be the most common. We'll talk about more is going to be sole proprietor. All right, so sole proprietor. All right, we'll talk more about that in a second. The next one's going to be a partnership. And then the most common form of business entity that gets set up is corporations. Now, when we talk about corporations, there's different types of corporations, and let's go ahead and break down some of the different types. There's quite a few. There's also a couple different types of partnerships. So when we talk about partnerships, let's go like this. All right, so there's two different types of partnerships. The first type of partnership is called a general partnership, and then the second type of partnership is a limited partnership. Limited. Cool. Now, lots of different types of corporations. There's actually 6 different types of corporations we're going to talk about. So let me see if I can draw these out. 3, 4, 5, 6. So these are all different types of corporations. The first one is the C corporation. I'm just going to call it C for short. The next type of corporation is the S corporation. Again, we're going to go through all of these in just a moment. The next one is the LLC, or the Limited Liability Corporation, or Limited Liability Company. And then there is a professional corporation. Then there is a nonprofit. And then there is a B corporation. All right, so we're going to talk about each one of these in depth, but all you need to know is that, hey, look, there's different ways to structure the legal part of your business, and whether it be a sole proprietorship, a partnership, or a corporation. And then if you choose a corporation, you can see there's a whole bunch of different types. There's different implications when it comes to tax, when it comes to whether or not you're going to have partners, and then also kind of what industry you're in. For example, professional corporations that might be used for the medical industry. Same thing with a limited partnership. These are all different types of industry norms, but a large part of it when it comes to doing a startup is going to be your tax implications, and the size of your business a lot of times will determine whether or not sole proprietor is enough for you, or if you need to go into these other different types of entity structures. Let's dive a little bit deeper into each of these so you can understand which one is best for you. All right, so let's talk about a sole proprietorship and what that is. First of all, if you're living in a country outside of the United States, at this part of the course, this is the part you might want to go talk to an attorney, or at least your Department of Licensing, to be able to figure out if this is actually what the advice should be for your given country. I'm most familiar with the United States and a little bit of Canada, so if you want to email me, definitely feel free to reach out if you have questions. But when we talk about sole proprietors in the United States, it's the most common way. Over 63% of small businesses in America start using a sole proprietorship. And the reason for that is because it's really easy to start. Very, very simple to start. And the reason for that is because in some states, you don't even have to have a business license. You can literally just get started with your social security number as a form of your business entity. And it's really cheap to set up. In some states where you do need a business license, it's like paying under $100 or maybe $60 or $50 in some places. You can do it all online. It's not super complicated. You don't have a whole bunch of pages about articles of incorporation. Just really, really simple. All right. And what's really cool about a sole proprietorship is all running underneath your social security number. So you might get forms that ask for like your employment, identification, or your employment number, or some number that you're going to need to fill out on like a W-9, for example, which we'll talk about later, on like a W-9 or some sort of tax form that you might be asked for some sort of employment number. Now, for a sole proprietor, we're going to be using our social security number, and in a second we'll talk about corporations. That's when you actually get an EIN from the IRS, an employer identification number. But again, this will work just fine. Using your social security number is just fine in terms of opening up a sole proprietorship, which basically means the business business is you. How I like to think about it is like, if Mike Andes is a sole proprietor and I own a business, that business is Mike Andes, because literally it's tied to my social security number. If it makes money, Mike Andes makes money. If it loses money, Mike Andes makes money, because it's all tied back to my social security number. Now, it's very cheap to file taxes using a sole proprietor. It's very simple. You're not going to have to pay a lot more money. You don't have to do a separate tax return for a sole proprietorship. In your same tax return, there's literally one form that your accountant can fill out underneath your social security number, and basically if there's profit, it's looked at as income, and if there's losses, it's looked as a deduction. So when it comes to sole proprietorship, it's very simple to set up, very simple to use for your taxes, and there's hardly any setup costs, and in some states there's zero setup costs to actually get started. This is the downside, though, of a sole proprietorship, and this is why we want to talk about the other forms of incorporation, and that is that there's what I call unlimited liability, which basically means the liability on the part of the owner extends past their investment in the business. So if I go buy a bunch of trucks and equipment and all the rest of it, if I'm underneath a sole proprietorship, it means that if something happens to the business, not only can they go after the assets that I've purchased for the business, they can go after everything I own, because remember, I am the business under a sole proprietorship. So if the business doesn't do well and I have a creditor that wants to come after me, or if I get sued because I ran over somebody's toe, or I crashed into somebody and they had to go to the hospital, they can come and sue me, and not only can they sue for the business's assets, they can actually sue me for all of my assets, because again, I am the business. They can sue me for my personal house, my car, any investments I have, any money I have in the bank that might not have anything to do with the business, but they're my personal assets, and therefore, because those personal assets are tied to me, then the business is tied directly to me, they can come after those assets as well. I really encourage people to start with sole proprietorship. If you're single, if you're just getting started, if it's a really small business, definitely start with a sole proprietorship. But as you begin to grow, if you have family members, if you start to get assets like a car, if you buy a house, that's when it's very important that your business not be a sole proprietorship. We're going to talk about some more of the different types of corporations that you want to use to make sure you don't have unlimited liability. So that if something does happen in your business, whether it be a lawsuit or there's something horrible that happens and you fail, the creditors can't come back to you when you declare bankruptcy. If you declare bankruptcy, that's all fine and good, but they can still come after your personal assets. Whereas if you have a corporation that holds the business and the assets of the business and you declare bankruptcy, it's a lot harder for people to come get your house and your personal car. And definitely when you have a family, that's something you need to think about. So in terms of like, if you're deciding between a sole proprietorship and a corporation, if you're manufacturing in your side of your business with some sort of hazardous material like metals or some sort of chemicals, there's a lot of liability there. If you're having like a personal daycare, for children, like there's a lot of liability. So one of them could run out across the street, or one of them could get, hurt while they're playing around on the playground. That's a lot of liability, and you don't want to be having a sole proprietorship in that instance, because you're opening up your personal assets to all the liability of the business through either lawsuit or through, if the business fails, through creditors. So another thing to keep in mind when it comes to sole proprietorships is when the business owner dies, the business is technically done. Like, so when the owner, the person whose social security number owns the business, when they die, the business is kaput. It's done. Like, because they're no longer existing, and the sole proprietor, their social security number is basically what the business is built on. So if you have a sole proprietorship, make sure, this is when it's really important to have a will. That means, that says, it states exactly what happens when you die, whether it be that business being passed along to somebody, whether it be someone else is going to take ownership of the business and run the day-to-day operations. That all needs to be stated, especially if you have a sole proprietorship, because otherwise it can get very hairy for creditors and employees. If the owner passes away, they are the sole proprietor, and now all of a sudden no one owns this business and no one owns these assets. Trust me, creditors are going to get very, very unhappy and come after the assets, and employees are not going to know what to do. All right, so it's very, very important that if you have a sole proprietorship, that you have a living will, as well as having a power of attorney. So if you're ever incapacitated, if there's any, like a vegetative state that you might be in from an accident, God forbid that any of those things happen, and it's horrible to think about that, but if you have a sole proprietorship, making sure that you have a living will and you have a power of attorney so that someone can make decisions for you on your behalf if you're in the state where you can't make decisions and you're in some way incapacitated. If you are in a coma and you need your business to keep running on. And so you need to have a living will and a power of attorney. Power of attorney gives someone else the ability to make decisions on your behalf from a legal standpoint. Make sure those things are set up. Now, you can definitely kind of limit somewhat the liability, even though I call the sole proprietor unlimited liability. There's definitely ways you can use insurance to kind of make sure that you don't fall into too many issues. So for example, it protects against lawsuits a little bit more. So if I do have a child daycare and someone gets hurt and I get sued, if I have insurance for my sole proprietorship, there's a really good chance it's going to cover that. Now, what it doesn't cover though is if the limits of my insurance is say $200,000 and they sue me for $1 million, guess what? They're going to take my $200,000 from my insurance agent, for my insurance company, and they're going to come and say, hey, look, you're still on the bill for $800,000. And guess what they're going to do? They're going to come after any of your personal assets when they come to court. So your house, your car, all of that's on the table. So you can definitely use insurance, and we'll talk more about insurance later on. You can definitely use insurance to limit some of the liability, but from a corporation standpoint, you and the business are the same thing. So if the business doesn't do well, any creditors, anyone that's doing a lawsuit can come after your personal assets. Definitely something to keep in mind as your business is growing, or if you have dependents, in my opinion, or if you're dealing inside of a business that has high liability and there's a likelihood of something going wrong, either in the business, like it's a very high risk kind of type of business, or you're actually manufacturing or doing something that there's potential for someone getting hurt on the job or around your workplace. All right, so let's talk about partnerships. So partnerships are most common and almost necessary in some sort of law practices and medical practices, but I'm assuming most of you are not that. And so in terms of small businesses in most industries, I'm a big believer in not doing partnerships, and I'm gonna tell you some of the risks and some of the things you should just keep an eye out on. But me personally, like my personal advice, and for me personally, I would not go into a partnership. The reason for that is because I know what my weaknesses are, and I usually look for those in the people I hire, and I don't want to be hindered and slowed down in process of making decisions because I got to run things by someone else all the time, or coming to a crossroad in the business that I believe in 110%, but I can't do it because my partner doesn't want to. And so that's just me. Some people would say it's controlling or whatever. I feel it's like the fastest way I can move a business and be most nimble. But if you need a partner, because some of the things we've talked about in the past in terms of you having certain deficiencies in your skill set, experience, money, and you need a partner, let me kind of give you 5 things that just be my advice in terms of just things to look out for and some tips for you. So number 1 is pretty obvious. Choose your partner very carefully. This is literally like a marriage. Like a legal part of a marriage is like very similar to the legal part of entering into a partnership with a business in terms of you really need to know this person and have aligned goals and compatible and complementary skills. Not necessarily the same skills. You might have completely different skill sets, but then because of that, you'd be compatible and you'd complement each other because you're differing. Sometimes the worst partnerships are the ones where the both founders are exactly the same and they clash the most. So it's not necessarily having the same skill set, but having complementary and compatible skill sets and aligned goals. That's the biggest thing. The biggest reason my partnerships fall apart is because the end goal is not predetermined, and therefore as the business begins to grow, they have different goals. One of them wants to stop after $1 million, the other one wants to take it to 10 million. You're gonna have a problem at $1 million because one person wants to basically stop there. So partnerships are definitely something you want to make sure that you have aligned goals, and the last thing here is you want to be trusting of this person. So number 1 is know your partner carefully. It's like a marriage. You need to have aligned goals and you need to trust them. Now, a lot of times when we talk about trust, people are kind of led into believing, well, I should have a family member or a spouse or someone I know really well, a friend, be my partner. Be open to this, but be cautious about partners with your friends. There's definitely partnerships that have done very well with friends and family, but remember, like, if something goes bad with the business, it's now going to affect your personal life, and it's not going to be something that you can just like get rid of. Like, if a partnership goes bad in business, guess what? You wash your hands of it, you get figured out in court or whatever it might be, depending on how bad it goes, and then you just move on, and you don't have to talk to that person again, you don't have to see them. When it's your family, when it's your friend, it's someone you go to see at church every single week, it gets a little more difficult to be able to just wash your hands of that partnership if it goes awry. Third thing is, try to test drive the partnership if at all possible. So whether it be you working together on a small project, or you go do like a fair of some sort together, like some sort of a fair where you're selling the product, or you do something around the business where you're not partners, but like they're either working for you. Like if they've worked for you for a few years as an employee, and you're like, hey, we got to take the business to the next level. I need a partner. You've had a couple years to really like see who they are and see what they do under stress, and see if their goals are aligned with you, see what their skill sets are like. Don't just willy-nilly go into this. If you can, try to test drive the relationship before you actually become a partner. Fourth thing is create a combined vision for the business. Expectations of each founder need to be determined. Like, how much money is everyone expected to contribute? How much time and energy and expertise are we supposed to be giving to the business as these partners? Like, what are the expectations? And creating that combined vision for the business, the future, as well as what each partner needs to contribute to that vision as the business goes forward. Number 5, last thing here, just a word of caution, prepare for the worst. Like, prepare for the partnership going bad, and it's the same thing with marriage. No one wants to talk about the beginning, but when it comes to business, you've got to talk about this. You've got to prepare an exit strategy for the partnership, and know that from the onset, before you even start the business, know that, okay, if something happens to one of us and we want to leave the partnership, here's what happens, line by line. And whether you're buying each other out, or whether you create stock at a certain percentage and a certain valuation, or do you have annual valuations by a third party that determines the value of the business, so if someone wants to exit, they can buy the other person out, because things happen in life. And especially if you're in a partnership with someone that is, in a different family, in different past, different age, all the rest of it, they could have health problems. They could have a divorce with their own spouse. They could have a family, big blow up in their family. They could have a job opportunity that they just have always dreamed of having, and it just happens to be, a few years into your business, and now they need to leave across the country. Like, these things happen. Life happens. So prepare for the worst when it comes to your business partnership, and know from the beginning how that partnership can end if worse comes to worse. All right, so another video on partnerships, because it is something that some people fall into and make mistakes. And so I want to talk about it really quickly, a couple more things. Number 1 is have a partnership agreement. And I know I mentioned this on the last video, but I want to make it very clear. You should go to an attorney and you should have a document that states what you should do. Not like, hey, I should be the sales, you should be the service. That sounds great. No, go to an attorney, figure out what you're responsible for, what each person's responsible for, what your rights inside the partnership are. Like, make it very legal, okay? This is not like a marriage where, like, literally you can just be like, hey, you want to marry me? Yeah, great. Okay, cool, let's go sign a document together. Like, that's why marriages end badly, because sometimes people don't put planning into it. Like, the same thing goes for business. This is a kind of marriage that you can have a very structured, you do this and I do this. Like, you can't get into a marriage and be like, I'm going to take out the trash, I'm going to do the dishes, you're going to vacuum. Like, you don't get into a marriage like that. It probably won't be successful. But when it comes to business, you need to do this. You need to have, these are the rights and these are the responsibilities of each member of the partnership. Use an attorney, spend the extra dollars, and get an attorney to make that partnership agreement. Now, I want to talk about something here called joint and several liability. And this is something to think about, again, if you are wanting to start a partnership. And that is the fact that when you sign a partnership with someone, you kind of take on liability for their actions. Because when they sign a contract or go into an agreement, into a legally binding agreement, even if you don't know about it, you're responsible. Like, you're on the docket for it because you've entered into a partnership, and kind of like their name on the check is as good as yours. So if they go into a contract and agreement and you don't even know about it, if they've signed it, you're stuck with the liability. If something goes bad, if they make a poor decision, if they make a poor business decision, it's not like because they made the decision in the business that only they are liable or could be sued or lead to business loss. Like, if you sign a partnership, their name on the check is as good as yours, their name on the contract is as good as yours. And that kind of leads to like almost like unlimited quote unquote liability. We'll talk about limited liability, but there's a level of unlimited liability that when you have a partner and they can go out and do whatever they want and you're basically responsible for it, and they're not going to stop. If someone's trying to sue you or come after you, or the business does poorly and they're going to come after you and your personal assets, even though it might have been your partner's fault for the mistake or the issue, or they messed up a big contract, or they signed something they shouldn't have. You are joint and several, which means you are going to be liable for all of their actions. There's good sides to that. There's good sides, and there's definitely downsides. The good sides is that you are joint and several, and they add a lot to the business, but you're also liable. And that means that you're also liable for all the bad things that they might do, and your personal assets might come into question. Now, this last one seems a little bit, fatalistic, but in the event of death, it sounds really bad, but guess what? Death and taxes, they say, are the only two things that are for certain. So if you're going to go into a partnership, you should probably think about death. Because if there's death, incapacity, or if a partner withdraws from the partnership, that partnership is done. All right, it's not like you just keep going on because they died, or you can just keep going on because they're incapacity. They're in a coma. If they pass away, they go into a coma, they're incapacitated, or they withdraw, like they just want out of the partnership. That partnership is done. All right, you can't keep running the partnership if one partner's like, I'm going to leave the company. You can't do that. So when that happens, either death, incapacitation, or someone withdrawing from the partnership, it requires the business to either go through liquidation or for restructuring of the business and restructuring of the stakeholders and the investors of the business. And so if someone passes away, traditionally, you are going to basically have, let's say you have three partnerships in a business, and one of them passes away. Now, let's say, for example, they all had 1/3 of the business. Now, all of a sudden, 1/3 of this business has gone to someone who has passed away, and that 1/3 is going to go into a very hard way of trying to get out of this, and that's because it's going to go into their estate and probably into their will. And if there's not clear guidance inside of that partnership agreement, you absolutely need to make sure that if someone dies, even if you're young, like someone might get hit by a bus, like we don't plan for these things, it's unexpected, but it happens. If someone gets hit by a bus, you need to make sure that in your partnership agreement, it stipulates that if a partner dies, the other partners can buy their stake or interest. That way it doesn't go to some long legal battle or caught between family members who want the piece of the business or blah, 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 blah. Make sure that these two people have the right and that their partnership agreement stipulates that they can buy out any person that passes away in the partnership. That way, if they pass away, these people can simply buy the business or buy their stake and go to, so now this person is gone, they've been bought out, and now these partners both own 1/2 of the business, okay? Now, how you can make sure this is economically viable is to have a life insurance policy on this third or on all of your partners. Have a life insurance policy on all partners of the business so that if anyone dies, the other partners have the cash and liquidity to buy out their stake. This is going to be the safest thing for the business. It's going to be the best thing for the remaining partners, and make sure that the business is not hurt by the fact that one partner, and therefore a big chunk of equity, probably a board seat if you have a larger company, is incapacitated or passed away. Again, that partnership agreement needs to also state what happens if you're incapacitated or if a partner leaves in terms of buying this person out. But when it comes to death, this is one thing that people a lot of times forget about, is if someone passes away, you do not want their equity to be wrapped up in court, in between family members, in a will, all that garbage. You want to make sure it's very clear that these stakeholders, these partners, can buy out this person's stake, and you should make sure that's liquidity is made available by having a life insurance policy on all the members. I've seen this work very, very well, and I've seen it not work when people don't have it set up correctly in their partnership agreement. All right, so we've talked about partnerships. Now, let's talk about the C corporation. Now, I know some of you are going to be asking about all the different other types of corporations, but first I just want to focus on C corporations and the basic premise of a corporation in general. We'll get into some of the nitty-gritty and some of the finer details of a corporation like S Corp down the road. But when it comes to C corporation and a corporation in general, in 1819, the Supreme Court ruled that, they said that a corporation is defined as an artificial being, invisible, intangible, and existing only in the contemplation of the law. So what they were doing is recognizing that it's a legal entity, and as a legal entity, it means that you can file suit, you can be sued, you can hold and sell property, and you can engage in business operations as stipulated in the corporate charter. So the corporate charter is, you also might hear the word articles of incorporation or certificate of incorporation, but the corporate charter is those same terminology, and that is really just a document that shows that the corporation exists and tells the government what your business does. So as long as you have a corporation, it's literally like the same way that you are an entity. Now, your corporation is an entity, except it doesn't live. It's dead. It's lifeless. It's intangible. It's invisible. You can't even see it. A corporation doesn't really exist, except it's a legal structure. There is absolutely no person behind a corporation. So really, what the corporation does is it's a separate entity from the individuals who own it. All right, so we talked about a sole proprietor, and if this is Joe, and Joe is the owner of his business, he is also the entity, because his social security number, i.e. the entity number, this is the entity, the social security number is his identity. His sole proprietorship is his social security number. With a corporation, we have a corporation that is completely separate. So if this is the business here, this is a completely different entity than the owner. This does not equal, like this person does not equal the business. There is no relationship whatsoever. We're going to talk later on about like making sure it stays that way in terms of not moving money in between two and things like that. But from a legal standpoint, a corporation is a completely separate entity, and which really means that the owner, the corporation, not the owners, are liable for the debts of the business. This is very important. This is really what leads to massive wealth when people start to create multiple entities and corporations. And that is that if this business, oops, different color. If this business has debts and this business goes under, it tanks, does not do well, business goes under. When it goes bankrupt, it does not affect this entity over here, i.e. the owner, all right? So in the past, if you had a sole proprietorship and you went bankrupt, the business went bankrupt, they would come after, if you have debts, they would come after your house, your personal assets, everything you had. With a corporation, if this business has debts and it goes bankrupt, they cannot come after this person because they're literally different people. Like they have no relationship whatsoever. And so the entities are completely separate, and the biggest factor is that when the corporation, if it fails and there's debts, that the debts are not liable to the owner. That's the biggest change, and that's what allows a business owner to make massive risks. Is because at the very worst, if they have a corporation, you know what? Instead of making one store, why don't we make 3 stores? And instead of 3 stores, why don't we do 4 stores? And the reason is because they can take more and more risk, knowing that, hey, if we go belly up, the business will go bankrupt, and all of that debt will be wiped away, and it will not hurt me. All right, so it allows for a business owner to take massive risks, and is what allows business owners and people that use corporations to really excel. Like a lot of people, when they think about corporations and all the rest of it, they think about tax liabilities and things. And yes, definitely tax havens, and we'll get into that. However, the biggest reason why a corporation is so valuable is it allows you to take bigger risks without putting your own assets in being liable for those things, without putting them in harm's way, because if the business goes bad and there's debts, they can't come after you. They can't come after your personal assets. So ownership in a corporation is evidenced by stock certificates. All right, so you're like, well, if I'm the owner and I'm not in any relationship with this business, how do I actually own the business? How do I prove? Well, what happens is you are going to have, let's see if I can do this. There you go. So ownership in this corporation is evidenced by stock certificates, which stipulates the number of shares owned by a stockholder. Now, you're saying, oh my goodness, this seems very complicated to set up a corporation. It's really not. Basically, think of it like this. I have 2 different partners. I'm going to have 2 different stock certificates because I have 2 different I'm not even going to call them partners. I'm just going to say different stock. I'm splitting the stock in this business. And we're going to say there's 100 shares inside of this corporation. So there's 100 shares, all right? I'm going to have 2 different stock certificates. Let's see if I can do this again. No, I can't. There you go. 2 different stock certificates here, because I'm going to split the stock evenly between 2 different people, and this person's going to get 50 shares, and this person's going to get 50 shares. All right? Now, I could have any sort of scenario in terms of 60-40 or 30-70 or whatever, but at the end of the day, these stock certificates, they are going to stipulate exactly how many shares each shareholder, so in this case we have 2 shareholders, it's going to stipulate how many shares each shareholder has. That's what the stock certificate is. Literally, when you're setting up a corporation online, you are going to have who are the shareholders, and what's their stock percentage, or how many shares are you going to issue, and then how many shares are you going to issue to each stockholder. Now, if you're the only owner, if you're the only shareholder, you're going to get 100% of however many shares you have in the corporation. All right, so it's very, very simple. Especially if you're just by yourself and you do not have other people that you're splitting up stock with, very, very simple to get set up. Because literally, you're going to say, okay, I'm going to be the only shareholder. I'm going to make, it doesn't really matter how many shares you have at this point. Let's say you have, I want to make 1,000 shares, and I'm going to be the 1 shareholder, so 1 shareholder, and I'm going to have all 1,000 shares. So this stock certificate states that this 1 shareholder, which in this case is this guy over here, has 1,000 shares in this company. All right, so Mr. Bob over here is the 1 shareholder that has 1,000 shares. This stock certificate is what states that, and that's the only relationship he has to this business, is the fact that he holds a stock certificate to this corporation, okay? Now, this is a really great entity structure. Like I said, there's taxation benefits. Biggest thing is liability in terms of if things go bad, allowing you to take bigger risks. But there's also a great way to sell parts of the business, i.e. sell stock in the business without giving up control. Because in a partnership, if I do 50-50, or if I sell a piece of my business and I gotta become a partner in that legal entity structure, now they can have control in the business. Where in this scenario, let's say Bob over here is like, hey, you know what? I wanna sell off 200 of my shares. All he needs to do is go and into his corporation structure, say, you know what? I'm going to create another stock certificate. I am now going to have only, instead of I'm still going to have 1,000 shares in the corporation, but I'm going to have 800 shares. I'm going to sell 200 shares to somebody else. All right, now, he can still retain his ownership, complete control of the corporation by making sure he has all the board seats, all the voting power, all the rest of it. But when it comes to stock in the business, he can sell a piece of the company without having to go into a partnership with this other shareholder. Because now we're going to have two shareholders in the business. Now, this is literally what massive companies do, like Apple and Google and all the rest of it. They have millions of shares. They have tens of thousands, hundreds of thousands of shareholders, and all of those people, all those investors have shares and they have stock certificates in that business. At the end of the day, though, it's just a corporation with a number of shares. And at the end of the day, it has no relationship to any one person at all. That person can only own stock certificates. That way, if this business goes down, the value of these stocks go down, these stock certificates go down, yes. And the debt on this business, though, cannot be tied back to the shareholders. Very, very important. A great entity structure for tax liability, but more importantly, most importantly, it's a great entity for being able to take risks, knowing that if the business doesn't work out, your personal assets and your entity is not at risk. All right, so we're going to talk about some finer details and smaller types of legal entity organizations. But I want to kind of do a summary of the pros, the cons, and just comparison of some of the basic legal forms of organization that we've already seen. So what we're going to do is we're going to do sole proprietor. We're going to just do a comparison here. So sole prop, I'll call it. Then we're going to do partnership. And we're just going to do a general partnership for now, just for the sake of this example. We're going to talk about different types of partnerships and things like that. So general partnership, and then the last one is going to be our corporation. All right? So these are going to be the three different entity structures that we're going to talk about right now. All right, now let's compare these on several different fronts. Okay. So, sole proprietor. When we talk about sole proprietor, general partnership, corporation, three basic different entity structures. First off, the initial organizational requirements and costs. All right, so right now we're talking about this, and we're talking about the initial setup and costs. All right, so when it comes to initial setup and cost for a sole proprietorship, it's very cheap, minimum requirements, and honestly, in most states, there's not even a registration or filing fee. When it comes to general partnership, there's not a whole lot of requirements, but generally there's no registration even really needed or required, but we've talked about the fact that we do really recommend that you should do it, and a written partnership agreement, not legally required, again, but I strongly suggest it, all right? So this one's probably the easiest. We've talked about this before, easiest setup. And then a corporation is, probably the hardest one to set up in terms of, it's the most expensive, it has the most amount of requirements, there's filing fees, there's state compliance with most corporations for most states. And so when it comes to which one's the best when it comes to initial setup and cost, sole proprietorship or a partnership, they kind of win the game, all right? So they're definitely the winners when it comes to initial setup and costs. Now let's talk about the liability of the owner. All right, so now we've talked about initial setup and cost. Sole proprietor and general partnership have kind of won out on those. Then we talk about liability. Can't spell. Liability to the owner. All right, so liability for sole proprietorship is going to be unlimited, and for general partnership, it's also going to be unlimited, whereas with a corporation, it's limited, all right? And the reason for that is because, again, if you have a limited liability company and it's only limited to the investment in the company. Remember, they can't come after your personal assets, whereas they can in a general partnership or in a sole proprietorship. So in terms of corporations, they're the winner when it comes to liability to you as the owner. The corporation wins out. Now, when we talk about the continuity of the business, something happens to the owner, what happens to the business going forward? So first off, it's dissolved if you're a sole proprietor. It's dissolved upon the proprietor's death. So when the sole proprietor dies, the continuity of the business is over because the business is continuity. So when the sole proprietor dies, in terms of continuity, not good, because the business basically is done. When it comes to a general partnership, unless a partnership agreement specifies differently, the business needs to be dissolved. The partnership is no longer existing because there's not a partner, and needs to be dissolved upon withdrawal or death of a partner. So we've talked about this before. In a general partnership, when it comes to continuity, if an owner and a partner pulls out of the partnership or passes away, then that partnership needs to be dissolved and liquidated. We've talked about how you can mitigate that risk, but it's definitely a risk nonetheless. Now, when it comes to a corporation, the continuity of the business is really unaffected because it's completely separate than the owner, and really, if someone passed away, a shareholder, it doesn't matter. Like, the stock is still there, the business is completely separate than the owner, and so the business can continue on. And especially when it comes to just, passing that stock along. So again, when it comes to continuity, a corporation wins out. So I'm going to continue on with a few more variables. When it comes to initial setups and costs, sole proprietor and general partnerships a lot easier than a corporation. It's going to cost more money, take more time, have more registration, filing fees, all the rest of it. When it comes to liability, you have unlimited liability for a sole proprietor and general partnership, which means if the business does poorly, if you go bankrupt and it fails, they can come after your personal assets. Whereas in a corporation, the liability is much, much better because the business, if it goes under, they can't come after your personal assets. When it comes to continuity of the business, a corporation is also much better because there's stock in the business that can just be passed along. The business can move forward and not have any consequences, even though the founder or owner, a shareholder really, passes away. All right, a few more different variables, and just when we compare the different legal structures, let's talk about transferability. All right, so we talked about in the last video, transferability. If a founder or someone dies that owns stock in the business or is the sole proprietor, etc., how is it, what does it do to transfer ownership of these businesses? So when it comes to sole proprietorship, the sole proprietor may transfer ownership of the company name and assets. All right. When it comes to a partnership, this requires the consent of all the partners. This is a little bit harder to do. When it comes to the corporation, it's very easy to transfer the stock of the business and the shares of that stock and giving off the certificates of stock. And so therefore, very easy to transfer for the corporation. So this one is very difficult to say which one's the winner because it really depends, right? Like a small business, not so hard to transfer the sole proprietorship, general partnership, or the corporation. Like every single scenario is going to be a little bit different in terms of transferability. It really depends on the circumstances in terms of which entity structure is the easiest to transfer. Now, if we're talking about a really big business, probably a corporation. If we're talking about a certain type, like every single scenario of transferability is different. So this one is really not a big reason to choose between a different entity in terms of transferability of ownership. Now, next one is management control. All right, so management control. When it comes to a sole proprietor, they have absolute management freedom. Like because they are the business, they have absolute control. They have freedom to do whatever they want. When it comes to management for a general partnership, the majority vote of the partners is required for control. So if someone wants to control and manage the business, they need to have majority stake ownership, or they need to have a stake that's greater than their partners in order to make a decision or to have control of the management of the business. When it comes to a corporation, the shareholders have the final control because they're owners, everyone eventually does, but usually there's a board of directors that controls company policies. All right, so even though you might be a shareholder in Apple and have some stock, you don't make decisions for them. You don't make decisions on hiring, you don't make decisions, legal matters or financial or marketing decisions, just because you're a shareholder. It does not matter. There's a board usually that makes those decisions and policies. So again, in this regard, when it comes to management control, every single scenario is a little bit different. Like we talked about absolute control as a sole proprietor, which is great. But again, it really comes down to every single instance and scenario is different. That's why it's very hard to tell people sometimes, which one definitely needs to be the right thing for them. And some people say, oh, no, you have to use the sole proprietorship, or it's so much cheaper. You don't have to do a different tax return or whatever. That's okay, that's fine. We're going to talk about taxes in a minute, but there's definitely things that you need to take into consideration because the scenarios that might happen down the road are going to be different. And that's why I'm not going to give anyone a winner. There's no distinct winner in these categories of transferability or managing the management control, because there's just so many different scenarios in business. Now, when it comes to raising attractiveness, let's just call it attractiveness for raising capital. So when it comes to raising money, people that want to invest in your business, when it comes to sole proprietorship, it's really limited to only the proprietors, the owners, personal capital, because no one can invest in this business. It's really up to them to invest their own personal capital, and that's it. When it comes to a general partnership, it's limited to the partner's ability and desire to contribute capital. So we're trying to attract capital into the business, but it's really limited to just the partners, and if they're able to and willing to continually put money in the business. With a corporation, it's usually the most attractive form and entity for raising capital because, again, it's very easy to give pieces of the business, i.e. stock, away to different shareholders, and they can do that very easily. If you're trying to raise capital, you can give them equity very simply for that capital. So definitely a big winner for a corporation when it comes to attractiveness when you're trying to raise capital. All right, last one we want to talk about is income taxes. So there are definitely tax implications that depend upon the entity structure that you choose. So remember, if you are a sole proprietor, when it comes to taxes, any income that you make from the business is taxed as personal income to the proprietor. Because remember, your Social Security number is used as identification for this. Therefore, when you make your tax return, your income tax is basically, if you made profit, that is going to be taxed at a personal tax rate. All right, so that is the sole proprietor. You're going to use that same tax return. Any profit from the business is exactly income on your personal tax return. Now, when it comes to a partnership, income from the business is taxed as personal income to all the partners. Pretty much the same thing. So if the business made $500,000 and there's in profit, and there's 5 partners, and they all evenly own the partnership, then $100,000 would be going to each partner, and that $100,000 would be taxed as personal income on their tax return. Now, the C corporation, the bottom one, is taxed on its income, and the stockholder is taxed if and when dividends are received. So what that means is money comes into the corporation gets taxed a corporate tax rate on those profits, and then any distributions or dividends given to the owners or shareholders of that corporation, that is the only money that is taxed when on their personal tax return. This is why a lot of people would say that C corporations are definitely a great haven for entrepreneurs. Now, there's definitely scenarios where these, I don't give C corporation absolute pass as the best thing for taxes. Now, generally, if you're growing, yes, I would say you want to have a corporation. However, the reason that I'm not going to give this an absolute pass is because there's some instances where when it comes to a very small business, that it actually makes the most sense to have a sole proprietorship. Because if you're only doing like $5,000, $10,000 a year or $20,000 a year, in terms of simplicity and just getting something up and running and just putting it on your tax return, probably going to be the best thing to do sole proprietorship. If you're in a partnership, there's definitely scenarios where having a partnership is going to be the best tax because you can evenly distribute those profits, and there's definitely advantages to that. And a lot of doctors and lawyers use that, and so. But for the majority of us watching, a corporation is going to be the best when it comes to income tax because you can really move money and distribute the money in terms of dividends or distributions to you as the owner, i.e. shareholder, and you get taxed on that at your personal income tax rate, but then the corporation itself is taxed on the profits of the business. So money comes in, profits on the business, and then you can give yourself a W-2 and pay yourself as an employee, and then that that money you'd be taxed on at a personal level. But that gives you the ability to kind of manipulate how much money you're getting, the dividends and the distributions, to make sure you minimize your liability in terms of taxes by making sure whichever tax rate is lower, either corporate tax or your income bracket, that you make sure, your personal income bracket, that you make sure you lower your tax liability. So a lot of different scenarios and things like that. Most of the time, if you're trying to start growing your business, though, the bottom line is, though, I'm probably going to push you eventually to become a corporation. This is a great place to get started, a sole proprietorship, if you're just getting started, brand new, don't want to go through a bunch of hassle. And when it comes to general partnerships, don't do it unless you actually do have partners involved and there's a very distinctive reason as to why you're doing this and not just distributing stock via a corporation. General partnerships a lot of times are in doctors, lawyers, those practices where they all share an office, things like that. But when it comes to most entrepreneurs watching this, you can get started with a sole proprietor. Eventually, you're going to move to a corporation once you can afford the extra little cost of getting a license and the just the structuring of it, and maybe have an attorney and get your articles of incorporation and all the rest of it. But at the end of the day, once you start really making profit, this is the part that's going to save you a lot more money than it takes to get this set up. So at the end of the day, usually that's where most businesses go. Now we're going to talk about some finer details of different types of corporations and some finer types of entity structures that are available. All right, so in the last video, we talked a little bit about the comparison of the different entities in taxes, but it deserves its own video. Like if Uncle Sam, it's so important, we better make his own video here so he's not offended, because if death and taxes are the only thing that are for sure in life, we should make a video about taxation. All right, so we're gonna look at the differences of the entity structures when it comes to taxes, and we'll talk a little bit more about this later on, but this is more or less a higher level view so you can understand. And that's because next video and the video after, we're going to talk a little bit more about different entity structures that actually are formed, and mostly their differentiation is just around taxes. But we're going to use really just the same three that we've been talking about the most. Sole proprietorship, we have a partnership, and we have a corporation. All right, and you're going to see why in just a second, why it's important that there's further breakdown of the corporation side of things when it comes to taxation. But for the sake of this example, let us talk about these three. All right, so when it comes to sole proprietorship, very, very simple. We've talked about this before a little bit. I won't go too much into depth, but I want to make its own video here. Sole proprietor, essentially the profits of the business are taxed at the same rate set by law for the individual. So if I make $100,000 in profit, okay, so we're going to assume that they make $100,000 in profit. We're going to assume that the tax rate so tax rate for personal is going to equal 30%. And then for corporate tax, corporate is going to equal 20%. Just for the sake of this example, this is going to vary all over the place, but for the sake of this example, we're going to use this, all right? So sole proprietor profits $100,000 in the business, and that is going to be taxed directly at the personal tax rate of 30%. So we're going to be paying $30,000 in taxes as a sole proprietor, because that $100,000 in profit from the business basically goes directly into a Schedule C, it's called, on a tax return, and is going to be taxed at that 30% rate of taxes. Now, partnership. So a partnership is basically the same thing, except now you got multiple people involved, right? So the partnership itself does not pay taxes. It's not its own separate entity, separate from all these people. So the partnership itself does not pay taxes. The profits are recognized as income on the personal tax returns of all the different partners at the given percentage that is reflected on their agreement. So for example, if in this case here, if there was 3 partners, so we got 3 partners, so 3 partners, and each of them made $100,000. So the profits of the business, let's say $300,000. The $300,000 in profit. Each partner got $100,000 in profit. So essentially, they're still going to be taxed $30,000 each. each partner. And we're assuming here that each partner has 33% or a third of the business, because with the partnership, someone might have 20%, someone might have 20%, and someone else might have 60%. And then this $300,000 would be divvied up based upon that percentage in their agreement, and then that would be the determinant of how much they actually made on their income, and that is taxed at that same personal tax rate of 30% on their tax return. Now this is where it gets interesting, and that's a corporation. So the corporation is its own legal entity all by itself. And so because of that, it is going to get taxed as a separate legal entity, and it reports its income and pays taxes on its profits, completely separate than the personal, the owners or the stockholders of the business. It even has its own tax return. So the same way that you would get your personal tax return, well, in a corporation, the corporation gets its own tax return, and then you would get, as the owner, a salary. And again, that needs to be a reasonable salary. It's important that it is reasonable, that you can justify that. If you take a reasonable salary from that corporation, and then your wages in that case are a write-off for the business, and so you only pay taxes on the money that you get as a salary. All right, we're going to talk about some other things in just a moment. But when it comes to a corporation, what is so cool about this is the owners or the stockholders, they take their reasonable salary, and that's taxed as personal income, but you can write off that salary as a business expense, and then the corporation only pays taxes on the profits that's left over at the end of the day. All right, so let's go through this example. Again, $100,000 is going to be the profit of the corporation, $100,000 in profits. Now, what we're going to do is we are going to take a $50,000 salary. So let's take a $50,000 salary from the business. Because, hey, like, we're the owner, we take a salary, maybe, about $900 a week or whatever it is. But then we're also going to keep $50,000 in the business, because this is profit. We're going to keep $50,000 in the business. $50,000 is going towards our salary. So what's going to happen is this $50,000 is the profit for the business, whereas this $50,000 is our personal income. So this is going to get taxed at 30%. So 30%. Which is going to mean $15,000 is going to be what we pay in personal income taxes. Now, we're going to take this up here, this $50,000 in profit, and it's going to get taxed at a 20% corporate tax rate. Remember, the corporate tax rate is here. Again, we're assuming these brackets. Usually this is actually higher than 30%, but we're just going to go with these numbers. And at 20% here, that's going to equal $10,000 in corporate taxes. So at the end of the day, the total amount of money that you actually give Uncle Sam is equal to $25,000. All right, which basically means you save $5,000 in this scenario in taxes overall, due to the fact that you can get $50,000 in this scenario, taxed at a lower corporate tax rate, and only give yourself a reasonable salary at that higher tax rate. So this is the beauty of a corporation, is being able to give yourself a salary and then have a lower tax bracket or tax level or percentage in a corporate tax. Now, tax plans change all the time based upon the government that's in. So if you're watching this in 10 years, there's a chance that your corporate tax might be higher than your personal income tax, in which scenario you're going to put more money into your salary and less money into keeping it in the business. So that's a big problem or big thing to think about, is these numbers do change, and that's why at the end of each year you're going to sit down with your accountant and actually go over these numbers, see how much money you should be taking from the business as your salary, how much you should be keeping in the business. It's okay to take a big chunk of salary at the end of the year, as long as it's reasonable, and usually they'd rather you have it on a consistent basis. But it's okay to take a big chunk of salary at the end of the year, and usually the IRS does not raise a big eyebrow to that. And so you can meet with your tax accountant and figure out what is the best scenario in terms of distributing the profits from the business. And I'm saying that because in our businesses, we are usually the 100% owner of the business. So we can determine how much our salary is. We can determine how much money money stays in the business. But when it comes to massive corporations, now we're talking about like, not just our local, corporations, but like we're talking about like the corporations that are on the stock market. All right. So this is where it gets a little bit interesting, because a dividend from a publicly traded company, a dividend is going to be taxed twice, because a dividend is going to be taxed at the corporate level, and it's also then going to be given to you, that dividend, and then you are going to have to pay that dividend as personal income. So this is what's called double taxation that can occur when you have a C corporation. All right, so now in the next video, we're gonna talk about the difference between these types of corporations, but in like a massive large companies that have more than 100 shareholders, for example, big companies in the stock market, they give what's called dividends, or pieces of their profit they will give to their stockholders. If they give it to them as a dividend, not only is it recognized as profit for the business and that's taxed, but then when that dividend is given to the investor, the stockholder, now they are going to get profit, or they're going to see income that's going to get taxed at a personal level. So that is in the case of a C corporation, and that's why there's a new type of corporation we want to incorporate and talk about, and that's called the S corporation, which means that it's for smaller corporations like we can use, that allows us to not have that double taxation and not get taxed at a corporate level and at a personal level when we give ourselves distributions from the business. So stay tuned for that. If this doesn't make a lot of sense to you, just search on Google and watch videos about the difference between S corporation and C corporation. But let's talk about S corporation, and I think this will clear up some things. But right now, all I want to talk about is the overall taxation of a sole proprietor, a partnership, and a corporation, and how you can use corporations to really save yourself taxes by simply giving yourself a reasonable salary, getting taxed at a higher personal tax rate, but then getting taxed at a lower personal tax rate, or lower tax rate for corporate tax. What I didn't even make into consideration here is that $50,000 is probably going to go into a lower tax bracket than $100,000 like the sole proprietor. So in reality, this person is probably at 35%, and they're going to be at, say, 25% personal income. So again, you're able to reduce what tax bracket you even go into based upon really manipulating your salary versus what the income or the profits are retained inside the business and paid at a corporate tax bracket level. So very important to know what those numbers are here to be able to know where you want to put more of the money towards, and that's what an accountant should really help you with at the end of a year. All right, so now we're going to talk about a couple different other types of entity structures that we haven't mentioned yet. They're sort of hybrid between kind of the three common ones. We've talked about sole proprietorship, partnerships, and C corporations. Now let's talk about some other ones. Let's first talk about limited partnerships. All right, so a limited partnership, as implied by the name, partnership, is going to have a limited partner, or limited partners and general partners. All right, so remember back when we talked about a regular partnership, it's going to be very different because, again, in that scenario, everyone was given they're all stakeholders, they're all completely involved in the business, and they're all liable for the success of the business, the liens of the business, etc. With a limited partnership, what it allows is it's a partnership with at least one general partner and one or more limited partners. The limited partners only can really give capital. They only give money, invest money in the business. They do not have any management say. They don't say what goes or who gets fired or hired or anything. They have no management involvement, and they have limited liability. So they're not responsible if the business goes bankrupt. Only the general partner is going to be responsible. So inside of here, we got the general partner. They're going to be the one that is involved in management as well as the liability. Okay? Then you have a limited partner, and they are going to have no management say, and they are limited in their liability, okay? So that's what a limited partnership is. This is very common with like doctors and lawyers. When a lawyer has an attorney, they have an office and it's their name, Bob Ellison Attorney's offices. But then underneath him, he has other lawyers working for him. He would be the general partner, and then they would be limited partners because they don't manage it and they still are part of the firm. That's where that kind of firm practices, same thing with doctors. It's where it kind of becomes professional. We'll talk a little bit more about professional partnerships in a second, but that's kind of the concept is, look, when there's one person that's managing it on a day-to-day basis and they're really liable for the liens of the business and everything, a limited partner is someone who only invests money. They might even work there, but they do not have any management say, and they are limited in their liability. Now, the next thing we want to talk about, another entity structure we want to talk about, is S corporations, all right? S corporations are awesome. It's a type of corporation that offers limited liability to its owners, like a regular C corporation that we've already talked about. That's what, when we've been saying corporation, we've been talking about a C corporation. Well, an S corporation is something that I feel is really mostly small businesses are going to use S corporations. Most of us are not going to have a C Corp, but let me explain why. So first of all, an S corporation doesn't pay income taxes, but rather passes taxable income or losses on to the shareholders. So the shareholders or the stockholders of that business, of that S corporation, are going to get the monies, the income and the profits or the losses is going to be directly handed to them, and then they would pay personal income tax on those profits or deductions, I guess, if there's losses, okay? Now, what this does is it prevents double taxation, because when we talked about C corporations, remember, you had to pay taxes at the corporate level, and then those profits would then be distributed to the shareholders, and then they would have to pay taxes because it'd be recognized as income, as personal income, and they'd be taxed again. So to prevent double taxation, the government allows for S corporations to basically create these pass-through entities, which means the money goes from the corporation directly to the shareholders without being taxed at the corporate level. All right, so a couple things that are required to be an S corp, right? When you think about Apple, Google, all these big corporations, they are not S corporations. If you're going to be doing public tax, trading on the stock market, on a public stock market, you're not going to be having an S corporation. S corporation is for small businesses, and in my opinion, really kind of middle-range businesses. Like, you're not going to be usually starting a corporation from day one, a lot of times, but you aren't going to do it when you have 1,000 or 1,500 employees. That might be more like a C corporation, for example. Just for example, an S corporation is usually a mid-sized business. And so a couple of restrictions, though, that are required in order to have an S corporation. Number one, you have to be domestic. So you can't have an international with offices on the other side of the country or other side of the world. Can't do that. It has to be domestic. Number two, there has to be less than 100 stockholders. All right? So you can't, that's why you can't have this on the public market. Like, you can't have an S corporation and have thousands of stockholders. Less than 100. You also must operate on a fiscally, you have to operate on a calendar year basis. So you got to operate from January to December. This is evident too if you look at the stock market. Fourth quarter for some businesses might be December, January, and February, and this doesn't even make sense. Well, for S corporations, you can't do that. You have to operate within the 4 quarters of a calendar year. Also, for an S corporation, partnerships, corporations, and non-resident aliens cannot be stockholders. All right, so it's got to be primarily, it needs to be personal people. Like, you can't have corporations. Sometimes certain estates and trusts will be allowed to be stockholders in an S corporation, but for the most part, it needs to be individuals, and you can't have corporations and partnerships that are a stockholder of an S corporation. So again, this is really mostly a taxation thing in terms of having all the benefits of limited liability and having the corporation still separate from the owner. However, there's not a separate tax on the corporation before it comes to the stockholder. That money, that income is just passed through, a pass-through entity, goes directly to the shareholder, and then they would pay personal income taxes on that money. So again, a way for it to be able to hedge against that liability, but also have the benefits of having the corporation and something that really, I believe, a middle-sized business, something that people usually do not from day one, but as the business begins to grow. And this is the one that's most common, something we haven't even talked about, and that's the LLC, or limited liability company. And this is the most common for small businesses that are just getting started, and the one I recommend to get started. The reason is because, again, every single situation is different, but for most small businesses just starting out, LLC is great because it's very easy to set up. It's literally like a sole proprietorship in terms of ease of getting it set up and cost, and then but it gives limited liability. In other words, you're not directly involved, and there is somewhat of a distinction, like you as a sole proprietorship, if the business goes under and you get sued or you have debts and you declare bankruptcy, they can still come after your personal assets. With an LLC, if done correctly and the business is made sure it's kept separate from your personal finances, you absolutely are giving yourself somewhat of a liability protection by not making your personal assets be on the table in the case that there are debts that go bad, or bankruptcies, or if the business gets sued. So in my opinion, it's kind of the best of both worlds, the simplicity of a sole proprietorship, as well as and yet at the same time shielding you from liability like a corporation. And so very easy to set up, and a single member LLC is treated very much like a sole proprietor in the fact of just the ease of setup. The cost is really low, but it's just a great way to get started, and it offers some liability protections, not as strong usually in court as, say, a corporation to some extent. But again, if you're going to have an LLC and you want to have that liability protection, you need to make sure you keep the finances of your personal life and the business as separate as possible. Because if the worst comes to worst and you go to court over a lawsuit or a bankruptcy, if you have been commingling your personal and the business, they're going to say, look, this LLC is only here for taxation purposes and for liability protection purposes only, and it's going to be null and void. And so if you're going to have an LLC, you got to remember you got to keep your personal finances and the business finances very separate. Otherwise, this whole limited liability thing can be thrown out in court. So keep that in mind. All right, so now we're going to talk about 3 other types of entity structures. Again, these ones are less popular. Most of you won't be using these, but just for the sake of knowledge, let's talk about these 3 different types of other corporations and entity groups. The first one is the professional corporation. And as the name states, usually this is used by professionals such as doctors, lawyers, attorneys, chiropractors, engineers, architects, accountants. But the big thing here is this type, the professional corporation or professional corporation entity structure does not prevent someone from getting sued due to malpractice or negligence. So usually this isn't even used, and in most states it's going to be used instead as an LLP, which is a limited liability partnership. Again, one of the biggest reasons for the type of entity structure you choose is for limited liability, whereas in this case, you do not get that limited liability due to the fact that if you do malpractice or negligence, like if you hurt someone inside of an operation as the doctor, you can be sued. Whereas inside an LLP, a limited liability partnership, you get some liability protection. All right. So even though this is not commonly used, depending on the state that you're in, most of them are going to be using an LLP, even though they are part of this type of group of individuals and a profession that requires a license. That's really what determines a professional corporation. Is if you need a license to be part of that type of profession, then you could start a professional corporation. Now, the next one we talk about is a nonprofit. It's a nonprofit corporation. Now, as the name states, you actually create a corporation and then claim nonprofit status, okay? So you cannot have a nonprofit for a sole proprietorship or a partnership. You create a corporation and then you claim your nonprofit status. So this type of corporation, once you've created the corporation and it's come under the umbrella of being a nonprofit, is established to serve civic, educational, charitable, or religious purposes, and it's not for the generation of profit. And in the articles of incorporation, when you create your corporation for your nonprofit, you actually have to spell out the limitations on the enterprise. Be like, look, we are not making profit. Here's what we're going to do to make sure we do not make profit. And this is going to be definitely harder. This entity status is going to be much harder to find investors. Usually investors want a return on their capital and a return on their investment. And so it's a lot harder to find investors. It's also a lot harder to get capital from a bank because at the end of the day, they're putting their money at risk and they want either a return or at least to know that you are going to be striving for the financial betterment of the business and the corporation, whereas for a nonprofit, they're not maximizing their returns. And so they're generally not used for small business. The last one we want to talk about has become a lot more popular over the past decade, and that's what's called the B Corp. Again, most of you aren't going to use this, but in case you hear it come up. So a couple examples of companies that are big and are B corporations are companies like Etsy, Patagonia, Warby Parker. Some of them, as they've gotten bigger, and if you're watching this later on, they already might have switched out of being a B Corp, especially when they go public. However, a B corporation is basically a form of corporation that creates a positive social or environmental impact while maintaining high standards of transparency and accountability. So basically they're forced to share a lot of their numbers. They're forced to really show, hey, this is our mission, our purpose for social good, whether it be environmental or socially, and they gotta actually prove and track towards that mission. And so the B corporation, a lot of people think whoa, does that mean I get tax incentives like a nonprofit? No, you don't. A B corporation has no tax incentives in comparison to an S corp or a C corp. But really what it's all about is transparency, right? So the transparency is actually enforced by what's called the B impact reports. And so when I say B impact, I mean B impact reports. And so this is actually going to be regulated that these B corporations are transparent with the numbers. They're sharing what their environmental impact is when they're creating their products. They're sharing what their social good or social evils are and what they're trying to do to change the evils, obviously. So the B corporation also binds the company to policies that might not be in the best interest in terms of profit. And so this can be a little bit disturbing for a potential investor, whereas sometimes customers, this is what they love. Sometimes this is why employees would join a B corporation. And investors worried because what if you have a down year and you need to adjust some things financially in the business, but because you're a B corporation and you got to stay focused on the mission, like the social good or the environmental good. And so sometimes decisions are not made in the best interest of dollars and cents in a B corporation. Whereas an employee, they might literally take a lower paying job just to be able to be part of a B corporation where there's transparency, accountability, positive change. They're driving towards that mission. And then customers also sometimes much more loyal to a B corporation because they see that they're doing good and they see how open and honest they are with their practices of creating their products and treating their employees correctly and driving towards that mission of positive change that they're trying to create. And another kind of negative thing is that it does permit shareholders to directly sue the directors if the company falls short of their social mission. So if they're not tracking towards, if they have certain metrics and numbers that they're trying to hit in terms of environmental friendliness, or if they're trying to drive towards reducing their carbon impact or certain things, if those things are not being done correctly in the minds of shareholders, they can actually sue the directors directly. Again, that promotes a lot of accountability and promotes a lot of transparency, and that's why B corporations have become pretty much more popular in the past decade as companies are more mission-minded and focused on what they're doing socially or environmentally. But usually not where you're going to start, and definitely going to be a little more challenging to explain some of these things to potential investors as you grow your business. All right, so now I know for some of you, like, just give me the bottom line. Like, how should I start my business? For most of you, I'm going to give you a recommendation for what type of entity structure you should use, when you should change, etc. All right, so I'm going to give this kind of going on a limb. Most people will not share this because it is going to be very, very specific to your circumstances, your state, what type of business you're in, etc. But for the most part, this is my recommendation I give to people, and that is to start an LLC when you start your business. So we've talked about why an LLC is better than a sole proprietorship. It gives limited liability. So if something goes wrong in the business, in terms of bankruptcy or someone sues you, if you've kept the business finances completely separate than your personal finances, it's a big asterisk. If you've done that correctly and kept the company completely separate, then they can't go after your personal assets, all right? So they can't come after your personal house. If your house is owned under Mike Andes, but then your LLC is Mike Andes Enterprises LLC, for example, if I keep the business completely separate and someone sues my business, the LLC, they cannot come after my personal home, my car, etc., things that are in my personal name because of the LLC. Now, the reason I recommend you start with this is because it is very simple to set up, right? Most states allow you just to do this online. It's like $200. Literally in 15 minutes, you can set this up and get rolling. Very, very simple to get started. You do not need articles of incorporation and a whole bunch of other things like you would if you were starting an S corporation or a C corporation, or even a partnership. So LLC is a great place to get started, and just for ease of use getting started, as well as that limited liability. Now, there's gonna come a point in time when I recommend you switch to an S corporation, all right? So again, this is very, very specific to your needs, your industry, all the rest of it. But there will come a time when you need to switch from an LLC to an S corporation. The main reason really is for taxes, because for an LLC, you're going to be taxed a self-employment tax, okay? Now, this self-employment tax can change like literally with every single administration. So if you're watching this in 10 years, this might be different. But right now, as of right now, the self-employment tax is 15.3%. What that means is if I'm in a single member LLC, which means I'm basically an LLC with one owner, 100% of the stock is under one owner's name. Any sort of profit from that LLC is really treated exactly like my own personal income, and I'm going to be taxed a self-employment tax. This is a self-employment tax. Self-employment tax of 15.3%. Again, this can change from year to year. So what stinks is, hey, if I make profit from my business, I gotta pay a self-employment tax, plus I then gotta pay income taxes, okay? Whereas with an S corporation, what I can do, and by the way, this self-employment tax covers things like Medicare, Social Security. I think 12% of it is Social Security, 3% of it is Medicare. But the S corporation, because I'm not self-employed, technically, because remember, an S corporation is a completely separate entity from you, and I take a paycheck from the corporation. So I am still going to be paying taxes on that paycheck, but any sort of leftover income or leftover profit is just going to be going directly. I'm going to get taxed on it from a income tax perspective, all right? So over here, maybe my income tax bracket is 30%, just for the sake of an example. So this is going to be income tax. And any money from this LLC, I got to pay 15.3% self-employment tax because I'm self-employed, and then I got to pay 30% income tax, for example. Now over here, I am going to, take a salary from the business, a normal salary based upon what you are worth to the business, and you want that to be lower because traditionally, you don't want to inflate your salary coming from your corporation, because usually this is going to be taxed at a higher rate than the profits of this business that are just going to go directly down to your 30% income tax. Just for the sake of this example, it might, via different tax bracket or whatever, but just for the sake of this example, you do not have the self-employment tax. And that's the main reason why you're going to switch from an LLC to an S corporation. And again, laws change, every administration changes this up when it comes to self-employment tax. However, the main reason you're going to switch from an LLC to an S corporation is to avoid this self-employment tax due to the fact that 100% of your profits here, so this is the big factor, is that 100% of your profits are going, 100% have to be taxed here, and then they're taxed here. Whereas here, I can take some of my money out as a salary and probably get taxed pretty substantially. Let's say it's like 25%, just for the sake of an example. But then I can not have to pay any sort of self-employment tax on the profits of this business. And because it's a pass-through entity, the profits basically just come to me personally, and I have to pay my income tax on the profits from the business. So that's really the main reason to go from an LLC to an S corporation. I recommend you start with this. And when the big question mark here is, when do I change? When do I go from an LLC to an S corp? Very simple. When the business starts making a lot of profit. Because again, we're trying to get started with the LLC. The first couple of years, you're buying equipment, you're growing, you're hiring, you're doing all these things. At the end of the day, a lot of times you're just breaking even. And so an LLC, you do not have to create a separate tax return. So again, more administrative costs when you have a corporation versus an LLC. So usually a great place to get started. But when you start making a bunch of money, like you're making $100, $200, $300, $400,000 in profits each year, all of a sudden this 15% or any sort of self-employment tax starts to become very, very unfriendly to you, and the tax man starts taking more and more money, and that's when you are willing to pay some extra money for your articles of incorporation, going to an attorney and getting it set up, having a separate tax return every single year. And again, those are extra costs, administrative costs you don't need if you're not making a bunch of profit. When you start making a bunch of profit, it's time to switch over to the S corporation, so you don't have to pay that self-employment tax. You can take a salary out of the business because you are not self-employed. You are employed by your corporation. You make a salary, but then the profits of that corporation go directly to you. And because it's a bypass, remember this is not a C corporation where the corporation is taxed here and here. This is an S corporation where the profits of the business directly go to you personally and you pay income tax on that. So I hope that makes sense. That's my recommendation. Start with an LLC. When you start becoming very profitable, switch over to the S corporation. It's worth the extra hassle and it's worth the extra cost for getting your tax return done, getting it set up with your articles of incorporation, etc. All right, so we're not going to talk a whole lot about creating a board of directors because I think for most of you, you're not ever going to get to the point where you have directors and you appoint an entire board and the whole 9 yards. So I want to talk about something that's a little bit more practical, especially as your business starts to grow and starting to expand and you're still a small business, under 100 employees. This is something that I think is really, really good idea. And instead of getting a board of directors, instead of getting a board of directors where they literally have voting power, they could literally go against your authority as the business owner, they can vote you out as CEO, they can inflict change in the business. Instead of having a board of directors, have a board of advisors. So board of advisors. Now, traditionally, with a board of directors, there's some sort of liability for them to be on the board as a director because they have some liability in terms of if the business does poorly, people can sue them over certain things, they have to make decisions for the business. And so a board of directors, a lot of times for a small business, a lot of people don't want to join a board of directors just because there's a certain amount of obligation, but more importantly, it's the liability of joining this company. And as a director, you actually have some skin in the game. And if the business does poorly, you could be affected. Like someone could come sue you. And usually if someone on their board of directors is going to be affluent and they're going to have money and they do not want people to use them being on a board of directors of a small business as an avenue to sue them and try to get their assets. So again, board of directors for us as small business owners, usually not super useful. Now, a board of advisors, I think is great, especially if you're well connected in your local community. You can get people that are simply advisory to you in your business. These can be people that you respect in your industry. These can be just business leaders in your local area. This can be family members that have a lot of experience and used to own the business and have passed the business along to you. Now, this board of advisors can be very, very valuable. You want to treat them with all respect. They don't have a whole lot of usually financial, like you can't pay them to be on this advisory board. Like usually it's gonna be like a nice dinner, or maybe you take them away for an evening and you do some sort of entertainment. But at the end of the day, you want, if you can create this board of advisors, it can be very, very beneficial to get 3 or 4 or 5 of these business leaders and advisors in the room and run by them your budget, run by them your marketing plan, run by them what the plan and strategy is for the upcoming year. Maybe it's an annual meeting, maybe it's quarterly. Remember, if you're gonna get really good board of advisors on your board, they're probably gonna be very busy. They're gonna be very, very involved in their own businesses and their own investing. So you're not gonna probably get like a weekly meeting out of your board of advisors. Don't expect that. If you got quarterly, I'd be surprised. Usually even annual is some benefit to you though. If you spend $1,000 or $2,000 on a really nice dinner, maybe some entertainment, and try to get close to them, get their advice on your upcoming year's plans, a potential big key hire in the business, a pivot, a change, the growth or expansion of your company, they can be very, very valuable. Not only would you be able to increase the business and help the business, usually if you can connect your board of advisors who want to get to know other board of advisors on the board, that can be beneficial for them as well. So just keep in mind, if you're doing a board of advisors, it's probably the place you're going to start, because board of directors gets very complicated in terms of liability for them, as well as they have a lot of power if you actually formally create a board of directors. Whereas with that board of advisors, it's really just advisory information only. They can't kick you out, they can't overturn your decisions, and you really have the full autonomy to control the business, whereas with board of directors can kind of put some handcuffs on you. So that's my suggestion when it comes to directors, is if you're a small business and you want to control the company and you don't want to give away shares or any sort of interest in the company, stick with the board of advisors for now. Try to find someone locally in your business that you look up to, or locally in your community, in the business community that you look up to, or better yet, industry-leading professionals that you somehow have an in with that would be willing to meet once a year or talk with you. And ideally, you get a couple of these people in a room, and they have some great ideas. If they've been in the entrepreneurial game for 10, 20 years, hired lots of people, maybe they're retired, that's an easier, usually person to get on your advisory board, someone that has retired, done really, really successful, and maybe balances out or complements certain elements of your characteristics, your aptitude, your personality. They might be able to balance you out, offer some opinions or advice or ideas that you didn't even think of. So board of advisors is where I would start. Obviously, you get bigger, you get a really big company, you're gonna need a board of directors usually, especially when the investors get involved, because the investors want the board of directors to keep you in check as the owner. All right, so a term you've probably heard before, but I want to talk about quickly before we talk about financing, is bootstrapping. And honestly, really one of the most common ways of starting a business, and that is starting a business from your savings and starting and growing the business using the profits from the company. The reason, I don't know why, there's probably some reason why they call it bootstrapping, but I kind of look at it as like, you know, people say it's hard to pick yourself up by your own shoelaces. I kind of look at it the same way. Like bootstrapping is very hard because you're literally trying to use your own force to pull yourself up. It's very difficult. So I want to talk about the pros and the cons very quickly before we talk about financing and loans and getting money from friends and family and all the rest of it. But bootstrapping is really the most common way to start your business, just using the money you have, and then as the business grows and gets more profit, continually investing it back into the business and growing. So the pros, what are some of the good things about bootstrapping? All right, one of the best things about it is that you have ownership of the business. Like you control the stakes of the stakeholders. You can control 100% of the company. You don't have to give away pieces of it. You don't have to give away equity, because usually when you're taking loans or you are, raising money from investors, you're giving away equity. And there's gonna be a certain amount of, number two, control that you give away when you are not bootstrapping. So it's definitely a pro of bootstrapping. So you get complete control of the business because you're using your money and you're using the profits in the business, and you get to determine how those are being used, and you get to control where the business goes and what it does, and you're not having exterior forces of a bank telling you, hey, you need to produce, grow here, or you need to make sure you do this, and they have all this leverage against you because you owe them money, or potentially you have an investor. And so control is a massive part, a pro of a positive thing about bootstrapping. Another thing is keeping your business. So especially if you're doing a multi-generational business where you want to pass the business on to the next generation, bootstrapping is very good because you don't have a third party that potentially might change their mind and not want to be involved in the business. Like a bank might call a loan, or they go out of business and they're like, hey, we're stopping all these loans, we need it paid up in the next year. And that can be very difficult on the business and literally cause someone to shut down. Or an investor be like, hey, I'm out and I don't want to be here for 20 years and I want my return now, or whatever it might be. Traditionally, bootstrapping gives you the most control over keeping the business for a multi-generational business. Again, the thing that I love probably the most about bootstrapping is that forces a solid business model, a solid business plan, and more importantly, it just really concretes and requires to have good business fundamentals, which is be profitable and do business decisions that are sustainable and keep you in business for a long time. Sometimes getting a whole bunch of money from a bank or investors leads to short-term decisions or not thinking about the future in 20 years, instead just being like, oh, I got all this money, I can do whatever I want. And they make poor business decisions, fundamentally poor business decisions, and not focusing on profit instead they focus on these other metrics that maybe in the long-term growth, they can, make the business work profitably. But what's great about bootstrapping is you need the profit in order for the business to continue. And the business lives and grows on the profits. Therefore, you try to get to profitability as soon as possible. And then you ensure that the profitability is healthy. And that leads to a sustainable business. And a lot of times the downfall of companies that don't bootstrap is that they do run out of cash, or they are focused on metrics outside of just the fundamentals of customer acquisition and profitability, and that gets thrown out the window because for metrics outside like growth or user growth or clicks and all these things that don't actually drive the business. So those are the pros for bootstrapping: using your own money and then using the profits from the business to continually grow the company as it begins to expand. Now, some of the cons. Honestly, survival rate. One of the biggest reasons why small businesses don't succeed is lack of capital. And I feel like that excuse is way blown out of proportion. However, it is definitely a factor, and that is, as a company is even growing and expanding and doing well, the lack of capital really can keep them and make them go out of business. Just because if the business is growing, things are doing good, but if they need a big order and they don't have the money to buy that, they might literally lose out on a big order or lose a big customer because they can't supply the order because they're using their own bootstrapping, they're using their own money instead of getting a loan or an investor that could provide that liquidity. So bootstrapping is great, but cons is survival rate. A lot of businesses that try to just bootstrap themselves, there's a lower survival rate and a higher failure rate for bootstrapped businesses. Also, slower growth. Again, as I use in that example, big order comes in, and if you don't have the money and profit sitting in the bank, your own bank account, you might have to turn down business simply due to the fact that you can't sustain the business if you're growing too quickly, because growth sucks cash in the form of inventory, hiring, advertising, all these other things, and you might not be able to grow as fast if you do not have outside capital in the form of loans or investors. And then the last thing about the con or negative thing about bootstrapping, we're talking about cons. Another con about bootstrapping is just it's very hard. It's very, very hard because you're constantly managing cash as the business is growing and constantly having to keep an eye on on your bank account, because that's literally the fuel tank for the engine of growth, right? If you have more fuel, you have more cash, you can bootstrap it and put it into the engine, and then you can continue to grow. Whereas if there's no fuel in the tank, there's no cash, you can't bootstrap yourself, and you're not going to grow the business very much. So it takes a lot of hard work. It takes a lot of pushing, and just like really, it's very difficult to bootstrap your business and grow, because you're constantly having to manage your bank accounts. You're constantly manage your cash and your cash flow. Again, those are not bad things. That's why I kind of like bootstrapping, because it forces fundamentals. It forces you to watch your numbers and watch your profitability and make sure you're running a sustainable business. However, that can be very difficult, especially the first couple years where you literally aren't making much money because the business is growing, growth is sucking the cash, and it's very, very hard on some owners that literally, they just had a few years buffer of cash and got a loan, got an investor on board. Yeah, they might lose out on some control or ownership, but they would be able to get through it. And they'd actually survive those first few years of business ownership and be able to, hopefully with some liquidity in terms of a bank loan or investor, they'd hopefully be able to lose less sleep and have less gray hair after those first few years of constantly having to watch the numbers and make sure you don't basically go bankrupt within a week just because of poor cash flow management. And that can happen when you're bootstrapping, when you're running a tight ship that's growing and you don't have a lot of capital available. So those are the pros, those are the cons. I'm not going to say which one's better or worse. Every single situation is different. I like bootstrapping because it forces fundamentals of profitability, but also it's one of the biggest downfalls as to why companies don't actually get through those first few years of business, because it's very difficult and it's very hard to grow a business just using the profits from the existing firm. All right, so now when it comes to getting capital for your business, one way that you can also do that is through government loans. And so we're going to talk about the SBA process and the different types of loans that the SBA offers. So the SBA stands for Small Business Administration. Okay, now kind of a common misnomer, or something that people misunderstand with the SBA is the SBA does not lend money to a business, okay? You get a loan from a bank, and then the SBA, they guarantee that they will pay the loan, they will pay the payments if you default as the business owner on the loan, okay? So the SBA does not give you money. What happens though is there's an SBA loan process that you would go through at a bank, a commercial bank that they have vetted, and they have to have certain FDIC restrictions and all the rest of it. They would have a process that you go through, and you get the money from the bank. The SBA guarantees the bank that if you can't pay that loan, they will step in and pay for it. Okay, so it's basically the government, the federal government saying, hey, look, we want to stimulate the economy. We want to create small businesses. We want the small business to grow and expand. We see it as a valuable part of our economy. And in order to stimulate that growth, we are going to guarantee the banks, because the banks are set up much more efficiently for taking applications, meeting you, going through that whole loan process, underwriting, all of that. They do all of that. The SBA is simply going to be another checkbox, another part of the loan process to get clearance from them, and it's going to allow, and because the government steps in and guarantees these loans, that's what allows these banks to lend to you. If you went into some banks as a small business, you'd be looking at like 10, 12% in interest. Ridiculous, like crazy, and let alone even businesses or even banks that would even want to give you money, let alone the interest rate. Like just even getting accepted for a loan from a bank is nigh to impossible for a brand new small business. You have no track record, you're usually needing quite a bit of capital, and so the government, in order for those loans to be able to happen, guarantee the bank, hey, if they default, we will pay. Therefore, the interest rates are much, much lower, usually between 4 and 7%, depending on the type of loan you get and what you're using that loan for, as well as your own personal financial history. But again, for most of us, this is the best route in terms of getting a loan is going to be from the government, because well, not from the government, again, not from the SBA, but from a bank with an SBA loan process that guarantees the loan. That's what allows the interest rate to be very low, and if you can get money for under 5%, I'm usually a really big fan of taking the money if you can use it to grow your business and use it efficiently. So the SBA is a great system that allows us as small business owners to actually take advantage of lending, which would otherwise not be available to us through the commercial markets and through commercial banks. So let's talk more specifically about several of the different programs, and we're just going to focus on the ones that are most popular. There are some other smaller types of SBA programs and SBA loan programs for independent research, laboratories, etc. We're not going to talk a lot about that. We're going to talk about the two main ones that you're going to probably use. All right, so now we're going to talk about the two most common types of SBA loans, and the first one is the 7A program. This is really the most common one. This is how you're going to see it written, 7A program. And this is a max of $5 million. Again, your application, like we talked about, is going to a bank. The bank puts you through all of their vetting process and all of their underwriting. Then they send it to the SBA for approval. So you kind of have two different underwriting. Sometimes this process can get a little bit long because of the fact that they got to hand it around, and depending on the volume of the SBA, how many loans they're getting received at that time, it could be a very variable rate of acceptance. I've had loans, an SBA loan, take as much as 7 to 8 months, which is a pain in the neck. So the first one though, a 7A loan, it's a maximum amount of $5 million. The SBA guarantees as much as 85% of the first 150,000, and then 75% of up to 3.75 million. All right, so really it's a function of, hey, like if you're only getting $150,000 or less, 150K or less, you're only going to have to bring in 15% down, because they're going to guarantee up to 85%, the SBA. So this is a great loan for working capital. Like any business can basically get this. Working capital, machinery and equipment. You can't just walk and say, I want money. Like they're gonna wanna know why you're using it. And that's the main thing here. And what's going to determine whether or not you get the loan is, do you have an actual rightful cause for needing this money? And they're gonna want proof and receipts and all the rest of it. So working capital, machinery and equipment, furniture and fixtures. So if you're kind of like remodeling, land and building, you can do a 7A for land and a building, especially a smaller place might want to do that. We'll talk about the next program in a second that's usually more used for land and building, but also leasehold improvements. So if you are, for example, building a gym and you're renting a space, you then got to improve the whole area inside, drywall, put your equipment inside, all the rest of it. That would be a great 7A loan. Also, under certain special circumstances, you can actually use the 7A program to do debt refinancing. So if you have a whole bunch of debt, if you have a whole bunch of equipment loans and a whole bunch of other debt, you can kind of restructure it all using a 7A under certain circumstances. You're going to want to talk to your bank about this and get exactly your situation and what they're willing to restructure. Okay, so 7A, most common, the SBA is going to guarantee up to 85% of this. And for example, like it depends a little bit on your bank too, because remember the loan is with the bank. So if the bank is going to do 85% of the first 150, they're going to do 75%, beyond this up to 3.75 million. But let's just say, for example, the 150 grand. If the SBA is going to guarantee 85%, the bank might not make you pay 15%. They might only make you pay 10%, and then they just kind of float the other 10% risk. But that's uncommon. So it's really going to come down to your bank. Get a good lender, get someone that has a good SBA program that you know actually does SBA loans. Doesn't just offer it, but like an SBA specialist, someone there that only work on SBA loans. They're going to make the speed of the application process faster. They're going to allow probably better terms, and they're just going to know a lot more of whether or not you can or cannot get a loan, so you don't waste time. Okay, so that's the first one, is the 7A. The next one is really for like big equipment, building a headquarters, building a real estate deal, buying real estate, big equipment, machines. This is going to be the 504. Now, it's usually going to be technically it's called the CDC, which is the Certified Development Company 504 loan. And so basically, certified development company, you can kind of get the idea. You're developing. So usually you're buying real estate and then building. And usually you're not going to be able to find a bank that, even with a commercial loan, is going to beat the rates of an SBA loan underneath the 504 program, because the amount of risk when you're just like buying brand new land and building on it. Like, most banks don't want to take that risk from a small business. And so the 504 program allows for for buying like real estate, building a big shop on it, buying big machines, expensive machines, etc. Long-term fixed rate financing. This is going to be much larger in terms of their loan limits too, in comparison to the 7A, because you're buying an asset, usually like a fixed asset. And so long-term fixed rate financing, and it's going to be used for like expansion, modernization. If your business is growing really fast, you got to build a headquarters, you got to build more locations, for example. That could be used underneath the 504. And on this one, you only have a 10% down payment, which is really nice as well, because you can hardly get a real estate loan for 10% down if you're doing new construction. So really awesome that they have the only 10% down, meaning you can get like $1 million for $100,000 down to build your shop, or to build a brand new real estate store that you own, not a leasehold improvement. That's going to probably be your 7A, but an actual buying and purchasing of the land, the building, etc. That's when the 504 comes into play. And something to keep in mind when you start looking at leasing versus buying underneath the 504 is it actually cheaper just to pay the interest on a 504 loan than it is to lease property and you don't own anything. So really great programs, the 7A and the CDC 504 loan program. Definitely talk to a local bank. Make sure you vet your banker. We've talked about this before. Vet that banker and make sure that it's someone that you want to work with, and they've done SBA loans all the time. Like, that's their job. Not that they do it on the side or once a year they're doing it on the side. No, they need to know the SBA program inside and out. They need to have a contact at SBA and be able to give you good guidance without needing to follow up with you. They should know this stuff. SBA loans, great programs. We're going to talk about another one here in just a second called the micro loan. That's for really small, kind of under $50,000. Here we go. All right, so the last type of SBA loan that we're going to talk about is actually called the 7M. And the M just stands for micro. It's a micro loan. So usually micro loans are small loans. So basically a micro loan from the SBA loan, a 7M loan, is $50,000 or less, and it's for small businesses and for non-profit child care centers. And these are short term, right? So these are not like 20, 30-year long terms. It's going to depend on your lender, but it could be as short as a year. It could be as long as 5 years or 10 years. Like, it just depends on your lender, okay? And what you're buying. So for example, like, you can use this for working capital. You can use this for inventory. You can use this for supplies, like literally cleaning supplies. Like anything you need in your business, basically, a micro loan. It's small. It's under $50,000, okay? So it's under 50K. And the hard part about a micro loan is honestly just finding a lender that offers this, because for the lender, the bank, it's not very profitable to have this small of a loan and have to go through the whole underwriting process and all of that stuff. It's expensive for them. They don't make a lot of money. They don't usually like to do microloans. So sometimes you might have to look around for a lender that is, like a credit union or a nonprofit credit union that's doing these for really the sake of the business owner and not for profit, because microloans don't make the bank a lot of money. But also in the 7M program, what's kind of unique is that the lender is also supposed to provide business training and support to the borrower, just from a training perspective and all the rest of it. So really $50,000 or less, small micro loan, can really be used for everything inside the business. It doesn't need to be an asset. It can be something that you use up, like supplies or inventory, for example. Whereas the 7A or the 504, there needs to be like an asset. There needs to be receipts, a transaction taking place. The microloan is not as stringent on what you're buying in terms of having a physical asset that they can come and get if you the loan didn't, you didn't pay on the loan, no collateral on these loans. So, every single one of these loans, depending on the SBA and your lender, is going to determine your collateral, right? So do they want to have your house as collateral? Do they want to have your car? Do they just want to take the assets of the business as collateral? On the 504 and the 7A, where there's actual assets usually involved, that's usually going to be enough collateral. If I'm buying trucks and equipment, that would probably be enough for my collateral. Whereas I'm doing a microloan, I'm just buying supplies and inventory, there's a really good chance they're gonna wanna put like a collateral on my house, my personal car, things like that. It's gonna depend on your lender, negotiate this, make sure you work well with your lender, they're on your side to try to push as much on just the business and less of the liability and less of the collateral on your personal assets. All right, so overall, when it comes to a loan, there's really three things you're looking at. And there's obviously a lot of different fine print and different things that would make a loan more appealing to you at certain times, given your certain circumstances. But really, there's really mainly three. Number one is collateral. I'm probably spelling this wrong. But basically that is like, okay, what happens if the loan goes bad, if you fail, if the business doesn't do good and they need to come back and try to collect something, what is that collateral going to be? That's a big thing. And obviously you want to reduce the amount of collateral you need to guarantee on a loan, especially if you're doing it for your business and they want to collateralize your house, your personal assets, etc. So that's the number one thing. But really I want to focus on the number two and number three, and that is the interest rate percentage, as well as the term of the loan. Okay, so that's gonna be like how many years. We're just gonna assume years, okay? This is the most important parts of debt, honestly. Obviously, collateral is important, but for most of us as entrepreneurs, like if we're gonna start a business, if we gotta collateralize everything, including our right foot, we're gonna do it. And so, obviously we wanna minimize our collateralizing our personal assets, especially when you have family and dependents. But when it comes to interest rate and term of loan, those are the big drivers of the cost of borrowing that money. So interest rates, we're gonna talk a little bit more about in the future, but obviously a percentage of every single payment you're making is going towards interest. Now, this is something that people balk over a lot when really the term of the loan is more important, okay? Because I can take a loan that is 5 years long, and the reason it's so important, the term of the loan, is because it breaks every single payment down so much further and makes them a smaller payment. So from a cash flow perspective, the term of the loan is so much more important. I would much rather have, I'll just do two scenarios here. So like number one scenario, number two scenario. I would much rather have, in most cases, a 8% interest with a 20-year term. I would much rather have that than a 4% interest and like a 5-year loan, all right? Yes, there's a higher interest. Yes, some people would say, well, you're flushing more money down the toilet. I agree. However, the term makes my payment so much smaller. And so especially when you're first getting started, from a cash flow standpoint, this payment per month is probably gonna be about a third of this one. It's not gonna be a quarter, because it's not gonna be broken up like 5 times 4, or a quarter would be 20. It's going to be about a third because you're gonna have a higher interest rate, right? So there's gonna be more money going into interest. However, as long as you don't have a prepayment penalty and there's not a clause in your loan documents that say, hey, if you pay this loan early, you get a penalty. As long as that's not there, I would much rather have a lower payment per month to get started, and maybe in year 3 or 4, I'm like, hey, I got lots of cash flow, and maybe I start chipping away at the actual principal of the loan and pay it off in, say, 10 or 12 years. That's an option. And so in that case, I would much rather have this if I'm getting started, simply due to the fact that the term of the loan makes my monthly payment so much lower, and therefore my cash flow is better. So a lot of people will get hung up on interest rate, like, oh my word, I'm literally gonna pay twice as much interest in scenario number one. That's true, but if your monthly payment is 1/3 the second option, if it's gonna be 1/3 the cost per month, there's a much better chance your cash flow is gonna be better. That money, the other 2/3 that you're saving, could be spent on advertising, hiring, and a lot of other things to grow the business. And if if you don't succeed because you do 3 times the size of a monthly payment, you might never even make it to 5 years. Whereas over here, after 5 years, because your cash flow is so much better, you will be able to actually pay the principal off sooner, or keep growing and build the business a lot faster. So cash flow is something very, very important, all right? Interest rate, yeah, interest rate is definitely gonna be a factor in terms of your cost, but the term of the loan is really the driving force when it comes to business loans. That's why the SBA is so nice, because they give 10, 15, 20, 30-year loans on business loans. That's unheard of in the commercial loan market for starting small businesses. So taking advantage of the SBA is why you're able to get interest rates that are below 8%, why you're able to get terms of a loan that are 10, 20, 30 years long. All right, so these are very, very important concepts. And something to kind of keep in mind is your interest rate, this is kind of my philosophy. As long as your interest rate is below about 5%, you almost want to get as much money as you possibly can. And this number is obviously going to change with inflation, as well as what the feds do in terms of the interest rates. But overall, anything under 5% interest, I want that money, because I'm very confident I can turn any sort of real estate deal, even stocks and bonds, and like low grade investment, things that aren't super risky, I can beat 5%. So traditionally, if I see money that's being offered to me under 5%, I'm usually all over it. That's why when 2020 happened and mortgages became so cheap in terms of interest rates, that's why so many people started buying houses, because the money was cheap. It was no longer 4 and 5% for their mortgage. It was 2.5%, 3%. And so as those mortgage rates stay low, people will continue to buy because the money is cheap. If the interest rate in general is under 5%, I'm going to take the money. Because I know if I can deploy that money into my business, into stocks, into real estate, in some other form or fashion, I'm going to be able to beat the 5%. So the interest rate is, again, if it's lower than 5%, usually I'm all over it. If it's going to be marginally higher, but I'm going to have better terms of the loan in terms of years tacked on, and therefore increase my cash flow by having smaller monthly payments, I'd rather go for the term of the loan. So if you're negotiating with a bank, I would rather have your term of your loan be higher and your interest rate a little bit higher. I'd rather have that if it's going to reduce your monthly payments at the beginning. Now, if you're an established business, if this is more of like a working capital or an expansion, yeah, you might be interested in the fact that the interest rate, you don't want that to be very high, and because you don't need the term loan to be super long. But when you're first getting started, again, we're assuming you're just getting started, that term of the loan is so important to reduce your monthly payments and that amount of money, because it's going to help with your cash flow, and by reducing the fixed cost of that mortgage, of that debt burden, you're going to be able to use that money on expanding the business, growing the business, and using it on things that actually move the ball down the court. So this is just my general rule of thumb. Money under 5%, any money under 5%, I want to take that debt. All right, so that's why real estate is so appealing, is because you're able to get loans and debt for 3%, 4%. Like, I want to do that every day, and the terms of that loan is like 30 years. That's a great investment because it's very, very low risk, and I know I can beat the 5%. Okay, so but when it comes to your business, traditionally, unless you're going to the SBA, you're not going to get around 5%. Usually, if you go to a commercial bank, you're going to be like at 10, 12 plus %. That's why the SBA gives them the insurance that, hey, if this business defaults, we'll pay you back, and that's what allows the bank to give you an interest rate of 6, 7% underneath an SBA loan, which is still a really good deal, but not like I'm going to be lining up all the time trying to get it. Literally, as we are recording this, I'm trying to get an SBA loan, a 7A, because I can get money very, very cheap, and I'd rather use, even though I have cash in the bank, I have cash in the bank, but because the interest rate on this debt is going to be around 5%, I'm going to take that money and use it for expansion instead of using the cash in my bank account, which the money in my bank account is going to be used on real estate, or goes like a down payment on real estate, or it's going to be used in the stock market where I know I can beat 5%. So that's the time value of money, and thinking about, should I actually get debt instead of using the cash in my pocket. I'm assuming, though, for most of you just getting started, you're going to use this money to get your business started, and you're going to be very interested in these two things, your interest rate and your term of your your loan. Obviously, make sure you're not going to lose your house if you have children, a wife or a husband, and you don't want to put yourself in that situation. So collateral, make sure you can minimize that as much as possible. If you're getting a loan for equipment or real estate, try to make that the collateral and not your personal asset. All right, so another way that you might finance your business is actually through what's called a HELOC, all right? So I'm gonna show you an example here of when using a HELOC might work for funding your business. So a HELOC stands for Home Equity Line of Credit. And basically it means the equity in your home, you get a line of credit on that equity, okay? So I'm gonna show you an example of how that might work, all right? So let's assume we have a $500,000 house, and that's the value, all right? So that is like the market value, $500,000. Now we're going to assume though that we have a mortgage of $300,000. All right, so we still owe, debt. We still have $300,000 on that house. So technically, the equity on this home, the equity is equal to $200,000. And this is basically what the bank is like, okay, look, you got value, you got equity in your home locked up. Why don't we collateralize, secure this loan with the equity of your house? Basically what this means is if this loan goes bad, if you default, we can always come back and get your house, all right? So instead of actually going and getting a loan, like an SBA loan or a commercial loan to start your business, you literally are just gonna go into the bank and be like, look, I want a HELOC, I want a home equity line of credit. They're gonna look at what's the value of your home, they're probably gonna do an appraisal, they're gonna look at how much you owe on it, and then the leftover, the equity, is what you can actually then take out of the equity of your home. And then what's cool about this is this interest rate is gonna be much lower. So the interest rate is much lower than a business loan. And the reason for that is because equity inside of a home is traditionally looked at as very safe, all right? Not only is it the fact that they can come get your house, but what's really nice about a home equity line of credit is you don't even have to tell them that you are necessarily using the home equity line of credit for a business. You can just say, hey, look, I want to go on a vacation, I want to do this other stuff, whatever you want to say, get the HELOC set up, and then literally it's like you can put money in and put money out. And what's really cool is not only is the interest rate a lot lower, you're probably going to be looking at between like 3 to 5%, very, very low, even lowered, honestly, in some places, 3 to 5%. Great interest rate, but what I love about it most is it's revolving, which basically means that you can take money in and take money out. I can use $50,000 and then pay that $50,000 off, and then maybe next year I need a little bit more. I can just keep taking it. So a line of credit basically means that I can put money in, I can put money out, and they are giving me a set amount of money as my line, what dollar amount I'm able to use. Now, you have $200,000 in equity, but most banks, all banks, will not give you a HELOC for $200,000. They're gonna give you usually around 70 to 80%, but let's just go ahead and just say 70% to be conservative. So 70% of our equity, our home equity, would be $140,000 total. This is gonna be what is actually your HELOC going to be. The line is gonna be $140,000, and literally you're gonna have in your bank account, you'll have your checking account, savings account, and then you'll have a home equity line of credit, LOC, line of credit, and it's gonna say $140,000, and you're able to put money in or put money out. What's great is if it's all paid off, you're not paying any interest. Your interest rate becomes zero because you're not using it. And so what I love about a HELOC is your ability to move money in and move money out, whether it be for business or investing. This is a beautiful thing if you have equity inside of your home. This is the value of owning a home and paying it off over time, is that you do build up equity, especially if it's appreciating in value, and therefore you can then one day, if needs be, on a rainy day, take out this money if you need to, whether it be for expansion or if it is a rainy day and things are going really bad. So if you have a business right now and you're watching this, I recommend seeing if you have equity in your home, getting a line of credit set up so that on a rainy day, you're not going and using a credit card. You can use very, very cheap debt. Also, it's a way, if you get an opportunity that comes your way to expand the business, you again have cheap debt. You don't have to go out and do paperwork and ask for a business loan or all the rest of it. You can simply come into here, get the money out, and you're all set up. It's literally a line of credit, which means once it's set up, you can take money in and take money out. It's literally an account in your bank most of the time, okay? So great option if you have equity inside of your home. Obviously keep in mind that you are collateralizing your home. Okay, so the last video we talked about collateral being a part of something you want to really think about when it comes to loan terms. And when you get a HELOC, if you default, like if your business is so bad and now you've used up all of your home equity line of credit and then the value of your house comes down, you hit a recession or something, and the bank says, hey, look, now you're underwater, we need you to sell the home or pay us or whatever, you're literally gonna lose your house. You don't want to do that. So don't max this out on some really risky thing. Make sure this is a great way to have sort of an insurance policy almost in terms of if you have something bad in the business happens, or have it so that you can expand the business if an opportunity comes around. But again, if you're going to start a business, very risky, try not to max this out. I just don't like to see people maxing out their line of credit, maxing out now the market value is equivalent to the debt because they add, say for example, 140, if you add this up here, now this becomes, your debt becomes 440. Well, if the market value, tanks by 20%, for example, now it becomes 400K, the market value, and now you owe 440K, the bank is gonna come along and say, all right, time to sell the house if you stop making payments. So definitely something that you wanna approach cautiously, but remember, this is a great option because you don't need to do a bunch of paperwork and restrictions. Your interest rate is lower, you can pay it off and then pay it, use it again, and you take money in, take money out, and improve and increase this line of credit if the value of the property goes up and your debt is going down as you pay off the mortgage. Try to increase that equity, that home equity line of credit, HELOC, every once in a while to improve this number and just have that cushion, available cash that's cheap in terms of interest rate and very, very accessible once it's been set up. All right, so we've talked about several different ways to finance your business, but now I'm gonna compare or just kind of look at the two different ways that you can fund a business. Either a loan, and we're gonna assume like a term loan here, or you could theoretically use a business line of credit. Okay, so we talked about a home equity line of credit where you're using the equity from your home in order to get a lower interest rate on a secured mortgage, right? Basically, you're basically selling the value of your home as the collateral for that loan. HELOC, home equity line of credit. Now, you can also have a line of credit for your business. Now, traditionally, this is going to be a higher interest rate than a home equity line of credit because, again, the collateral for a HELOC is your home. The collateral for a business line of credit is usually not much. You can actually get with unsecured lines of credit, okay? So you have secured lines of credit, which we're gonna talk a little bit about in the next video, and then unsecured lines of credit. And for this video, I wanna focus on the unsecured line of credit, which basically means they're gonna look at your financials, they're gonna look at your balance sheet, your profit and loss statement, all that good stuff, and then they're gonna determine how much money they're willing to lend you on a line of credit. Again, remember, watch the last video, this line of credit, what's really great about it is you can move money in, you can move money out, and as you need it, you can use it. It's kind of like money for a rainy day. If something bad happens in the business, or if an opportunity comes along, you're able to tap into the money and then get paying interest on it while you're using it, as you use it, and then pay it back. And you can only use some of it. Like let's say, for example, we have $50,000 as a line of credit. We don't have to use all of it, right? We can use maybe 10,000 because we want to buy a piece of equipment, then we pay it off after a year, it goes down to zero, and then maybe after another year we want to buy a couple pieces of more equipment, 20,000, okay, we pay that off to zero, and then over time, we want to buy out one of our competitors, we're going to do 40K. Like, so you can use it. It's a move money in, move money out. It's a revolving line of credit, and it's either secured, which means it has collateral like equipment, or it has a home. That's a secured line of credit. A HELOC is a form of a secured line of credit because it has collateral. An unsecured line of credit is traditionally going to be a much higher interest rate because there is no collateral. It's literally like, hey, we trust you based upon the financials of your business. And big businesses, big corporations that are public, they get pretty decent unsecured lines of credit. But for small businesses, higher risk of failure, it's very difficult to get unsecured lines of credit. It's almost impossible if you're just getting started. But if you have a business established already, you can definitely use an unsecured line of credit to be able to have that money set aside for a rainy day. Like the worst thing happens, you can tap into it, knowing that the money's there, that you won't go bankrupt. But it's, again, you're probably going to want to use it. This is the key part here of the business line of credit. This is usually what you want to do for short-term stuff. Okay, because the interest rate is going to be very high. Usually you're looking at 7 to 12%, if not higher, depending, again, on your financials and all the rest of it. So compared to like a HELOC, compared to a secure line of credit that has collateral, it's going to be a higher interest rate. You want to use this for short term. Do I recommend that you get these? Absolutely. You want to get a business line of credit once you're in business, because you want to have that money set aside for a rainy day. You don't want to go out of business because one bad thing happens. You don't want to pass up a great opportunity and not be able to take advantage of it because you don't have the money there ready to go. So do the work, submit all your financials, get it all set up, pay a little bit of fees to get it started, whatever it might be. But that way you have the money. It's kind of like, again, last resort for insurance, and it's high interest usually, but you're willing to pay that for a few weeks, a couple months to get the business through that time or take advantage of that opportunity, and the money is available. So definitely set up a business line of credit. You can get it secured, and we're going to talk about in the next video. But if you're going to do an unsecured line of credit, it's going to be based upon literally your business financials, and they say, hey, we're willing to give you a revolving line of credit for X amount. Here's the terms in terms of their interest rate, and again, going to be higher. You're going to be usually using this for short term. The big key on this is get the business line of credit when you don't need it. All right. It's a funny thing when you need money, a bank doesn't want to give it to you, and when you don't need money, the bank wants to give you money. So when you don't need the money, that's when you want to go ask for a line of credit. That's when you want to ask for more debt. Is when you actually have cash in the bank, you don't really need it, and you're literally just going to them like, hey, I want to get this for a rainy day just in case. You do not want to be showing up at the bank asking for a line of credit when you're like, yeah, there's a creditor coming after me and I lost my biggest account and we're not doing well, we had our worst month ever. That's not the time you want to be asking for a loan. Now, a term loan is traditionally going to be longer term, all right? So there's not going to be like a usually a revolving line of credit over here where you can take money in, take money out. A term loan is going to have a set amount of time usually, and again, in general I say long term in terms of like a year or more, but usually you're going to have some sort of a term or years that is on this loan. So like probably 1 to 30 years of an actual loan. So really what I want to make this video is do you need a loan that is going to give a set monthly payment for X amount of years, or do you just need a business line of credit that you can tap into when you need it? When you need a little bit of a piece of equipment, you can buy it and then pay it off over the course of a couple months. This might be a great option if you need it to be where it's revolving and you take money in, take money out. You don't need it all the time, maybe once or twice a year. Like, this is great for that. Or you get a big purchase order, you can go in, use the money, and then once that order's been shipped out and fulfilled, you're able to pay it off and just use it as short term. That's going to be the line of credit. A term loan is going to be something long term. This is usually what you're going to do to get started, especially the SBA. If you're using a 7A, 10 years. If you're using a 504, probably more like a 25, 30-year term loan. This is going to be usually where you start, because a business line of credit probably not going to get established from day one because you don't have the financials to back it up unless you secure it with collateral using something like a HELOC, where your home is the collateral. It is what secures the loan. All right. So we're going to talk a little bit more about secured lines of credit in a second for your business, but for most of you, if you're just starting out, this is, again, the term is so important. The amount of years on that loan is so important, and this is going to be something usually longer term, 5, 10 plus years, and that's why the SBA is so great. They give those longer terms, making your monthly payments much smaller. All right, so before we talk about secured lines of credit when it comes to your business, I want to mention really quickly, and that is a program that the SBA has that's called the SBA Express loan. So technically it's kind of a 7A loan, but they have this new kind of form called the Express, which is actually a revolving line of credit, all right? And what's really, really cool about this, again, you can get this, and for up to 7 years, it can mature. It matures in up to 7 years, which means for up to 7 years, you can have this line of credit that's revolving. And it can go up to $350,000, all right? So up to $350,000, you can have this line of credit from the SBA. Now, if it's over $25,000, you do have to usually get collateral on it, but if it's under $25,000, you can usually get it with unsecured. So this is a great option once your business has gotten started to have a line of credit. I'm going to call it a line of credit. They do not call it a line of credit. They call it an Express 7A loan, but really it's a revolving line of credit. It matures over 7 years. It means for 7 years you can use money, take it out, put it in, take it out when you need it, as you need it, and then pay an interest rate that's very, very reasonable. Usually this is going to be the SBA terms in terms of like 6-7%. So this is a great option. Great option. This is the one that I said we were applying for, and we're trying to go after the full 350 because we want to be able to use it to expand, and then we'll pay it off, and then we'll grow and expand, and then have it paid off. And so this is a great option. Again, you can get under $25,000 if you're literally using this in a very small business to do micro orders of like $5,000, $10,000. You need to get a PO, and you get a PO for 15, 20 grand. You can easily get that funded with an unsecured line of credit, i.e. an Express 7A SBA loan. Great option. Great option. I can't overemphasize how great this program is for your business with a very reasonable interest rate and the ability, again, revolving. So awesome. Definitely check this out if you're an established business, and if you're willing to collateralize it with some equipment or something like that, you can get above 25 grand. And if you're really small, but you have an established business, get that $25,000 of unsecured line of credit. Great deal. The Express 7A 504 is not anything to do with this, okay? It's a 7A Express SBA loan, and this is a tough one to find anyone to actually, a bank that will actually be the lender, because they don't make much money on these, okay? So that's the bottom line. So the bank as the processor doesn't make a lot. You might have to search around and find someone that actually does an express loan, similar to the micro loan. It's like the micro loan we talked about before. It's another version of the 7A. It's small. They don't make much money. It's hard to find someone that does that loan. But this kind of line of credit type of loan, the revolving line of credit, the Express, is sometimes hard to find. So search around SBA programs, see which one offers the Express 7A, and definitely check it out. All right, so I want to talk kind of a little bit about a trick that if you're going to try to get a business line of credit, all right? So again, we're talking about a line of credit for an established business, and you're trying to get financing, trying to get your business line of credit. Now, this is kind of the trick. You know, I'm in the lawn care landscaping industry. A lot of my followers, I know people watching, might be in this industry. And this is really for you, as well as anyone that has vehicles, equipment, machinery in their business. And you've paid everything off. Everything you ran on cash your whole life, you run really profitably, you don't have a bunch of debt, but you've heard the last few videos, you're like, oh my goodness, I need a line of credit for a rainy day, and I need to do it because I don't have any debt, and because I'm running a good business, and this is the time to get my line of credit. So amen to that. You need to go get a line of credit for a rainy day, for that opportunity that comes along, and you need to jump on it and have the money right away. So get yourself a line of credit, absolutely. Now, when it comes to a line of credit, you know, you can get what we talked about before, which is the unsecured business line of credit, which is going to be, there's no collateral. It's unsecured. This is not good. We don't want this, all right? We do not want an unsecured line of credit because interest rates are high. You know, it's not good. Like, the interest rates are way too high usually, and we're talking 12, 15% sometimes. Like, it's almost, you might as well get a credit card. It's pretty bad. What we're looking at is a secured line of credit, which basically means it's collateralized or has collateral to back it up, which means if you default or the line of credit goes bad, you're not able to pay it off, they could come pick something up. They could come take something from you as collateral if you do not pay off the loan. Now, what I like to do is secure my line of credit using my equipment in the business. I do not like to use my personal home or my personal vehicles or my personal assets or my real estate deals or assets from other businesses. What I want to do is I want to use my paid off trucks, my paid off equipment, whether you have track loaders, tractors, you have machines, you have equipment, you have computers, whatever it might be, stuff that is a marketable asset that you know could liquidate pretty quickly. Usually the bank will will allow you to use that as collateral. Now, they're not gonna allow you to use like, lights or rugs and carpets or chairs as collateral. They're not, because they can't easily liquidate it, right? Trucks and equipment that are really easy to sell and it's easy to determine their book value, great option for collateralization, all right? So if you can say, hey, look, the Kelley Blue Book price on my truck is $20,000. I bought it for $25,000, I've used it a couple years, but it's worth $20,000. That's great. They can use it as collateral on this loan, and maybe they'll allow you on that $20,000 worth of collateral, maybe they'll allow you to borrow $15,000 underneath a secured line of credit. So what we do, and we have done with our trucks, is we don't have any debt on them, but we use them all as collateral, and we have a lien holder, even though we don't use the line of credit, but we use them to be collateral for the business line of credit. Because if I can't pay my line of credit off, like my trucks we're obviously failing, so like they can come take my trucks and pay themselves off, right? So I like, this is a little trick that I found, is use your business line of credit. You gotta build one, but in order to get it secured, i.e. in order to get your interest rate where it's actually like a decent number, like 4, 5, 6%, and it's secured, use your trucks, use your equipment, use the things you've paid off. Again, they gotta be things that are easily sold off, but if you're in the landscape industry like me, use your trucks as collateral to get your line of credit to a very good point in terms of rate, as well as they'll allow you to borrow a lot more, all right? So if you have $500,000 worth of equipment, they might allow you to have $400,000 line of credit, because they know if you default, they can come get all your equipment. But that $300,000 might allow you to acquire a competitor. It might allow you to grow really fast in a year that a lot of businesses coming in and take advantage of opportunities. So I love having that line of credit set up, and then I love securing it, using the equipment from the business. All right, getting the interest rate lower and allowing my limit to be a lot higher. All right, so another form of financing when you first get started is borrowing from friends and family. And I'll just be open and honest from the get-go, not a big fan of this idea, okay? Really, at the end of the day, you're putting more than just your financial future at risk. You're putting personal relationships on the line if you are going to take money from friends and family. And so really, I want you to think of it as like a high risk form of financing, the same way that you think about like using your credit card like as like high risk. Think of the same thing if you're borrowing money from people that you actually care about or care about you. And now, of course, unless if you have a really rich uncle or a rich family member and they're not gonna miss the money if you lose it all, then it's okay. But don't try to avoid using the last bit of your grandma's retirement fund. That's a lot of pressure on you, and it's gonna be a lot of pressure on the relationship, especially if things go poorly. You wanna have agreements in writing up front. Know what the expectations are up front from both parties, them as the lender, you as the borrower, and what they should be expecting in terms of interest rate, payback terms, etc. And the thing that I don't really like about borrowing from friends and family is that sometimes they almost sort of think that they can have say in the business, in the decisions, if they think the business should be ran a certain way because they've invested money, and you don't want that. You do not want that kind of pressure. People who don't have any equity and yet they feel like they can control what's going on in the business. At least with a loan from a bank, they can't tell you what to do on a daily operational level. They can't make decisions for you. And so if you have to eat supper with someone every single evening, or you have to see them at family or occasions, make sure that they're happy with you and that you've done everything that you can do to make sure that that relationship is held intact. You want to make sure that you pay these loans off as soon as possible, okay? So if you're gonna get these, it's the only form of financing that you can get at the beginning, or you have somebody in your family that has money, even if they could miss the money, they don't need it. Pay these loans off as soon as possible, and just don't deal with them as much as possible. Don't borrow money from friends and family, but if you must, follow those guidelines in terms of having the expectations up front, in writing, and know when you're gonna pay these off, and better sooner than later. All right, so now you're gonna get the very biased opinion of Mike Andes on how you should finance your business. And this goes for probably 80% of you, so let me just put that caveat on. There's definitely businesses where this is not applicable. But I would encourage the vast majority of small business owners to really focus on creating a minimum viable product. We're gonna talk more about this in the future, but essentially it's how big do I need to build my business to the point where I can actually make a viable product? In other words, how fast can I start generating revenue? And get the business to that point when you think about financing. So many entrepreneurs I talk to, small business owners, they don't start their business because they feel like they need to have $1 million in startup capital. It's like, no, look, if you did 100,000, you could get a minimum viable product, maybe take an extra year or two, build that product up to where it's actually cash flowing, and then use your cash flow to bootstrap your way to what you thought where you would need $1 million. So I really encourage you, what can you do now to actually generate revenue, number one, and then generate profit, which usually comes a little bit after that, and then use that profit to then cash flow the further expansion of the business, okay? So try not to go into debt really heavily in your first business. You have so many different things you need to learn about your business, right? Especially if you're not going to a franchise where they have systems and procedures and they can help and guide you all along the way and tell you when you're doing things poorly. Like if you're just going on your own and it's your first thing, don't go heavily into debt. Try to create a minimum viable product and see if this business thing is for you. How can you test to see if you're good at hiring, if you're good at managing, if the stress gets to you? Until you've actually been in the trenches and started, it all sounds great on paper. It sounds great listening to this course, but until you actually get in the trenches and you hire people and someone's mad at you and you have internal issues and then you have a PO that isn't filled and they have warehousing manufacturer issues and then you have trucks that have equipment issues and insurance claims. There's a lot of stuff that goes on. So I really would encourage you, before you go out and get a massive loan, go into credit card debt, or even before you even think about creating a business, try to create a minimum viable product, see if it works. Some of the best businesses that have ever been created, big businesses, were started with someone made something in their kitchen, oh, this was good, and they went and sold it door to door. Then they sold it at some farmers markets. Then they maybe got a co-packer. It was a slower growth. It wasn't go out from day one, I'm gonna take this recipe that I just made in my kitchen, I'm gonna make it into a multi-million-dollar massive distribution network. That would have taken a lot of money to get that all set up, and loans and debt and getting investors and the whole 9 yards. I'd much rather you focus on that slower growth, not go into debt, and prove that the business works. And when you've proven that a business works and it's cash flow positive, banks usually are pretty good about giving you money. The SBA wants to give you money so you can go out and make more jobs. Usually easier to get investors if you want an equity partner when you have a cash flowing business. So focus on creating a business that works, even if it's smaller. And if it works, you're probably going to be able to get debt a lot easier to make the business bigger. So my biggest driving force is, can you make the business break even and profitable? How much money do you need to get to that point? Not how far do you need to get to massive business or where I want to be in 3 or 4 years. No, how can I create a business that has a minimum viable product or service that I can actually go sell, make a profit, and then go look for financing, then go look for an equity partner, or bootstrap it and use those profits to organically grow the business without having debt, without leveraging the business. Maybe slower growth, and maybe that's not right for everybody. And definitely there's tech businesses and other companies and startups that go massively into debt or raise money and get sell off 90% of their equity in order to grow the business pre-revenue or pre-profitability. But for most of us, 80% of us, probably not the best thing to do. Focus on getting small wins and getting momentum and growing the business. That way you'll be able to retain your equity, you will live a little bit longer because you won't have the debt and the stress of having debt, and you're overall going to be able to grow the business at the same rate at which you are learning. So as you're growing the business, instead of having all this money behind you in terms of debt and leverage and investors pushing you to do things that you might not feel comfortable to do, or growing the business faster than your skills are actually growing, I don't think those are positive things. The beautiful thing about this is as you're growing and learning and making sure that you're really want to keep growing the business, before you go get debt and leverage and investors that are going to push you in directions and are definitely not borrowing from family and their retirement funds or their home equity. Definitely not. All right. So I would be looking for how much money, what do I need to do to get started? And you don't need a lot of times people overthink this part. If I'm trying to create a multi-billion-dollar cookie company, I do not need to go out and build a factory. That's not my minimum viable product. My minimum viable product is to create a batch of 12 and go sell it along the street or at the local farmer's market. All right. Much lower cost of entry. Prove that model, then move on to the next one. Takes a little bit longer, but I promise you, for most of us, that's the way we should build our businesses. Real quick, a reminder before we wrap this up about financing. I want to just make sure I nailed this point home, and that is about business lines of credit. and really debt in general. When you need debt, banks don't want to give it to you. When you don't need debt, banks want to give it to you. It's reverse psychology. It's like, well, if I need the debt, why wouldn't people want to give it to me? I have a good business, but like I need it because I don't have enough cash in the bank. I have a big purchase order that I need money like tomorrow. Like when you need money in your business, usually the hardest time to get money from a bank. When you don't need the money, that's when you should go get a business line of credit. That's when they're going to give you a line of credit, a certain amount of money that you can use, you have the potential to use. You don't have to use it. You don't need it, so you don't use it. But get the line of credit opened when you don't need the money. Because when you do need the money and your balance sheet doesn't look good and your profit and loss is going bad, you hit a pandemic like we had in 2020, or your housing market starts to collapse, or something crazy goes on, and they're all locking up credit lines. Like, oh no, like the first thing banks will do is like, okay, lock all credit lines. Like we're not extending any more credit to any more people because we don't know what's going on. We don't want to extend ourselves too much. That's the first thing they do. So what you want to make sure you do is in good times, when the economy is doing good, when your business is doing great, when you're growing, when you're really profitable, that's when you open up a line of credit, and then every single year come back to your banker and be like, okay, so here's my new updated P&L, profit and loss statement, my balance sheet. Can I get a bigger line of credit? Go back to the video we talked about, sort of secured versus unsecured lines of credit, and that's going to obviously dictate a little bit about terms in terms of your limit as well as your rate, your percentage rate of interest. However, regardless, if it's an unsecured or secured, open up lines of credit when times are good. Do not wait until you need money and then be like, oh yeah, Mike said I can go get money from the bank with a business line of credit. They're probably not going to want to give you money because they don't think it's going to come back to them. All right. So make sure if you're watching this and your business is doing well, make a business line of credit right now. You should be calling your banker, and then every single year updating your financials with them and trying to get that limit increased. Instead of 50,000, can we do 75,000? Can we do 100,000? Every single year trying to get it increased, giving you a bigger cushion and giving you a larger margin of error if something crazy goes on in your business. God forbid something crazy happens, like someone dies or you lose employees or a flood or something crazy happens, but you got to make sure you've built that safety net, that cushion for you in the form of a business line of credit. Get it now if you're doing well. If you're doing bad, time to figure things out, get it back to good, and then that's when you should apply. And if you're just getting started in your business, make sure that when you have started to get some success, when you have become your first year of profitability, you should be going to the bank and opening up that business line of credit. All right, so now let's talk about insurance. And if you listen to the Geico commercials, 15 minutes could save you 15% or more on car insurance. All right, well, we're not just talking about car insurance here, we're talking about general liability insurance. Also, there's probably different types of insurance that your business needs, so you need to go talk to an insurance agent. Now, if you don't know an agent, go talk to a broker, right? So the reason I say this is because if you know an insurance agent and you really trust them and you know they're gonna do what's right for you and your business and not just try to sell you more stuff, I would use them. And that's what I do. I have someone that I know personally I've used all my insurance for all my businesses, everything, right? Because I know that they're in the best interest for me. And when it comes to, if you don't know someone like that, then I would go to a broker. A broker can sell you multiple lines of insurance from a whole bunch of different carriers, okay? And they can usually get the best price for you. And if you're going to someone who you don't know, a stranger basically, price is kind of the most important thing when it comes to insurance, because you're comparing apples to apples pretty easily. All right, so some things you want to think about. General liability. This is like if you mess up. If you sign a contract that's wrong, if you damage property of a customer, things like that, all sorts of different things. All that is inside of a general liability insurance policy. Now, you need to actually go through it, okay? And this is the reason it's important to get a good agent, whether it be on the phone, in person, or a broker, is you want to be able to ask them questions like, okay, so what happens if this happens? What am I covered for this? Am I covered for that? So in the event that this would happen and I cover, like you need to run through some scenarios. Don't just go there and be like, hey, I want some insurance. And they give you 50 pages and you're like, oh, hey, sign it, cool. Like there's so many different clauses and things that you want to kind of make sure you at least know what's covered, what's not, when should I come for a claim versus not, how do I make a claim? These are all things that your agent can help you with. And so I don't really care who you go with in terms of company, just make sure you have a point of contact. Even if it's someone, like if Geico, for example, you don't go into a Geico office. You call Geico or you email or chat, whatever. But like ideally you have one person you deal with, and you don't have a whole bunch of, like, a team of people who don't know your business, don't know any sort of context about what your company is doing, the goals of your company, the growth, none of that. They have no idea what's going on. Ideally, you don't do that. And so you deal with someone that is going to know your business, and when you ask them a question, they have context of what you've done in the past year, where your growth trajectory is, how many employees you got, things like that. They're going to be able to help you a lot faster. Now, when it comes to insurance, the biggest thing that really, not the biggest thing, but one of the big things that is going to affect your price is your deductible. Now, I like to have high deductibles because I have cash in the bank. And this is going to change as your business gets older, and that is the deductible is the amount of money that you need to pay to the insurance company before they would cover any sort of damages or, any sort of, if someone sues you, for example. The deductible you have to pay. Like, I'm not a big fan of having a $500 deductible because guess what? If it's under $500, I'm going to pay for it, right? No matter what. And then if it's like $1,500, I'm probably going to pay it out of pocket because guess what? My premium is going to go up. The amount I have to pay the insurance company every month is going to go up if I use my insurance a lot. Okay, so why would I, if it's a small claim, usually you just want to pay it. And again, this is something you need to go with your agent and be like, okay, what's the actual amount that I should probably consider just paying it myself versus even bringing the insurance into play. For example, when I first got started in business, I had 3 claims literally within the first year. And the reason for that is because I was like, man, this whole insurance thing is awesome. I only have to pay, I think it was $500 my deductible at the time, and I can get whatever mistakes I make, I can get covered. Okay, so the first one is, when I first started out, we were doing cleaning services and lawn care. So the first one we stained carpet. And so literally I played big shot. I was like, you know what? We're going to take care of it. We'll replace all of the carpet in your house. And in my mind, I was like, oh great, I'll just make an insurance claim. And I did that. And I think it cost about $2,500. Okay. Then my second one was we backed into someone's fence post and they wanted to fix it themselves. Literally this probably would have been $1,000 to fix. But I had my insurance, I made a claim on my insurance, and by that time I was like, this is great. I just call them, they give me they send money to the customer, and it was super, super easy. I was like, this is great, Number 3, save my bacon. It was a $32,000 mistake. This is when you definitely needed insurance because an employee cut down the wrong fence. We were replacing a fence, and they were 2 identical fences next to each other. Did a walkthrough with the employee and the customer, and then a week later we came to do the job, and the employee cut down the wrong fence. They were right next to each other. And this was not like a small fence. This was a 600 feet long fence, okay? So $32,000, we had a claim for $32,000, saved the business. It was still young at the time. Now, these ones should not have been claims. If I would have known what I know now, I would have just paid that $1,000 out of pocket. I would have paid that $2,500 out of pocket. The reason for that is because after this third claim, immediately my insurance was dropped, and my insurance, the company was, did it Liberty Mutual. All right, there it is. We're trying to skirt around the fact. So Liberty Mutual, the carrier, they dropped us. And when they did that, we had to go what's called surplus lines. Surplus lines, basically, it's like surplus lines. Surplus lines of insurance is basically insurance for people that usually can't get insurance because they're so risky. Okay, so this would be like if you have a bunch of drivers that are illegal or have a bunch of DUIs, very hard to get insurance. You're probably gonna have to go to some sort of surplus lines. We had to do that for our general liability insurance and go to surplus lines. Doing that literally tripled the cost of our insurance for 3 years. Now, this one paid for itself. This was great. To have insurance for this, woohoo, great, awesome, very excited that I had insurance, saved the business. For these ones, I probably ended up paying about 5 times as much as I would have if I would have just paid for the damage out of pocket. all right? So if you can afford it when you're small, pay for these little damages and little tiny claims. Don't go pay $500 on a deductible and then have the insurance company cover $1,000. That's ludicrous. So as the company grows and you get some cash in the bank, you can make the deductible go down. So, up. You can increase the deductible so that way your premium goes down. Okay, so if the deductible goes up, the premium goes down. So now our deductible, I think, is $2,000, and that saves us hundreds of dollars every single month. And so why wouldn't I save hundreds of dollars every month and literally just put it aside to save up for the $2,000 instead of $500, right? Same thing on car insurance and vehicle insurance if you have trucks and equipment for your business. But bottom line, you need to have insurance. It could save your business. Literally, that's what it did for us. But when you're first getting started, this is not like a free ride. Like, oh, I'll just give them the bill. Like, this is all expenses paid. Like, it's not that way. At the end of the day, you're paying for insurance, and when they pay out for you, it goes on your record. It's like a driving record, okay? The same way if someone's getting a bunch of accidents, speeding tickets, all the rest of it, their insurance goes up. If you're getting a bunch of speeding tickets and all this, little damages and things like that, your insurance premium for general liability is also going to go up. Okay, keep that in mind. Don't fiddle around with small little claims. Pay it out of pocket if you can afford it. And once you get some cash in the bank, just increase your deductible so that way you're not stuck paying hundreds of dollars every month just for a lower deductible, okay? Save it for a really bad day. Do not outpay. Just pay out of pocket for these smaller expenses. Again, talk to an insurance agent. Really try to understand what's covered, what's not covered, and when you should pay the deductible and get the payout, or when you should just cover the little piddly claims and things that might come in through your business. Again, different types of insurance in terms of umbrella. There's an umbrella policy, there's a general liability, there's a whole bunch of different types of insurance. I'm not gonna go deep into that. Talk to your local or your personal insurance agent and see what's right for you. And some types of businesses require different types of insurance. And make sure you're covered for the services and products that you actually do. Again, I've seen time and time again where someone goes to make big jumbo claim and the insurance policy, the holder is like, actually, you're not covered for that. And they're shocked. You need to know what you're covered for. Negligence of employees, are you covered for if someone sues you? What happens if you sign a contract and you didn't mean to, or you were duped into it? You gotta make sure these things are covered and you know what is covered and what's not covered. And then try to eliminate the things that are not covered in your business. For example, when it comes to lawn care, some people will just get a policy under like mowing services and it's a lot cheaper, but then they'll go install like hardscaping and use excavators and big dump trucks. And then when they make a damage or there's a lawsuit around their excavation job, guess what? The insurance company's like, well, guess what? You didn't come to us and tell us that you were doing hardscaping, and you didn't tell us that you had all this big equipment, and you never said that anything about doing hardscaping. You said you were doing lawn care. We were covering you for lawn care, not all this other stuff. And you might not get a claim actually paid for. So be honest, share what you're doing, share your numbers, be open and transparent, because you don't want any holes, any loopholes for them to hop through when you try to actually make a claim, and you need it for the longevity and success of the business. All right, so now we're on to module 6, which is all gonna be about numbers. All right, so before we get into module 6, we start talking about balance sheets and profit and loss statements and income statements and statement of cash flows and just so many different things. I want to do a couple disclaimers here, because I know this is probably the module where for some of you it's going to be a little bit dense. It's going to be a little bit, treading water. And so I want to do a couple, offer a couple different scenarios for you. Number one is these modules do stack on top of each other, these videos. So if you fall behind on one of them, you're probably gonna get further behind. So this is probably the one where I'd recommend not listening to it in the background, actually watching, seeing if you can't actually watch me do stuff on the whiteboard. I'm gonna be doing a lot of numbers on the whiteboard. So this is definitely the module you wanna actually watch. And I would also say that even if you're watching and you're still kind of lost, because maybe you don't like math, maybe it still doesn't really make sense to you, I'm gonna try my best to make it as simple as possible and use simple numbers. It's the concepts that I want you to get, all right? So if don't get hung up on like one part you don't understand of like why numbers went here or there. Like I'm gonna try to do my best to make it as simple as possible, but don't get hung up on something if it doesn't make perfect sense to you, all right? Get the concepts. Okay, Assets, liabilities, okay, that makes sense to me. What's an asset, what's a liability, that makes sense to me. Get the concepts. Remember, our goal here is not for you to be able to do your own taxes or be able to be the CFO of your company, the chief financial officer. That's not our goal. Our goal is that you can be the CEO, the founder of the company, and when you're talking to your CFO and they're talking about the balance sheet and how we need to get certain types of debt and things like that, that you at least are educated about the terms and terminology behind what they're talking about. And you can have an educated discussion about, certain things in terms of cash flow or certain things in terms of interest rates and how it affects the overall picture of the finances of the business. That's the goal here, all right? The goal here is not so that you can come out of this course and know how to create a balance sheet or even, make your balance sheet perfect or make your income statement just absolutely flawless. That's not the goal here. The goal is so that you can take these concepts, and when you're talking to an accountant, when you're talking to a chief financial officer, when you're talking to another advisor that you have inside of your business, either internally or you're hiring out, that you can have an educated discussion, all right? So if you get lost, stick with me as much as you possibly can, and then maybe watch Module 6 a second time. We're gonna try to keep it really, really basic, but again, if you jump forward or you miss it, you're like, oh, I know what assets and liabilities are, I can skip the next one. Okay, but it's gonna build on each other, right? So when we're gonna start with lemonade math on the next video, and we're gonna use literally as if we were starting a lemonade stand and how that affects the balance sheet, and then we're gonna move into income statements. So it all builds on itself. I'm gonna try to keep it as simple as possible, but just don't get hung up on this. Don't get frustrated with Module 6 and not go to Module 7. Watch as much and get as much as you can out of Module 6 and go on to Module 7. I'm sure in the future I will add to Module 6 because I'm sure there'll be little parts where I could have made that transition better between videos, or I could have made it simpler, explained it a little bit better. So I'll try my best in the future when there are consistent gaps of knowledge or areas where people get hung up on. I'll try to fill those in later. But for now, if you're watching this when the course is fresh, there might be occasional times where I assume something that you might know and you don't. And I apologize for that. I'm going to try to simplify as much as possible without making a 3-hour-long video for every single one. I'm trying to make these simple and short and concise. And again, I just need you to be able to get the terminology, get the concepts, and have the ideas in your head so that when you do talk to your CPA, when you do talk to your bookkeeper, you have an educated discussion and can from that discussion, make educated decisions strategically for your business. That's what really moves the needle down the road. Moves the needle and moves the ball down or moves the car down the road, whatever, is the strategic decisions. But you do need some of this back-end knowledge in order to make those strategic decisions accurate and really, really wise when it comes to finances, accounting, and some of the numbers behind your business. Real quick before we get started with the numbers and the rest of the videos, I want to make one quick distinction, and there's going to be kind of some videos that are really short, that are just nuggets that I kind of want you to get in terms of terminology, because I need to stick with you even if you don't get the numbers and the calculations and the math side of things, okay? So what I want to talk about right now is the balance sheet. So balance sheet versus the income statements. So this is income statements. And this income statement is the same thing as a P&L or a profit and loss statement, all right? So this is all the same thing. P&L, profit and loss statement, that's the same thing as an income statement. So when someone says income statement, it's the same thing as profit and loss statement. Same exact thing, all right? What I want to make the distinction here is these are two very, very important documents. With these two documents, you can basically tell the health of a company. The balance sheet and the income statements, or the P&L, profit and loss. Now, the balance sheet, how I like to think about it is the balance sheet is like a snapshot, okay? It's a moment in time. Because the balance sheet is going to tell us what are the balances on debt, what are the balances in the bank, what is the balances of owner's contribution to the business, what are the balances in terms of accounts receivable, what are the balances of the accounts receivable and accounts payable. That's the balance sheet, all right? It's a snapshot. It's like, okay, the business is going along, bam, what's the balance sheet? What's the balance sheet? It's a snapshot, okay? It's a moment in time. The income statements or the profit and loss statement is like a story, okay? Because it's going to tell the story over the course of time, all right? Over the course of a month, over the course of a year, over the course of 5 years. So an income statement is like a story. You see the progression. You see monthly, weekly, daily. You see a whole, annual revenues and expenses. It tells a story of the business. Whereas the balance sheet, it's kind of like the snapshot. You take a picture of the business, that gives you the snapshot. You can't look at a balance sheet and know how the business is doing good. And is it getting better? Is it getting worse? You can't tell that because it's a snapshot. It's a picture. You don't know if I'm going like this, and I'm going down like this. If you take a picture of me right here, you don't know if I'm going up or down. That's the balance sheet, that snapshot. You don't know if the business is improving or if it is getting worse, all right? Whereas the income statement or the story, the profit and loss statement, it would tell different segments, maybe monthly, of this trajectory, and you'd be able to look at the profit and loss statement, look at the income statements, and see what's happening in the business in terms of the direction the company's going. Now, that is not to take away from the balance sheet, because the balance sheet is very, very important. It's kind of like the vitals of the business, because if you run out of cash, if you run out of money, it doesn't matter how good your story is, you're out of business. And so the balance sheet is very important. We're going to talk about this one first, then we're going to get into the income statements, and we're going to use the example of a lemonade stand and what that looks like when you're first getting started. So the balance sheet is comprised of assets and liabilities. All right, we're going to talk about liabilities in just a second, but let's first talk about assets. Okay, so in the future, we'll talk more about assets. I think most of us know kind of in general that assets are like trucks, equipment, real estate, whatever the company owns. What's the real assets of the business that have value, all right? But we'll talk more about it in the future. Let's make it really, really simple and make sure that we understand exactly what we're talking about here. So the equation I want you to know right now is total assets equals debt plus owner's equity. Okay, OE just stands for owner's equity. So total assets equals debt plus owner's equity. And so basically this is how it is. It's like total assets equals money borrowed from others plus the money you invest yourself into your business, okay? So the example that we're going to use for this, and we're gonna actually create let me give you this example real quick just so this is solidified a little bit more. Let's take a house, for example. Say the asset value here is $100,000. I was gonna do 100K, but we gotta start using all our numbers here. But what happens if I get $70,000 from the bank, i.e. debt, plus I put $30,000 down on the house? There it is. $100,000 total asset value equals the debt on the house plus the amount of owner's equity, i.e. the amount of money that I invest into the house. Now, a lot of people, what they don't wrap their head around is this. Just by looking at this equation, they say, well, how is it possible my total assets can equal debt plus owner's equity? Because what if I pay off my debt? That means, okay, this side's going down. Well, how are my assets going down? I'm gonna pay down my debt. How is that affecting my assets? Remember, we have not gotten into this too much yet, but cash is a form of an asset. So what's probably happening in this transaction is that I am reducing my cash and therefore I am reducing my debt because I'm using the cash to pay off the debt. Now, if I get debt, the exact opposite is true. If I go out and I go to a bank, for example, and I up my debt, goes up, I get 10,000 or whatever in debt, that is gonna increase this side of the equation, all right? But when I get the debt, I'm gonna get cash because I borrowed the money and it's gonna increase the asset value because cash is a form of an asset. Okay, so total assets equals debt plus owner's equity. When you see this equal sign, it means that everything moves proportionally. So if my assets are gonna go up, there's gotta be something on this side that gives. Either the owner's equity, like either I'm putting in more money or something's happening that they have to be balanced out here. If this goes up, something on this side has to go up, either debt or owner's equity, okay? So that's total assets. Now let's do an example. remember, total assets equals debt plus owner's equity. So let's go ahead and do your assets here. I got that, perfect. And now we're gonna do loans or debt, either way, and plus owner's equity. Okay, owner's equity, perfect. So we are going to assume that we're gonna have a girl that is going to start her lemonade business. She's gonna start selling lemonade. And she's like, you know what? I can do this myself. I don't need any loans. I don't wanna go into the debt. I am going to have this business be debt-free. So what she's gonna do, she's gonna take cash of $10, okay? And that's gonna be her total assets. You know, at the end of the day, this is the only assets that she has to start the business with. So her total assets is equal to $10, okay? Now over here, because remember, assets need to equal loans plus owner's equity. So over here, we're gonna have, let me write this up here, we have loans. She has nothing here, $0. And then she has owner's equity. Some people call this owner's contribution. Owner's equity is the actual technical term on a balance sheet. Owner's equity is $10. You say, well, I thought we only have $10. Now you have 10 over here and 10 over here. No. This cash equals the owner's equity. So now, when we add all of this stuff up, the total loans plus equity over on this side is going to equal $10, all right? So total assets equals total loans or debt plus equity equals $10. These two things need to balance out in order for the balance sheet, okay? The balance sheet has to balance. That's why when your bookkeeper says, I gotta balance your books. What are they trying to do? They're trying to make sure this all lines up. Because if this doesn't all line up, that's when the IRS is not happy. That's when your accountant is not happy. So that's why balancing the balance sheet is so important. It's literally called a balance sheet because you're looking at balances, but more importantly, you're trying to balance both sides of this equation and making sure everything lines up and is balanced, because if it's not, something went wrong. We didn't calculate something correctly, all right? But you know what? You know, Sally, because Sally is the name of the girl that is starting the lemonade stand. She's like, you know what? If I could get a loan and get some more cash, I would really probably be able to grow this business a lot faster. So you know what? I'm gonna take a loan. I'm gonna take a $40 loan from my mom, and I'm gonna get some debt on the business. I'm gonna take a $40 loan, but I need the cash. So what's gonna happen? So she's gonna take a $40 loan. She is now going to have $50 in cash, $50 cash. Her total assets are now $50. But now we gotta make these balance, because this is not, 50 does not equal 10. What do we need to change? Okay, loan from mom. This goes up here. Loans from mom. Loans from mom, the bank of mom, just gave us $40. Okay, 40 plus 10, loans plus equity equals $50. I know this is really, really simple, but this is really all a balance sheet is at the end of the day. We're gonna talk about liabilities too, but like in terms of assets, this is really all it is making sure these things balance. It's really, really, really simple. It does get more complicated, obviously, but all we're really doing is we're either adding loans or debt or owner's equity, i.e. the owner's contributing to the business, or the equity of the value of the business is going up, right? That's great. Loans or debt plus owner's equity, $50, because she contributed $10 cash, loan from the mom, 40, and over here, we end up with $50 cash. Cash is an asset. Now, obviously, in the future, the business, we're gonna have more assets, things that are worth money, and we're gonna talk about that in just a little bit, but this is really the basics of it. Assets equals loans plus owner's equity. All right, so let's talk about inventory now. So Sally wants to start her business. She went ahead and got a loan from her mom for 40 bucks. Her total assets now, 50 bucks, and the combination of her debt plus owner's equity is also $50. Again, debt and owner's equity need to equal our total assets. Now, we gotta start the business though, and we need to actually go buy some cups. We need to go buy some lemonade mix, for example. And so all of the inventory and supplies is considered an asset, okay? So what's going to happen now is we are going to get $40 worth of inventory. Now, the thing is, how are we going to do that? Well, we're going to spend our money, all right? So in order to get our inventory, we're going to take our cash and go from $50 down to $10 in cash, but now I'm going to get $40 worth of inventory. You could also call this supplies, either way, all right? But now $40, again, everything is still lined up here. Nothing on this side had to be adjusted because all we're doing is buying inventory and supplies. When you buy inventory and supplies, it's considered an asset. It's coming usually out of your cash. You say, well, what if I need debt? Again, your debt would go up, giving you more cash, and then out of that cash account, you'd be buying your inventory and supplies. But this is now what this, balance looks like. This balance sheet is looking like when it comes to starting the business. So now Sally is ready to go for her first day, her opening day of her lemonade stand. All right, so now Ashley, she actually joins forces with another one of her friends and starts opening her lemonade stand. So first day of business, now we got to talk about something else because we've talked about the balance sheet, assets equals liabilities or assets equals loans plus owner's equity. But now they're in business, they have their first day of operations, they have what's called an income statement. All right, and we're going to talk more about this in just a little bit, but for now, we just need to get these numbers to see how they affect the balance sheet, all right? So the income statement, what's going to happen is they're going to sell these glasses or these cups of lemonade for $1. Now, it costs them 25 cents per cup in cost of making the lemonade. It would be the cup, the mix, all the stuff that we've already purchased in the form of inventory and supplies. So it costs them $1 per cup. Now, they recognize that people do not always have cash when they are walking down the street. So they decide, you know what, we're going to have it where they can pay with cash or they can just write their name here and then they will owe us money down the road and we can just get the money from them later on, okay? So what they did though is they sold 60 cups of lemonade for a total of $60 in total gross revenue. All right, so that would be our total gross revenue for the day was $60. Now, the cost of the lemonade, creating the lemonade times 60, which is the cost, I should say, is, so the cost per cup is 25 cents, okay? So 0.25, and we're gonna multiply that by the amount of cups. We know that that's now $15 worth of supplies that it took to make the cups of lemonade. So at the end of the day, our total profits for the day were $45, okay? That was our total profits for the day. Now, the problem here is that only half of these 60 cups paid with cash today. The other half wrote their name on the sheet of paper, and they are now going to become accounts receivable, i.e. they owe us money, all right? So now the question is, okay, we got this income statement, first day of business, let's go. We sold 60 cups, 30 was the people on credit, 30 was people in cash, and based upon our costs for the 60 cups, we made $45 in profit. But how do we now allocate this on our balance sheet? Because everything needs to balance here. What's going to happen? So first things first. Right now we had $10 cash, and half of these lemonade people, half of them paid with cash. So now we have $30 extra of cash. Okay, great. So let's go ahead and edit this. I'm gonna use a different color here. So it's pink. All right, so good, pink for pink lemonade, let's go. So cash, they now have $40 in cash because they had a plus 30 happen here, right? So we had plus 30 cash because half of these cups were paid with cash. Now, on inventory and supplies, we had to create or make 60 cups of lemonade at 25 cents a pop. So this $15 right here is coming directly from our inventory and supplies. So now our inventory and supplies is gonna go from 40 down to 25, all right? So we use $15 worth of inventory and supplies in order to make the appropriate amount of lemonade to sell for the day. So now our total assets are gonna come to a different number. However, we gotta add something to our assets because now no longer do we just have cash, inventory, and supplies. We also have another asset that we're gonna add, and that is going to be accounts receivable, all right? So this is accounts receivable is like how much people owe you. So because they sold half of these cups in cash, they made the $30 in cash. But now they've also sold 30 cups of lemonade, and they are owed by customers $30 in accounts receivable, all right? So right here, we had the $60 worth of lemonade, 30 of it went to cash, because half of them paid with cash, and 30 of it went to accounts receivable. So now if we add all this up, our total assets are gonna come to $95. I've got all sorts of colors happening now. $95 is now our total assets. Okay, so now this isn't good because our balance sheet doesn't balance. We have $95 in total assets, our liabilities are 50. So what needs to happen in order for this all to balance? All right, so what has happened is that at the end of the day, when you have what's called retained earnings, this is retained earnings right down here. These profits are gonna go back into the balance sheet in the form of retained earnings. All right? So this is gonna be $45, and that's gonna make everything balance out. So now this is gonna be 95. Now you're gonna ask yourself, but what happens if someone actually comes back to them and pays off what they owe them? They pay down the accounts receivable. That's going to bring down the total assets. Not necessarily, because they're gonna have more cash on hand. All right, they're gonna get more cash as the accounts receivable goes down. Now the retained earnings isn't gonna change. This is how much we actually earned, our profits, our retained earnings goes up here, $45. But over here, as the accounts receivable is paid off, i.e. those customers come back and pay for their lemonade, the cash is gonna go up, accounts receivable is gonna go down, and total assets will stay the same. So now, again, everything is balanced out. Total assets, total liabilities, I should probably write this in here, liabilities, all right? The balance sheet is so important. Always think it's gotta be balanced. Assets and liabilities are our debt plus our owner's equity. Retained earnings are a part of owner's equity. All right, so that is the balance sheet. We're gonna continue to build this little business, and we're gonna come back to the income statement in just a minute on the importance of creating this as well. But this is the first day of business. Very exciting. We use some of our inventory and supplies to create $45 worth of retained earnings, $60 in sales, and we add some accounts receivable on our balance sheet. So now we're gonna assume that Sally calls all of these people who owe her money, and they get all $30 paid back to them over the next few days. So now accounts receivable is gonna go down to 0, like we stated before. I just wanna show this so that there is no mistake. 0, they collected all of that money, and that $30 now has been turned into cash. So now that $30 is added to our cash balance. So now we have $70 in cash, $25 still left in inventory and supplies, and still our total assets equals our total liabilities. All right, so Sally and her friend are super revved up and happy that their business got off the ground. Now we're gonna talk about day 2 of operations. So they decide, you know what, instead of just staying in our local neighborhood, why don't we get a couple of our friends, we'll hire them for the day, we'll pay them $10 each, and we'll go to a park outside of our neighborhood, and we will sell lemonade there, and we'll have 3 different stands. You know, the 2 of us will work, and then the 2 of them can do 2 different stands, and we can sell it to the bikers and the joggers and people that are at the park. But since we're not in the local neighborhood anymore, we're not gonna do any more credit. We're not gonna allow people to just put their name down and get lemonade. We're going to make it where they have to do cash only. So the cash only is the only way we're going to accept the lemonade sales. So what we need to do first of all is we need to do income statement for day number 2. So day number 2 comes around, they are now in the park. I'm gonna erase all of this stuff here. They're now in the park. They have 2 of their friends working for them. They're paying them $10 each for the day. They're gonna do cash only, so no more credit, no more accounts receivable for them. And when they show up, there is just a ton of people ready to buy. And literally, they sell out extremely quickly. Now, we know that right now they only have $25 worth of inventory and supplies, which means they only have 100 cups worth of supplies and inventory, 100 cups worth of lemonade. So they literally sell 100 cups of lemonade 100 cups of lemonade within like a few hours, all right? So we got 100 cups of lemonade. So right now we're working on the income statement. They have sold 100 cups at $1 each for a total sales of $100. Okay, so this is their total gross revenue, you might say, okay? Now the cost of the lemonade, so cost of inventory and supplies is going to equal, again, 25 cents a piece is gonna be $25 for that. But now we have additional expenses because not only are we going to pay our two friends $10, Sally's gonna pay them $10 each, she's also going to pay $5 to Aaron to actually collect all the money from people and put it all together and take it to the bank, okay? So their total, I guess you call wages or salaries to their employees is going to be, so let's do wages is going to equal another $25, okay? So $10 a piece for each of their friends plus $5 to Aaron, another one of their friends that is going to actually get all the money together, bring it all, count it together and take it to the bank, okay? So their total wages for the day was $25. So now when we look at profits from day number 2, profits is gonna equal $50. Okay, that's $100 in gross sales minus the cost of inventory and supplies to make the lemonade minus our wages. Now our profits are at $50. This is our income statement. We're gonna talk more about that in just a second. But now the question is, how does this affect our balance sheet? Okay, so let me just clear this up just a little bit. Okay, so we got total liabilities over here, got total assets there, so liabilities. Okay, so we wanna make sure everything is, again, reconciled and balanced on the balance sheet. So our cash is gonna go all the way up to $145. All right, so we're gonna go cash, $145, $145. So we basically added here, we had 70 before, we added 100 cash in sales minus the salaries we paid our friends, so 25 equals 75. So we had 70 in the past, that was our cash before day 2. Then we added 100 in cash from our income. Then we minused out our wages, and there's our $75 worth of extra cash. Now you're saying, well, that doesn't really make sense because why didn't you just add 50? Why didn't you add 50 in profits? Why didn't that go over here? Well, because at the end of the day, this is coming from our inventory and supplies. Technically, when we sold $100 worth of this lemonade, $25 of that actually was going towards the inventory and supplies. Okay, so what happens now is we did 100 in sales minus the amount of money we paid to our friends, but we're not going to take out this inventory and supplies because that is still going to show up on the balance sheet, but it's coming now out of inventory and supplies. We ran out of inventory and supplies, so this went to 0. Okay, this went to 0. So $100 in total sales minus the wages. We did not minus out the cost of inventory and supplies because that came from over here. All right, so now our inventories and supplies is at 0 because we sold out all of our inventory. All right, so if we add all this up now, our total assets, when we add this all together, it's gonna be $145. We don't have any accounts receivable because we didn't take any credit. We have more cash on hand now, and then the $25 of inventory and supplies has now been sold, okay? Now, if we look at what happens on this side of the equation, total profits for both days is $45 on the first day, we got that, plus $50 on day 2. So now our total retained earnings is going to go all the way up to $95. All right, so now our total retained earnings is $95. Everything else held constant. We are going to come up with $105 for the fact that we have 105 in total equity. What's wrong here? I did something wrong. Oh, it makes sense. Sick. So now when we look at the liability side of things, we add all this up. What does it come to? $145. All right, again, our assets equal our liabilities, and our liabilities is equal to the loans that we have from our mom, as well as the OE, or the owner's equity that we have in the business. Retained earnings is considered part of owner's equity. Balance sheet is balanced. Now let's talk about income statements, breaking this down a little bit more. All right, so now we're gonna talk about the income statement, but I'm gonna kind of make like a flow diagram to explain how the income statement actually works. So this is kind of like a summary overview of it all. We'll dive into it a little bit in just a little bit, all right? So the first big chunk of the income statement is gonna come from operating activities, and the second little part is gonna be financing activities, okay? So bear with me for just a minute, all right? So first off, we gotta talk about sales, all right? This is your sales or revenue, okay? I gotta write small because it's a pretty long list here, all right? And if we minus out, we subtract out cost of goods sold, COGS is what it's also referred to, cost of goods sold. This includes the cost of acquiring or producing the product or service to be sold, all right? So cost of goods sold, this can, like, for example, if you're in lawn care landscaping, that's gonna be like the actual labor, like the cost of goods sold include not only the materials, but also the labor to actually create the goods or service. So cost of goods sold, all right? And that is going to equal your gross profit, all right? So a lot of times when people start talking about profitability, this is where you gotta ask them, is this gross profit or is this net profit? Because there's a big difference. Because this is gross profit, just wait until everything else that's gonna come into play before we hit net profit. All right, so now if we subtract out of this, we do gross profit, and we subtract out our operating expenses, so OpEx, that's operating expenditures or operating expenses. This includes like your marketing, your selling, general and administrative, so if you're like an office. It also includes your depreciation expense, all right? So operating expenses is really big, okay? There's just so much that goes into that in terms of if you're doing ads, so that's all of your marketing expenses. Any sales activity, like what do you have to do in terms of like selling, sending out samples, things like that, is all part of your operating expenditures, operating expenses. OpEx is what we call it, okay? So that is going to equal your operating profits. Okay, so if someone says, well, what's your operating profits? Okay, that's different than gross profits. That's gonna be different than net profits. All right, so keep this in mind. So sales, our revenue, minus our cost of goods sold equals our gross profit, minus our operating expenditures, like our marketing expenses, like our selling, marketing, advertising, our office, administrative, all of that stuff equals our operating profits, all right? Now, this is really also known as earnings before interest and taxes, all right? Before interest and taxes. So if someone says, what is your earnings before interest and taxes? They're talking about your operating profits, okay? So next up, so we got operating profits. Now, if we go, the next part, like this is all what we call I don't want to write anything more. Sure, I will. So this is all operating, can't spell. These are all considered operating activities. Operational activities, I guess you say. Activities. Now, from here though, we're now gonna go up to here and we're gonna start talking about financing activities. Financing activities. Okay, so when we talk about financing though, there's, again, we're not operating profits, haven't taken the fact that you might need financing. So this is going to be interest expenses. So now we got to minus out interest expense, and that, so again, operating profits minus our interest expense, or this is also considered like the cost of borrowing money. So cost to borrow, because you might pay this not necessarily in the form of interest, you might pay this in the form of points, which is like if I pay 2 points on $100 of a loan, that means I gotta pay $2 no matter what. It's like a fee for the loan. So any sort of interest expense or cost to borrow money is right here. So this equals profits before taxes. So this equals profits before taxes. So again, you got like gross profit, but then you got to minus out your operating expense. That's your operating profits. Then if you take out the interest expense or the cost to borrow money, that's your profits before taxes. All right. Now you still got to take into account the fact there's taxes, and those are never going away. So you got to minus out your income tax. Then, and only then, can you truly say that you have net profits. Okay, So this is the income statement summary. You got sales and revenue, minusing out your cost of goods sold, your COGS. That's gonna be the material, the labor, all of that good stuff to actually make the product or service. That's your gross profit. Minusing out your operating expenditures, your marketing, administrative, office, etc. That's your operating profits. That's your earnings before interest and tax, which interest and tax is considered financing activities versus operating activities over here. Then over here, we got financing charges or cost to borrow, interest expense. That equals out your profits before taxes. But then you take your income tax, that becomes your net profit. So the question is, what is most commonly used? And this is actually what's most commonly used, because this is earnings before interest, taxes, and appreciation, EBITDA, all right? So we're gonna go through more of these different types of profit margins and words like this, but EBITDA, if someone says, hey, what's your EBITDA? That's earnings before interest, taxes, and appreciation, all right? That's earnings before your financing activities on your income statement, okay? So that's earnings before interest, taxes, and appreciation. When someone asks what your EBITDA is, or that's like when you look in the stock market and someone says, what was their EBITDA? They're asking, what was their earnings before interest, taxes, and appreciation? But that's not the full story. You can have a great EBITDA, but if your cost of interest is through the roof, if you have a horrible tax situation, you still might not make any net profits. So again, just keep in mind, gross profits are definitely not equal to net profits. That's your income statement in a nutshell. All right, so we went through the entire income statement from start to finish. Now I want to actually show you some examples. Really, we're just going to take what we just learned in the last video and put some numbers to it so you can see it in a little more detail. All right, so we're going to start off with this company, this hypothetical company that does sales of, you know what, let's do different colors here. $850,000 in sales. I'm going to draw all the zeros here. And then again, we take out our COGS, so cost of goods sold. COGS are going to come out of that, and that is going to be a negative number of $550,000. $550,000. And you're going to notice throughout the rest of the course, whenever a negative number in a financial statement is being shown, it's traditionally just shown in brackets. All right, so if you see, or not brackets, parentheses. If you put parentheses around a number, it just means a negative number. All right, so when we actually put all of this out, it's going to be $300,000. And if you remember from our last video, this is going to be considered gross profit. Gross profit. So our gross profit of $300,000. But as we learned in the last video, that is not our total profit. All right, it's not our net profit. So now we're going to go over the operating expenses. So let's do operating expenses. Okay, so underneath operating expenses, we are going to have marketing expense. Do some marketing, and let's go ahead and spend $90,000 in marketing. $90,000. Then we're going to do general G&A, or general and administrative. G&A, general and administrative. And we're going to go ahead and spend $80,000 in G&A. $80,000. And then also as part of our operating expenses, we're also going to spend $30,000. It's going to be considered depreciation. Let's do $30,000 in depreciation. All right, so now our total operating profit is after all of this. So let's go ahead and mark that. So the total on our total operating expenses, if you add it all up, is $200,000, right? So if you add all these up here, that's $200,000. And so we're going to less that from our gross profit to come out to our operating profits of $100,000, right? So let's do operating profit is going to be $300,000 minus $200,000 equals $100,000. Okay, we're going to continue on. Now we're going to start doing the financing expense side of the business. So let's start off, we have our operating profit, but now we are going to have, let's do this one, do interest, cost of interest. Let's go ahead and assume that we are going to spend interest expense of $20,000, so $20,000. And then that's, again, we talked about this on the last one. These are now financing activities of the business in terms of on the income statement. So interest, we take it off. Now this is our profits before tax. If we go here, so profit before tax is now going to equal $80,000, okay? But now we still have to do taxes. So we're going to do an income tax of 20%. So let's do tax of 20%, income tax we're just going to assume. So if we take 20% of our $80,000, that's going to be $20,000. Again, negative for that. Therefore, we then have our net profit of $60,000 right there. So that's our net profits, $60,000. That's a 7% net profit margin off of the original $850,000. And then after your net profit is when you would take dividends, or you would basically add to your retained earnings, because at the end of the day, this $60,000 on a balance sheet needs to be accounted for somewhere. So what I might do is, you know what? I'm going to take 15,000 of this and pay in dividends. So I'm going to do dividends. I might say, okay, well, I'm going to do 15,000 of that in dividends. So that's going to go to, owners distribution, stuff like that, whatever you want to call it. And then that's going to leave $45,000 remaining in the form of retained earnings. And remember, this is what's going to make sure you put on your balance sheet, because this is going to stay in the business, right? So net profit, that's kind of like a very important number, but then your dividends is how much money of that is going to go back to the owners. Retained earnings is, basically what's staying in the business. $45,000 at the end of the day is what's going to be staying on the balance sheet in the business. So this is kind of an income statement like we watched in the last video, we talked about in the last video, but kind of adding some numbers to it and saying, okay, we have an $850,000 business, cost of goods sold, always a big chunk usually, gross profit, our operating expenses comes under our operating profit. Then we got to take out our interest expense. Then we got to take out our taxes. That then gives us our net profit. And then after the net profit, if we're going to take dividends, that's going to be showing up here in the income statement. And then the retained earnings, what's left in the business, retained. That's kind of what I think about retained earnings left in the business. That's going to end up being on a balance sheet on the liability side, because it is considered owner's equity. All right, there you go. All right, so we've talked about income statements, but I just want to kind of summarize it really quickly. And I know it might seem a little bit repetitive, but the goal is so that when you think about income statements, it makes a lot of sense to you, okay? So in summary, an income statement is really answers the question, how profitable is the business? And when you provide that answer, the income statement and the report that you get from that financial document is really related to 5 different kind of broad areas of business activity. So we already talked about these, but I want to go over them real quick. Sales. Obviously it's going to be showing the sales aspect of things. Revenue. So sales or revenue. And then it's going to be obviously talking about the cost of producing or acquiring the goods and services. Okay, so this is going to be the COGS. All right, so the COGS. And that's just like, what does it take to actually get the product or service made? Okay, that's COGS. And in every one of these elements of the business, you could be seeing faults or issues. And it's important to look at not just net profit at the bottom of all this, because there's a good chance that maybe you have a broken sales system. Maybe you have a cost of good or inefficient process for producing the said product or service. So every single one of these elements can be broken down and really need to be dissected to see if there's an actual issue in a business. The next part is the operating expenses, and we've already talked about these, but again, this is where an issue in the business can be. Overhead, marketing, someone's spending way too much money in marketing expenses, and general administrative, rent, because you have too fancy of an office, managers' salaries, people that aren't actually producing the product and service. This is a massively bloated category of the income statement, and this is, again, these are just the 5 different areas I want to go over that really highlight what are highlighted inside of an income statement. The next part is going to be not our tax, but our interest expense. Okay, and again, this is where a potential business could have a big issue if they have a bunch of loans and a bunch of high interest debt. This is where debt consolidation might be important if you have a lot of high interest rate debt, to be able to consolidate it under something like an SBA loan, which you talked about, that might have a lower interest rate than credit cards or high interest loans that you've taken personally. All right, and the fifth one is tax expense. Okay, so every one of these categories on the income statement, these are two completely different areas of the business, in my opinion. And if there's an issue with what pops out at the end, which is going to be our net profit, if there's a problem with this, it could be an issue with any one of these 5 things, okay? You could have just a bad sales system, people not being able to sell, not trained how to sell, bad revenues, no growth. You could have cost of goods, there's going to be inefficiencies, not having lean manufacturing, not having lean thinking, and making sure everything is done very, very efficiently. Operating expenses, again, could be bloated with rents and manager salaries and sales expenses and advertising costs. Interest, tax, same thing. All right, so these are the 5 areas that you really need to look at when it comes to the question is, how profitable is this business? All right, so if someone asks you that, you can't just say, oh, well, here's the net profit. There you go. No, you need to look at each one of these 5 things and ask yourself and kind of grade it based upon all 5 of these areas. Then you can answer the question, how profitable is this business? All right, so I know we've talked about the balance sheet using Sally's lemonade stand, but I want to talk about it in more general concepts right now as an overview, and we're going to dig into each element of the balance sheet. So we've already established that the balance sheet is assets equal to debt plus owner's equity. All right, so we've established that already. We've talked about that. Now I'm going to break down what is debt. What is debt and owner's equity, and then what are assets. Okay, so we're going to break them down into different categories. So first of all, we have assets. So under assets, we have several different categories. We have current assets. Now under current assets is going to be things like cash, accounts receivable. Okay, so let's just write these out. Cash, we have accounts receivable or AR. We also have inventory. How I like to think these are like easy to access. They're right here, right now. They're current. They're more liquid almost. That's kind of how I think about it. It's like liquid assets, okay? Things that I could, cash, I can easily get it and suspend it and all the rest of it. Accounts receivable, I have it there. It's right there. It's immediate. It's current assets. Inventory, same thing. I go liquidate. I can go sell it right now. So those are my current assets. But then also, when we talk about assets, we got to now add in also that there's fixed assets. And I like to think of them as fixed, like they are almost like bolted down a lot of times. So for example, it's gonna be like machinery, equipment. Let's write these down. Machinery, equipment. This could also be like buildings or land. All right, so buildings. And if you're doing like a leasehold improvements, so if you rent a land, your fixed assets would actually be under building and land. It would be like your leasehold improvement. So improving the current building or land, okay? And then we also need to add in other assets. So we have current assets plus fixed assets plus other assets, okay? And that's gonna be like long-term investments. It's gonna be patents. These are very, very hard a lot of times to liquidate. It's kind of how I like to think about them. So these are like, let's just say long-term investments, like patents, any sort of IP, like copyrights, things like that. These are other assets. So it's sometimes hard to value a patent, like these intangible IP, and we'll talk more about IP, intellectual property, down the road. But is it a form of asset? Like, is it a definite asset to the business to have a patent? It's definitely long-term investments is what I meant to write here. These are going to be things that you are investing in for the long term. You might take some of the retained earnings or the distributions and put that in, like, say, a mutual fund or something like a long-term investment. That's going to be there. Patents as well. So kind of in my mind, how I look at the asset column is like from most liquid, like cash, all the way to down to like the least liquid. The thing that's like difficult to sell. It's long-term. It's, very, very, specific to my business, like a patent. And then in between is like fixed assets, like machines, equipment, things that are bolted down, buildings, land improvements, all the rest of it. So they're your assets. That's your asset column. Okay. Now, on the debt and owner's equity side, there's also, more things we got to go over. So we got debt. Let me see here. This is gonna get a little bit long. But we got current. This is also sometimes referred as short-term debt. So this is gonna be like, your credit card. This is gonna be like very, very, again, speed up here is like how fast can I get rid of it, how fast can I access it. Same thing over here with debt, right? So over here we got, let me do this, accounts receivable. Okay, so over here we got, sorry, not accounts receivable, accounts payable. Accounts payable here. So accounts payable, it's right now, like I have to, it's current, it's short-term, debt and obligations. We have accrued expenses. So accrued expenses over here. We also are gonna have short-term notes. So any sort of debt that you might have that's short-term notes, okay? So this is like current short-term debt. That's really what we're looking at here. Okay, so that's the first firm. Plus, we also have long-term debt, because right now this is the debt column. Like this first part here is debt. Okay, because of course we have debt plus owner's equity. So this is the first part. This is the current and short-term debt. Now we have long-term debt. This is going to be like your mortgage. So long-term debts. And so this is going to be like your mortgage or other long-term notes. So long-term notes plus like things like a mortgage would fall into this, a 30-year mortgage. If you got like a SBA 504, you have like a 27-year, something like that, that's going to fall under long-term debt. Now plus, so remember we have debt plus owner's equity. So now the owner's equity standpoint down here plus owner's equity, there's several things that are going to fall into this one. So underneath the owner's equity portion of things, just go ahead and owner's equity. Underneath this, we're going to have several things as well. So we have the sole proprietor's net worth, or, so underneath owner's equity, you can have several things, right? You can have a sole proprietor's net worth, or, let me do an or here, green. Or you can also have a partnership equity. So again, if you're in a partnership, partnership equity. Or, because again, you might have a C Corp where you have common stockholders. So you could also have common stockholder equity. Common stockholder equity, right? So if you, sole proprietor, obviously you're gonna own the entire thing. Partnership, you're probably gonna have 1, 2, 3 people. A partnership type of entity structure. Common shareholder equity is gonna, like, if you own shares in a company and usually like a big company like Apple or Amazon or whatever it might be, the equity is gonna go to the common shareholder because you're a C corporation, you have that type of equity structure. So at the end of the day, this is your total assets. This is your total debt and equity, okay? So this is the balance sheet, and this is what goes into it. We've talked about it in abstract. Now we're gonna go into each one of these different categories and talk more about them. I know it kind of seems like we just did a whole bunch of review, but again, I wanted to put this out here. This is your total assets plus your debt and your owner's equity, and that makes up your balance sheet. Now let's dig deeper into balance sheets and each one of these categories. All right, so we're now gonna go through the balance sheet and break it down. So the first thing at the top of all balance sheets is current assets. So current assets are also looked at as working capital. So current assets. And how I like to think of it is like current assets are equal to working capital, which is also really another word for liquidity. So we're going to talk about that just here in a second. Liquidity has a relation to do with liquidity. So current assets equals your working capital. So you hear people say, hey, what's your working capital? The reason it's so important in terms of what is your working capital is that working capital needs to be liquid. It needs to be, you can access it easily. Assets that can be converted into cash relatively quickly is considered a current asset. So you can't have long-term real estate or anything like that as a current asset. This needs to be stuff that you could literally sell very quickly. It has it's marketable, you can sell it very quickly, and we're gonna go through 3 different types of current assets. So the first one is really simple, cash. Pretty straightforward, it's in the bank. This is the money used to do payroll, really just bankroll the business. It also though can, like as the business grows, it can be like short-term market, like government marketable securities can fall into this kind of category. They're almost considered cash because they don't move very much, they're not very volatile, and you can move them in and out very quickly, and they're short-term, right? You can't do a long-term like 10-year bond. That's not considered cash because it's not easily converted into cash quickly. All right, so again, current assets equals working capital, and that is gonna have to do with the liquidity of the business because it needs to be liquid. It needs to be, when we talk about liquid, I think about like, pouring water into a glass. It's liquid, it's very fast. I can just quickly pour it. Now, if it's ice, I have to wait for a long time to melt before I can pour the liquid into a cup. It takes a lot longer when it's frozen. Now, if it's liquid, I can quickly do it. So it's short term. Whereas the solid or a long-term marketable security or other forms of assets are not considered current assets because they're not liquid. They can't be turned into cash really quickly. So the first one is cash. The next one is accounts receivable or AR. Okay, so we're gonna refer to it as AR, which equals accounts receivable. So accounts receivable happens when your product or service is sold, but prior to you getting the money for it, there's a gap. There's a space of time where it hasn't been converted to cash, it's still accounts receivable. So the product or service is sold, but paid later. It's paid for later. So this is, you do services all month, and then you bill the customer at the end of the month, and then you do all services all month, and then you bill them and you invoice them at the end of the month, or charge their credit card, for example. Throughout the month, your accounts receivable is growing because you've done the work, but it hasn't been paid for yet. Still another form of a current asset. It's gonna be really important if like a creditor is looking at your business, for example. They're looking at your accounts receivable because it's basically like cash. Like it doesn't take a lot of work to make accounts receivable cash because it's money owed to you. So you just gotta go collect it, basically. So that's why it can be considered working capital or current assets. The last form of current assets is inventory. So in service-based businesses, we don't have a whole lot of inventory, if any at all. This is going to be the raw materials or the products themselves once they've been created while they're being held for sale. Like they haven't been sold yet, they're in inventory. They're just sitting around, whether it be the raw products or the actual manufactured good. So again, service-based businesses don't have a lot of inventory usually, but your manufacturers, your wholesalers, and your retailers, they do have quite a bit of inventory, and that is going to be considered a current asset because again, you could quickly sell your inventory. If it's raw materials and there's a price and it's a commodity or metal or something like that, you can quickly sell that inventory and turn it into cash. And again, in order to be considered a current asset, it needs to be liquid. It needs to be easily turned into cash. Therefore, this is also current assets is also considered working capital. All right, so I want to talk about the working capital cycle. So the working capital cycle. Okay, so this is the cycle that working capital goes through. And for a service-based business, this is pretty straightforward, but for manufacturers, wholesalers, and retailers, it's a little bit differently, all right? So first of all, you purchase or produce the inventory to be sold to the customers. So first of all is produce inventory. Produce inventory. Okay, now if you are a service-based business and you use materials, there is going to be definitely some amount of inventory still, but you usually don't have as much. Retailers, people that actually create goods and physical products, they're going to have a lot more inventory. All right, so that's the first thing. Let's get a different color here. The next thing is going to be to obviously sell the product or the inventory. You got to sell the inventory, all right? So sell the inventory. And then it really depends if it's a cash product, cash sale, I should say, or a credit sale. Just like we have with Sally and her lemonade stand. She had some people pay with cash, some people pay with credit card. So we're gonna sell the inventory. There's one very fast way to get cash, and that is if they sell if you sell the inventory for cash, right? So sell for cash. This is literally a matter of like, I buy product, I give cash in bank. Very, very simple working capital cycle. But there's also if you sell the product or you sell the inventory on credit. So we can also sell on credit. So this is going to be where you have payment terms, like you can pay off this invoice in 30 days or in 10 days or sometimes 60 or 90 days, depending on, usually a lot of times, the sales cycle that the client has. So if they have 60 days, they want to pay in 60 days or 90 days, whatever it might be. The bigger the client, the bigger like B2B, if you're dealing with big corporations, a lot of times they're going to be asking for payment terms. They don't want to just, give you their credit card or give you a check every single time you do service. They're going to want to sell on credit. So what happens is when you sell on credit, you're now going to increase your accounts receivable. So you're going to increase your accounts receivable as you sell the inventory on credit. Then what's going to happen is you're eventually going to collect. All right, and this is the part that some entrepreneurs fail to do when they sell on credit, is they forget to collect. I'm gonna actually put collections, because you actually now need to collect if you have accounts receivable. If someone's just paying with cash, you don't have to, go and try to find them or make sure that they are paying, etc. Because they pay the minute they get the product or service. When you sell the inventory. Now, when you sell on credit, accounts receivable is going up. Now you've got to collect. You've actually got to collect on the goods and services that you've sold. And this is a lot of times where people fail in the small business, and they allow their accounts receivable to go up, and people are owing them money, and now it's 4, 5, 6 months gone by, and their accounts receivable is still going up, and they're not collecting because until you actually collect on credit sales, there is no cash made, all right? And so even in a service-based business where you are performing services throughout the month and then charging on credit at the end of the month, that is a form of selling on credit because you are performing the services before they actually pay you. So if you're going to do that, if you're going to allow that to happen, your accounts receivable throughout the month is growing. You need to collect very quickly, whether that be making sure you have credit cards on file, whether that be making sure your payment terms are that they pay within 14 days instead of like 60 days. You want to make sure that the collections process is as fast as possible, all right? The amount of cash that you have on hand at any given time is dramatically increased if your collections process is slow, all right? So this is the working capital cycle, whether you sell for cash or whether you sell for credit. When you sell for credit, realize you open yourself up to accounts receivable. Not a bad thing. It's almost like standard in most businesses, but you've got to collect on this money as soon as possible, whether it be reducing your payment terms, so instead of 60 days, they only get 30 days, whether it be getting a credit card on file, whether it be trying to get 50% of the inventory that you sell in cash, i.e. right away, and then the other 50% at the end of the job or the end of the shipment of product, then you collect on the other 50%, but at least you get some of it in cash right away. So something to think about is the working capital cycle. Faster you can get from inventory, raw products, raw goods, raw labor into cash, the better. All right, so the next part of the balance sheet is fixed assets. So we talked about current assets, now we're going to talk about fixed assets. And in the same way that current assets are very easily the liquidity is high, they can be sold very quickly and turned into cash. Fixed assets, in my mind, they just can't be turned into cash as quickly. You can't just immediately sell your building and your cars and your trucks and everything your business has. It's not as simple. You can't just quickly turn it into cash. So fixed assets, in my mind, is like everything that's bolted down, everything that is physical in my business. So let's go over this a little bit more in detail. So we're talking about fixed assets. It's also sometimes referred to as PPE. Assets, let me just spell this out first. So sometimes people refer to it as PPE, and that just stands for property, plant, and equipment, okay? So PPE, I don't use that because PPE is also personal protection equipment, and so I get mixed up sometimes. So I just stick with fixed assets, but sometimes you'll hear people say PPE, but there's property, plant, and equipment. So this really includes land, buildings, machines, trucks, computers, and really every physical asset that the company owns that will be used in the business for at least 1 year. So 1 year or more, anything that's fixed. fixed asset is going to kind of encompass all of those things. On the balance sheet, a fixed asset is listed at the original cost of when it was purchased. Okay, so it's very important. We're going to talk about why in just a moment. But as the value of the product, or the fixed asset, I should say, goes down, you don't adjust that. You don't adjust the asset value on the balance sheet. You're going to use depreciation over the lifespan of that fixed asset. So, for example, most fixed assets are depreciable, which means they wear out over time. They become obsolete over time. For example, like I can buy a brand new computer today, but in 5 years it's like old news. It's unusable almost. Let's say 10 years. But what you could say is then that fact that I got to depreciate the value of that fixed asset over the course of the usable life, 5, 10 years, whatever I assume. But on my balance sheet, that the original price at which I paid, the original cost is what's going to be on there. Depreciation is going to be a different line item when we talk about fixed assets, all right? So for example, before we talk about depreciation, when you think about a truck, or you think about a computer, or you think about a building, these are all PPE. These are all fixed assets within the business. A truck, over time, it goes down in value. If I buy it brand new, it might be $30,000. 15 years later, it might be worth $3,000 or $4,000. The depreciation, that is what is going to be on the balance sheet as a separate item, but the actual the fixed asset is going to show the original price, the original cost that was paid for that truck. Okay? Same thing with the computer. If I paid $1,000 today, maybe in 5 years it's only worth $100, but I'm going on my balance sheet under my fixed asset, so there's going to be $1,000, and then depreciation is going to slowly chip away at the value of that fixed asset, but it's going to be a separate line item. Same thing with a building. So depending on what type of building you have, traditionally it's like 25 to 30 years, 27 and a half is a lot of times what people use. Depends a lot of times on your mortgage, but that's going to be the rate at which you're allowed to depreciate the building, which basically means after 27 and a half years, the building's basically quote unquote worthless on your balance sheet, okay? Because you've depreciated it over the 27 and a half years. That's the lifespan of that fixed asset, and now it's technically worth nothing. Now, when it comes to taxes and all the rest of it, that's when it starts to become really interesting, because we know that a building probably lasts longer than 27 and a half years, that a truck or a piece of equipment actually lasts longer than 5 years, which we might put as a lifespan for the fixed asset in terms of depreciation. Don't worry about that too much. We're going to talk about depreciation in just a moment. But for now, just know that fixed assets, any sort of physical product, physical asset that your business has that you're going to use for more than a year, that can't be turned quickly into cash. It's not like money in the bank. It's not like your inventory that you can quickly go sell. These are things that are like locked down, parts of your business, their equipment. You're using these for long periods of time, and many times they're depreciated. When it comes to the balance sheet, the original cost that you pay for that fixed asset is going to be what's on the asset side of the balance sheet. Okay, so when you're looking at a balance sheet, what you're usually going to see is something like this. Your fixed asset, and then you're going to have your gross fixed asset, your accumulated depreciation, and that comes out to be your net fixed asset. So what it's gonna look like is you're gonna have your gross fixed asset, which is kind of like equal to what you paid for it, like we talked about in the last video. The original cost of the fixed asset is gonna go up top here, okay? So that's gonna go, original price that we paid for it. Accumulated depreciation is gonna go up over time, because as the fixed asset goes down in value, the depreciation is increasing, okay? And that's gonna come out to your net fixed assets, all right? So now let's take a look at what that actually means, okay? Just to kind of give an example. So we're gonna talk about a truck. The truck, we bought it for $20,000. So the fixed asset, the gross fixed asset, the day we purchased it is $20,000, okay? So the gross fixed asset, I just kind of shorthanded it here, is $20,000. Now, the accumulated depreciation after the first year is going to be $5,000. Again, parentheses around a number is like a negative number when it comes to accounting. So negative 5,000 is the accumulated depreciation. So the net fixed asset is $15,000, okay? Now we move on to the gross fixed asset in year number 2. What is it? Still the same price that we paid for the truck originally. Okay, so the gross fixed asset never changes. So let's just go ahead and save ourselves some time, because that never changes over the course of the 4 years. We have assumed here that we are going to depreciate this, or what's called straight line depreciation, over the course of 4 years until at the end of the day, the net fixed asset is worth 0. Okay, so this is straight line depreciation. What that means is every single year, we're going to have accumulated depreciation of $5,000. And what that means is that in the second year, it's going to be $10,000, $15,000 of accumulated depreciation. And finally, our depreciation is going to be negative, exactly 0, because our GFA, our gross fixed asset, minus our accumulated depreciation is $20,000 minus $20,000. So this is what's called straight line depreciation. Every single year, we're taking $5,000 more in depreciation. That means it's straight line. We'll talk more about this later when it comes to taxes. But this is straight line depreciation with a lifetime usefulness, or like lifetime, like how long can this truck be used? If we bought this truck for $20,000, we're going to do a straight line depreciation over the course of 4 years. A lot of times at the end of that, people will sell it, or you just say, hey, look, I can't depreciate anymore. The reason people will sell after this is because no longer can they take this depreciation when it comes to taxes, okay? Because there's nothing more to depreciate. But what's going to happen to our net fixed assets is it's going to go from $10,000, and then here it's going to be $5,000. And so this is a lot of times what people think of in terms like the present value of that truck. Because the truck's obviously being used, is decreasing in value. After a year, it's only worth 15. Year 2, it's worth 10. Year 3, it's worth 5. So on paper, when it comes to the balance sheet, after 4 years, it's worth 0. But again, good chance you're going to be able to go sell that piece of equipment, or keep using it without having to go buy new equipment, but you're not going to get the tax benefit of depreciation. Okay, we'll talk more about the tax implication in the future, but what you need to know right now is that fixed assets, like we talked about, are usually depreciable. Because we're using them more than a year, we're going to depreciate them on our balance sheet. The gross fixed asset, the cost at which we purchased the original piece of equipment, truck, land, whatever, that doesn't change. But our accumulated depreciation goes up over time. Most of the time, we're going to use straight line depreciation, which means we basically take the total GFA, the gross fixed asset, divide it by how many years we're going to depreciate this item over, and then it's just a matter of 5,000, 5,000, 5,000, 5,000, which is basically 20,000 divided by 4 is $5,000. That's straight line depreciation. Our net fixed asset is going to be taking into account the fact that this equipment, this truck, this computer, this land, this building over time is deteriorating. It is eventually going to go, it's not worth anything. It eventually is obsolete, the equipment, the truck, etc. And so that's why the net fixed asset value goes down over time. We'll talk more in the future about why depreciation is so important when it comes to taxes, why some people would sell this piece of equipment when the full lifetime use of that piece of equipment is completely depreciated or fully depreciated, because they might want to just go sell it so they can get another piece of equipment, because depreciation is gold when it comes to taxes. So we'll talk more about that in the future. But for now, just realize that fixed assets depreciate over time. They're long term. They can't be turned into cash easily. And this is how accumulated depreciation works over the course of a straight line depreciation schedule. All right, so now we're going to talk about current debt and short-term liability. The whole time we're talking about the balance sheet. So we want to make sure that we always have the fact that assets equals owners, equity, and debt. All right? So we're always going to keep that in mind as we talk about the balance sheet. So there's really 3 different areas that short-term liabilities or current debts are going to fall on the balance sheet, and 3 different kind of areas. Number 1 is accounts payable. This is also referred to as trade credit. Okay, so this is going to be like you have a vendor, someone that is your supplier, and they give you materials and for you to purchase your inventory. And a lot of times it's going to be like 30, 60 days. We're going to talk more about different payment terms in the future, like net 10, what that means. You can get discounts for paying it sooner, but at the end of the day, accounts payable is going to fall over here on the debt side, and it's going to be short term, right? 30, 60 days, and as inventory on this side goes up, you're purchasing that through accounts payable many times. You're gonna pay it off in like 30 or 60 days, which then would affect cash, okay? So as I purchase more and more accounts payable, as I get more and more accounts payable on this side of the balance sheet, on this side, I am going to have an increase in inventory. So inventory goes up on my asset column, my accounts payable is going to go up on my debt column. All right, then the second area is accrued expenses. What this means is the expenses that are incurred and owed but not yet paid. The best example of this is payroll. So for example, someone can work for like a week, but still their pay period is another 4 or 5 days away. So from a business standpoint, I'm accruing those expenses as they are being given to me, every hour, every day, etc. However, they're actually not paid until the end of the pay period. So, the payroll, any sort of wages, hourly earners, anyone that is actually on salary, you still are accruing those expenses throughout the pay period, and then you pay them, and then they get their money. And so then your accrued expenses will go back to zero. So when the employee is paid, accrued expenses goes down while cash goes down, okay? So you have all of this cash sitting over here. We have accrued expenses going up, up, up as the pay period happens. And then what happens is we spend the cash, so that falls, and then accrued expenses also drops down because now we've used the cash to pay off those accrued expenses, all right? The third one is short-term notes, okay? This is going to be debt that is payable within 12 months. So money that's borrowed and you're only going to use it for 12 months or less. And in general, short-term liabilities and current debts traditionally are thought of as 12 months or less. But short-term notes, more specifically, is actual loans that are 12 months or less. When we talk about current debt, short-term liabilities, anything less than 12 months, whether it be accrued expenses, accounts payable, those are always things that you kind of owe money, but it's not long-term. You're not spending more than 12 months on paying your vendors underneath accounts payable. You're not going to be having accrued expenses for longer than 12 months where you don't pay your employees for that long. Those are going to be short-term, 2 weeks, 3 weeks, a few months maybe on to pay back those debts. That's why they're considered short-term or current when it comes to the debt category. The other form of debt is what's called long-term debt or long-term notes that you can have on your balance sheet. Again, on the debt side. And this is going to be when any sort of loan or money that you borrowed is payable with outside of 12 months. So 5-year notes, 10-year notes, 30-year notes. Now, if that note or that loan is against real estate, for example, you buy a warehouse or you get a bunch of land to build a headquarters on, for example, that amount of money, that is going to be called a mortgage. And again, that's just long-term debt or a long-term note that's going to be on this equation, this side of the equation on the balance sheet. Okay, so now we're going to talk about retained earnings and owner's equity. Maybe you've been listening to the whole balance sheet part and you're like, I don't even really know what owner's equity even means, because that's, again, this part, now it's gone, I've erased it, the owner's equity portion of the other side of the balance sheet. What is that? Now we're going to explain kind of what that is all about. So owner's equity is money that the owners invest in the business. And most commonly, when we think about owner's equity, we think about the startup capital required, or writing a check or investment. This is also called owner's investment, like the initial amount of money to get the business going, the money that goes from the owner into the business, like money from owner to business, owner's investment, okay? And that can happen throughout the business as it grows. Maybe the owner still has to continually put money into the business to make it grow, keep it alive, etc. But also, another form of owner's equity is what's called retained earnings. And what retained earnings is any profits that are left in the business and reinvested are considered retained earnings. And that's a part of owner's equity. Okay, so if I have $100,000 in profit at the end of the year, but I only take $50,000 for myself and I leave $50,000 in the business so it can continue to grow and expand. That means that I have $100,000 worth of owner's equity because I have had $50,000 to me in profits, and I have $50,000 in retained earnings, i.e. it's still profits, but it's in the business. There's earnings, but retained inside of the business. Okay, so retained earnings are profits not paid out as dividends over the life of the business. Okay, so retained earnings. Now we got to actually do some numbers. All right, so retained earnings equal. So retained earnings, again, the profits that are left in the business and not taken out as a dividend to the owners of the business, is going to equal total net profits minus, again, we're taking out any total dividends paid to the owner, okay? So retained earnings is going to equal the total net profits, so like bottom line of the profits of the business, minus any total dividends that were paid out to the owners, okay? That is going to be retained earnings. Now, we gotta look at owner's equity, because as I said, owner's equity is a little bit different, because now owner's equity is the owner's investment. Remember, this is money going from the owner into the business. Usually at the beginning, like startup capital, or even as the business is growing, you're having to put more money in. That's all owner's investment plus retained earnings. So again, what you could do is you could say owner's equity equals owner's investment plus the total net profits minus the total dividends, because that's what retained earnings is. You can literally just take this formula, pop it down here, and it would work. Really, at the end of the day, it's just what is the money I've put into the business, and then what are the profits that I've left in the business. That's owner's equity. All right, so we've talked a lot about the balance sheet. You know, in my opinion, I look at the balance sheet, that snapshot. Remember, how is the business doing now? And when you have that snapshot or a balance sheet, it needs to answer certain questions. This is why it's so important to know what the balance sheet is and why we've talked about it is, number one, is the business in a position to expand? Okay, one of the things I'm looking at is like, does it have too much debt? Is it too risky to keep growing? Maybe I need to take a couple years and pay down the debt with some of the profits, i.e. take the cash and move it over to the debt side of the balance sheet. Another question that the balance sheet can answer is, can the firm easily handle the ebb and flow of sales and expenses? Do they have enough cash to be able to pay out money and then have it come back in, like, you know, buy inventory, and then it comes back in the form of sales, and then to be able to carry their accounts receivable, because there's some time before the money comes back into their account. These are all things that can be determined by knowing what the balance sheet is. Can you handle that ebb and flow? Do you have enough working capital, i.e. cash, in the bank to be able to handle the fact that you're going to have to pay for inventory before you actually collect on the payment for that sale? Number three, is the firm collecting its accounts receivable in an efficient manner and as planned, and making sure that it is actually collecting on all of its inventory it's selling? It's selling its inventory, but now it's going to collect the money. Is it taking months and months? Are they having to send, is some of this, accounts receivable going into debt collections, and they're not actually even getting the money, and they have to go to a debt collector? That's not a good thing. You do not want it to be where it's taking months and months and months to get payment. Ideally, you shorten that amount. You shorten how long it takes for a customer to pay you, and your accounts receivable is collected in a timely and efficient manner, and there's not bad debts being made. There's not people paying months down the road, because the further and further accounts receivable gets, the bigger and bigger accounts receivable gets, the more cash I've got to have sitting in the bank as working capital just to float me through the ebbs and flows of my cash flow. All right, number four, another thing that a balance sheet is so important for is answering this question: can accounts payable be paid more slowly to prevent a cash shortage without hurting the credit of the owners and the reputation of their credit? So this is going to be one of the things you can do, is ask for better terms from your suppliers. So if you order machines, if you order supplies and materials for your work, can you ask the supplier, hey, I'm going to get all of my products, all of my different supplies for you. I'm going to buy inventory, I'm going to buy raw materials, whatever it might be, throughout the month, and then I want you to bill me at the end of the month. That's a great way to make sure that you're paying your accounts payable in a much slower manner. Instead of me having to pay today, I'm able to delay that payment for weeks down the road by just asking for better terms from my suppliers. So again, the same way that I want to shorten my accounts receivable, money that is owed to me, I want to shorten how long it comes back. I also want to lengthen my accounts payable. I want to make it as long as possible where I'm able to pay for something that I get today. All right, so if I'm able to get my raw materials today, how far from now can I actually extend out to where my accounts payable is down the road? That's all going to help a lot with cash flow and really help you be able to keep the amount of working capital and cash down so that the ebbs and flows of cash flow do not sink the business, even if it's growing. Even a growing business with a lot of debt can run out of money. It can run out of cash. It can be a really bad spot. So that's what the balance sheet's all about. It also answers the question of like, how much equity do I have in this business? What is my owner's equity? We talked about before, retained earnings plus the owner's investment. Remember, like the owner's investment, how much money you put into the business is not necessarily your equity. Because if the business is generating profits and you're just taking those profits and reinvesting it in order to make the business grow, that's still part of your equity. Those retained earnings are part of your equity. So these are all questions that the balance sheet can answer. And when it comes to buying someone out, what is their owner's equity? How much money have they put in the business? How much money have they reinvested in the business? A great thing to know and look at when it comes to buying out someone or potentially selling your own business. This is all answered by the balance sheet. That snapshot. Remember, the income statement tells a story. It tells where money's been going. It tells over the course of time, over 12 months, a quarter, etc. Whereas the balance sheet is that snapshot. What is the health of the business? I look at it like triage. What's your heart rate? What is your, I'm not looking at the course of 10 years what your heart rate has been or what your EKG is over the course of a couple hours. I'm looking at what's that snapshot. How healthy is the business today? I want to expound a little bit on that concept of a snapshot versus the story. Okay, so the snapshot is the balance sheet. Now, when we look at the income statement, we're going to talk more about that in just a minute, but we've already talked about the balance sheet. Now we're going to talk about the income statement. These are two very important documents. If you want to know the health of a business, you ask for the income statements and the balance sheets. Okay, so what does that mean? What's the difference between a balance sheet, what we talked about before, a snapshot, and an income statement? Here's the example. So from January 1, and then over here we have December 30th. It really doesn't matter what dates these are on. I'm doing like in a calendar year, for example, in this example, but it really doesn't matter. This could be January 30th. It could be December 1st. Doesn't really matter. Just some given point in time. What we can do here is we can have a balance sheet as of January 1, and we can compare it to the balance sheet of this date and time, which is December 30th. But again, these are two snapshots, a snapshot of the business at January 1st and a snapshot of the business on December 30th. What it doesn't tell me is what happened in June and what happened throughout this entire period. So what an income statement does is it does the top part here, which is it shows all the ebbs and the flows and how the business grew or declined or whatever it might be. That's the story. It takes into account the entire range of time. So this would be the income statement. It shows what happened over the course of that entire period of time. Now it actually might show each month, it might, or it might not. It might just be one document, one statement, but it's over the course of the entire period of time. Whereas a balance sheet is literally as of one day here, as of one day at the end. It doesn't fill anything in between. It just literally takes a snapshot, and the income statement tells the entire story. One without the other is almost useless because I can't really, just knowing the income statement is great and fine, but I need to know where the cash went, how much debt is on the books. So a lot of times you go to bankers, if you're trying to sell your business or buy another business, the two things they're always asking for is the income statement. They want to know what's the business doing over the course of a period of time. A lot of times income statements are compared against quarters or years, like quarter over quarter growth. That's going to be, okay, my income statement for this quarter versus the income statement for this quarter. All right, income statements. over the course of the whole time. It tells the whole story, tells the entire period. Whereas the balance sheet are the snapshots in time, beginning and the end, for example, January 1st, December 30th, and we can compare balance sheets. We can see where money went. We can see if people got more debt in their business. But the income statement really tells the entire story. Together is really what gives the full picture of the health of the business. Just a quick clarification, and that is that the income statement, when I say that, that is the same as saying the profit and loss statement, or P&L. So P&L equals profit and loss statement equals income statement. You'll hear people say this all the time. They are the same thing. An income statement is a profit and loss statement. Now we need to make another distinction, and that is that the income statement is not the same as cash flow statement. We're gonna talk about the cash flow statement down the road, but I wanna make this distinction now because a lot of people get this confused. Because an income statement doesn't track necessarily where the cash is going. I've heard it before said that a profitable business can go out of business, okay? The reason for that is because an income statement can show profit, but again, it's not keeping track of the cash. It uses something called accrual accounting, which means when I earn the money, when I earn the sale, it shows up on my income statement. What it doesn't show is the statement of cash flows or where the cash is going. At the end of the day, a cash flow statement, we're gonna get to it more in just a minute here, but a cash flow statement answers where's the cash actually going. Because I can earn money all day long on my income statement, look like I'm making really good profits, and I am. But if I'm not collecting it, if my accounts receivable is horrible, if I have bad debts, if I have so much debt that the monies are going out in the form of interest, and I could literally be having horrible cash flow. So cash flow is king. Even though your income statement might make you look like you're profitable, keeping your cash flow very, very steady is important. Knowing that you, again, we talked about already, keeping your accounts payable, being able to extend that out as much as possible, and making your accounts receivable when money's supposed to come to you, making that as short as possible, that's gonna really help with your cash flows. But statement of cash flows, it really answers one question: where is the cash going? All right, so just be very clear. Income statement does not equal statement of cash flows. All right, statement of cash flows. So we talked about the fact that an income statement is equal to a profit and loss statement. A profit and loss statement, income statement, that is equal. But those are not equal to a statement of cash flows. We'll talk more about this down the road, but I want to make that distinction now because some people say, I want to see a statement of cash flows, and you might think, oh, income statement, a profit and loss statement. No. Statement of cash flows, totally different. It's going to use what's called cash basis accounting. We're going to talk about that in a minute, but now we need to talk about accrual accounting, which is what an income statement or a profit and loss statement uses. Let's go ahead and jump into that. All right, so we're going to talk about cash versus accrual accounting. So you might have heard cash accounting versus accrual accounting. I'm going to explain the differences as well as why usually accrual accounting is used in taxes and with your accountant. So first of all, cash accounting is really when you record cash when it is received and you record expenses when they are paid. This is the most simplest way of really tracking your expenses, and that is literally what you can do is use a tool like QuickBooks Online, and literally what you're going to do is attach your bank account. And then as transactions take place, you're going to have positive and negative, or deposits and expenses coming out in the form of maybe it's plus 100 and plus 200, and then those would be like deposits, and then these would be like negative 150, negative 200, whatever it might be. These would be expenses. Then all you got to do is literally categorize them into what appropriate category they're going to be, like fuel expense, insurance, whatever it might be. And this is a form of cash accounting, which basically means when the cash actually leaves the bank account or comes into the bank account, that's when we account for that money. It's not always the most accurate, especially in businesses that have a lot of inventory, have a lot of supplier credit, or they have a lot of accounts receivable, which means that they're going to allow their customers to pay them back over the course of time. So let me explain a little bit more in detail. So cash accounting, in my opinion, is really the best for simplicity's sake. If you're just getting started and you don't understand accrual, you don't have a whole lot of big complexities in your business, just doing cash accounting, in my mind, is better than nothing, okay? It's gonna be the simplest way. It's the simplest way to share numbers with your team. So we're gonna talk about open book management later on in the course, and a lot of times employees aren't going to understand accrual accounting, but cash accounting makes sense because they see like money leaving bank, money coming into bank. Very easy to transact and categorize those expenses. Now, when we talk about accrual accounting, let me write this out here so we're all on the same page. Accrual, A-C-C-R-U-A-L. This is what you're going to usually use with your account. And a lot of times, if you do cash basis accounting, when you go to run your taxes, your accountant is going to ask for all your bank statements, because what they're trying to do is figure out, they're trying to work it from cash back to accrual. Because accrual is really the most accurate way of running the books, paying taxes, and doing accounting for several different reasons, and not necessarily better, I would say, but the most accurate for several different reasons. One, sales, when it comes to cash accounting, is recorded including credit and cash. What I mean by that is, so if I have accrual, what that means is I'm only going to account for this money when the profits are earned, okay? So if we look at the differentiation here, it's earned is accrual, and then cash accounting is gonna be when it actually hits the bank, okay? It hits the bank. Now, it might seem like, well, what's the difference? Well, the thing is, a lot of times when someone pays you, you're not going to actually get the money in your bank account for a while. Whether they have payment terms, whether they pay with a credit card, it takes a few days to go through and process, or whether you send them an invoice and then it takes them a few weeks just to send you a check, for example. So cash is when, if you're doing cash accounting, it means when it hit the bank. Accrual is when the money is earned, regardless of whether or not the cash is actually collected. So what that means is I could mow someone's lawn 4 times over the course of a month. I can mow it the first week, the second month, the second week, the third week, the fourth week, and I can bill them, but really, I might actually get the money in my bank account the next month. So for example, right now it's April. I mow someone's lawn those 4 times. I bill them on April 30th, the last day of the month. Well, I might not get that payment till May 15th. Cash accounting would mean that the money for those mows was accumulated during May, because that's when the money actually hit my bank account. Whereas accrual accounting looks at when the money was actually earned, which would mean that that money would be set aside in the account for April, because that's when it was earned. So cash, another thing about the difference between a cash and accrual is that cash doesn't account for financed inventory. So what that means is I might have $500,000 worth of equipment or inventory that I've purchased, but the supplier said, hey, you pay me $400,000, $100,000 of that I'm going to do on credit for you. So what that means is I literally purchased $500,000 worth of inventory, but actually what came out of the bank was only $400,000. So a more accurate way is to actually see when the expenses and the revenues or profits are actually earned, or when they actually, like when I make that order for the inventory and when I make that purchase, regardless of whether or not half of it is on credit or all of it is on credit, doesn't matter. That total dollar amount is what I'm going to be used in accrual accounting. The last reason, the kind of difference between cash and accrual, and this is the reason why for tax it's so important to use accrual, is because depreciation is a non-cash expense. So depreciation never leaves the bank. If I'm running this through QuickBooks, I'm never going to see like an item come out, a transaction either in or out of my account for depreciation. Depreciation is a non-cash expense, which means, as we've talked about before, depreciation of, say, a truck over the course of 10 years, if it's a $20,000 truck, is $2,000 per year if I'm doing straight line depreciation. That is a non-cash expense. I am not going to see that hit the bank account. That is going to show up in the form of accrual accounting, though, because I'm going to have a depreciation expense that goes for all 10 years at $2,000 per year. So what I would recommend, if you're just getting started, start off with cash, because I just want you to know your numbers and it's close enough. But accrual is going to be the most accurate because you're for taxes, for submitting documents to a CPA or to a bank. They're going to want accrual because it shares the whole picture, because you can have what looks like a really good business and it'd be really bad because of you not collecting the cash. All right, so keep that in mind. Keep in mind with accrual that it's when you earn the money. Again, that means assume that you're going to be able to collect on that money. So keep that in mind when it comes to taking payments and allowing people to pay 2, 3, 4 months down the road. That accrual accounting, you might have earned that money in April, but if you don't collect it till June, you never actually see it in your bank. So we talked about cash versus accrual accounting, and at the end there we talked about how important it is to collect on the money, because accrual accounting, if you're using that, it can look like you're making good money, but if you're not actually collecting the money, you never get the cash. So we've talked about cash flow, we've talked about statement of cash flows, but I want to go over some really specific strategic things you can do in your business to make sure that you reduce your cash flow problems and you lower your accounts receivable, okay? So again, accounts receivable is the money that is owed to you after you have sent out that invoice. And again, if we're using accrual accounting, we might earn that money in this month, but until that money actually is collected, that cash doesn't hit the bank. Okay, so I'm going to go over 5 different things. There's a multitude of other ones you can probably think of, but these are the most common ones to make sure that your accounts receivable stay low, i.e. you actually collect on the revenues you earned on an accrual basis. So first off is to invoice very quickly. All right, so getting the invoice out. I've seen so many times, especially in the service-based businesses, where people do the work and then literally weeks, months later, they're sending their invoice out. It's not the customer's fault. They literally just don't get the invoice out fast enough, and therefore they're left floating the cost of labor and materials and everything else that went into the job being done. So invoice quickly, get it out. Ideally, again, using software, a lot of these things is going to be very simple. Using a CRM to be able to send out your invoices very quickly. Number 2 is shorten your payment terms. So maybe in the past you've allowed, whether it be a manufacturer, whether you are a supplier, whether you're a service-based business, whether you're a retailer, it doesn't really matter, shorten your payment terms. Do you allow people to pay at the end of the month? Or do you maybe you should invoice them every single week. Maybe you should invoice them every single day. Maybe you're a retailer and before they walk out the door, you make sure that you take payment for that and you're not going to allow them to have credit terms where they can pay you in 30 days or 60 days, etc. So shortening that payment term. If you send an invoice out, maybe right now you say, hey, within 30 days, that's our payment terms. Maybe you make that 10 days. Shortening your payment terms is going to allow you to collect on the money that you've earned, accrual accounting, as soon as possible. Number 3, accept credit cards, auto pay, ACH. ACH stands for automated clearinghouse. That's basically where you're going to have the routing number and account number for a potential client or a client and charge directly to their checking account. More frequently and more commonly used is credit cards. Get credit cards on file. Yes, you're going to have to pay 3.5% on processing fees, but what you're paying for is the fact that you get the money instantly. You invoice, and the next second you have the money. Because it's credit cards, like it's digital. And so that is a great form of solving the cash flow issues where you have a whole bunch of accounts receivable. It's having credit cards on file and then charging them at one time. That's really the best situation, having the credit card on file and you charge it and immediately you have the money. The next step below that is sending the invoice and then the mail to pay with credit card. Because at least in that situation, you've eliminated the need for them to print out the invoice, get a check, write the check, put it in the mail, then the mail gets to you. So at least just accepting credit card payment is great. But again, the most optimal is having credit card or payment information on auto pay where you can click a button, charge all their cards, charge their account, and you don't have any time delayed of them getting the invoice, writing a check, mailing it, all the rest of it. So again, you can quickly take, maybe your turnaround on accounts receivable might be like 30 days by the time you send the invoice, they receive it, they print it off, they write a check, they mail it, you get it in the mail, and you now take it to the bank. There's a lot of time that can go on there. Whereas if I can just have a credit card on file, click a button, charge the cards, charge their account, and have the money in my bank account the next day. Literally taking it from 30 days down to 24 hours if it's done right. Number 4, negotiate more favorable terms with your suppliers. So in the same way that we want to collect money as fast as possible, we want money to be leaving the organization as slow as possible. So maybe if you have a supplier somewhere you're always using materials from, can you set up a credit account with them where at the end of each month you pay what's on the account instead of every single day you come, you swipe your credit card. That is a great way to manage your cash flow because they're almost kind of giving you like this free loan for the 15, 20, 30 days until you actually have to pay. So setting up those favorable terms, making sure, obviously the thing is, this is a beautiful thing about capitalism, they in their business are also trying to reduce terms so they can help their cash flow. But from our perspective as business owners, we want to be able to collect money as fast as possible, and when we have money going out, we want that to be as slow as possible, all right? This is why a lot of times I'm against employers paying their employees every single day, because if you pay them every single day, at the end of the day, they're going to get money. Usually they manage it less, they don't manage it as well, but more importantly, you are having to every single day be paying. Like, you have no accounts payable. You have nothing building up, and again, the slower money leaves the organization, the better your cash flow is going to be. Number 5 is you want to have a flexible line of credit. This is what's called a revolving line of credit a lot of times, which basically means you can use it, and then you can pay it off, and then you can use it, and you can pay it off. This is really, really helpful, so that way if someone, account does come payable and you got to pay like payroll or any sort of like supplier, you have a payable bill come up and you don't have the money and your cash flow is kind of tight, you're waiting for a big account to pay you, you have something to tap into. This is the last line of defense. You do not want to be using a line of credit for working capital, in my opinion. You only want to use it when like there's a big investment or you're trying to do something that's short term, but in terms of always having to dip into it, you don't really want to, but you want to establish it now when you don't need it, so that when you do need it, the bank isn't like, no, you don't have any money, we're not going to give you a line of credit. So open up a flexible line of credit or a revolving line of credit that allows you to take money away when you need it, and then pay it off later, and you're just paying an interest rate based upon the days that you have the money out of the line of credit. This is the last line of defense. It should not be used as a piggy bank. It should be used as something that only happens if you're not collecting on payment from your customers fast enough to pay your suppliers. All right, so we've talked about accrual, we've talked about cash accounting. Before we go on though, I just want to make it very clear. Cash accounting, accrual accounting, yes, accrual accounting is the more specific, more detailed, more accurate way of doing your books. It's what's used in your tax returns, it's what's used for accountants when they run your numbers, all the rest of it. But at the end of the day, that can look really, really good and still you'll be losing money, simply because you're not collecting your money fast enough. So please watch the previous video again if you have trouble where your CPA, the documents they give you look like you're making a bunch of money, but you know you're struggling to make rent, you're struggling to pay your employees. It almost always has to do with a cash flow problem. Go back, watch how you can reduce the cash flow issues by reducing the amount of money that is out on accounts receivable and reducing the amount of time it takes for a customer to pay you. Cash is king. Cash is like oxygen in your business. Without it, it will die. You can look great on paper and be super profitable, but if you don't collect on that money fast enough, your money could run out of oxygen. Cash is king, and don't forget, you can look all good on paper, and trust me, I've seen it many, many times, but the people in their bank account, it's literally dried up to nothing because they're not collecting on the money they've earned. They've earned the money, great on accrual, but if you don't actually get the cash, the king is not happy. Cash is king, remember that. All right, so now we're going to give an example of cash flows and talk about the 3 different types of cash flow activities. What I've written up on the board here is our example previously that we used of starting a lemonade stand. So let me walk through all of these different transactions, and this is just money flowing, right? Cash comes in, cash comes out of the business, and there's 3 different types of categories that all of these are going to fall into. So the first one is Cameron and Ashley, their initial investment, put $10 into the business. Then they got a loan from mom that put $40 into the business. And then they went out and purchased inventory. Remember, like their cups, lemonade, supplies, all the rest of it. That cost them, again, parentheses around it as a negative number, that cost them $40. Then their cash from their first Saturday sales was $30. Cash from their second Saturday of sales was $100. And their salary expense, or what they paid their friends, was $25. So at the end of the day, their ending cash balance was $145. Now, we're going to come back to this. This is just basically probably how your QuickBooks looks like. You have a bunch of transactions, money coming in, money coming out. That's cash flow. Cash flows in, cash flows out. But there's three different three different activities that cash flow falls under. The first one is operating activities. This is going to be like the normal course of operating on a daily basis, beginning with purchasing your inventory on credit, and then selling your product on credit, and then finally collecting the sales that you made on credit. So that whole process is the operating activities of getting the lemonade stuff, the supplies, then transacting and buying that and getting on credit and actually collecting the sales, collecting the cash. All of that's just operating activities, okay? The second category is investing activities. This is going to be when cash flows in or out of the business when buying or selling fixed assets like equipment, buildings, trucks, any sort of asset. Now, an investing activity is not recorded on the income statement, because if I sell $50,000 truck, for example, yes, money is going to flow, cash is going to flow into the business, but it's not shown in the income statement because I didn't actually make a sale, all right? It's only going to be shown on the balance sheet, all right? So these investing activities are only shown on the balance sheet. If I go sell a bunch of equipment and get a bunch of cash into my bank account, it doesn't mean that I made a bunch of income. All right, this is a different type of cash flow. It's an investing activity. The third type of activity for when it comes to cash flow is financing activities. This is going to be when cash flows in and out of the business because of a loan. So like when they got their loan from their mom, $40, that that inflow of cash is from a financing activity where the company borrows or repays debt. So for example, they might actually repay this loan from their mom, and if they did so, that would be again an outflow of cash from their bank account to pay off the financing activity of the loan. So this can also be when profits are distributed to the owners in the form of dividends or maybe owner's compensation. This is, again, money moving out of the business. This is not an expense. If you're taking dividends from out of your company, it's not recorded an expense in the business. Again, it's a balance sheet, not an income statement line item. So if I take $50,000 as an owner's distribution or as a dividend from my business, that is not an expense on the business. You can't write that off, okay? That is based upon a financing activity when it comes to your cash flow. It can also be when owners put money into the business. So when I'm just getting started, again, up top here, money going into the business, again, from a cash flow standpoint, it affects things, but it's not going to show up on an income statement because it's going to be coming in the form of additional equity. When Cameron and Ashley put this money in, they got equity in the business. There was no sale being made, and there was the cash, although it was going up, it does not mean that income was going up from actual selling things, okay? So these are the three different types of stages or categories, you'd call them, of cash flow. Operating activities, investing activities, and financing activities. We're going to now break apart these transactions, figure out which categories they're in, and just realize that investing and financing activities don't actually show up on an income statement. They only show up on a balance sheet because it has to do with debt and it has to do with owner's equity. Now, if you're running the math on me, you probably added this up and realized this is incorrect. I forgot one transaction. I do apologize, and that is a $30 accounts receivable. Because remember, on this second day, they actually collected some of an accounts receivable as well as the cash that they collected on the second day. So this $30 is accounts receivable. So I apologize for the calculation error. All right, so I've already mentioned this in passing, but I wanted to kind of make sure I make this point. It's really helped me think about financial statements in general. And so we've talked about the balance sheet and we've talked about the income statement, or the profit and loss statement, it's also referred to. And those are the two documents, in my opinion, that really make up kind of like the triage of your business. So if you're going to a medical, hospital, or someone's going to get checked out by a clinic, first thing to do is what they call triage, which is they're going to look for like their heart rate, they're going to take their temperature, they're going to get their weight, they're going to get their height, age, very basic measurements and units of health. And being able to know and pick up on things like heart rate can tell a lot about a person. Blood pressure can tell a lot about a person. So those, in my opinion, financial statements are like the triage to your business. You give someone your income statement, you give someone your balance sheet, they can tell a lot about your business. The context of knowing and seeing the changes between these documents as time goes on is really what allows you to kind of look deeper into the business. But I can promise you that if you have your income statements in order and you have your balance sheet in order, your business has the data that is required to be able to diagnose certain issues and be able to see where you can improve your business. Without these documents, without clear documents and income statements and balance sheets, you can't accurately diagnose the patient. When you go to the hospital, if the blood pressure reading was way off, if the height was way off, if their weight, the scale is not correct, like all of those things are going to mess up the diagnosis that comes later on. So when we start looking at your business and we start going through the later parts of this course and we start talking about like fixing certain issues, you've got to remember that triage when it comes to business is like your income statement and your balance sheet. You need to have these things in order. They need to be accurate in order for you to further diagnose the problems going on. And triage is something you should do on a regular basis, i.e. keep your income statements, keep your balance sheet in order and up to date. Very important so you can actually diagnose the problems that are going on in your business and catch them before there's a 911 emergency. You can catch before someone is having a hemorrhage in the brain, you can catch certain issues that are happening via triage. Right, so before you have a big ER and emergency visit, try to make sure you keep a pulse. Try to keep your blood pressure on track. That is what keeping your income statement and your balance sheet in check and constantly updated is going to do. Make sure you do that, and always remember your income statement and your balance sheet is like the triage of your business. Keep track of it and keep it accurate. All right, so we know now that the financial statements are like the triage, but what do we look in that data for? What are the things that we're trying to actually figure out? There's 4 pillars that we are going to talk about in really evaluating a business's financial performance, all right? So the number one that we're going to talk about, number 1, is liquidity. When we talk about if I can spell it right, liquidity, it really has to do with the firm's ability to pay its debt as it comes due. Can it meet its short-term debt obligations? That's really what it has to do with. It's not so much about like long-term debt or long-term assets. So what we have to keep in mind when it comes to liquidity is a ratio called the current ratio. So current ratio is equal to the current assets, current assets divided by the current liabilities. Now you'll be saying, well, what's this whole current stuff going on? Again, go back to the balance sheet. We talked about current assets. Current assets are things that can be quickly turned into cash within 12 months. So there's going to be working capital, it's going to be inventory, and it's going to be accounts receivable. Right? So we talked about in the past. Things that can quickly turn into cash. This is going to be current assets. Current liabilities is going to be anything, any sort of debts or loans or accounts payable that is due within the next 12 months. So for example, this is going to come out to a ratio. Say for example, in my, let's say I have a manufacturing business and I have $300,000 worth of current assets. All right, so my current assets. And then I have $100,000 of current liabilities. So this might be a line of credit. This might mean I need to pay my suppliers for the inventory that I've purchased, for the materials, the raw product that I've purchased. So this is going to be my current liabilities. This would mean that my current ratio would be 3.0. Now you're asking, well, what should my current ratio be? For every industry that's different. So you might want to look this up. What is a current ratio norm in my industry? Because in certain types of different types of industries, you're going to need more liabilities, which is going to make this ratio lower. Obviously, the higher the ratio, the more assets you have in comparison to your liabilities. That's a positive thing. But again, you wanting to take advantage of opportunity, you're going to have to go get some liabilities. You might need to go get some accounts payable so you can get a big trade credit from a potential vendor. You might need to go get some debt, that short-term working capital for you to grow the business. So there's not a right or wrong here, but it's a number to keep track of. So again, triage is great. I can take my pulse, I can get my ratio, but there's something, a pillar of really determining the financial performance of a business, and I'm going to want to keep track of this. If this is constantly going up as the business grows, that might be a good thing, but if it's going really down, or it's perhaps like a decimal point or a fraction, that would mean that I have more liabilities than assets, and that's not a good thing. You could potentially be insolvent depending on your long-term assets and liabilities. So there's a great thing to keep track of, but really it comes down to liquidity, which is like, it's all about how liquid is the business? How many assets to the liabilities that are current? In the next 12 months, what can I turn into cash quickly? That's what current assets are, and making sure that this is a positive number is important, but more importantly, tracking this over time is the first pillar of the 4 pillars we're gonna talk about when it comes to determining the financial performance of a business. Okay, the number 2 way to evaluate a business's financial performance using the balance sheet and the income statement is number 2, and that is the profitability on assets. So profitability on assets. Some people will call it return on assets, but let's just call it profitability on assets. All right, so again, comes down to a ratio, but really what this ratio is all about is efficiency. Because if I give someone $1 million worth of assets, a big office and a bunch of inventory and all this stuff in assets, and they only produce $10 in profit, that stinks. But if I gave someone $1 of assets and they somehow turned it into $10 worth of profits, that'd be like a 10x return. That'd be fantastic. So at the end of the day, someone could say, I make $1 million in profit. But again, if you're having to take billions of dollars worth of assets to produce that profit, it's inefficient, okay? So that's kind of how I look at profitability on assets. It's like, how efficient are you utilizing your assets? Because at the end of the day, a firm's assets are invested for the express purpose of producing operating profits. The reason there's risk in business is because you invest the assets and you want profits in return. That's the return on your investment, okay? So this, in my opinion, really does measure efficiency. Here is the ratio. It's gonna be our return on assets, is equal to the operating profits divided by the total assets. Let me just make sure it's total. Yes, total assets. Perfect. So, return on assets equals operating profits divided by total assets. So, in using my example, if we have someone with, say that they have operating profits of $100,000. They profit $100,000 in their business, but it takes them $1 million worth of total assets. Okay, this ratio, this return on assets is going to be 0.1. You could really say it's like a 10% return on your assets because you invested $1 million in assets, you got $100,000 back, 10% or 0.1 return on assets. Now, how can I increase this? Well, I can either make it more profitable, make the business more profitable, say, oh, you know what, we're going to make it more profitable, we're not going to need any bigger office space or all the rest of it, but now our return on assets is going to be 0.2. Likewise, I could literally say, you know what, I'm going to make this even better, but instead of increasing my profits, I'm just going to reduce the amount of total assets I need to invest in the business. So now, instead of that, I'm going to have only $500,000 worth of assets that I need for the business. That would then immediately take this all the way up to a 0.4 or 40% return on assets. Now, again, this is a number that you're going to take from, you got to know your operating profits and your total assets. You need to know your balance sheet. You need to know your income statements. That's the triage. You need to know those things. And then from that, we can deduce our return on assets. This is a number we're going to keep track of because if I compare it against my competition, that's where I start having a benchmark against my industry, against other people that I'm competing against, my direct competitors. This is very, very important. Now, if your ratio is lower than your competitors, all right, or your industry average, there's 3 possible things that could be wrong. Number 1 is you could be not collecting on accounts receivable as fast as your competition. All right, so if we look at this, if I'm not receiving fast enough on my accounts receivable, money that is owed to the business, my operating profits are going to be lower. And if this number is lower, it means that my return on assets is going to be lower. Okay? Number 2, if your return on assets ratio is lower than your competition or industry average, number 2 is you could have too much money tied up in inventory. Because remember, inventory is an asset. So if I have a whole bunch of inventory down here, my assets are inflated, it's going to reduce the return on assets. And again, that's probably meaning I have inefficiencies. All of these 3 things I'm talking about here that are a reason why you would have a lower ratio. a lot of it has to do with inefficiencies. If you're not collecting on your accounts receivable, that's inefficient. You're wasting time. You need to collect faster. Number two, we just talked about too much money tied in inventory. You have a ton of inventory, but you're only selling a little bit each month. It leads to waste. You now got to get a big shop space to store it all. All inefficiencies. All right. Too much money is tied up in inventory that inflates the assets and reduces your return. Well, I can't spell return. Return on assets. Okay. The third reason why your ratio, your return on assets ratio, might be lower than your competition is if you have possibly overinvested in fixed assets. Okay, so again, if I inflate my assets, this could be like office space. It could be equipment, trucks, all of those things. I see it so often in the landscaping industry. People buy a whole bunch of fixed assets, a big shop space, a big office, a bunch of trucks, a bunch of equipment, and because of that, it inflates their asset column of this equation, and therefore the return on assets goes down. That would be the equivalent of like, I'm gonna buy a bunch of trucks and a big office and all the rest of it. That's the equivalent of making this number go up, which in turn is going to make return on assets go down. All right, return on assets, when I think about that, I think efficiency. How efficient am I at taking risk on assets and turning it into operating profits? Because that's what a business exists for. How much do I have to invest? How many assets do I have to put at risk in order to create a profit? And if I have a whole bunch of inventory, if I have a whole bunch of debt on equipment and a big office space and real estate and all the rest of it, it's going to bog me down. It's going to make me much less efficient on the assets that I have invested. All right, so the third pillar, the third way to evaluate your business's financial performance is the use of debt. So we're just going to call it the use of debt financing. Use of debt financing. Now again, all of this is found on the triage on your balance sheet, okay? So the ratio that we're going to be looking at is the debt ratio, and the debt ratio is your total liabilities divided by your total assets. Total assets. Okay, now, at the end of the day, the more debt that a business takes on, the more risk it has. Okay, so the more debt a company has, it takes on more risk. Now, people, of course, would take that more risk if they thought there was more opportunity. We'll talk about that in a second. But debt ratio equals total liabilities, total. This is not current. This is not about, remember, liquidity is current. But the use of debt financing is talking about total liabilities and total assets. So if I had total liabilities of $100,000 and my total assets were $400,000, and again, assets are going to be everything from my office space, just everything, all assets, total assets of the business, that would impute a 0.2, I didn't mess this up, 100,000 and 400,000 would impute a 0.25 or 25% debt ratio. Okay, now you ask, well, what happens if the total liabilities are greater than total assets? That business is in technical insolvency. Now the reason you can have, it's called technical insolvency, it's not like this company immediately has to go bankrupt. That's not technically the case, because a company that has a whole bunch of debt can still be producing a lot of profits. But at the end of the day, regardless of how much profit is being made, because again, this is all balance sheet stuff. This is not income statement stuff. This company could still be making a bunch of profits, right? But technically, it's an insolvent company if you were taking a snapshot on their balance sheet, because the total liabilities are greater than total assets. But at the end of the day, regardless of how much profit is made, the debt is a fixed cost that has to be repaid at some point. However, if a company can earn a higher return on the investments they make compared to the interest that they have to pay on the debt, then they would actually benefit from the leverage or the debt that they incur. Which means if I'm paying 5% on my debt, but I am able to deploy and buy more assets and buy and invest in back in the business and get 10% back on the debt that I invested in. Again, we talked about previously on the profitability of total assets. If I am investing in total assets into the business, I'm buying equipment, I'm buying trucks, I'm spending money on just investing back into the business, I am then going to be able to get a higher percentage return in comparison to the interest on the debt. This is a very scary thing to do your business, run your business. If you're insolvent, technically insolvent, but profitable. This is why there's businesses that are profitable and still go out of business. Because this business, if it had, let's just say this business had, okay, we go, let's say the total liabilities on this company were $1 million, and the total assets, all the assets of the business were $500,000. This would mean that the debt ratio is 2.0. This company would be in technical insolvency. This company could still be producing profits. This is why people say there's a profitable business and they're going bankrupt. That can happen. There's a lot of issues that you could dig into why this is happening in terms of accounts receivable, too much inventory, too many, too much long-term debt they couldn't handle, etc. It eventually catches up with them. But when it comes to debt, as long as, from a technical standpoint, as long as your return on what you purchase with that debt is higher than the interest rate of that debt, technically it's a good thing for your business. But keep in mind, this is the high growth trap that people fall into because they're growing and growing and growing, getting more and more and more debt because it is, they are making more on their investments, but eventually something could change in the business, and all of a sudden if their operating profits disappear, they're going to have to go bankrupt because they're an insolvent business and they'll eventually have to sell their assets to try to cover their liabilities. Because guess what? Debt is a fixed expense and it has to be repaid, either through selling off your assets or going through bankruptcy. So if you're not producing profits at a very good clip, do not expect to be able to have a over 1.0 or more liabilities than you do assets. Again, there's another number to track, another number to keep in check as you're growing a business. What is your debt ratio? Are you efficient at using debt? All right, so the fourth and final, probably one of the most important pillars or ways that we evaluate a business's performance is the return on owner's equity. So I'm going to write this down. I'm going to have to erase this board because I got a lot of other stuff I want to write. Actually, I'll just use the bottom part. Actually, I think I make it work. So return on owner's equity. Again, these terms should be familiar to you if you watched everything to do with balance sheets. Okay, owner's equity, remember, was an asset. We're going to talk about that more. All right, so a couple things when it comes to this ratio that we're going to look at, because the equation here is return on equity. So return on equity is going to equal net profits. So net profits, like bottom line net profits divided by our total owner's equity. Again, I kind of look at this as efficiency, like how efficient am I on my owner's equity to actually create profits, okay? Because at the end of the day, if I am creating owner's equity, I'm putting money into the business, I want to make sure that net profits are coming out at the end of the day, okay? We talk about debt, and that's all fine and good, like assets and liabilities, but like at the end of the day, as an owner, I just want to know how much am I putting into the business, owner's equity, and what are my net profits coming out of that? This is a very important number, especially for small businesses. Return on equity. So there's a couple things you need to know right off the bat. Using this equation, you can determine a couple things. A firm with a high return on assets, talked about return on assets before, profitability on your assets, high return on your assets. If you have a high return on your assets, you will have a high return on equity. Okay, because equity, owner's equity is an asset on the balance sheet. Okay, so if you have a high return on your assets, which is number 2 here, if you have a high return on your assets, you're going to have a high return on equity. Simply due to the fact that owner's equity is an asset, okay? Next thing is, as the amount of debt increases, its return on equity will increase as well. So what we're assuming there, though, is that the return on assets is higher than the interest rate paid on the debt, okay? So let's just take a step back and be like, whoa, that's just too much, okay? So as your debt increases, your return on equity is going to also increase, simply due to the fact that your net profits are going to exceed your total owner equity on that debt, okay? So if I'm taking on debt, that is not owner's equity, all right? I'm just taking on debt. This is not having to do with liabilities. This is having to do with owner's equity. What that means, if I'm taking a bunch of debt on, this number is not going up, but if I am making more profit in In other words, my interest rate is lower than the return on those assets that I buy, then the net profits is going to go up. And if my net profits go up, then the return on equity is going to also go up. So this is why debt is a really, really powerful thing to create better return on your equity, is because debt doesn't affect your owner's equity. You don't have to put the money in. It's from the bank. It's debt. And the net profits will go up as long as the interest rate you pay on that debt is lower than the return on the assets that you buy with the debt. Okay? So the more debt and less equity that you use, the more what's called financial leverage the owners have. Which basically means the more I get debt and don't have to use my own cash, my own owner's equity putting into the business, the more financial leverage I have. And this is where it comes into play. People say people are over leveraged. What that means is they don't have a lot of owner's equity in, rather they get a whole bunch of debt. Now, in the short term when everything's hunky-dory and going well and the economy and their business is doing well, they're gonna have really, really good return on equity simply due to the fact that they didn't have to put any owner's equity or their own capital in. It was all finance, and when things are going good, the cost of that capital, i.e. the interest on that debt, is lower than the return on the assets they buy using that debt. Okay? So negative financial leverage is when the interest rate of the debt is greater than the return on assets. So for example, let's do a quick example here, and then we're gonna call it quits on this module. Let's say, for example, I'm going to buy a truck for, say, let's say $10,000. $10,000 truck, and I am going to pay 10% interest on this truck. What that means is I am going to have a $1,000 interest payment every single year. So 10% interest on the truck. Now let's assume that by buying this truck, my return on assets is going to be 8%. Okay, so if I have 8%, that means that I'm going to have 8% or $800 that I am going to get as a return or profits from this business, from having this debt. The problem here is I now have a negative number. I have a negative $200. I earned $800 extra in my business because I bought this $10,000 truck, but that $10,000 truck costed me $1,000 in interest. This would be negative financial leverage. Okay, because now debt doesn't even come into the equation, but I have a negative 200, therefore my net profits are going to go down, and therefore my return on equity actually goes down as I get more debt. Okay, so this is where debt's a double-edged sword. As long as your return on assets is greater than your interest rate, as long as this number here is greater than this number here, your return on equity will go up, all right? Because your net profits are going to go up. But if this is not the case, and you are not being efficient with the debt that you're using, your return on equity will actually go down. And this is very, very risky, especially if you have high leverage. And as we talked about before, if your return or your use of debt financing is all messed up, and you have a lot of liabilities and not many assets, and now this starts happening where as you actually get more debt, you're actually losing profits, it can be very, very bad. All right, so debt is a great thing. It's a double-edged sword though, because if you cannot make a higher return on the assets you buy with that debt in comparison to the interest on that debt, your return on equity will actually go down. But you can use financial leverage by not having to put any owner's equity in, invest money into the business using debt, and therefore increase net profits. Therefore creating leverage increases the return on equity.
I have had some really bad experiences with accountants and bookkeeping firms in the past. I once had an accountant firm that I was using that didn't tell me about a $150,000 tax bill that just auto-debited out of my account. And although I owed the money, I was like, look, can you not just tell me that there's $150,000 about to disappear from my account? And it's simply a lack of communication. The thing I always hated was that my accountant wouldn't explain things to me. They wouldn't explain the loopholes, explain the strategy behind what they were doing. And honestly, to get a real tax strategist can cost tens of thousands of dollars a year, to be perfectly honest. And actually have a firm really think about your account, like tens of thousands, hundreds of thousands, to get a team of accountants and legal professionals thinking about your taxes and how to save money. Now, you're not going to be able to afford that until you're doing tens of millions of dollars in revenue. And so what I recommend is finding a CPA, certified public accountant, do your tax return. Now, if you're like me, you're like, why in the world would I pay someone $1,000 or $2,000 to do my tax return when I can do it for like $50 on TurboTax? I agree. I did it for a long time. The very first year I got a CPA to do it, they saved me over $5,000 of stuff I just didn't know I could take some deductions on. I didn't know there's some credits. I didn't know that that specific year there was some law that I was able to take some extra deductions, and all of a sudden I saved $5,000. And that's a big deal when you're small. And as I've grown, I've realized that now it's become $50,000, $100,000 they can save me by simply giving me the right strategy. And so if your accountant isn't actually sharing the numbers and like why you should be an S Corp or an LLC and what's the opportunity in terms of unemployment taxes and or employment taxes or self-employed taxes and everything else that goes into your taxes, if they're not explaining it to you, I recommend finding someone else. Now, I do have a recommendation. It's my company, so like obviously I am completely, I have a horse in this race. However, the person that runs this firm alongside me is Brad Dreher, and he has worked with me for years. He actually was in the field, working part-time out in the field, but also working for TurboTax back in the day. And now, fast forward to today, he runs homeservicecpa.com with me. And we do bookkeeping, payroll, and tax strategy and tax, actually doing your taxes for you. And it's flat fees. So go check out the site. I just really recommend it. If you're doing your bookkeeping yourself and you're not really sure if things are balancing out, the number that says in QuickBooks is not actually what's in your bank account, if you're not reconciling your accounts at least quarterly and having a good profit and loss statement and a balance sheet, you'll never be able to get debt from a bank. You'll never be able to buy anyone out because you won't have financials in place. And you'll never be purchased in terms of acquired. Most importantly, you'll not be able to make good business decisions because you won't have clean data. And you got to have that from a bookkeeping perspective. If you mess up payroll, you're going to get messed up eventually. I have seen time and time again where lawn care and landscapers don't do their payroll taxes correctly. They don't do anything they do something wrong with payroll, and it can lead to a huge problem with workers' comp, etc. The last one is your taxes. If you're running a profitable business, especially if you're running over $30,000, $40,000 in annual profits, you want to have a great CPA, and I highly recommend using Brad. If you go to Home Service CPA, you can actually book 15 minutes with him for free, and he'll actually look at your account, look at your business, and see if there's a strategy that he thinks he could use to be able to save you money. I highly recommend him, at least for tax strategy and running your taxes each year, but even for payroll or bookkeeping, this is the way to be able to know your numbers and then be able to make sure that you're saving money and not giving money that should be in your pocket to the IRS. So go check it out, homeservicecpa.com.
All right, so once you've started your business, the question is always, well, how big should you get? And should I grow or should I not grow? To grow or not to grow? That is the question. So first off, I want to talk about the financial implications of growing your business. Most people say they want to grow their business, they want to get as big as possible. They're always talking about the revenue numbers and how big they want to get. We have to realize that a growing business is like an organism. As an organism grows, it requires energy, food, water, etc. in order to take those resources and then grow, whether it be in size, whether it be in growing in weight or expending that energy in order to move. You really have to have more resources. And so from a financial standpoint, when it comes to the question, well, should I grow? You've got to realize that growth sucks cash. All right, I've said this a lot of times before my podcast, but growth sucks cash. And this is because, the reason I say this is because there's many successful, even profitable businesses that will run out of money and therefore go bankrupt. You say, well, how can that be possible? They're profitable and they run out of money and they become bankrupt. It's very possible. Let me explain. I call it the growth trap, right? And that's like basically where everyone wants to grow and a business is even profitable, but it can still fail because it's growing too fast for its financial resources. Okay, so there's a few reasons why this happens. The first off is an increase in inventory. The reason you need more inventory is because now your sales volume has increased. If you're growing your business, you're going to need more inventory, whether it be products, equipment even. I'd even mention the fact that, typically with growth, you're going to need more equipment and assets. You need to purchase in terms of real estate and trucks and all sorts of equipment. But inventory has to go up in order to deal with the fact that you're going to have a greater sales volume. So if I have a store and I'm expanding my store and growing the size of my store by 10 stores, like 10 times, I went from 1,000 square feet to 10,000 square feet. Well, I have to fill the inventory and fill the shelves for all 10,000 square feet now, which means I need more cash. So again, that's going to be a cash draw. I'm gonna have to take cash out in order to put inventory on the shelves as I grow and expand. If I am selling lawn care and landscaping services and I inventory seed and fertilizer and soil and gravel and mulch, I have to get a lot more of that as my business grows versus when it's small. And all of that inventory costs money before I actually get paid from the customer. Therefore, my accounts payable and receivable goes up. So let's first go over accounts receivable, okay? Again, accounts receivable is when money is owed to me from my customers. As my business grows, my accounts receivable will go up because my sales growth is going up. And even if I have the same payment terms of, let's say 30 days, now there's a lot more money. Just the dollar amount is a lot greater of what people owe me, and that I have not actually, I don't have to my name anymore. Maybe in the past I did $10,000 a month in revenue, I'd get paid over the next month, and I'd need to keep $15,000 in my bank account in order to make sure I was able to float the business until my accounts receivable were collected in the following weeks. Well, if I 10x that and now doing $100,000, I need $150,000 worth of cash in order to float the business until my accounts receivable is all collected. So again, as I grow, my accounts receivable is also going to go up. Another thing that's going to go up is my accounts payable. Most notably in the form of labor, because as I'm growing, I'm getting more employees and I might be paying them weekly or bi-weekly, and then I'm actually invoicing at the end of the month. Therefore, I need more cash in working capital in order to be able to actually float the business. So both an increase in accounts receivable and accounts payable is going to lead in an increased need for working capital. Okay, need for working capital. Very important. And that's why a business is being successful, growing very quickly, is profitable. Is a very profitable business, can run out of cash because they're growing so fast that they need a lot of inventory. But again, you're paying for inventory before you actually sell the product, before it's on the shelves, before it's available, before you're collecting on that. Then your accounts receivable is going up because now you're just growing in sales. Even if the percent of your revenues are collected from your clients are the same, like let's say 80% is cash, 20% is on credit, accounts receivable. Well, if I just grow my business just in terms of top line revenue, that percentage stays the same, that dollar amount goes up, which means I need more cash to float the business. I need more working capital. If I hire more people and I grow and expand, my accounts payable, what I owe to other people in the form of my employees or even other vendors and suppliers, etc., that's also going up, increasing the need for working capital, increasing the amount of money that is required for the business, and that is the growth trap. We want to grow, 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 and we see our business being successful and even profitable, but it can still run out of money, and a business without money is like an animal without oxygen. It dies. So when it comes to whether you should grow or not from a financial standpoint, you really need to keep in mind that growth sucks cash, and have a plan in place to make sure that you have enough cash to suffice the beast of growth as it comes to your inventory, accounts receivable, accounts payable, and you have enough working capital to get through the times of the cash flow going up and down, and that is why it's called cash flow. It flows. That cash flow coming in and out, the ebbs and flows of cash flow need to be accounted for with your working capital. All right, so when it comes to deciding if you should grow or not, to grow or not to grow, that is the question. We talked about the financial implications of growth, but there's also implications when it comes to personally, what it's going to do personally. And I think the big thing is asking yourself, does growth in the business align with your goals, your personal goals, what you want out of life, etc.? And why do you need to grow? Is it for money? Do you want more money to do in order to buy certain things or in order to live a certain lifestyle? Is it because you want to grow in order to have more time so that you can grow to the point where you have a manager and you don't have to be there every day and you can go on vacation or you can spend more time with your family? Maybe it's you want to grow the business in order for freedom, because you feel like you need to grow to a certain point where you feel like you can do whatever you want. You can spend wherever you want and there is no limits, or it's at least going to suffice the certain lifestyle that you're trying to achieve and that you would consider your ideal scenario, your ideal lifestyle. I think it's important to start with the end in mind and really think about, what do you want the business to achieve for you? Someone that I really look up to and respect once said that the business is made to serve you, not for you to serve the business. And so as long as the business is growing in order to serve the purpose and the goals you have for it, we're good. But as soon as you start serving the business just in order to make it grow and make it bigger, you're just serving it. That's usually when there's a breakdown physically, mentally, psychologically, and then it trickles into the business and becomes a financial problem eventually down the road. But from a personal standpoint, what are your goals? What is your why? Why do you need to grow? Why do you exist and what do you want from this business? If you know that and you have that goal in mind, you can really begin to make sure that as you grow the business, you keep asking yourself, is this growth going to get me closer to that place I'm trying to get to? Get me closer to the money goal, the time goal, the freedom goal, whatever you're trying to get towards and why you had the business in the first place. Keep that as your North Star. It's very easy to keep growing for the sake of growth, but you're literally chasing something that's like a carrot before the horse. It just keeps, the faster you run, it's still right out in front of you. So knowing what the end goal is very, very helpful. Don't grow for just the sake of growth. Grow for the sake of reaching your goals. Growth is gonna put more strain on your relationships, family, significant other, children, etc. And you gotta ask yourself, are you ready for that? Is growing the business and the strain it's going to have on your relationships worth, and are you ready for that? Are your relationships ready for that strain? Having a fragile relationship going into growth and massive growth in your business, it's only going to create more strain. It's only going to create more pressure. I very, very rarely ever talked to a business owner that said as they grew the business faster, the rate at which they grew it, their personal life and all their relationships, because of the growth, actually they spent more time with their family, or they didn't have any relationship strain and they had no stress. So when they came home, they're always in a good mood. Growth a lot of times has a trickle-down effect. When the business is growing, a lot of times it's going to affect your mood. It's going to affect how much energy you have, affect how much sleep you have. And it leads me to the next thing is growth will put unlimited demands on your time and energy. You have to be the master to the servant. The business is your servant. You are not the servant to the business. And you have to realize that growth will put unlimited, which means you basically work 24/7. You could work as hard as you possibly can and still not be done, because it's, growth is an unruly master. You can just keep working and working and working and then have unlimited levels of expectations on yourself and unlimited levels of energy and time that are required in order to meet those expectations. So you have to ask yourself, are you ready for that? Are you ready to have to calibrate how much you can actually get done in a day? When you need to stop? Are you physically capable of less sleep? If not, maybe that's the boundary you set. But as you begin to grow the business, realize the bigger and faster it grows, the more demands on your time and energy are going to come into play. And physically, you have to ask yourself, can I take that? Can I psychologically, mentally, and physically take all the, flying around the country? Well, as I grow, I have to go international. Okay, well, can you physically take that? Is there certain allergies, things that you have in your food, your diet, your exercise routines? Can you expect your body and your mind to stay up with the growth demands, or the demands that growth entails? Growth will also require finding more and better employees, better managers, better associates, better partners, better investors, better suppliers. As you grow, you're going to have to really expand and find more and better people to work with. A lot of that has to do with employees, and a lot of strain and pressure of growth on a personal level comes from dealing with the people that we have to hire, that we have to work with, and a fast-growing business, there can go from 100 to 400 employees in very quick amount of time if you're growing very, very fast. That's a lot of pressure, it's a lot of strain. Finding those people, retaining them, keeping them happy, paying them, lots of stress, lots of pressure. You have to ask yourself, are you ready to do that? Growth sucks cash. We talked about that already when it came to the financial side, but growth also sucks energy. And you need to make sure that you have enough energy to get to the goal you have in mind. Don't just keep burning and burning and burning and burning, because eventually you'll burn out. All right, so when we talk about growth, I want to kind of illustrate where you can think about on this graph I'm going to draw. I'm going to try to draw this. And what's important about this is knowing where you're at on the graph as your business grows, okay? So we're going to plot this out. We're going to have there, and the x-axis will go across here. So the y-axis here we're going to be is dollars, so money. On the x-axis, we're going to do time, okay? Now, there's 4 different stages of the product life cycle. You can say the business life cycle as well. First off, we got introduction, so intro, and then let's draw a line. Let's see here. Let's do here introduction. Then we're gonna have growth. Growth, if I can spell growth, and that's gonna be stage number 2. Then we have maturity, and then we have, which is not good, decline. Decline. Okay, so those are the 4 stages of growth. Hope you can see all those there on the bottom. All right, so now the question is, well, when does the sales and profitability, where do I fit on this graph? Because when I first start my business and I start making sales, there's a curve that it follows, right? So sales start to pick up, and then over time, this is kind of what the growth curve looks like. Again, this is sales. So I'm gonna write in, let's do this, do sales. So this is a sales line. What I'll do is I'll go over it again with blue so we don't get confused. Okay, so there's sales, the blue line there, okay? And this is the thing though, there's a profit curve as well. And that is, at the beginning of your business, when you're first getting started, you're actually losing money, all right? So again, same thing's gonna happen here. You have a curve, you have a maximization of profit, and then the profit is also going to slowly decay, okay, in the time of decline. So a few things I want to point out here, and you could probably dissect this and say I'm wrong or whatever, but overall, this is the growth pattern and life cycle that you're going to experience in your business. So again, this is profit curve. Now, if you are over, technically there is another stage here, and that is pre-revenue, and that would be if this line, at 0, you haven't implemented anything, you're pre-revenue, the business is pre-revenue, and you're probably still losing money at that point. And that's why it's so important in my mind, we talk about creating an MVP, minimum viable product. Because at the end of the day, creating your minimum viable product is going to allow you to get started on your sales curve here, all right? The minimum viable product is what gets you, what can I sell today? What can I get started today? That's your minimum viable product. But you can be in a stage of burning cash as you're growing the business. Introduction. The business is still in this period of introduction, okay? Business is usually just growing the first year, first 2 years, etc. This is why I always say, you gotta give yourself a little bit of time and patience, because year 3 is usually when you start to see some real money coming in. Because you can see the massive incline in profitability happens in stage 2, which is growth. So you have a lot of growth coming in here in the introduction phase, but really you really hit profitability right here, which means I'm losing money. It's very discouraging. It's also very hard because I'm trying to get all this momentum, trying to grow the business. But then in the growth phase, I actually started to see my profitability. I'm making good money now. Again, a lot of times this is year 3, 4, 5 for most business owners. Okay, that's stage number 2 of growth, and then maturity. And you can look at every single brand and ask yourself, where are they at in this adoption curve or in the sales curve? So for example, you look at a Tesla. Well, it depends who you talk to, but a lot of people are saying, well, they're in massive growth mode, right? They're 100% year-over-year growth. There's doubling every year, for example. Then you look at a company maybe like, even someone like Apple. They might only have 10% year-over-year growth. They might be somewhere more along the lines of somewhere like here. They're growing still. They're still growing, but they're a mature company now. They're mature. There's still growth opportunities opportunities. They're still growing 5, 10% in their sectors each quarter, but they're not experiencing 100% year-over-year growth. That being said, they're much more profitable. Because see, Tesla down here, they literally just crossed profitability at the time of me recording this. And the fact of the matter is their profitability is much lower than the likes of Apple, that is in the maturity part of their business, right? So again, as the sales maybe, even though the growth is slowing down, you're actually maximizing profit when you are at a stage where the sales are somewhat level, because growth sucks cash. And if you're taking away from cash, you're taking away from profits. Therefore, there is a maturity life cycle of the business where, and this can be 20, 30, 40 years, whatever it might be. A lot of businesses don't last that long because they enter a stage of decline over time. They start coming to a place where their profit margins start to sink because they fall behind on technology. Their sales start to sink because they fall behind on marketing and they hire a bad CEO or whatever it might be. So over time, unfortunately, entropy comes in. Things tend towards eventually the businesses fail just because of bad management or bad product or technology taking them out, competitors coming in. The market is fierce, whatever it might be, but you have to keep in mind, this is the sales and the product life cycle of a business, and you have to ask yourself where you're at in this phase, right? So a lot of times people are gonna talk about this is the product life cycle, and I agree with that, right? You have an introduction phase where the product's being introduced, then it grows, matures, and declines, but I think this also has a lot to do with businesses, right? We have an introduction part of the business, we're losing money, we're not profitable, then we hit the point where we're actually profitable, which fuels more growth because now we can actually put money back into the business, which fuels more profits, and we get to the point where, well, now we're a mature business, maybe growing a little bit here, maybe like an Apple, for example, 5, 10, 15%. That's the most profitable years for the business. And as time goes on, with complacency, with technology, with new management, with things always changing in the market, over time, profits and sales decline. Now, it might seem really fatalistic to think that every single business is eventually going to go into a period of decline on this graph. Now, there is one way that a business can make sure they never go into this state of decline, and they stay in a constant state of growth and maturity. Now, in the long run, eventually, I do feel like businesses will decline, but what you can constantly do to make sure that happens further down the road is constantly innovate and change the business. So when a company goes in this growth, maturity, and they start to go into this decline, what they can do is reinvent their products, reinvent their services, and they can see their sales and profits actually start to decline and go into even further projections of growth and go into a whole nother, growth stage and growth maturity phase of their business. This is going to come about as of creating new products, new services, and this is usually the result of massive change in industry. So for example, over time, a lot of times businesses fail because technology catches up with them. Economic times come. Things in the industry change, break up certain trade levels, certain sort of trade deficits, and all of a sudden now they're in a state of decline. What you can do to prevent that is constantly change, innovate, and constantly looking for how you can improve the business. Create new products, create new services. A company like Apple, when they first started, were selling just an iPod and music on iTunes. Well, now they sell computers and iPhones. A company like Amazon, for example, started off selling books, but now they sell basically everything known under the sun, along with web services and groceries. It's incredible. They constantly change and evolve. They constantly had these periods of growth, maturity, growth, maturity, growth, maturity, and stepping the business higher, and did not go into a time of decline. So a lot of times what happens is right at this point, as they enter into the phase of decline, a business will a lot of times get new management, get new CEO, a new chief of staff, a new people that are really taking the C-level suite, and that will kickstart the business into thinking about new solutions, new creative ways of looking at the problems in their business, and coming up with new products and services to jumpstart this business. Now, dependent on the industry is really what's going to be the deciding factor of how often you're going to need to do this and reinvent the business. For example, in the video game industry, you might have a one-hit wonder, like a really, everyone loves your game, your video game, your app game, whatever it might be, but you probably every year or two have to reinvent yourself, create the new product, create a sequel, really keep innovating and recreating that sense of what is is so special about the business. Other businesses, you might get away with 10, 15, 20 years of pretty much doing the same thing, but eventually, every industry, every business will start to see a state of decline if they do not constantly innovate, recreate themselves, break their own business, and rebuild it literally from the growth and maturity phase time and time again. But this is how you can take $1 million business, and when it starts to have difficulty, it goes through a time that is uncomfortable, and it starts to decline, but then recreate it. Figure out a way to like go from retail to consumer packaged goods, or going to direct to consumer, DTC brand, and all of a sudden take the business to a completely different level if you're willing to go through the pain of recreating the business and bucking the trend of this graph. So now we're going to talk about branding, and when we talk about the word brand, a brand is just a verbal and or symbolic means of identifying a product. So if I'm going to sell this marker, I'm not going to show you this marker and say this is the brand. What I am going to say is that, hey, this is an Amazon marker, and you're going to have certain feelings, emotions, either verbal or symbolic, around the fact that this is an Amazon marker. That's what branding is. It's obviously the golden goose when it comes to growing your small business, because you can spend money all day long on buying ads, getting customers from Google, Facebook, all these different platforms, giving out flyers, all that. But when you come to branding, people buy because of that intangible, because there's something you didn't have to pay for. It's no longer a transaction of you spending money on ads in order to get a customer, but now you're getting customers from word of mouth, from people talking about you, from people seeing your trucks and your equipment, from people seeing your shopping bags, other people are walking throughout the mall. These are all ways of branding. And there's 3 things that go into that. So we're gonna talk about branding and talk about, most importantly, brand identity, okay? So when we look at brand identity, there's 3 different kind of parts that make up brand identity. The first one that we wanna talk about now, identity, probably spelled that wrong. Brand identity, the 3 things that go into this, and you're like this, that, and then here. Okay, so the 3 things that go in that. The first one we're going to talk about is going to be the brand image. So brand image, and this is intangible. So intangible. You can't touch brand image, and we'll talk about that in a second. Tangible. Then we have next up, which is going to be our brand name. Brand name, which is tangible. You can see that. And then next up, we're going to have our brand mark, okay? Brand mark. And again, this is also tangible. These are the 3 things that make up brand identity. All right, so let's first talk in this video about brand image, okay? So brand image is a lot of the intangible things when we talk about branding that we can't explain, we can't see. All right, not a lot of the nonverbal, the things we cannot identify, it's more symbolic, etc. So instead of trying to explain brand image as much, because we kind of all get the concept, I want to go through a few different companies and share what their brand image is. So for example, with Coca-Cola, their brand image is happiness. That's literally what they're trying to show in their ads, throughout their marketing, is their brand image of happiness. FedEx, they want you to know that they are dependable. Their dependability is the brand image of FedEx. For Ford, it's consistency. It seems like every single Ford commercial starts with some different type of bad weather. They're proving that they're consistent. They have their ads that show people getting up in the morning every day for work, in harsh environments, in workplaces, consistency. Apple, they sell cool. That is their brand image. It's cool to have Apple. That's why they showed like Apple versus Mac. The ads where they would show a PC versus the Mac, and the PC guy was old, and the Mac guy was a young dude that was hip and cool. Southwest Airlines has literally built their brand image around being quirky. Nordstrom has built their brand image around customer service. So what is your brand really standing for? What's your brand image going to be in the minds of customers? This is not something they specifically are stating. It's not specifically saying Apple saying we are cool and you are not. This is not Southwest Airlines saying we are quirky and you are not, and like making their ads only about that. This is literally the symbolic part of their brand. It is intangible. You cannot see you cannot see cool, all right? You can only know the fact that an apple is cooler than a PC, but it's intangible, all right? That feeling of being cool is intangible. That's brand image. This is the golden goose of brand identity, and there's two more we're gonna now talk about that are more tangible, things that we can control, and we wanna talk at length about your brand name and your brand mark. All right, the next part of brand identity is the brand name, and there's 6 things I wanna talk about when it comes to considering what your brand name is going to be, and this kind of ties into what we talked about earlier, like naming your business, but a brand isn't necessarily the name of your business, all right? So let me talk a little bit further though about your brand name. So number 1, you should select a name that is easy to pronounce and remember. So for example, 2 men in a truck moving. Very, very easy to remember, very easy to say, and very descriptive. Number 2, choose a descriptive name of what you're trying to do. Now, what you wouldn't want to do is call it Rocky Road for a mattress company, for example. Like, you want soft, you want plush, you want cushy, you don't want Rocky Road, and it's a mattress company. So think about what your brand is going to stand for, what your brand image is going to be, the conception of what your brand wants to stand for, and make sure your name actually aligns with that. All right, so Rocky Road, not going to be a great choice for a mattress company when you want people to think about soft, fluffy things. Number 3, use a name that is eligible for legal protection. All right, so especially if your business is going to grow down the road, you might think at the beginning like, oh, it doesn't really matter. But if you're going to grow this brand and you're actually paying for and investing in people actually remembering about your brand identity, you want to make sure that this is something that you can protect. For example, if you're going to have a business, don't call it Wally Mart, because guess what? Walmart is probably going to come after you because they have trademarks and all the rest of it to protect that name in a legal sense. They have certain protections with trademarks and copyrights and all the rest of it. Make sure that if you're going to choose a brand name that you're going to try to create brand identity and affiliation with, that you can actually protect that from a legal standpoint. This is actually something we had to go through with Augusta Lawn Care because the name of a town cannot be legally protected. So the word Augusta can do anything. However, because we associate with golf, there was other people that had associations of their brand with the word Augusta and golf, those associations. So legally, we couldn't get a trademark if we had golf and Augusta together. So what we do, we had to rebrand, we had to recreate our brand image so that our brand name could be protected. All right, from a legal sense. So that's why we instituted Max, our dog, the mascot, in order to make sure that we disassociate ourselves from other brand names that had legal protections, okay? Number 5, select a name that can be used on several different product lines of a similar nature. So for example, if I am creating an automotive company, and I'm trying to do automotive inspections and maintenance, and I call it Just Brakes. Just Brakes, and put a big sign out, I'm doing brake checks and installing new brakes on, installing new calipers, etc. That kind of pigeonholes me because I can't necessarily it'd be difficult to go do oil changes or do tires or do mufflers or suspension when I've named my business and my brand Just Brakes. So again, your brand name needs to accommodate the fact that if you're going to have several product lines of similar nature, you're saying category of automotive, that you can still create those new product lines without having to change the brand name, okay? So for example, like Amazon, when they created their whole, selling books online, it's a good thing they didn't call it something like the online bookstore. If they just called it theonlinebookstore.com, it would have pigeonholed them into going into a plethora of other different product lines down the road. Number 6, in cases where online presence is super crucial, you're definitely going to want to consider the cost of the domain and acquiring that name. So for example, if you're wanting to sell diamonds and you want diamond.com, you better be willing to spend millions of dollars literally just to buy the URL, the domain name for that business. If you're going to make it an online, very centric business and you want and need that URL and you need that domain name, you're going to want to consider that when it comes to your brand name, because you're not going to want to have to spend out to wazoo to buy that specific domain name or you at least need a budget for it, all right? Last thing is, when it comes to brand names, you can kind of cheat the system a little bit by doing what's called a license, where a licensing deal, you're going to actually buy the rights to use a brand name that already has a strong brand affiliation and brand identity with your customers. So for example, if I am making glasses and I'm wanting to break into the sports glasses market, specifically going after like people who are doing shooting at shooting ranges or hunting, and I want to go after that market. I make glasses. I do not have a brand affiliation or brand image or brand identity inside of that target market. However, what I can do is I can take the tangible benefits of having like Remington, for example, that already has a brand name that is recognized by that customer, and I can license that name and use it on my glasses, put Remington. Again though, I'm going to have to pay for that brand name. I'm going to have to pay them a licensing fee in order to use their name. This is what happens with like the NFL and the NHL and all the other sports names, sports leagues, is they license their name and their likeness and their brand name out to other companies that want to use and tag along with that affiliation. They want to put the emblem or the logo of a sports team on their coffee cup or on a shirt or on whatever type of merchandise. There is a licensing agreement and money being transferred to that brand name in order for exchange for that company to use that name. Okay, so for example, I would be paying Remington a certain amount of money underneath a licensing agreement to use their brand name, and the idea in that would to be able to license that strong brand name that already has recognition from the customer base, because typically if you have a strong brand and you have a strong brand identity, you're able to charge a higher price and have higher margins, and therefore afford that licensing agreement and afford the fact that every single time you sell a pair of those glasses, some of that profit is going to go to Remington. However, I can go right into the marketplace and immediately have brand identity and awareness around my product because of the licensing of that brand name. Again, we're going to keep talking about brand mark, but just start to realize the power of your brand mark, brand name, and brand image, because you can literally make money doing absolutely nothing and simply licensing your brand name. There's power in brand. Brand is the golden goose of building a business, and at the end of the day, people literally will pay you to do nothing if you have a strong brand and they want to affiliate themselves with you. Remington makes money doing absolutely nothing in the case where I want to sell my glasses, pop their name on it, because I want the affiliation that brand name has in a specific target market. Brand identity is extremely, extremely valuable. Now, let's talk about brand mark. All right, so now we're going to talk about the third and final part of brand identity, which is the brand mark. So a brand the brand mark is something that cannot be spoken. It's like a logo. It's something that is representing the brand, and it's a mark. A lot of times people talk about trademarks. We'll get that in a second. But this is the mark of the brand. A couple examples is like the golden arches from McDonald's. Without seeing the name, without seeing burgers or anything like that, just that mark, people think about McDonald's. Same thing with like the Nike swoosh. Somehow, they paid a design student like $35, but somehow they paid this design student like $35. But in the day, this swoosh right here of Nike became synonymous with their brand. All right, it's a brand mark, that alone. So it's sort of like your signature, right? If you see that bottom in like the bottom corner of an ad, you see just the golden arches, it's a McDonald's ad. If you see this swoosh anywhere on an ad, that's a Nike commercial. For example, even with Nike, they don't even put the words the letters Nike underneath this. They literally just use this for their stores. Like, they don't even put the word Nike, they just put the swoosh, all right? So a couple of things to remember when it comes to coming up with a brand mark. Number one, be simple. For example, like Target, their brand mark is literally a target, something like that. It's very, very simple. It's easy to remember. And what's nice if it's simple and it's not super like elaborate is the fact that it's slow to appear dated, right? If you have some really complicated target looking thing, for example, maybe you did like a 3D target, or you added like an arrow in here for like showing that this is a target, like that can become dated very quickly. Simplicity these 2D objects that Target and Nike have, for example, the golden arches, very, very simple. They don't become dated as quickly. Number 2, design for visibility so that you can't miss it wherever. All right, the golden arches, the Apple logo, the swoosh from Nike. These are all things that you can't miss. Like if you see them, you're not confused with anything else. That is the brand mark, okay? Leaving it open to interpretation is actually a really good idea too. So number 3 is leave it open to interpretation. Like Nike, they look at the swoosh as what they call an empty vessel, which means you can look at it, it can mean so many different things. There's no obvious meaning. Like, it could be a shoe. Or it could mean like there's like Greek mythologies around a swoosh like this. Like there's all sorts of meanings. They don't really give it a meaning. They allow that meaning to be unobvious and an empty vessel of what the customer wants it to be. And that also gives a lot of flexibility. So for example, like Nike, they're not pigeonholed to shoes or to shirts because this is not a shoe. This is not a shirt. This gives a lot of flexibility as they add products and they add an app and they add technology and all these other things around the brand mark, okay? Be relentlessly consistent. This is number 5. Be relentlessly consistent. So pick a typeface, a certain font you might use, a specific color, and use them on everything, okay? Look and feel over time will get established, and this is part of it takes time. But if you're making an ad, use the same font, the same colors, have the same couple colors that you use all the time. At Augusta Lawn Care, we have the same yellow, green, and brown that we use in all of our ads, all of our fonts, all of our colors revolve around that typeface and color, right? Be consistent though, all the time. Recognize the importance of the logo design and just elevate it in terms of where you think about design and the conceptuality of your brand with design. You think of Steve Jobs with Apple. He was relentlessly thinking all the time, maniacally about the design of the products and how that was going to fit into the overall brand around what the brand identity was to the customer. Again, we've established the fact that Apple is cool. We've talked about that. That is a lot of around the fact that they're design marks and the thing that they established, that simple Apple logo, the simplicity of that. And Steve Jobs was always focused on design. A couple more things, get good advice. Number 6, talk to logo designers, talk to professionals in branding, talk to some other people, get their opinions. Talk to your family and friends, obviously, but talk to some professionals when it comes to your brand and what your brand mark is going to be. And number 7 is don't expect miracles, all right? Some people think like, oh, if I just get like the perfect thing, the perfect brand mark, it's like I'm just gonna like win the lottery. It takes time. In order for a brand to be established in the mind of the customers, a lot of times it takes a lot of time, a lot of effort, a lot of size, like a lot of growth for the business to become to the point where like it's actually synonymous with the name of your business, a certain mark. So don't get in a rush, right? Don't expect miracles that you're just gonna get this one thing, a name or a mark, and it's just gonna like that makes the business. It's rare that actually happens. When it comes to a brand mark, there's trademarks and there's service marks. So a trademark is a legal term just basically indicating that a firm has the exclusive rights to use a brand to promote a certain product. A service mark is the same thing, but for services, all right? So a trademark is really the fact that, hey, you have exclusive rights to use this specific brand for a product, and for a service mark, it's that same thing. It's giving a company the exclusive right to use a certain brand to identify a service. All right, so for Augusta Lawn Care, we have a trademark and a service mark. A service mark is the fact that, hey, you cannot use Max, our mascot, in any sort of lawn care or landscape related industry, right? That's a service mark. Our trademark is the fact that if we throw that onto a shirt and we sell it, only we can do that. Only us can make the products and use that trademark. These are things that are filed. It's a legal safety net. It's a legal kind of protection to make sure that people can't rip off your brand mark. They can't make a swoosh. They can't make a Target symbol and make that their brand mark because you have actually legal protection around it, around a trademark or a service mark. All right, so now we're going to talk about trademarks. And even though I talk about service marks in the previous video, really most people, even when they refer to service marks, they'll just refer to them as trademarks. It's just the most commonly used word, and honestly, I very rarely hear people talk about service marks. They usually just call them trademarks. So I want to talk about a few things about that, patents, and then also copyrights. There's difference, all right? So basically we're trying to legally protect our IP, our intellectual property, our business. So a trademark is important for a whole bunch of different things that you can actually safeguard. The name of your business, a certain word, a phrase, a slogan, a symbol, a design, a certain picture. You can actually, to some extent, do like a scent or a noise, but those are a little harder to hold up in court if you actually have to go do legal battle over it. Those are a little harder, but all of those things, a phrase, a slogan, a word, if you have a certain logo, a design, for example, all those things, anything that can be identified by the customers and is identified with your business, and that can be trademarked, okay? And really, what I would recommend doing if you are considering getting a trademark or thinking you potentially might need a trademark is go to uspto.gov. I better write that down. It's uspto.gov. That stands for United States Postal Service, United States Patent and Trademark Office. And you're going to go there and be able to do a search and see, type in the word, put in a picture, see what other things, other trademarks are already there. Same thing is going to go for patents, but right now we're talking about trademarks. And so I would go there, type in the name that you want to name your business, make sure that it's something that you can actually protect and that someone else couldn't potentially come after you and say, hey, you can't use that name. I have a trademark on it. This actually happened to us at Augusta. I kind of referred to this before, but Augusta National, because they had a trademark affiliated with the words Augusta and a certain font, and we used that certain font on our website one time, and they basically told us, hey, you knock it off. And we had to change because they sure enough had a trademark that uses that font and the name Augusta, and those two correlations was enough identification for them to have grounds to enforce their trademark. So, when you go to the USPTO, there's applications there, you can register and you can submit those online. There's filing, search, and examination fees that are going to be charged. And if you have legal counsel of your own, like a patent attorney, or sorry, should I say a trademark attorney that's going to do the filing for you, do the searching, do the application process, the examination part of things, that's going to be an additional cost. So this can range everywhere from just a few $100s if you're going to go do all the application side yourself, all the way to tens of thousands of dollars if you're doing the more complex a design, more complex the verbiage, a logo, the more things you got to add, that potentially might get a little more hairy. And it gets a little more hairy when you start bumping into other trademarks. You're starting to get close to other trademarks, and you have to start creating delineation between why your trademark is different than someone else's. That's when you really are going to need legal counsel, and you're going to need to probably hire an attorney, and it gets pretty expensive pretty quickly. It can cost, usually I would say though, unless you have a lot of big issues for a small business, a couple $1,000s is going to definitely get someone else, a legal counsel, to get you taken care of, and you'll be okay. The couple things about trademarks. You have to have intent to use. What that means is you can't just willy-nilly be running trademarks for everything under the sun. I want to trademark this and trademark that. And you're just sitting on all these trademarks hoping that one day someone needs it and you can go, hey, give me $1 million, or I'm going to sue you because I have a trademark for that. So the USPTO doesn't want that. The Patent and Trademark Office, they don't want that. And so you need to have intent to use. And it's a little bit hairy, but every 10 years or so, they make sure that you're actually going to use that patent, so you can't just sit on it for years and years and years and never use it. You need to use it for your products or services. Some things can't be trademarked and are considered public domain. And so, for example, like Augusta, I cannot trademark the word Augusta. I can only trademark the words Augusta Lawn Care because the word Augusta is a name of a city, and I can't trademark that. Same thing happened to Microsoft when they wanted to trademark the word Windows, because they made the Windows operating system in DOS, but they were not allowed to trademark the word Windows because it's public domain. There's too many other trademarks that it would be bumping into, and they can't get that word, Windows. So, because obviously there's windows of glass, windows in your car, all the rest of it. So every time technically when someone uses that word, if they aren't paying you for a licensing fee for your trademark, you'd be infringing on someone else's trademark. So you have to have intent to use, and it can't be public domain. And public domain is gonna be things like the name of places and commonly held items. Like I cannot patent the word or trademark the word marker, right? It's part of our English vocabulary. There'd be so many other infringements if we tried to trademark that, and it's very, very difficult, almost impossible. It won't even be allowed. And so again, they're going to check every 10 years, making sure you're using it. And as long as you are using it, a trademark is indefinite. So it's not like you have to keep applying for it every year. As long as you can prove that you're using the trademark, the owner of the trademark keeps it indefinitely. All right, so now we're going to talk about patents. So we talk about trademarks. Now let's go ahead and talk about patents. This is the one you hear a lot of times if you listen to Shark Tank and things. They talk a lot about patents. So first of all, a patent is just a registered exclusive right to make, use, or sell an invention. All right, so any sort of product you make, you build an invention of any sort, if you want to make it, use it, or sell it, you can protect those rights to your business against that product, okay? So there's a couple different patents that you've probably heard talked about. Again, they come up a lot on places like Shark Tank because there's a lot of product-based businesses that are being pitched there. And so there's two major ones. There's another one called like plant patents. Like if you find like a new species of plant, you can patent it, but that's not really necessary for us to know about. First one is utility patents. This is traditionally the strongest one when it comes to inventions, but it really depends on the exact type of product you're selling. But this protects a process, a machine, or manufactured product. Okay, so and most importantly, it really protects the process. So the utility, the actual function of that machine, that product, and the process by which you make that is a way you can protect those things, okay? Now, a utility patent lasts for 20 years. What that means is every 20 years you've got to reapply and try to get that patent again. And there's a whole business around when patents end and then people coming in, swooping in and trying to buy them up or trying to get their own application in behind that. So 20 years is for a utility patent. A design patent is something that covers the appearance of a product and everything that is inseparable from that product. Okay, so this is design, and this is again mostly from an appearance standpoint, and this is why design patents usually don't hold as much weight, because if I change one little thing of the design, if I change one little thing of the appearance, I can get around that patent usually pretty easily. Utility, the process of that machine, the process of that product, and the process by which I make that product, that's usually more difficult and more cumbersome and expensive to get because it's a little more detailed and more protective. Whereas again, design, it's only going to cover the appearance. So one little tweak, and this is how patents work a lot of times. Companies will get around them by just changing one little thing. Even to the process, it's like, well, we can just change the process slightly and now we're not infringing. So this is why, in my opinion, patents for small businesses don't mean a lot, because it's not a matter of getting a patent. A patent is only as good as you are willing to enforce it. Where someone coming in and trying to do something, infringe on your patent, are you actually willing to go spend money and defend that patent in court and defend it by the law and spend the money to go get attorneys and fight that infringement? That's the biggest reason why I see small businesses not really needing patents as much, is because getting them can be time consuming, it can be costly, but it's the cost of actually defending that. It's like, really, are you going to actually spend hundreds of thousands of dollars trying to find a massive corporation that's coming in and infringing? Probably not. They have a lot more money and they can just keep fighting, or they can get around your patents a lot of times. Now, that being said, it is good to get a patent, especially in a product-based business. But I see most small business owners going too far in the direction of them needing a patent, and they're waiting years for their patent to get cleared after filing, and or they get provisional use of that patent, and they still wait because they want it to fully clear, and like they wait so long for this patent, and at the end of the day it's like, well, are you going to actually enforce it? Like, are you actually going to have somebody go to court and fight over this and spend money on an attorney to keep another company at bay? A lot of times they're not. And so I would say, if you have a product-based business, you definitely want patents. You want utility, you want a design patent, the more the better. But you have to ask yourself the question, are you actually going to spend money to defend that patent? Is it really that important? And because a patent attorney is almost not likely, but almost necessary when it comes to defending litigation, that litigation process if someone is infringing on your patent. Sometimes the cost of fighting a patent war is just not worth the cost of losing the cash that you need early on in the business to grow. If you're a small business and you need cash to grow, and growth sucks cash, why, potentially you could get put out of business if you're taking all your cash and putting it towards, patent infringements. And this is what big companies can do. They can fight a patent and just keep fighting in court until finally the small business owner has to, they have to go out of business, or they have to sell the patent to them because they simply, they can't afford the cost of defending the patent. Now, not too long ago, there was this new rule that was really not great for American small businesses, and it's called first to file. And it's a new rule that basically, it's based upon who is first to file, not who is first to actually build or create the product. So basically what that means is I can file a patent, and that basically gives me protection, which is really, really bad for small businesses, because these big corporations with a bunch of money, they'll go out and just put a whole bunch of patents and file a whole bunch of patents on things that they feel like down the road they might want to invent, down the road in the next 15, 20 years that they're going to build. Those big put a whole bunch of patents out to give them protection, and therefore inhibiting smaller players coming in and actually trying to utilize those inventions and utilize those design processes and utilize that appearance of that their design and utility patents are protecting. So in my opinion, it's not a great thing for small businesses, and this is what has really led to the whole approach for big corporations, which is file early and challenge often, which means file your patent as soon as the process. If you think you're going to go for it, just file a patent. For small businesses, we can't afford to do that. We can't afford all the application costs and the legal costs and all the rest of it. They can, so they file early as soon as they think about an idea. It's like, oh, file a patent, and then challenge other people as often as you want, because it'll scare them away. A lot of times they won't even challenge, they won't even refute the challenge on a certain patent. So this is why an NDA can be important, a non-disclosure agreement, NDA, when you are pitching potential investors, because a lot of times those potential investors are startup incubators. They can have really deep-pocketed investors that have connections to these big corporations, and they potentially might have a conflict of interest with the fact that they see your idea like, great idea, I'm gonna go file a patent. Because again, it's first to file. So whoever files first, they don't even have to get that patent cleared. It can block you for years, even if that patent is pending. It can really put a damper on your ability to go and protect your IP, your intellectual property, simply by if an investor or someone you tell your idea to goes out and files a patent. So again, I'm not big into NDAs or thinking too much through that process of sharing your ideas and being protective over it, and it turns most investors off. However, if your product is really, really intricate and engineered and invention, it's like very new, brand new technology, you might want them to sign a non-disclosure agreement so they can't just simply take your idea, great, go file a patent, and prevent you and block you from actually creating that, because it's first to file, not first to actually build and develop the product. All right, I promise this is the last boring legal matters that we got to talk about, and that's copyrights. All right, so copyrights really give the exclusivity of using a specific type of creation from the author. So a composer, an author, a designer, a photographer, any sort of artist, you inherently have a copyright when something is created. However, a lot of times you will file and get a copyright in order to actually be able to use it, when you start sharing it publicly, and we'll talk about it in just a second. But if you're going to either sell, reproduce, or publish anything, you'll need a copyright to do so. Again, they're inherently given if you've created the work, but if you're going to use it publicly and you want to enforce that copyright and not allow people to rip off your song or use your pictures, or if you created an album and they start messing with it and making it their own, and if you don't want that to happen, you need to create and enforce that copyright. So a copyright gives exclusivity to the author for their life plus 70 years. All right, and what's interesting is a lot of really famous pieces of work are coming to the time now where their artist, their author, died 70 years ago. And that's becoming now where that copyright is becomes either public use or someone could potentially try to get it. But once that author's passed away, it becomes public. So this is why certain like really old books can be found everywhere and anywhere, and like it doesn't matter if they're free online because no one has the copyright to it. Whereas if the author just wrote the book a few years ago, they're going to hold that copyright so they can sell it, they can reproduce it, they can publish it. Right? So copyright, it's the author's life plus 70 years. That's when that copyright is locked up. Now, if someone is hired to create work for somebody, then it's protected for 95 years from the date of publication or 120 years from its creation, whichever is shorter. Okay, so again, that is for somebody that is hired to produce content for somebody else. That work is considered protected for 95 years from the date of publication, so when you publish it to the public, or 120 years from the time that you created it, whichever is less. So also, copyrightable works are automatically protected. We've already talked about this from the moment of their creation. However, if you're gonna distribute this to the public and you wanna have that copyright protection, you need to have a copyright notice. Number one, that needs to have the symbol, little copyright symbol, which by the way, we didn't talk about trademark symbols, which is similar to that. You might see that sometimes, but the C with a circle around it, that's what it stands for, a copyright. So in order for you to have a copyright and actually have that registered, and when you're giving out your works of art or music, whatever, publicly, you need to have the symbol, the year that the work was published, and the copyright owner's name. All right, that needs to be shown. So for example, I might have something like 1996 Mike Andes. All right, so that's the copyright the copyright symbol, the year it was published, and the copyright owner's name. Okay. Copyrighted work can be reproduced. It can't be reproduced, and it can't even be photocopied. So like a book, for example, like if it's been copyrighted, you can't even photocopy it technically. Again, it really matters. Like the thing is, like, is someone really going to come after you for it? Well, if you're going to go try to make profit off of it, there's potential that you could get in trouble for using that copyrighted, even a photocopied piece of work. That being said, there's certain fair use that would allow copyrighted work to be used. So for example, if it's for education or for research, or if you're critiquing or commenting on a specific piece of work, there's certain rules that will allow you to utilize that music or that piece of art or that photograph. So for example, if I am commenting on a certain genre of music and I use that music, I potentially might get in trouble if I use the whole song, for example, on my YouTube video, but I might be able to use a snippet of it and therefore be able to comment it or critique it or make some sort of judgment on that from an educational standpoint or from a research standpoint. And so there are certain things that are considered fair use. So you can use copyrighted material without getting in trouble for it. That being said, for example, YouTube, you might hear copyright strikes. This is when people use music or they use video from other creators that they really shouldn't be, and they get demonetized. They don't get any money from that, and instead the money goes to the people who have the copyright. So again, if I have a music, I have that music, I create that and I create a copyright around it. If anyone ever uses that and sells it or duplicates it, I'll get the money from that on YouTube, and I potentially might get a royalty, or I might be able to license that copyright to other people if they want to use it. Okay, but again, this is where things like Spotify come into play. Spotify is paying the people that have the copyrights every time their song is listened to, but they are buying the license to the copyright that the author owns and holds in their possession. All right, so copyrights, again, all around music, artwork, videos, pictures, anything like that. The author gets it, but you do need to protect it. And if you're going to create something around art, music, etc., make sure you have copyrights, make sure you have the correct annotation on your album, on your design elements, on your website, to make sure that you are protected and people can't just go reproduce it. And in this digital age, a copyright becomes much more valuable because it's easier to replicate and distribute mass media very, very quickly. And so you want to make sure you have a copyright. All right, so we're going to talk about channels of distribution. And I want to focus on 4 different types that you can choose in your business when it comes to choosing your channel of distribution. We're going to talk about in a second the pros and the cons of the specific types of channels, but for now, let's go ahead and just discuss what they are. Let's go ahead and go through the whole process and walk you through what this is going to look like. All right, so first of all, you can be a producer. So this is really like the chain of getting something to the consumer, right? So you have a producer, then you have an agent. These are also sometimes called brokers. And then usually that product or service is going to go to wholesalers, and then those wholesalers are going to sell it to retailers, retail. This might also be called just an industrial distributor, but let's just call it's just a distributor. And then typically this, from the retail perspective, is then going to go to the consumer or potentially like the industrial user, okay? But for the sake of simplicity, let's just use consumer. Okay, so if you were to use this model where you really did the entire process, right? And you really worked the entire thing, you could become an agent or broker, right? Like, so that's, option number 1. You're an agent or a broker. The next thing you could do is really become, like in this case, you're going to be selling from yourself to these agents and brokers. This is like option number 1 right here, right? We produce the product or service, and then we sell it to the agents or brokers. Then what you could also do is become a wholesaler channel, where you're like, you know what, we're not going to take brokers, we're going to sell directly to wholesalers. Okay. Then you could also take the retailer channel, where you're going to create the product and try to get it into, Walmart, a Costco, the actual retailers. And now what is becoming, really a phenomenon in the whole retail world is the fact that now you can go from the producer all the way to consumer, which is going to be DTC, or direct to consumer. So if you hear anyone say DTC, it stands for direct to consumer. And what it means is you producing the product and you're selling it directly to the consumer. But that's not the only type of channel. This is what's considered a direct channel. Okay, so we call it direct to consumer, but it's really called a direct channel. Remember, we're talking about channels of distribution here. So direct channel would be if we did direct to consumer, right from being the producer all the way to the consumer. But then indirect channels, so indirect channels of distribution are going to be any of these other 3. All right, so either A, we're selling to the agents and the brokers. 2, we're going to sell to a wholesaler, or 3, we're going to sell to the retailer or the distributor. There's pros and cons. It's not necessarily best that you always go direct to consumer, although that is right now a big trend that is happening. There's pros and there's cons. Each one of these different stages of the distribution process definitely adds value. And if you're going to go direct to consumer, there's a lot of bumps and hurdles that are going to come along the way. So there's no best model necessarily, or best channel of distribution. We're going to talk about in a second which one you might want to choose and what are the pros and the cons. But keep in mind, what is indirect channels where you aren't selling directly to the consumer, or direct channels of distribution where you literally produce the good and then you sell it directly to the consumer. There's so many different ways that this can be done, and it's going to depend a lot on your product and service. For example, I am not going to be able to sell certain things directly to consumer because the retailers have such power over it. It's very rare that I'm going to sell a Tupperware direct to consumer. Is there people that do it? Yes, but traditionally it's going to go to a retailer. Now, then it's a matter of, well, does Walmart want to have relationships with thousands of producers? No, they want to deal with wholesalers, and those wholesalers deal with agents. So this is the complicated kind of distribution process, and you've got to choose what distribution channel you're going to use, either direct to consumer or an indirect channel of trying to create your business where you eventually get to the consumer. All right, so when it comes to choosing which channel, which distribution channel is right for you, let's go ahead and talk about some of the things you want to take into consideration. The first thing is costs. Obviously, you're going to have a much lower price, lower cost, cheaper to just sell to indirect channels. Okay, so it's cheaper because I don't have to figure out all the different steps of the whole distribution method, the whole different distribution process. If I am producing dolls, I might not want to be in the business of selling to wholesalers and then having a warehouse and then having trucks to go distribute those to the different retailers, or the retailers that I buy stores and retail spaces to sell to the consumers. I might not want to do that. It might be cheaper and just easier for me to sell to an agent or sell to a wholesaler and not worry about all these other steps. And really what it comes down to is, are those costs worth the discounted price you have to sell to the indirect channels? Because I can't get full price. Maybe I sell my doll for $100. I'm not going to sell my doll for $100 if I'm going to sell it to an agent or a wholesaler, for example. They're going to want a discounted price. So at the end of the day, it comes down to, is that discounted price worth the ease and the cost savings and the ease of doing business and getting my business off the ground? Perhaps at the beginning, I might go through these different steps because it's just cheaper. So it's cheaper to go through indirect channels, but you're definitely going to have to discount your price in comparison if you went directly to the consumer. All right? Each one of these steps is going to want a cut of the price. They might want 50% each, and so a $10 doll might end up becoming $100 to the consumer, but you might have only had to sell it for $20 to the agent or broker, whereas you lost out on the $100 fully to the customer because you didn't actually take care of the entire process of distribution. Another advantage of the indirect channels is going to be coverage. What I mean by that is, if I sell 10 wholesalers on selling my dolls, and all of these wholesalers have 200 retailers that they sell to. If I can just sell 10 wholesalers, I literally have now have access to 2,000 retailers, and they probably all have access to thousands and thousands of consumers, and I was able to do all of that by just selling 10 wholesalers. Whereas if I try to go to each store, each Walmart, each Whole Foods, whatever it might be, and sell the retail store, I might have to go one by one by one, when literally if I would have just sold 10 wholesalers, I would have got 2,000 of those retailers. So coverage and the speed of distribution, much, much easier using indirect channels. So again, I could sell one by one to each consumer, or I could sell one or two wholesalers, get in front of thousands of stores, and therefore get in front of tens of thousands of consumers very quickly. So the speed and the coverage is much easier when it comes to indirect channels. Now, the third thing is all about control. And that's the winner of that's going to be direct channel, all right, to direct to consumer. And the reason for that is because I want to be able to control how the product is marketed and supported to the end user, whether it be online or the retailer, distributor. I want to make sure that, like, if I'm selling to Home Depot, for example, and I'm producing something, and maybe went through a broker and then a wholesaler, and eventually they sold it then to Home Depot. Home Depot is now putting it on their shelves and in front of the consumer, but their associates, their store associates, have no idea what the product does. They can't give any information. They have bad product knowledge. Maybe it's put in a bad spot on the shelf, not really marketed well. Now, I can't control that. I can't control that as the producer if it's gone through all these different indirect channels. I cannot control how it's being marketed and portrayed to the end consumer. So a big part of going direct to consumer is the fact that you can control what the image and marketing is directly to the end user and not rely on these other third-party intermediaries before the consumer actually sees your product. Now, let me say this before we finish. The internet is changing all of this, okay? The ability now to skip these intermediaries is becoming easier and easier with the advent of social media, because now I can market my product and service directly to my consumer. I have full control of what those customers see online. I don't have to rely on a retailer with physical space, because now I can use fulfillment by Amazon, FBA. I can put it on a marketplace that is literally in front of millions of people on Amazon or eBay. I can create my own website now very easily on Shopify and cut out the fact that I don't even need the agent or the wholesalers, for example. So the internet is really changing this entire process. The fact now that a lot of these agents, wholesaling, distribution is becoming automated and things that you can tap into. It's reducing the price that you have to pay as the producer to skip these steps and go directly to the consumer. Especially with social media, this is the power of direct to consumer, is the fact that we can control the brand, control what the customer sees, and the price that we would otherwise have to pay to all these other people doesn't equate to the fact that now we can use these services online, our website, to sell directly to the consumer, and distribution is taken care of in an automated fashion by other tech companies. So, direct to consumer is changing potentially what your small business can do, and the price that it used to be so much more discounted to go to indirect channels, it was so much cheaper because you'd have to get otherwise a big warehouse or a big truck and all the rest of it to do distribution. That's not becoming the case anymore, and the advantage of going indirect channels is becoming less because the price savings is becoming less when you use those indirect channels. Direct to consumer, in my mind, is where your profit margins are going to be the highest. We'll talk more about profit margins, et cetera, when it comes to direct to consumer in the future. But for now, just keep in mind the internet is changing the game and squeezing indirect channels, squeezing them like a pimple. All right, so we're going to go over the benefits and the trade-offs between equity versus debt, because now we're going to talk about financing. So you can either use equity or debt to finance the start and growth of your business. So debt being loans, credit lines, a whole other host of types of financial products in terms of debt. And in terms of equity, a lot of times we think about bootstrapping, using our own money, using our own credit cards, etc., or potentially giving equity away to other people in order for their money. All right, so this is going to be like a private equity, public equity, for example, could be where someone else is giving me money in exchange for the equity in the business. So let's talk about the trade-offs that kind of come with that. So first off, let's say debt is here, equity here. Okay, so the first scenario, we're going to say that debt, we're going to have less debt, more equity. Okay, so this is going to be someone who's like, Dave Ramsey's the best. We're not going to get into debt. We're only going to use equity. I might go out and give equity to family members or an investor in order exchange for that money, or use my own money. But regardless, I'm not going to I'm going to give away equity or keep the equity, but not have any debt in the business. So there's pros and there's cons. So first of all, we got, let's see here. Let's do. I guess we'd have a return on owner's equity, and then we're going to have financial risk. So I just want to compare these two. Risks. And then the next one, the third one, is going to be owner's control. Owner control. These are really the variables. All right, so in the case of no debt or low debt and more equity, we're going to have a lower return on the equity of the owners. Why? Because more cash of our cash is being put into the business. And when that happens, the return becomes smaller, not because maybe your profits are less, but simply because as a percentage of a return, it's less against the equity that you invest. Because a lot more equity, a lot more cash, either your cash or other people's cash coming into the business in exchange for equity. So return on equity goes lower. There is less financial risk, however, because we don't have a bunch of debt. We're not leveraged. Stuff that goes bad, there's not debt on the books. And there's also, the thing about owner's control is you might have to share control of the business if you're going to give equity to outside owners, or outside investors, I should say. So if someone's going to invest in exchange for equity, your control is going to be lower. All right, so if you're going to go sell equity in the company, yes, people are going to have an opinion, whether it be a board of advisors or some way they're going to want to know what's going on in the business if they have shares, and your control is going to be hampered somewhat if you have new investors that come in and want to have a say because they have equity. All right, so now let's talk about in the case of, okay, now we're going to have a whole bunch of debt. So instead of going out and getting investors and giving them equity, instead we are going to have a whole bunch of debt, but by doing so, we're going to be able to retain more of the equity. All right, so therefore, I'm going to use less equity to start the business or grow it, and I'm going to use debt. I'm going to go get a loan and go into debt. So on this In this case though, our return on equity is so much greater because I actually don't have to like risk very much of my own capital. I'm gonna go get debt. So the return on my equity is actually really, really good. If you don't remember what ROE or return on equity is for the owners, make sure you go back and watch previous previous lectures. So return on equity is actually going to go up. There's more financial risk, however, because now you have debt on the books, and if something goes bad, you're stuck with all this debt. So financial risk is going to go up because we have more debt. And then in terms of the ownership control, you're going to have full control because you didn't have to give any equity away. So for some people, getting debt is not a bad thing, right? We have a greater return on equity. We have greater owner control, but again, you also have greater financial risks, okay? So these are the trade-offs that come with using equity versus using debt. If I'm gonna go sell equity or give ownership to other people in the form of an investment, I'm going to give up control. That's the biggest downside. If I am going to get debt, the biggest downside is the financial risk that brings to the business by going into debt. But there are pros and there are cons of both, and there's trade-offs. Now let's look at a real example of why going into debt could be a good thing or a really bad thing in comparison to going in via equity, because debt is great. It's leverage. I can grow faster. I can grow the business, but there are downsides. Let's look at a real example of how you can use debt to grow the business faster. Okay, so we're going to say that an automotive company is wanting to invest into their business and grow the company. Either get started or grow, either way. But they need $200,000. And now they're going to ask themselves, hey, are we going to invest this money ourselves out of our cash, or are we going to take on debt? So I'm going to run you through two different scenarios showing how the return on your equity can be greater with debt when you're leveraged, okay? To make it make a little more sense, okay? I know it seems like a bunch of drawing, but let me explain. So, two different options here. We got zero debt with $200,000 of that coming from our own cash, our own equity, owner's equity in the business. So then down here, we have financing of $100,000 via debt, plus only $100,000 of our own equity. Now, we're going to assume that the business is either get started or continue to grow, and because of this expansion, we're going to get $28,000 in profit on the assets that we bought. So we bought $200,000 of tools, equipment, a lift, a shop, whatever it might be, and we made $28,000 on those assets. Okay, so $28,000 of profit on those assets. Doesn't change here, and that imputes a 14% return on assets. All right, so if you do 28,000 divided by 200, it's exactly 14%. And it doesn't matter in this case, return on total assets has nothing to do with financing. So that's why 14% return on total assets is here, as well as 14% on total assets is down below. Now, what starts to get a little, we got to take into account, okay, well, what's our return on equity? Well, on the top part here, we had $200,000 coming from equity. We had no debt coming into the equation. Therefore, we had 14% return on $2,000 in equity. So our return on equity would have been 14% because there was no debt service. So therefore, our return on total assets became our total return on equity simply because there was no debt service. Okay, no debt came in, all of it was equity. Therefore, on our $200,000 of equity or cash that we invested back into the business, we had a 14% return, which by the way is really good. It's hard to get 14% return in the stock market or in other places. So this is still not a bad option. But watch what happens when we add debt, when we leverage the risk in the business. We're going to get a loan for $100,000. We're going to put $100,000 in. Our total return on total assets is still 14%. But now $100,000 of debt, $100,000 of equity coming into the equation. Let's assume that this is an 8% interest on this debt. Okay, which means every year I'm going to spend $8,000 in interest on this $100,000, okay? 8% interest on that $100,000. $8,000 is going to interest every single year. So what that means now is I had $28,000 in profit, but now I have an $8,000 interest expense. So therefore, profit minus my interest expense is $20,000. So from a profit standpoint, I made less. However, when I look over here at the fact that I only had to do $100,000 worth of equity, capital injection for myself, I actually get a 20% return, because now I made 20% profit, or $20,000, I should say, on the $100,000 in equity that I invested into the business. So, greater risk, greater returns. Here, I have greater financial risk, as we talked about in the previous lecture, because I have the debt. However, with greater financial risk, I get a higher equity, return on my equity that I do have to invest in the business. That's why I call it leverage, because if I can leverage $100,000 in my business and go get $100,000 more of debt, I get so much more leverage, I get so much more weight, I get so much more I can do in my business, because now, even if I have the $200,000 in cash, you say, well, then you should use the, number one. Well, maybe, or potentially, could I use my $200,000 in equity and go get $200,000 in debt? And now, instead of investing $200,000 of assets, I can invest $400,000. That's the power of leverage. That's the power of debt. So I'm not against debt, but it's definitely increasing your financial risk. But with greater financial risk comes greater financial reward on your equity. I'm not pushing you that you should go get debt or you must use cash. It's going to come on a case-by-case basis, but what you need to know is that not all debt is bad. Some debt can get you a better return, and if you're confident in your business model and confident in the systems you've built, this might be the best way to grow your business faster and cut out years of otherwise trying to grow slowly. So, leverage equals higher financial risk, but also a greater return on the equity that you do have, allowing you to scale the business much, much faster. All right, we are going to go over the 5 C's. The 5 C's of getting a loan and convincing the banker that they want to give you money. We talked about it before, but the banker is your friend. The banker has what you want and need, and that's capital. So it's good. It's in our best interest to know how they're going to judge us and determine whether or not they're going to give us money. All right. So the 5 C's, and I want to do it a little bit more pictorially for you. So the first thing is character. All right. So character. That's the first C, and that's really the character of the borrower. Do they trust you? That whole process of getting a loan, there's a lot of times you're going to have interactions with your banker. Having that good relationship and demonstrating that you're a person of high character is important. Okay. The next C is the capacity. It's the next C, capacity to repay the loan. Okay. So this is going to be, looking at the profits of the business. It's going to be looking at your personal financial picture, your what assets you have, the capacity of yourself in terms of income to pay back the loan. The capacity to repay the loan is the second C. The next thing they're going to be looking at is the amount of owner's capital, or what owner's capital was invested into the business. Do you have skin in the game? They're not going to give you $500,000 if you literally just came with $1,000 invested in the business. Do you have capital invested in the business? All right, the next one is conditions. Conditions. And it's going to be economics in your industry. What are those conditions currently at? For example, when COVID-19 came through, it would have been really, really difficult to get a loan for a restaurant. Okay, the economic and the conditions of the industry were abysmal, and so that is something again that's going to be taken into consideration when it comes to getting a loan. The last thing, which kind of ties into capacity, but it's more in terms of the assets that you have, in terms of collateral. So that's the 5th C of the 5 C's that goes into whether or not you're going to be able to get a loan is collateral. So capacity really is going to be coming in. They're looking at your whole kind of financial picture and the income from the businesses, all your other revenue streams, etc. Whereas collateral, they need hard assets, so if you can't repay your loan, that you're going to be able to actually have something they can come after. Hard collateral, whether that be businesses, equipment, trucks, real estate, some sort of physical assets they can come and take as collateral for that loan. Those are the 5 C's. They're going to go into the decision process for your banker as to whether or not you get a loan. Make sure they're all strong. There's so many different things you can do in each one of these to improve the chance of you get yourself getting a loan. The middle one, there's a reason why I put it in the middle. Character is huge. I've seen loans be passed by people that I thought on paper would never get passed because the character of that person and the trust they built with their banker was phenomenal. So really the capacity, conditions, collateral, and capital revolve around the character of the person, and that is the gray area that is going to be determined by you with your relationship and the banker. Now when it comes to selecting a bank and a banker, here's a couple things you want to keep in mind. I want to really talk about like what type of bank you should be looking for, because not all banks are created equal when it comes to small businesses. Some banks are set up for more towards real estate. Some banks are more set up towards large commercial companies, and some banks are set up really for just personal finance. So finding a small business bank is something that you should shop around in your market. Unless you're in really small town America, you usually have at least a few different options. And so I'd really recommend looking around and asking about the different terms and conditions that would be best for your business. So a couple things to keep in mind. First of all, the two things that we do as small businesses the most, the financial products we use the most when it comes to a bank is going to be checking accounts, as well as short-term debt. So credit cards, lines of credit, maybe a short-term loan, maybe an equipment loan. That's the most important two things you're gonna, financial instruments and financial products you're gonna ask about when you go to talk to these banks. And the reason is because not all banks have the same exposure to risk. If there's a newer bank, they might be more open to risk because they're wanting to get more customers. Whereas if we just came through a recession and you're talking to a big bank, they might have way less exposure to risk and they might be very, very conservative. And unless you have 50% of the loan is collateral, and unless you have a certain amount of income, it might be almost impossible to get a loan if you're just getting started. So I would really say, when it comes to selecting a bank, try to get a bank that has some local branches that you can walk into and actually talk to a banker. Although it's not necessary, I would recommend that over having an online bank at first, especially because you're going to want to actually create a relationship with your banker, talk to them about the different products they have, talk to them about the different rates, talk about the future of your business and where some of their products might be facilitate your growth. And you want to have a person. In my opinion, it's nice to have a person, their email, one point of contact, and that's more difficult on an online bank or a bank that's so big that you get a different person every single time you go into the branch. So I like that kind of local bank, has some branches. And if you're going to go national and you're going to start having different states where you're doing business, that's when you're going to want like a Chase, US Bank. One of these banks are going to have branches basically in any county around the United States or Canada. And especially if you're going to go global, then you're going to start talking about really big banks. But you're definitely going to want to ask yourself, okay, if I'm going to stay local, I probably want to have a local bank. And in my opinion, a credit union, a local credit union or a nonprofit credit union, many times it has the best rates and the best customer service and the best just experience as a small business owner because they don't have profit, they don't have commissions based upon selling you stuff. They're giving usually an hourly rate as a banker, so their best interest is to serve you, give you good information, educate you, and not just sell you more products. Whereas if you go to a Wells Fargo or a US Bank or a Chase Bank, they're many times getting commissions based upon the different accounts that you set up or loans that they get you to sign. I want information. That's the most important part from this banker. And I don't have to pay for it, but I do want to make sure it's coming untarnished, that information, not because they have incentive to sell me something. And so a lot of times a local credit union is a great place to get started. You have local branches, really good bankers, and people that you can communicate one-on-one with in person and learn from and not have that filter of are they trying to sell me something? So that would be the place I would start. Usually at the most favorable terms, the best rates, and if they're nonprofit, you just know that you're not getting, you don't have to worry as much about having really, really bad rates. It really becomes a matter of, my opinion, the downfall of a credit union, sometimes local credit union, is their ability to do big projects because there's less incentive for them to sell stuff. I kind of as I've gotten bigger, we now use Chase because I have I have businesses around different states and around the country. I have international business that I'm doing. I want to have a bank that can grow with me. But Even if I was going to my local credit union, sometimes it's just annoying because things take a long time because they don't have that incentive to sell you something. There is no commission, and sometimes working with a bank that has that kind of puts a fire underneath a banker's belly to actually get stuff done. So I've seen it work both ways, but for most small businesses getting started, and until you have interstate or international business being conducted, a lot of times a local credit union is the way to go. All right, so now we're going to talk about interest rates, and one thing to keep in mind when it comes to interest rates, a key sort of phrase is what you're going to hear: prime rate or base rate. Both the same thing. Basically, this is the interest rate that is charged by most commercial banks to their most credit-worthy customers. So basically, it's like the bottom, the lowest you can go. Has a lot to do with the 10-year treasury, the bond yield of the United States. And there's a bunch of different factors, but it's traditionally what is looked at as kind of like the base rate or the lowest rate you can get from a commercial bank that they're going to tack on before they then add any sort of additional basis points. So a basis point is basically 1/100th of 1%. Okay, so 1/100th of 1%. So what that means is if I had 50 basis points to the base rate, I'm going to be adding 0.5% of interest. Right? So a couple ways you could say this. A banker might say, well, we're gonna charge you prime plus 2%. Well, let's just assume that prime and base is 3%, and they just said, hey, we're gonna give you prime plus 2%. What that means is what they're going to be charging you is a 5% interest rate, okay? This is the equivalent of also saying we're going to charge you prime or base plus 200 basis points, okay? Because again, 200 basis points is equal to 2%. So again, 5% is going to be the interest rate. So keep in mind that if you're having an adjustable rate loan, which means that your interest rate is not fixed, it actually adjusts, the reason it's going to move up and down is based upon if prime or base rate is moving. So if things are going in the economy, if there's inflation, if the Fed is moving up interest rates, etc., that's all going to affect the prime interest rate, and therefore an adjustable rate loan, you're going to actually have your percentage going up and down based upon prime. If you have a fixed rate mortgage or a fixed rate loan, you aren't going to have to worry about that. You're not going to worry about prime going up and down. Now, what you might want to do if you have to get an adjustable rate mortgage for whatever reason, or an adjustable rate loan, I should say, for whatever type of loan product you're getting, what you can ask the banker for is a ceiling on your adjustable rate. So you might say, hey, I want prime, they say, hey, we're going to give you prime plus 2%. It's an adjustable rate, which means if prime goes up and down, things can move. But you say, well, actually, I'm okay with that, but can I get a ceiling at, let's say, 8%? So right now, maybe prime is 3% plus the 2%. I'm at 5% now, but maybe I ask for a ceiling of 8%, so that if prime ever goes to, say, 10%, I'm not going to have to pay 10 plus 2, which would be then 12%. Okay? How you kind of want to look at it is like prime is 0. Anything in addition is usually where the bank is going to make their money. And so prime, though, goes up and down based upon so many different factors in the economy and the U.S. Treasury and the bond yield and all the rest of it. So that's what you need to know: prime and base rate plus any basis points, and a basis point is 1/100th of 1%. That's interest rate in a nutshell. All right, so another important part about loans is the loan maturity. And I've said it before, but a loan's term should really coincide with the use of the money. So if you have short-term needs, then you should, that really only requires short-term financing. But if you have long-term needs, you're going to make sure you want to have a long-term financing. And I'm saying this for one reason, and that is there's a note I want you to know, and that is that some banks require your line of credit to be what they call cleaned up at least once per year. And they'll actually put the maturity date of that line of credit to be 11 months, which basically means that once a year they want you to clean up all of your line of credit. This is basically their way of making sure you do not finance long-term debt obligations like inventory or equipment or real estate through a business line of credit that they might not want you to use that certain product for. They want you to use that on things that are going to be a month or 2 months, or maybe some working capital, or perhaps an influx based upon seasonality of a business. But just keep in mind, mind. If you're getting a business line of credit, there's something to keep in mind. If their maturity is set to 11 months, it means they want you to clean up that line of credit at least once per year to limit their liability of that particular product. And typically it's business lines of credit. So keep it in mind. Maturity of the loan is, the date of that maturity needs to coincide with how long do I need this debt for. If I'm trying to invest in real estate and buy a big shop or a bunch of equipment, or even where I'm going to need a bunch of inventory, I'm going to need that line of credit all the time. I'm never really paying it off, and I'm maybe using it from 50% to 90% of that full value of that line of credit. Probably not a good thing to go get a business line of credit that has a maturity of 11 months. Okay, so keep that in mind when you are looking for short-term versus long-term financing and loans. All right, so when it comes to a loan, the repayment schedule is also very, very important. And again, I'm just trying to give you some warning about something that potentially could be a massive trap for you, or just something that you overlook and becomes a big issue for your business. And obviously the repayment schedule, on a typical term loan that's set to be repaid over 5 or 10 years, is going to be like an even monthly payment typically over the course of the whole term to pay off the entire loan and the interest of the entire loan. But there's something called a balloon payment. Okay, and a lot of times when we think about balloon payments, we think about, oh, like, you know, obviously I'm gonna have to pay a bunch more at some given period of time. When it comes to business loans, it's something you want to be careful of, because there's something called the balloon payment clause, where in a loan, the bank can actually really put you in a bad spot halfway through what you thought was a 7-year term. All of a sudden, they're now expecting a big payment halfway through. Let me explain. So balloon payment is when a large payment, usually very large, is required halfway through the term of the loan over which the payments was originally calculated, and that balloon payment repays the remainder of the loan. Okay, so let me give you an example. So we're gonna go ahead and have a loan of $50,000 at 6% interest, and we're gonna do it, and we're gonna pay it over the course of 84 months. That's gonna be our term, 84 months. Let's write this up here. This is gonna be our term. This is going to be our interest rate, and 84 months is simply 7 years. So that's our loan, that's the term, that's the interest rate. Everything sounds great, and if everything goes smoothly, we're going to be paying a cool $730 per month for those 84 months, and we'll pay off the entire principal plus all the interest, okay? But what might happen is the bank has in the clause the right to call this loan at year number 3, which means after 3 years, you're still gonna owe, so after 3 years, if we do the math, we're still gonna owe $31,000, okay? And they have the right after 3 years, potentially, if they have the right to call inside of the loan documents, that means that after 3 years, they can be like, hey, we want the rest of the money, $31,000 right now. And this is why I'm talking to you about this, because you need to read these bank documents and ask your banker, is there a balloon payment in this? Is there an option for the bank to basically take my loan at some given point in this term and ask for the remainder of my loan to be paid in full? Okay, so in this case, what's going to happen is the bank is now going to, the reason they do this, by the way, the reason the bank does this is because what they want to do is they want to assess if you're still creditworthy after 3 years. If after 3 years, like this business is going down, they're not doing very well, we're going to call our loan while they still have assets and while they still potentially have some cash to give us, and not wait another 4 years when we're going to be basically going after them and they're now bankrupt. So again, the reason a bank does this is because they want to evaluate the credit worthiness of the business at some period in the middle of that term. So they're going to have 2 different options. One is that you're going to have to repay it. So one is that you have to pay the entire balloon payment of $31,000 to pay off the loan. Or 2, they just continue at what was previously agreed upon term and conditions, and the monthly payment would just keep going for another 4 years. And you just complete out the 7-year term, as was previously agreed. But this is a clause that you want to be careful of. If you have a term loan with a bank, the fact that they potentially might have a balloon payment clause and the right to call the loan at some period in the middle of the loan. Again, they're protecting themselves against the fact that in a few years, your business might not be as creditworthy. You might have sold off all your assets or the collateral or the inventory, or you might be running into really hard economic times, or things are changing with technology and your business isn't doing well. They want to make sure they get their money. And so they're going to assess the creditworthiness of the business and have the option to require a balloon payment, and it could be very detrimental. It could really, if you get caught with your pants down this one, I've seen this put businesses out of business by simply not reading their loan documents and understanding the fact that there is a repayment schedule and there's potentially the chance of a balloon payment if the bank has the right to call the loan. All right, so the last thing I want to cover when it comes to loans is what's called loan covenants. And really a loan covenant is really just bank-imposed restrictions on a borrower that increases the chance of timely repayment. So the bank just wants to make sure they get paid back their loan at the end of the day, and these covenants are just things that make sure that that's going to happen and you're not going to default on the loan or not be able to pay back the loan. So there's two different types of loan covenants. There are positive loan covenants and negative loan covenants. It's not like positive and negative in terms like good and bad. Positive just basically means that they're going to require certain activities, and then a negative covenant is just basically saying they're going to limit certain activities. Okay, so I'm gonna give you a couple examples, but again, the reason we're going through this is that when you go to a banker and you get a loan, you actually go through the documents and understand like what a covenant is and why it's a negative covenant versus a positive covenant, and that you understand your loan documents. You understand what you're promising to pay, and the terms of that loan are extremely important. And these covenants are also very important, all right? So a covenant that the bank might put in for your loan, first of all, might be that they require monthly or quarterly financial statements. This is going to be a positive loan covenant because they're requiring you to do something. Okay, they're requiring you that you must give them monthly or quarterly financial statements in the form of maybe a profit and loss statement and a balance sheet. Maybe they want a statement of cash flows, etc. But traditionally, at least a balance sheet and a profit and loss statement or income statement is going to be what's going to be required on a monthly or quarterly, sometimes annual basis. But definitely, this is the most popular positive covenant is going to be requiring you to give them a documentation of your financials. Let's go over a few different negative covenants that could be in your loan documents. First one is that they might actually limit the manager's salaries to prevent people from siphoning off cash from the business. So they don't want you getting a loan and then basically just raising your salary, owner's or manager's salary, to basically take the cash out of the business to you personally, and now the business is basically going bankrupt. They don't want that. So they might actually limit the ability for you to raise managers' salaries past a given point, and they might actually reduce or limit the ability for you to give personal loans from the business to any owners or managers to again prevent any sort of just murky waters or money being laundered or moved from the business into people's personal accounts, and then they are not able to collect on the business assets or the business loan that they've now created with the person they're giving the money to. All right, another negative covenant can be they could put limits on certain financial ratios. For example, they might not want your assets to liabilities ratio to get too low, or they might not want your debt to assets ratio to get too high. So they might actually have certain ratios that, based upon the positive covenant of giving the financial statements, they might say, hey, there's certain ratios we're going to limit you to, and if your debt is going too high, we're not going to allow you to keep actively using this loan, or we're going to call this loan if your ratios ever hit a certain point. All right, another one is the kind of a negative covenant is the fact that they are going to make you limit your limited liability. So what that means is, again, it's a negative covenant, which basically says, hey, if I have an LLC or a corporation, there's a certain amount of liability protection or limited liability that I'm going to get in having an entity structure. However, they might require you to limit that kind of protection by giving a personal guarantee, which basically says, hey, if this business goes under, I am personally signing on this loan, and if anything bad happens to the business and you can't collect either for the assets or the cash or the principal of this loan, I will then be on the docket. I will be the one that you can then come to, and you can personally come after me if the business cannot pay for this loan. So again, these are all covenants that a lot of banks are going to have in their loan documents that you'll want to go through to know what they're going to require you to do, positive loan covenants, or what they're going to limit you from doing or not allow you to do in the form of extra salaries, loans from the business to you personally, and even from a legal protection standpoint, you're almost going to be limiting that liability protection that your entity structure that we talked about previously might offer. But if you've waived that and given that away to them in the form of a personal guarantee, again, these loan covenants are to make sure that you do pay your loan back, and that's why the bank has them in there. Another form of accounts payable is what's called trade credit. And trade credit is typically short in duration, usually 30 to 90 days, and it's going to be owed, this money is going to be owed to your suppliers, the people who give you raw materials, potentially leases, or any sort of inputs, things that you need to pay for, but you're going to try to get a credit on. Typically, it's most commonly associated with getting your cost of goods, which is going to be mostly wrapped up in your materials. So for example, why is this so important? Well, it's important for seasonal businesses. So for example, if you are a sunglasses manufacturer and you sell 60 or 70% of your sunglasses in the summer months, you want to make sure that you try and pay for your materials later in the year. You don't want to have to be going through the slowest period of time in the winter when you're not selling many sunglasses, but you're also having to pay for all the materials required to build all the sunglasses you're going to actually sell next summer. So what someone in that case might do is say, hey, look, we're going to order all this plastic and all this metal and these hinges and all these things from you, but we don't want to pay for it for 90 days because we know in maybe 60 days we're going to actually be selling this sunglasses. We'll be able to collect the cash and then have the cash in hand before we're having to give our suppliers the money. Another example of this is in the landscaping industry, for example, when we do a big project. Take it off the table for a second that we want to take 50% down before we even start the project. But even beyond that, I want to even extend further out when I need to pay my suppliers for maybe the wall blocks or the patio pavers or any sort of trees that I'm buying. And so a lot of times those suppliers will have trade credit where you can apply for an account and pay for things every month or every quarter instead of every time you come into the nursery, every time you come into the landscape supplier, you got to give them your credit card. What this allows you to do is literally get 50% down on a project, complete the project, bill the client, and get the rest of your money for the whole project, and still you haven't paid for your materials because that happens at the end of the month or end of the quarter when you pay your supplier. So again, the reason you're going to use trade credit and the reason you're going to use accounts payable is because we always want to make accounts payable as long as possible, and we always want to make accounts receivable as short as possible. In other words, we want to collect on our money as fast as possible, i.e. keep accounts receivable, collect on it fast. When it comes to trade credit and accounts payable though, we want to pay our suppliers as slow as possible. This is the form of trade credit, and there's going to be times when they're going to give you better discounts if you don't extend those terms out too far, because again, they're trying to do the same thing, and that is collect money fast. So this is the perfect balance, but at the end of the day, when it comes to cash flow, the thing that crushes so many seasonal small businesses is the fact that we don't have trade credit and we can't survive the lull in cash flow when we're needing to build or get materials and put things together before we actually end up collecting on the cash and we sell the product. Very, very important when it comes to cash flow management, and always keep in mind the golden rule of cash flow is always making sure you collect fast and you pay down the road. You extend the amount of time you have to pay on this trade credit. All right, so we're going to talk about equipment loans and leases. So this is a really common thing because a lot of times you don't necessarily go to a bank to get these loans. You can actually get them directly from your supplier. When it comes to equipment and trucks or trailers, they actually do in-house financing, which is really like, hey, we're gonna break up your payments, and at the end of the day, they're still charging you interest on the principal. It's just, you're not going to an actual bank. You're not getting a bank loan or an SBA loan, you're getting an equipment loan. Now, there's loans for equipment from a bank, but these a lot of times are most common actually buying them from your supplier. Trucks, trailers, pieces of warehouse equipment, manufacturing pieces of equipment, these are all things that a lot of times you'll actually get directly from the supplier, and they'll finance it, either through a lease or through a loan. So equipment loans and leases, typically the term is 3 to 5 years, so 36 to 60 months. And with an equipment loan though, you're usually gonna have a down payment of 25 to 35%, and that equipment is gonna be the collateral for the loan. So you can't use that piece of equipment for collateral on another loan. This is the only thing you can use it for. Collateral is the loan that it is used for collateral on to buy. So if I buy a truck and I pay 25% down on the equipment loan, that 75%, the rest of the equity is collateralizing the loan for the remainder of the term. So with a lease, usually same thing, same 3 to 5 year period of time, but it covers 100% of the cost of the asset, which means there's no upfront down payment. We'll talk about that, the advantages of that in a second. It also usually has a fixed rate of interest included in the lease payments. So even though they're not going to break down, here's the interest rate and here's your, how much you're paying on principal like a loan would, when it comes to leasing, you're still technically paying you're basically still paying an interest rate, right? You're still paying an interest rate, and there's buyouts and there's different clauses, like sometimes after 3 to 5 years, you still have a balloon payment at the end, for example, to actually purchase the equipment, or you could give it back after a couple years and get new equipment. So there's a lot of different options with leasing, and we're gonna talk about that in just a second. So 80% of firms use some form of leasing on some or all of their equipment. There's 3 different advantages when it comes to leasing over getting a regular equipment loan from a bank or from your supplier and paying interest and having a regular, what we consider a loan. First advantage is the fact that there is no down payment. So 25 to 35% is typically required to get an equipment loan. You don't have to do that with leasing. 100% of the value of the asset is accounted for in the lease payments. So this is great because it frees up your cash. You don't have to sink your cash into that 25 or 35% down payment. The second great thing about leasing is that it allows you to keep available lines of credit to be used elsewhere. So instead of using your lines of credit to cover the down payment, now those lines of credit, you can keep them open. You don't have to go use them, and you can use them on other things besides the equipment. So it really frees up your cash flow as well as freeing up any available credit that you do have. The third thing is, this is also a hedge against equipment obsolescence. So with a lease, a lot of times you can give the piece of equipment back to the supplier or the manufacturer. Again, every single leasing term is so different. So I want to talk in generalities. But a lot of times a computer, for example, or certain types of hardware are only relevant for a few years. I don't want to purchase them and go through a 5-year loan agreement where after 2 or 3 years that piece of equipment is like obsolete and like technology is catching up so fast, I don't even need it anymore, and I can give it back to the supplier and the lease is done. So especially when you're buying a piece of equipment that's going to quickly be obsolete because of technology or the industry changing, probably want to do a lease instead of a longer term loan that locks up all my cash and I can't ever give it back. And that's the thing that's really cool about leases is a lot of times you can give that piece of equipment back halfway through the lease term and then it's like as if nothing happened. Again, there's always penalties, there's a fine print, you gotta really read into your lease terms because a lot of times you might use it for 2 years on a 5-year term or a 5-year period of leasing. When you give it back to them though, they're gonna charge you because of wear and tear or dings or dents or just normal stuff or just a penalty for not actually having the entire lease period being lived out. Now, one thing, everyone's like, well, should I get a loan or should I get a lease? The two big things I'd really look at is the tax implications, as well as the implied interest rate of your leasing program. Because like I said, even though there's not an interest rate on a lease, there is still an implied amount of money that you're giving up in addition to the principal, and it can be annualized, and you can figure out what that interest rate is if you just break down the payment numbers. And a lot of times if you ask your leasing agent, they'll do that math for you, but you can eventually just look, okay, how much is coming off of the principal over the course of my lease versus how much am I paying? Well, whatever is in addition is the interest that I'm paying, the extra money I'm giving this company because I'm leasing. That can be brought down as a percentage, and you can figure out how much I'm actually paying in terms of interest. So the tax benefits or tax implications, do you need more write-offs this year? Potentially you want to have the fact that I can get a leased product, leased item, and write it all off on a Section 179 and just write everything off. Again, talk to your accountant, see what's best for you, but that's an ability. You can literally, without having to put 25% or 35% down on a piece of equipment, I can get the piece of equipment on a lease and write it all off on my taxes. But again, you're gonna have to talk to a tax accountant because there's certain rules about what types, how you amortize, whole 9 yards. So, but those are the two things you're looking at, is tax implications as well as the implied interest rate on that lease. Now, a quick warning, because everyone's like, oh, this sounds fantastic. Why would I buy anything with cash? I'll just use credit, and I'll use debt and loans, and I'll lease everything now because I don't have to have any cash. You got to make sure you don't lease so much equipment that you can't make the monthly payments. That's first. But secondarily, a lot of times the thing that people don't take into account when they look at the implied interest rate of a lease or even the implied interest rate of a loan is the fact that a lot of times the bank or your supplier is going to require insurance on that asset, and that insurance is significantly higher premiums or standards that you would usually buy for the piece of equipment. For example, a truck. I buy my truck for cash, and I can choose what type of insurance I want to buy. If I buy my truck with a loan or from a leasing company, I might pay a lot more on premiums than I would typically get because they're going to require a very low deductible, very high coverage, comprehensive collision, a whole bunch of other stuff I might not have bought if I would have just purchased it on my own with cash. So that's the kind of the hidden thing that people don't look at a lot of times, is the extra premium cost of buying insurance that you otherwise would not buy if you were paying it with cash. So keep that in mind when it comes to looking at the implied interest rate, is what are the requirements of the lessor or the loan giver, the bank or whoever, what's their requirements when it comes to insurance, and how much more are you going to be paying for that insurance in comparison to what you would usually buy for that piece of equipment if you didn't have that as a collateralized piece of equipment because of the loan or the lease. So keep that in mind. It's kind of the hidden print. I've seen it before where the equipment loan has a 10% interest rate, but then literally they're paying $300 or $400 more per month in insurance, and what they would usually buy, $300 or $400 more per month in insurance compared to what they would usually buy. Now, if you actually look at the interest rate implied, it's like 16 or 17%, which is like a credit card. So just keep that in mind. It's kind of the hidden fine print, but when it comes to leasing versus a loan, you're going to look at tax implications as well as the implied interest rate of that lease. Now we're going to talk about asset-based lending. So typically when we talk about asset-based lending, it's basically a line of credit secured by assets such as receivables, inventory, or purchase orders. So let's talk about that. Typically, a bank or some sort of lender is going to give you up to 65 to 85% of the value of a piece of equipment, like a vehicle, for example. So I could say, hey, I want to go start my lawn care business. I need to go spend on marketing and uniforms and all the rest of it. But in order to do that, I need cash. And in order to get that cash, I'm going to take the truck that I own and I'm going to get an asset-based loan against it. They're going to usually give me 65 to 85% of the value of that vehicle as a loan, and the collateral is that piece of equipment, or is that vehicle, in this case my truck, that they could potentially collateralize, and I'm going to pay an interest rate on that loan. But again, it's based on the asset value, asset-based lending. Now, one thing that's interesting is what's called factoring, and factoring is really when it comes down to selling your accounts receivable to another firm. So typically, the value of the accounts receivable is going to be looked at like at 70 to 90% of the accounts receivable is what they're willing to give you typically. So if I have $100,000 in accounts receivable, they might give me somewhere between $70,000 to $90,000 as an advance before I actually collect on that money. So again, accounts receivable is clients owe me money for work I've done, goods that I've provided for them, and they owe me this money, but I haven't collected it yet. Again, we want to collect money as fast as possible, but accounts receivable, it's outstanding. I can sell this off, it's called factoring, and sell this off to another firm, and they're going to loan me $70,000 to $90,000, 70 to 90% of my accounts receivable. Now, typically, in exchange for that loan, they're going to charge about 2%, 2 to 3% of the accounts receivable as a fee, and then they're also going to charge you 2 to 3% interest on top of prime rate. So let's say if prime rate is 5%, they're going to charge you 7 to 8% interest on top of the set fee that they're going to charge as a function of how much accounts receivable they're actually collecting for you. So they almost kind of act like a collections agency, but really, because you're selling it off to like their asset now, because remember, accounts receivable is considered an asset. You're selling it to them, and they're going to usually take 70 to 9% value of it is what they would give you a loan against, and if they collect on that money, they get like 2% of it as a flat fee, plus any interest that you're going to be paying to them over the course of the time of having that advanced money. So purchase order financing is another way to get cash, and again, this is a form of asset-based lending, because again, your purchase orders are a form of an asset. So you can obtain a cash from a lender who, for a specific fee, advances the amount of the borrower's cost of goods sold. So if you have cost of goods sold, for example, I have a big order for my cookies, and I make cookies, and I'm selling cookies, and I need to order all the materials and the eggs and the ingredients and the flour and all the rest of it. I have this massive PO, this massive purchase order, but I need to go get the cost of goods, i.e. the ingredients, to actually fulfill the order. So again, this is another option, is if you have a really good purchase order, a big one usually for a small business, it's like your biggest one ever, and you can't fund all of the necessary ingredients or cost of goods to produce the items and the products to actually sell to fulfill the PO, that's when you'd go to an asset-based lending company and you say, hey, look, I have this purchase order, there's real value to this. If I produce X, I'm going to get Y in return, and they will then again look at the percentage of that purchase order and give you some asset-based loan based on the value of that purchase order. Again, all of this is considered asset-based lending, and typically that asset is going to have a value, and based upon the risk of that associated asset is what they're going to give you a loan based upon. Something like equipment, something like a truck that can be flipped really easily. They can take possession of it, take a title, and sell it. Typically, they're going to have a higher percentage of that asset that they're willing to let you borrow against. Whereas if it's a purchase order, they're less likely to be able to sell that purchase order or take ownership and give it to someone else for that same value. Therefore, they're less likely to have a high percentage of that asset that they're willing to let you borrow against. Another way to fund your business is through crowdfunding. So this has become popular in the past 10 to 15 years as the internet has really become more and more accessible to more and more people, and it has really allowed a way to raise money online, usually in small amounts per investor, so people aren't giving $1 million away, but really it's small amounts of money from a lot of different investors. And some of the most common sites you might be aware of is like Kickstarter, Indiegogo. There's a variety of different sites, but those are some of the more popular ones. And when it comes to crowdfunding, there's really no immediate immediate return for the investors. Either they're just giving the money away to the person who has this idea, this project they're working on, or they have some future expectation of a product or business being created and they get some sort of return, whether it be the product or in the form of equity. So really there's 4 different types of crowdfunding. The first is donations, and this is just going to be like free money, all right? So some people, they literally just want to see a project get started, and if you have a lot of friends, family, people in your community that want to support you, they literally might just donate to you. And these are just donators, but they're considered still part of crowdfunding. The second is rewards. So this is going to be saying, hey, if you invest, i.e. give me money, I'm going to give you rewards, and that can be in the form of some of your products. That could be some of an existing experience or something you package together to give people that are going to invest in the crowdfunding campaign. The third and most commonly known way of crowdfunding is through pre-purchases. So you might have heard of like the Pebble. It was like one of the first quote unquote smartwatches, and it was done through a Kickstarter campaign where they sold millions of dollars worth of these smartwatches before Apple Watch, before it got really popular. Pebble was launched as a Kickstarter campaign, as a crowdfunding campaign, and what they did is they sold a whole bunch of watches. They say, look, here's the price. It's going to be X amount. Let's just say $200. But if you pre-purchase, you can pay $149 today, and we're going to go ahead and get started on this project. We're going to build this product, and when we're done, you'll get the product. So pre-purchasing is a great way to get, especially product-based businesses, to fund the development of the project, the business, or the product. And if successful, then the contributors are sent the product, and then there's a reward down the road. And so the problem, the risk that pre-purchases have with crowdfunding is if the project is not successful, they might end up have lost their money. And some of these projects that I've seen on crowdfunding are a year, 2 years out. And that becomes difficult to crowdfund because it's very hard to convince investors that their pre-purchase is actually going to be fulfilled and in a timely manner, and the time is actually going to look and feel the same way that your video or your campaign presents, or is it going to look completely different or be completely like old news by the time you actually deliver it to them. So pre-purchasing, it's the most common way though. It's the easiest because people want discounts. They want to quote unquote invest in this crowdfunding campaign of basically purchasing the product before it's available. And you use this money then to go actually develop the product and actually meet those orders that are created by the pre-purchasing. The fourth and kind of the most blurry part of crowdfunding is equity crowdfunding. So the reason this is a little bit murky is because now the SEC, the Securities and Exchange Commission, is going to get involved because now there's equity being moved between people. And so there's some definitely legalities, and you have accredited investors and non-accredited investors, and a couple of different sites that work actually pretty good for this type of equity crowdfunding is Crowdfunder as well as AngelList. All right, and these are sites that a lot of times will help with the SEC rules and the investing rules with accredited investors and non-accredited investors and make sure everyone plays by the rules. So you can definitely check those out if you're interested, but it's definitely less common just because of the amount of legalities around it. And there's a couple of cautionary things I'd say, and that is, first of all, be wary, like you're giving equity away. You're getting partners now in your deal, and there potentially might be voting rights that come with that equity, and that's something that's going to be very important in the legal papers that you have to fill out when it comes to giving away equity is, do they get voting rights? Because now you might give away a big crowdfunding portion and raise a bunch of money through equity, but then now, 2 years into the business, now they have voting rights and they can actually change the direction of the business and vote you out or vote down your direction for the company. So equity, that's my cautionary tale, as well as the fact that now you've got to share detailed financial information as well as trade secrets that you potentially might have with not just a select group of investors that you have in a room that you're trying to get like an angel investor or venture capital. Now you're actually like sharing this publicly online with like hundreds, if not thousands of investors these specific type of crowdfunding type investors that are online. So those are a couple cautionary tales. Those are the things to keep keep in mind when you might be thinking about giving away equity in exchange for money. It sounds great because, hey, I don't have to go sell an actual product. I don't have to give and send out rewards. I don't have to ask my people for free money. I can just give away equity. That's great, but there's a lot of SEC rules when it comes to giving away equity via crowdfunding. And in other words, small little chunks of your business for small fees from a whole bunch of people online. There's a lot of rules and regulations. Make sure you go through appropriate sources like AngelList or Crowdfunder if you're going to go down that direction. Another way to raise money for your business is through what's called angel investing. And angel investors are typically private individuals who invest in early stage companies. So they're not usually institutional, they're not usually parts of big groups. These are private individuals, typically like just people who have been successful in business, or even like lawyers or attorneys or doctors, just people with a bunch of money and they want to invest in young companies and hopefully get a big return. Angel investing from their standpoint can be very lucrative if 1 out of 10 of their companies become really big companies and they are able to get equity in them. So 80% of business angels invest in companies that are really just startups with less than 20 employees, and usually they're going to invest in companies that are local, like close within 50 miles of where they live. And they're also usually going to invest in specific industries that they have expertise in. They're not just going to invest in like, manufacturing if they've never done manufacturing in their whole life. They're not going to invest in like a new gizmo for the oil industry if they've never been in the oil industry. So typically for an angel investor, they're going to invest in companies that they have some specific industry knowledge, experience, and skills in. And what's unique about angel investors is the fact that they're going to want to actually want to contribute to the experience the business has, and they're typically going to invest in those areas that they have that expertise and those skills. And that's the valuable part about an angel, is the fact that they can really add that level of skills, know-how, and something that you can tap into for knowledge and information if you are just getting started. So a couple things I want to go over to kind of keep in mind if you're going after angel investors or choosing between angel investors. And first and foremost, make sure they are an accredited investor. So there's accredited investors and non-accredited investors. Accredited investor basically is like legal speak for they can lose the money, and they're so rich they can lose the money and not worry. It doesn't matter. Like, it doesn't matter to them. They're rich enough to never get back a penny, and they're not going to get hurt by that. A non-accredited investor, that's usually when lawsuits come up because they can't live without that money, and they are going to come after you. So an accredited investor, an angel investor, typically you want to make sure that they are accredited, and if they lost that money they invest in your business, they'd be okay. The thing to, again, I've already talked about this, but make sure that you're not just getting their money. Realize that the real value is their connections, their skills, their experience, if they've been in your industry, the doors that they can open up, the phone calls that they can make, and when you're in a bind or you need help, they're actually going to be invested in giving you knowledge. Not just a checkbook, not just the money, they're actually going to add to the direction of the business and advice when you need it. Third thing is understand the motivation as to why this angel investor wants to invest in you. Because a lot of angel investors, they're not just looking at the numbers. Again, they're local. Again, they're investing in industries that they have skills and experience with. So there's a little bit more emotion that they're going to invest with. And a lot of times they're going to have a double bottom line, which means they're not just looking at the dollars and cents. There's some sort of underlining or other motivation that is driving this investment. And that might be helping the next generation of entrepreneurs. It might be continuing to kind of stay involved in the industry that they spent their whole career in. It might be living vicariously through a young founder that's trying to change the world or change the industry or make some big improvement. And they kind of get to, without having to be the everyday grind and working and managing the numbers and the people, they're able to still kind of live vicariously through the owner by staying in touch with them, helping out occasionally, and just feeling like they're part of something. Another thing is to keep in mind when it comes to angel investors, a lot of times you want to sign up people that, if you're going after a specific angel investor, you want to sign up people that they know or that they've heard of. If there's a really popular angel investor like Guy Kawasaki buying into a startup as an angel investor, that gives a lot of angel investors the confidence that this is a good founder, this is a good business, and that person, that angel investor, has a good track record. So either they've heard of them, like Guy Kawasaki, everyone knows who that is in the angel investing community, or people that they know, because again, a lot of times these angel investors are working locally, and there's other people that they know that are also angel investors. And so if you're going after someone, try to get the other people they know in your community to invest in the business, because that's going to lead to a lot of goodwill, because again, this is a much more tightly knit, closer network of people that are typically local. So try, if you're going after a specific angel investor, try to get the people they know or people they've heard of, and then you can kind of target them a little bit better. Last thing is be nice. When it comes to angel investors, typically, in contrary to VCs, like VCs, we're going to talk about in a second, venture capitalists, they'll sometimes invest in a schmuck because the schmuck has a good business idea and has a good track record for making good money and returns for their investors. And they'll invest in the idea. Whereas an angel investor, because they're a little bit more hands-on, because they're actually involved in decision making and involved with the founder a little bit more, they're going to be less likely to invest with someone that is disrespectful and is just arrogant or a pain to work with. So be nice and be respectful of them. They've usually had great success in their career, great success in their industry, have a lot of skills, and I feel like they should be respected, and that's how you're going to attract more of them, because they actually are going to be working with you. They're not just like a silent partner that just gives you money. They're going to be actually involved somewhat in the decision making for the business. All right, so another form of finding investors and finding capital is through what's called a venture capitalist. So venture capitalists are typically a group of individuals who form a limited partnership really just for the purpose of raising capital from large institutional investors, such as like pension funds or university endowments, or even sometimes insurance companies that are investing massive amounts of money, and they allocate these to venture capitalists who then take that money and basically give it to startup companies as well as established companies to try to obviously generate a very good return on their investment. Venture capital is risky. It's more risky than investing in like a mutual fund or in an index fund of stocks where they might have 5-10% yield every year. They're looking for hundreds of percent a year. They're looking for 10x growth. They're looking for massive growth typically, and they're looking at the numbers. And typically how a venture capitalist works is this group of people will raise a predetermined, so they say, hey, we're raising a fund of $500 million. And then that group is going to invest in those high potential startups and companies that they feel are going to give the best return on that fund's investment. And of course, by raising that money, they're going to these pension funds and they're going to these university endowments, and they're trying to get them to invest with their fund. So you have to remember, they're kind of running a business of their own, and they're going to be less inclined typically to give the personality that an angel investor is going to. An angel investor is going to be much more hands-on typically, a smaller valuation, a smaller company size, wanting to have some say in where the business goes. Whereas a venture capitalist, that group is typically going to have oversight of your business through a board seat as a board member on your board of advisors, or your actual, depending on the size of your business, if you have an actual board that they can have a seat on and actually have voting rights. So it really just depends on the size of your business, but typically a venture capitalist is only going to be involved when you have a larger company. Angel investors are a little bit smaller in the size of checks that they typically will write. And although they're hyped up, like venture capital, you hear venture capital thrown around on TechCrunch and these other companies that really talk about venture capital all the time, but really only about 1% to 2% of new businesses get started with venture capital. Typically it's going to be self-funding, bootstrapping, getting a loan, getting a grant, getting an angel investor. Only 1% to 2% actually get venture capital backed when they're getting started. So the big thing to remember is the fact that typically, if equity investment is your goal, as a small business, you're usually going to be looking for an angel investor. So if you're trying to give away equity in exchange for capital, typically an angel investor is going to serve you better because you're just getting started. If you're watching this, you're probably not thinking about venture capital. You're going to be trying to find an angel investor that's going to be investing a smaller check size, but but they're also coming to the table with their experience, their skills, and their connections in the industry that you're trying to build your business in. So for most of you, venture capital won't be really a big issue, but down the road, as you grow your business, you might start with an angel investor and then realize that you do want a venture capitalist involved because of the amount of money that they do bring to the table, and that's going to come in the form of a much more sophisticated investor that's looking out for the shareholders of that VC firm, and there's going to be a lot more numbers oversight. Typically, these VCs are trying to get in and out of a deal within 5 to 7 years, either through an acquisition, like you getting bought out, or you going public, and then they're converting to common stock. So it's definitely a different ballgame when it comes to venture capitalists because they're looking at the numbers. They're going to pressure an exit or liquidity event through an acquisition or going public typically. And so you've got to ask yourself, do you want that? Do you want someone putting pressure on you to sell the business or potentially take it public or raise another fund, another round of funding? That's something that you might not want pressure, and you might want more of a long-term approach from an angel investor that's willing to take the ride with you. All right, so we're not done the MBA course by no means, but I think this is a good spot to start talking about. We talk about equity investing, and a lot of times an equity investor is looking for return. They're looking for a harvest on the seeds that they've planted in the form of risk and in the form of capital they've given to you. And I think as business owners, we need to start thinking of our business more as a money machine, more as a way to get return, and not just a means of working 9 to 5 or just going to work and being busy all day. We need to start thinking of ourselves like, hey, we are investing in the form of sweat equity. We're investing in risking our capital, and that should come back to us in some sort of a return on that investment. And so all the planting that you do, starting the business, getting it off the ground, all the work, the effort, the risk, all of that pain should come back to you in the form of a harvest. All that planting should come back to you in the form of a harvest. So there's really 4 different harvesting options when it comes to your business. And that is, again, like you plant the seeds and all that work and the effort, that's really the startup process. Well, that should grow over time. 5, 10, 15 years might go by, and then you're gonna harvest all of that work that you planted, and now it's grown, and now there's actual return, there's value to the business that can be harvested. How do you harvest the business? There's 4 different ways. Let's go over them really quickly. So let's just do harvest options. And there's really just 4 different ways to harvest the business. The first one is selling the business. Okay. Now, when we talk about selling the business, there's really 3 different types of ways to sell the business. There is, let's just do 1, strategic. And we'll go through all these in more depth. There's strategic, as you sell to a strategic buyer. There is financial sales. We'll talk about each of these ones in depth just in a moment. And then sale to an employee. So you could sell it to an existing employee, all right? Now, we'll go through each of those in a second, but let's talk about the second way to harvest your business. And this is the one that people do, especially when they have multi-generational businesses, and that is distribute cash flows. All right, so this is going to be typically, like I said, someone that is holding on to the business for a long period of time, and they're just going to distribute the cash flows to the investors, i.e. equity holders, i.e. owners, i.e. hopefully you. The third way is something that you probably hear in the media about, and that's the IPO, initial public offering, where you're actually going to go on a stock exchange and you're able to sell your equity to the public at a predetermined stock price. Typically, you're going to be going through an investment, a banking company to make that stock available to the public. And the fourth way is through private equity, which we'll talk again about in a second. This is IPO is a public market, a public equity that you're offering to the stock market. Whereas the fourth option is private equity. So you're not going on a public stock exchange, private equity, and what they sometimes will call this is recapitalization. Recapitalization. And we're going to talk about all of this in just a second, but at the end of the day, the difference between number 3 and number 4 is really just a public stock exchange versus private equity firms that invest into businesses for equity. And you're really, the goal here is not to invest in the business necessarily, as much as recapitalize and actually give money back to the original investors and owners. But these are the ones that typically we're going to be staying in as small business owners, number 1 and number 2. We're going to talk about all of these, but number 1 and number 2 for most small business owners, that's where we're going to stick at. We're not going to ever offer, to the public stock market or private equity even. We're going to either sell the business or we're going to just distribute cash flows for generations to come. Either way, it can be a really good event because we're harvesting the business. The goal of everything we've talked about so far, and as we continue to talk about marketing and growth and sales and all the rest of it in the rest of the course, is the fact that you get to the point where you're able to either sell the business, someone actually strategically wants to buy it from a financial standpoint, or an employee you can sell it off to, or you can distribute cash flows. Like, this is why we build businesses. We do not build businesses to till the soil. We do not build businesses to constantly be investing and planting in the business and investing our time and our energy and our money and risking capital. That's not why we start businesses. We start businesses to one day harvest, and it's going to come in the form of typically selling or distributing cash flows for us as the owners. Let's dig into each one of these, as well as the 3 different options for selling your business. So we're going to talk about the different ways to sell your business, but before we do, I want to kind of add a little bit of a recommendation about business brokers. So if you're going to sell your business to a local competitor or family or friend or an employee, someone local that you know, you probably don't need to go find a business broker. Because in my mind, a business broker, their positive part, the thing you get a business broker for is to find a buyer. If you're going to be doing it to a family member, friend, employee, a local competitor, just get legal counsel, get an accountant involved, obviously get their help, but it's going to be cheaper to get their help than paying 5 to 10% as a percentage of the purchase price to a business broker. So again, if you don't need to find a buyer, probably don't need a business broker. If you don't have a buyer already in mind that you're kind of grooming or in talks to locally or that you know, probably a good idea to get a business broker. They're kind of like the real estate agent for businesses. They're going to be able to put you on listing services similar like the MLS, multiple listing services for real estate. They're going to do the same thing for your business, get you in front of potential buyers. Now, the pros of having this business broker is that they can advertise the fact that your business is for sale. They can also add some legitimacy to your business because they're going to make sure it's all done to a T. They're going to make sure that profit and loss are in place, statement of cash flows, that you have a balance sheet and everything is done right, and it's all packaged in a really nice bundle that they can hand to a potential buyer. So in my opinion, the 5 to 10% that you pay as a fee to a business broker can be made up for almost double in the fact that typically a buyer is going to look much more, look very well on a really well presented purchase agreement or purchase bundle with all of the financials and everything done just right and a plan in place and everything is just done correctly. So in my mind, the business broker is great because they're also going to make sure that once you've sold the business that legally you don't have any liability. So they're going to make sure like, is this new buyer bringing a new LLC or a new entity, or are you actually selling the entity and they're taking ownership of that entity? These are all the type of things that a good business broker should be thinking about and should be making sure you have done correctly in the process of transition of ownership. And now, that being said, there's some bad things about having a business broker, and that mostly revolves around the fact that if they're not that great, and I've seen too many times where business brokers are not super qualified, they don't have any credentials, and literally it's easier than getting your real estate license is a business broker license. So they don't need business experience or legal experience. They can literally just get a piece of paper and all start selling businesses. It's crazy. So make sure they have good credentials. They're worth their weight in gold if they're good, but they are really bad if they are scammy. And the reason I say that is because I've seen where business brokers, because they're only getting paid a commission based upon if the sale is consummated and goes through, they'll actually take certain financial documents out or hide certain parts of data so that the potential buyer actually makes the purchase. Because again, the business broker wants their commission. And that's great and all until the buyer realizes that certain things were hidden from them in terms of financials and comes back and takes legal action against the seller. So you want to make sure that your business broker is legit, has credentials, knows what they're talking about, has really good connections with legal people like lawyers, attorneys, accountants, etc. That's the type of person that is going to be their weight worth in gold. And so keep that in mind. If you have a buyer already in mind, you probably don't need a business broker. But if you need to someone to go find a buyer, it's going to add some legitimacy if you have a business broker instead of just like throwing up a Craigslist ad or posting on Facebook that you're selling your business. Probably not going to get a great valuation. Much better valuation typically if you have a profitable business that's of size that you're actually harvesting. Probably the best route is to use a business broker because it adds a lot of legitimacy to the prospects and the perception of a potential buyer. All right, so the first type of buyer that could potentially buy your business when you're wanting to harvest the company is a strategic buyer. So let's talk about this a little bit more. So typically there's two different types of strategic buyers. Either A, they're in a similar business, and usually that's if they are wanting to get that business in a different market, or they're really in need of a new product or services to sell to their existing customers. Okay, so they might be in a similar line of business and they're like, hey, we want to grow into this market, or we want to take your products and services and sell them to our existing customers. So similar line of business. Or it could be a completely unrelated business that wants to buy out your company, and really they're doing it just to acquire the seller's strengths to help the buyer's existing business. So completely unrelated from them, and they're buying it for whatever intellectual property, talent acquisition, things that they could care less about that business. Literally, they shut the business down. They are buying it for some reason that's going to strengthen their business. And a lot of times it is, hey, I want to grow and I need talent. I need a CEO and I want a great group of people. Great, I'm going to buy this business. I'm going to completely wipe the business out, and I'm just going to bring that talent over here and they're going to help me in my business. Or they have a patent that I need, IP, intellectual property. Or they have a trademark that I need for my business and I'm going to go buy them out. So there's a strategic buyer in that case. When you look at the valuation of a strategic buyer, they're going to pay more. Typically because you're looking at the standalone value of the business plus the synergies that this business is wanting to get from this acquisition is equal to a premium. So I always say stand alone characteristics of the business plus the synergies, synergies. And again, this is the part that is subjective to the strategic buyer. What are those synergies? That equals the premium that someone is willing to pay as a strategic buyer. Strategic buyers are going to have the best valuation. They're going to be the ones that typically are willing to spend the most money to buy your business. And so whether it be for IP, whether it be for employees and talent acquisition, whether they're trying to break into a new geographical location. Like if I have a lawn care business over here, I'm like, you know what, I want to grow over there. And yes, I could spend the next 5 years developing it, getting the customer base, etc. Or I could go buy the competitor that's over there. I would be, in this case, a strategic buyer. And I would probably pay a premium price in order to buy my competitor. So a strategic buyer typically pay a much higher price. And in that vein of thought, if you are a strategic buyer and you're wanting to buy your competitor, or you're wanting to buy out someone else for whatever strategic reason or synergies you see in their business that could help you, be willing to pay a premium. Because typically a strategic buyer is going to the seller and asking to buy their business. Whenever in negotiations you initiate the transaction, you're at disadvantage and you don't have the leverage. Because if I'm going and I'm asking, hey, I want to buy your business, what are you willing to pay? They're going to have a higher price in comparison to them wanting to sell their business. And now I'm lucky enough to be like, oh, actually, that's a really good deal. I'll take it. Typically, in that case, when they want to sell and then I step in as a strategic buyer, I can get a really good price on that. Unfortunately, it's a matter of luck if whether or not your competitor, the person in your next geographical location, or the person you want to buy out wants to sell their business. So typically, strategic buyers are going to go make an offer, put you at a massive disadvantage though from a leverage standpoint in the negotiations. So keep in mind, if a competitor comes to you and they're a strategic buyer, realize you have all the cards in the game. They are wanting to buy you. They came to you first. You should be getting a higher valuation, and it's going to be based upon not just the value of your business, but also the fact that they see synergies. That's what equals the premium, and this is what all of us want to sell to. This is what is usually heralded in the news when Google and Apple, these big companies, go buy out a small little company that literally has like 15 employees, and they'll pay $1 billion. And literally they're doing it just for the IP, the intellectual property, the patents, the website, the knowledge that's inside of the talent, like just for talent acquisition. They'll bring them over. I'm like, great, you're going to come over here and you're going to do something completely different. But we wanted to buy you out just for that purpose. That's why they get such a high valuation when they were potentially losing money. There was absolutely hardly any standalone value, but the synergies with that bigger company is what allows that massive valuation and that premium to be inflated. So now we're going to talk about selling your business to a financial buyer. So we already talked about a strategic buyer. Now we're looking at someone who's really just looking at the finances of the business. So typically a buyer for this type of a buyout is going to be looking at the business strictly standalone from a cash generating potential and really looking at that as its means of value. So it's not looking at strategically what it could do in the future or anything like that. It's simply looking at how much cash is coming in, and therefore here's the value that I'm willing to buy the business for. Now, typically because of that, the buyer's going to make changes to the firm's operations, such as cutting expenses and staff. So a lot of times when someone acquires a company that is a financial buyer, they're going to come in and cut staff, do a bunch of layoffs, and the reason for this is because they're simply looking at what's the cash flow on this deal, and I can immediately improve that by simply cutting expenses and cutting out a lot of the waste. Now, that might hurt the business in the long term, but a financial buyer might look at it from a completely different perspective, and they're looking at simple cash flow and what are the numbers. So a couple things you need to know. LBO is leveraged buyout. So LBO, leveraged buyout. And that basically means that it's a heavily financed buyout using debt. And this is typically where the cash flows of the target company are expected to be sufficient to meet the debt payments. So for example, if I'm doing a leveraged debt buyout and I'm buying a business for, let's just say, $1 million, new pen here, and my monthly payments, for the sake of the example, are going to be $8,000. The question that I have then is simply, am I able to finance this acquisition and make more money in cash flow than $8,000 per month? That would be the deciding factor. And really, in a leveraged buyout where there's a lot of debt involved, really what the buyer is going to do is actually work this backwards. What they're going to do is say, okay, you're generating $8,000 of free cash flow. Fantastic. If I get let's just say 5% or 6% or whatever interest, I'm therefore able to come up with a purchase price based upon the cash flow being generated, being able to cover the interest expense. Okay, so it's simply a number of, I can pay up to whatever purchase price as long as my interest is less than or equal to the cash flow that's being created. So this is a leveraged buyout, lots of debt being used, and that's why a lot of times when a new buyer comes in, the first thing they'll do is cut expenses so they can actually have some free cash flow after the fact that they're gonna have this big debt payment. So a bust up LBO or a bust up leveraged buyout is gonna be when the new owners pay down the debt really rapidly by selling off the acquired firm's assets. So someone buys this business for $1 million and they're paying $8,000 in interest, say for example, because that was what the monthly cash flow was coming from the business. They did a leveraged buyout. They go out, it's like simple arbitrage. Can I now make more than $8,000 free cash flow? Because that's going to be my profit. Therefore, what they're going to do is the first thing they're going to do is they're going to go try to sell down this debt. The debt that they just took out on the acquisition, they're going to go try to pay that down by simply selling off the acquisitions of the company, the assets of the company. So there might be property, there might be equipment, there might be intellectual property, all of these things that potentially have value that this new buyer, the new owner is going to come and say, hey, look, I'm going to sell this stuff off, I'm going to pay off this debt, and now I'm going to hope that I can keep this free cash flow coming to me instead of just going towards paying off the debt. So that's a bust up LBO. There's also a thing called a build up LBO, which is becoming a little bit more popular as companies try to take a conglomerate onto the stock exchange. So typically, this build up LBO is going to be a purchase of similar companies with the intent of making the firms large into one large company that's typically going to be put on the stock market and taken public. So an IPO, initial public offering, that we've talked about and we're going to talk about more in the future, is simply an LBO that is a build-up LBO. They take a bunch of smaller companies, usually similar. So hey, a whole bunch of dealerships. We'll take a whole bunch of car dealerships. Okay, great. We're going to buy them all up. We're going to acquire them all up through LBO, and then we're going to take them all public on the stock exchange and then be able to pay off our debts, and that's how a leveraged buyout using the build-up method might work. So again, this is a strictly arbitrage of numbers. What is my leverage going to cost me in the form of interest, and what is the existing free cash flow, and can I pay off the debt payments using that cash flow, and can I then reduce that debt burden by either paying stuff off or taking it public eventually. These are the type of things that happen in a financial buyer acquisition when the person coming to buy your business is strictly looking at the numbers. All right, so now we're going to talk about selling your business to an employee. Now, there's two different ways. One is an ESOP, or an employee stock ownership plan, and then the other one is like you actually just sell the business completely to an employee. We'll talk about both of those. The ESOP is common in larger companies because it does take a little bit of work to actually set up. But it's basically a business is sold in part or in total to its employees. And a lot of times with an ESOP, it's going to use the retirement contributions to basically buy company stock from the owner and then hold it in a trust. And then over time, the stock is going to be distributed to the employees' retirement plans. So what's nice about this is the owner can still maintain control, as well as the tax benefits that come along with this, because if 30% or more of the company is sold to the employees, then there's a lot of tax benefits to the owner, and they might be able to not only delay, but actually indefinitely delay having to pay taxes when they sell the business. So there's definitely some pros to that. However, many times, when you're giving stock to an employee, the reason you do it is because you want to reduce waste, you want them to think like an owner, you want them to take ownership of their job, to work harder, work longer hours, etc. But you've got to remember that motivation of employees differs. And for some people, having more stock or making more money, or them getting more in their their employee stock ownership plan, their ESOP, or having more in their retirement isn't going to do anything for them. It's not going to motivate them to work harder, work longer, work faster, think like an owner. And so what can be really detrimental to the business is if a large stake of the equity is now in the hands of the employees and they still adopt the 9 to 5 mentality of not really caring for the business. They still come in to punch a clock. They don't work overtime. They're not thinking about the long-term result of their daily operation and their contribution to the business. And so that can be really, really detrimental to the long-term success of the company, is if a big chunk of the equity is given to people that don't think like owners. So the goal is, hopefully, by giving them equity, that sparks that inside of them. But for some people, you give them all the equity in the world, but they're just not going to be motivated to work longer hours, to work harder, work faster. They're going to care more about work-life balance, or potentially being able to leave at 4 p.m. Like, these are the type of things that you got to take into account, that just giving equity to people doesn't necessarily mean they're going to work harder or better. That's the hope, that's the goal, but keep in mind there's other motivations that go into an employee's mindset. Now, the other more common way of selling to an employee is literally selling the business to an employee. They take a loan out, or they go get financing, and they figure out some other form of financing besides an ESOP, where you're giving the stock to the employees, usually through a retirement type plan. And so when you're selling to an employee, one thing that's really common when it comes to selling to an employee is seller financing. A lot of the reason for that is because an employee is not going to have the same access to capital. They might not have enough cash to actually buy the business out. Again, we're talking about smaller businesses here. Seller financing is going to be traditionally a little bit more common when it comes to selling to an employee. You as the owner have that trusting relationship probably built up with them, and they trust you more. So seller financing, I'm more inclined to say that we're a go, because you You trust them as an employee. They probably worked with you for a long time. They trust you as now you're going to be lending to them. They trust you as well. So a good relationship there. Seller financing is basically, though, where a part of the acquisition is going to be given in the form of a note instead of cash. So you might say, hey, look, we're going to sell the business for $1 million. That's going to be the acquisition cost, and 500,000 of that, you're going to go get a loan and from the bank. But because you don't have the money to pay the down payment, etc., I, as the owner, am going to give you another $500,000 as a form of seller financing. So this would be the bank. This would be seller financing. Now, there are definitely some tax benefits to being when you're selling your business to an employee, to having seller financing, because that way you can break up the money coming to you instead of in one massive fail swoop, one massive chunk. You can kind of break it over the course of a few years potentially. But the other thing to keep in mind here too is the thing that's really good about selling to your employee is this transition. Because if they've worked in the business, they understand the operations, they understand how things work. The other employees already know them. So unlike a leveraged buyout where the owners come in and they're looking only at the numbers and they start cutting people and cutting things and changing operations and cutting out waste, that can be very, a lot of upheaval for existing employees. And so if you're thinking a lot about the culture of the business, selling it to an employee is a great option because they understand how things work. They understand the operations. They understand all the employees. They know how everything works. So it might be faster and a smoother transition in terms of giving the business away to an employee versus someone from the outside that you have to teach them new stuff, how you do things. All the employees that are currently at your business have to get to know them. They have to get to know the employees. Like, there's a lot more of a transitional period, and especially if you're trying to get rid of the business quickly, an employee might be a better option because they already know how the operation should roll. So there's not as much of a transitional handoff that is going to be required from you as the previous owner. Another way to harvest your business is through distributing cash flows. And for some people, like, they buy and they hold and they never sell. Now, this is like, the classic Warren Buffett. Like, he's not going to sell his stock. He's going to keep these businesses for the long haul, and he is trying to exit, or he's trying to get returned by just distribution of cash flows through dividends. Okay, so there's really two different options when it comes to distribution of cash flows. One, like, the first thing you can do is just sell off all the assets and liquidate the inventory. If you're like, hey, I'm just done with this business and I'm not going to go through all these other ways of selling the business, I'm just going to liquidate, right? I'm going to sell off all my inventory. I'm going to sell all my assets, equipment, property, everything. I'm just going to liquidate the business, take that money, and I'm done. That's the first thing you could do. But if you're wanting to, like, you know what, I actually want to keep the business going, I want to have good cash flows, and this is going to be when the return on the assets creates value. Like, if there's no return on the assets, you should just go liquidate them. You should just go sell them. But if you can get a return on those assets, then theoretically, as long as that return is greater than, like, the rate of inflation, you should keep the asset. So it's dumb. Why would I get rid of a productive asset that's giving me, let's say, 10% a year return on that asset when the inflation rate's like 2%, for example? So there's intrinsic value there now if there's actual greater return than the rate of inflation. So therefore, usually you're not going to just want to sell all your assets and be like, oh, I'm just done in the business, I'm going to sell the assets, sell the inventory. No, like, you've created some value there. You've obviously created something that creates cash flow. Again, we're harvesting the business. It's been years you've been creating a unique advantage, you've been creating a marketplace, you've been creating customers, systems, and all the rest of it. Now you have a business that has value. So it should be beyond the value of just liquidation. So that's when distribution of cash flows might be a good option. And that is basically you're going to have someone else run the business, you're going to step away. And the thing that's relevant here is typically when an owner does this, growth and expansion is less important. Because now it's more about what can I get out in the form of cash flows from the business and less about me taking on new opportunities and growing and expanding and acquiring other competitors and constantly growing the company and having exponential growth. That's probably less important when you're trying to harvest the business and take it from the point of distribution of cash flows. You want to maximize cash flows, and therefore you're typically not going to be constantly growing and growing and growing. And so really what the business does is really just keeps enough of the profits in the form of retained earnings in order to keep the firm competitive and relevant without them constantly pushing for growth. So a couple advantages. First of all, the owner can retain control. So even though you are harvesting the business and maybe not involved, you still have 100% equity. You still have ownership in the business. And therefore, you can control still where it's going, what it's doing, etc. The second advantage is that owners don't have to seek out a buyer or worry about costs of selling the business. So all the previous ways of selling the business, you've got to go find a buyer, get a broker, figure out loans, and do a whole transition with a new person, and all the equity and things being changed over legally and new entity structures. That's all a bit of a pain in the neck. So the advantage of doing the distribution of cash flows is like, look, I'm going to stay the owner. I'm just stepping away from the business. I'm not going to be involved as much in the day-to-day operations, and I'm simply going to take the cash flows off the top at the bottom line of whatever is done, and I'm going to try to reduce my expenses. I'm going to not be spending a whole bunch of money on growth and expansion. I'm just going to try to get as much money out of this as possible in the form of cash flow. Now, a risk that comes with this is that by reducing the investment into the business in the form of growth, maybe R&D, research and development, this could leave the business unable to sustain its competitive advantage. Because at the end of the day, a profit is only created in a business when you have some sort of advantage over the marketplace. There's no reason why you should get, from a purely economic standpoint, you should get a profit if you are equal in terms of productivity, efficiency, and value to the customer. So therefore, if you have a profit, you have a unique advantage of some sort, and your competitive advantage against your competitors, that might be lost if what was creating that advantage was your investment into research and development, constantly growing and changing the business, breaking it, fixing it, constantly making it better, improving it slightly, modifying it, making new versions of your product or service. So keep in mind, this is a risk that is by simply distributing cash flows and taking as much money out of the business as possible, you run the risk of kind of running the cow dry. You take too much out and it goes dry. And so that could potentially happen. So something you want to make sure you do is, if you're going to distribute cash flows, make sure enough of the money is being invested back into the business to keep it competitive, keep its competitive edge, so you can keep charging the same prices and have the same margins. Because otherwise, over time, you can slowly deteriorate the competitive edge, therefore your prices go down, therefore your margins go down, and all of a sudden, there is no cash flows to distribute. And another negative really with the distribution model is too much time. Like, it takes too long to get your money. The beautiful thing about selling your business is tomorrow I go get the $1 million that we just talked about. Whereas if I'm distributing cash flows, I might make $100,000 or $200,000 a year in cash flows, but it takes years for me to get what would otherwise have been an immediate injection of $1 million if I would have sold the business to someone and they got a loan, and 2 weeks later I was out of the business and all hands off, totally done. So there are some negative aspects, and for some people the positive part is that they retain control. Well, that same attribute is the exact negative of someone else. They don't want the control. They don't want the responsibility. They just want to wash their hands of the business and go live on a beach and never worry about anything with the business. So keep in mind, if you're distributing cash flows and that is your form of harvesting, you always still are going to be worrying about the business a bit, because if the cow goes dry, there's no more milk to be had, and you don't get any more cash flows. So you're always going to have some ties to the business, and you better be sure that the people you're handing that business off to, if you are kind of delegating the operations and stepping away from the business from a day-to-day level, you better be sure that they know how to run the business. Because if they don't, and they don't know how to take care of the cow that's producing the milk for you in the form of distributions, you're going to run into problems. The one last negative thing, which doesn't apply to most small businesses, is that from a tax standpoint, if you have a C corporation, you potentially might have double taxation, where you're getting taxed at the corporate level, and then also once you take those distributions, you're getting taxed at a personal level. But for most small businesses, we're going to say in the S corporation or a LLC, to where that's not going to really be an issue. Double taxation doesn't happen. All right, now we're going to talk about IPOs, initial public offerings. This is really when a private firm sells its shares for the first time to the public. This is usually when you see the founders like ringing the bell at the NASDAQ or the New York Stock Exchange, and everyone's excited. They got banners of their company's logo everywhere. It's all exciting. It's great. So let's talk about what this really is, though. The initial public offering, when a private company first sells their stock to the public. So first of all, it requires registering the stock issue with the SEC, which is the Securities and Exchange Commission. So what that basically does, the SEC is there to basically prevent fraud and to ensure there's adequate disclosure of these publicly traded companies to investors, so people don't get scammed, like what happened with Enron, and there's tons of different examples of companies that have defrauded their investors by not sharing appropriate financials. And so the SEC is there as a regulatory body to make sure that, hey, the financials are clean, that investors that think they're buying a certain security are given the correct information and they're not being scammed. So in doing so, when you're going to have an IPO, you need to file a detailed registration statement that has very in-depth financial statements, management information, as well as operational information. Like everything to do with your business is disclosed. Now, keep in mind, this might not necessarily be a good thing because, for example, WeWork was a company that when they went through their initial paperwork and all the information required for their IPO, it showed a whole bunch of flaws in their business model that no one knew because of the private company. They didn't have to share all this information. They didn't have to share certain financial statements and management issues and where stock issues were going between the founders and where their expenses were at and how much money they were losing. All of that in a private company doesn't have to be shared. When you make an IPO and you get all your paperwork starting to get ready and all of your documents ready for your IPO, a lot of this information now becomes public information. And so you got to realize a company like WeWork, when they did all this, they all of a sudden a private company that used to be worth like 70, 80 billion dollars went down like 80, 90% in value, and they actually canceled the IPO due to the fact that in filing their registration with the SEC, all of this information that was private now became public, and it looked really bad for them and their business, and they actually canceled the IPO. So all of this is in the registration process for an IPO. It's to protect the investors and make sure everything is fully disclosed. Now, you've got to keep in mind the cost of managing an IPO. So you're going to hire an investment banking company like JP Morgan, these massive firms that will go out and sell these issuances of stock to the public. Because I'm a founder. I want to harvest my business. I want to take it public, i.e. give ownership to the public. Therefore, my stock, my equity needs to be sold to these investors. The broker doing in between, it's going to cost money because they are now literally taking a private company, taking through all the paperwork, the registration with the SEC, getting you on a stock exchange, a whole bunch of legalities, as well as now they are having to advertise that stock to potential investors. And usually at the very beginning, investment firms, insurance companies, and large corporations are going to buy a lot of that initial stock that comes available when the IPO takes place. So that takes a lot of money. And sometimes that can be, for a small firm, like up to like 20% of the actual value of the stock issue can actually just be the cost of managing the IPO. Obviously, a big firm, it's trillions of dollars, or billions and billions and billions of dollars, much less likely that costing me 20%, but it's still a very significant cost. People pay billions of dollars to get their stock on an IPO and their business on the stock market. So a lot of costs go into that. You got to keep that in mind, and that's why usually until a firm has a couple $100 million in value, it's usually not worth getting on the stock market. And traditionally, it's even a billion or 2 billion where it starts to become even in the realm of possibility or make economic sense because of the cost of managing the IPO. And the thing is too, you gotta keep in mind there's significant costs ongoing of running a publicly traded company. Regulatory costs, accounting costs, legal costs. You have quarterly meetings, so you gotta have accountants and figure out all the numbers for every quarter that you're gonna share publicly. You have like a PR company to make sure like the way that you present that quarterly report. You gotta have legal people figure out making sure everything's good with the SEC SEC. Like, there's a lot of costs ongoing, not just the IPO, but ongoing when it comes to a publicly traded company. So why would a company go public? Like, what's the benefits of issuing your stock on the public stock exchange? Is first and foremost, by having the IPO, it can really enhance the reputation of the firm if done successfully. A lot of people can know about you. People who never even knew you existed, all of a sudden see you doing an IPO and you're front page. You are headlines. There's a lot of recognition that goes around this, and the reputation of the firm can absolutely be bolstered. 2 is additional source of capital to grow the business. So potentially, a stock issue doesn't mean you have to sell all of the business publicly. You can sell a segment of the stock and issue only a percentage of the stock of the business on the public market. And when you do so, again, that can be a way of selling a piece of the business to the public and then basically taking that capital, investing in the business, and really growing. So some companies will go public in order to raise money and then go acquire another firm or really expand into a different marketplace or invest heavily into R&D to create a new product. So having an IPO is another way of doing that. Third thing is it's also more attractive when you have an IPO and you go public, you have a publicly traded company. It's really attractive to key personnel that do have stock options or incentives around potentially getting stock assigned to them because it's very easy to get that stock. It's not private equity where it's a lot more loopholes and hoops to jump through and signing over. Like if it's publicly traded stock, it's really simple to be able to get money in and out. It's easier for them to trade shares. Obviously, if they're an insider and a management, there's certain laws around that, but it's a lot easier to assign shares and equity in a publicly traded company where all the legwork of an IPO has been done, SEC, everything has been, all the I's have been dotted, the T's have been crossed. It's very easy to transfer equity and stock, and it's very clear in terms of if the stock price is going up or down. It's very, very clear. And so for someone that is getting stock options or incentives around getting equity, it's a really great thing for them to be able to see very transparently what the value of that stock is as time goes on. Another way to harvest the business is what's called a private equity recapitalization. It's also sometimes called a private equity recap. But basically what this is going to be is when a private equity investor, either a group or potentially even a private investor that's private equity, provides a combination of either debt and or equity to the business that allows the entrepreneur to cash out part of his or her investment in the company. So this is actually used quite a bit when a first generation business is being passed along to the next generation, because the business might be worth, say, $20 million. The first generation owners want to take $5 million off the table in terms of cash, but still pass the business along to the next generation and retain control. Right? So they may own 100% of 20 million. They sell off 25% of it to private equity in a private equity recapitalization, get the cash from that 25%, which is $5 million, but still the second generation retains 75% control of the business. So a great way to pass a business along, but then still be able to have a liquidity event. Typically after a private equity recap, the entrepreneur is still going to have control and typically still manages the business. So whether they're handing that off to another CEO or the next generation of their family, or if they're actually going to manage the business, typically this is not going to be a situation where the company gets a piece, the private equity group gets a piece, and then sends a new CEO and a new board of directors and all the rest of it. Typically, you're going to have a minority stakeholdership as a private equity recap. And again, the recapitalization part is again to give the owners a way to have a liquidity event, get cash, and sell a piece of the business in the form of loan or equity. So the advantages to this over going to the public markets and going to public investors is twofold. One is immediacy. So when you go have an IPO or you take your company public, typically you can't actually sell any of your shares for some lockup period. There's a certain amount of time that you cannot sell your shares. It might be a year, 2 years. I've seen 4 or 5 year lockup periods where owners cannot sell their shares after their company goes public. And so the nice thing about having a private equity recap is you can immediately get the money. You can sell your shares immediately after a recap. So that's the advantage in comparison to a public. Also, the advantage of a private equity recap versus going public is the fact that you have a lot more flexibility to build your business structure and the structure of your deal in a more more favorable terms to the entrepreneur. When you're going public, there's less flexibility because you're dealing with investment bankers and a lot of hedge funds and big companies and big groups in the stock market that are not going to look favorably on giving certain types of shares, like preferred shares or more voting rights, to the entrepreneur that might want more control. So flexibility is a big positive of having the private equity recap, and it's another way that you can sell a piece of the business off to private equity that is looking for a return. Typically, they are going to want some sort of residual return, or even they want to see you exit either through an IPO or a sale down the road. But getting the right private equity firm on your recap is going to be important, because if you're just going to pass the business to the next generation and sell off 25%, you're obviously going to make sure that that private equity firm is not expecting an exit in the next 3 to 5 years for you to sell the business. If your goal is to simply pass along the next generation, take your money out of the business, and still the next generation retain control of the company. All right, so we've looked at all the different ways to harvest your business, but now I want to kind of look at all of them together and really just look at the prism of a framework that I want you to think about when you're wanting to exit or harvest the business. Like all these different paths, going public, private equity recapitalization, all the different ways that you can sell off pieces of it or just sit back and take distributions. We talked about all of that. Now let's figure out what way should you use, because there's various ways of harvesting your business. And this is going to take a little bit of time, but just stick with me for a second here. So there's 7 different ways that you want to look at this. The first one is why, okay? So a couple questions I want you to ask when you're thinking about, why do I want to exit? Why do I want to harvest my business? And these are things that you should answer. Like if you come to the point where you're wanting to sell a business, or you're wanting to get out of the daily operations, and you're not sure if you want to sell, or if you want to hand it off to someone else and get distributions, or if you want to do private equity, this is what you might want to come back to this episode. This lecture might seem kind of, not useful if you're just getting started, but this is definitely something you should be thinking about, all these questions. So why? Why do you want to exit? What are the goals for the harvest? Okay, what are your goals in doing that? Whose interests matter most? Mine, those of the shareholders, or those of your employees? All those, like if you really care about your employees, you might do a different way of harvesting your business. What will I do in the next phase of my life? Like, are you gonna play golf? Are you gonna do a bunch of fishing, traveling? And those are not really the best answers. Like you could say, well, I'm gonna golf, or I'm gonna travel, or I'm gonna go shopping all the time. That's great, but what like the next phase of life, what's the goal of that? Like, why are you harvesting the business? Is it because you don't want stress and therefore you're going to go play golf? Is it that you want to spend more time with your family and your grandkids and that's why you're going to harvest the business? So again, why is really important, not just like, oh, because I want to sleep in. Like it's kind of a pathetic goal. Timing, all right? So the second thing I want you to think about when it comes to how you're going to harvest your business is timing, okay? So is now the right time to sell? And so ask yourself, like, why is now the right time to sell, right? So if you're having a certain goal to do something after your business is harvested, if you're trying to get into a different business, maybe you're trying to use those funds to invest in something else, whatever it might be. Why is now the best time to sell? And then ask yourself the next question. Well, the opposite. Why is this not a good time to sell? Perhaps your industry is going through a lull, and if you can just hold on a couple more years, you can get a much better valuation if you just wait a little bit longer. Again, just thinking about timing. And then, has the business been run in a way that makes it an attractive acquisition? We talked about how to make your acquisition and your business more valuable. And have you been running it in a way, the timing of it, like for example, if you've been the bottleneck in terms of CEO making all the decisions, maybe you need to wait a year or two, hire up another CEO so that when you step out, nothing falls through the cracks because you actually have a great leadership team in place. So timing, really important. All right, next thing is price. This is the one everyone wants to talk about. Price. What is the business worth? All right, so ask yourself, what is my business worth in the market today, in the long term? To a strategic buyer in a hot market, what is it worth to me? So again, price is going to be completely depending on, are you selling it to a strategic buyer? Is it more valuable to you than to anybody else? Well, that might be a problem if you're trying to sell. Is the price going to be determined, like what's the price you're going to get in a hot market versus in a time where potentially the stock market or private equity is not really looking at your industry. Their price to earnings ratios and their interest is just much lower in your industry. Again, what's the price is going to be determined by all those things. Do we want to be paid out in stock or in cash? It's going to be a really important part when you start thinking about pricing your business to sell it or to value it when you are doing private equity or public equity is, do you want stock from a company or do you want cash? Because you could potentially get bought out by a big company, a strategic buyer, but they're willing to give 90% of it in stock, in their shares, and then only 10% in cash. All right, how? All right, this is the part we've been talking quite a bit about. How are you going to decide on the method that you're going to harvest the business? What method is best? All right, and why? We talk about all the different ways to harvest your business, selling the business. You can sell it to a strategic buyer, sell it to a financial buyer, sell it to an employee. You can distribute cash flow. You can do an IPO and go public. You can do private equity. What is the best method and why? What will it cost financially? Again, if you're going to do an IPO, it's going to cost you a lot of money, all right? If you are going to potentially even sell it to an employee, it might cost you a lot of time and money just getting the business ready or that employee ready. And potentially if you're doing private equity, same thing. You might be traveling, trying to pitch to investors and investors groups, and it can cost you financially quite a bit in terms of how the method at which you're going to harvest the business. Will the harvest hurt the company? This is an important one. Will the harvest hurt the company? Will we have to provide access to proprietary information? All right, so again, deciding how the method that you're going to harvest it is, well, is this type of harvesting going to hurt the business? If I want to do an IPO because I've always wanted to take a company public and I have intellectual property that could potentially hurt the business, if I now become public and have to release that information, that could be a problem. It could also be a problem if I have proprietary information and I then go share it with a private equity group and now they take it and give it to all their other firms, and my firm no longer has any sort of unique advantage because they took my IP. So again, will it hurt the business? The method that I choose to harvest the company. All right, next thing is, how do I get the best price? So negotiation. So now we're talking about how do I get the best price on my harvesting? How do I make the pie bigger, okay? So again, how do I make the business bigger? How do I make it where the valuation is bigger? And how do I negotiate the best pricing? What are the best negotiation tactics? All right, these are questions you need to know, and a lot of times your negotiation tactics are going to be leveraged based upon, are you selling it to a strategic buyer? Who are you selling it to? Is it strategic, a financial, an employee? That negotiation tactic to determine the price, the timing, and why you're doing it will be, the negotiation. What are the best tactics to do that? How do we increase the pressure to close the deal? So if you have a potential strategic buyer and you know you're coming out with a new product, you might put pressure on them to buy the company or to invest or to negotiate using the leverage of the fact that you're about to roll out a new product or line of products that might compete directly with them. And now it's going to even put more pressure on them to buy you out or come to the terms of price that you have determined. All right, last one, and that is, do you stay with the business? Again, this is the framework, this is the matrix that you need to look through if you're starting to think about harvesting your business. Are you going to actually stay in the business? Why would I want to stay with the business after harvest? Some people want to do it because golfing every single day doesn't really matter to them. They want to stay involved. They love their employees. They love their customers. They love showing up to the office every day. And so that might be a big part of why they would want to stay. Then ask yourself, why would I not want to stay with the business after I've harvested? A lot of people, it feels like they literally have handed off their child to someone else and letting them raise it when they have now given equity or given ownership or given control over to another firm. They've been bought out or whatever it might be. Do you even want to stay, or is it just going to tear your heart out every day knowing that you don't make all the decisions in the business after you've harvested the company? And then if you do stay, what role would you have? Will I be able to enjoy and contribute to the new culture? Because things are going to change. If I got bought out, if I'm public and I got to answer to a board of directors, if I now have a private equity firm that's constantly looking for a return, do I want to stay? And then what role will I play to make sure that the business is actually going to thrive from me being there? And will I be able to deal with the new culture? If they come in and fire people, let people go, will it be okay? And it might not even mean if you get bought out. If maybe you hand off this business to an employer, hand it off to your children or a family member. Well, do you want to be around when they have the control, but you are now just watching them do things that you might not agree with? That might be something you want to think about when you're harvesting your business. So these are the 6 different things you're going to want to think about, and ask yourself all those questions. I gave you 3 questions for every single one, and you'll want to answer those when it comes to the time when you actually want to harvest the business, i.e. get out of daily operations, i.e. retire, i.e. sell out, i.e. pass it along to the next generation. That's harvesting the business. You've won the game when you got there. So congratulations, but definitely think through this process. And this is not a process that's thought out overnight, or over a day, or a week, or a month. Many times, a lot of years will go into determining exactly how you're going to harvest the business, why, the timing of it, the price of it, how you're going to do it, negotiating to get the best price, and whether or not you're going to stay in the business after you harvest. I know it's the last video of the module, but I want to talk really quick, kind of take a step back and look at the business as a whole from a strategic standpoint. And when we look at strategy, I feel like there's 2 different ways to look at strategy, 2 different lenses. I can't spell strategy, mercy, strategy. 2 different ways. One is a cost-based strategy, and then the second form of strategy is going to be differentiation. So differentiation-based. All right. And so when we look at cost-based strategy, it's going to be a strategy where it's like, look, we're going to cut everyone's price, undercut all of our competition's prices. And the plan of action really requires the business to hold down its costs so that it can simply compete by charging lower prices and still make a profit. This is really the strategy behind Walmart with their slogan, everyday low prices. We're going to keep prices so low that no one can compete with us, and we'll still make a profit. Same thing with Costco. It's like, look, we're going to get everything in bulk here so that people cannot get these products any cheaper anywhere else. We're not going to make any money actually on the products and services. We're only going to make money on the memberships. Right? So again, cost-based is really dependent on low labor costs, operational efficiencies. So for example, Walmart has its own distribution network. It has ships, it has trucks, it has planes, literally because it's trying to create operational efficiencies to reduce costs and therefore get the price as low as possible. And it used to be impossible to ever really compete on a cost-based strategy as a small business owner, because you're competing with these massive companies that have tons of money and have resources that we can ever dream of having. However, the internet really changed the game here, because now you from your own computer without a big office or a skyscraper in New York can get started on and take down a competitor that might have economies of scale but way more overhead and infrastructure and people and payroll and legal and accounting and all this other costs of doing business that you might not need. So therefore, cost base is actually something that's interesting with small businesses. Now we actually have somewhat of an advantage against the incumbents in some regards. But typically, it's really hard to create brand loyalty or customer loyalty and long-term success using the cost-based strategy, simply because the customer is always looking and on the hunt for the next good deal. They're not allegiant to you, your brand, your products, and they'll just leave you if there's ever someone else that's willing to go cheaper. So that's why places like Walmart and Costco are always on the hunt for cutting costs and reducing their efficiency drag, because they've got to keep prices low, otherwise they will lose customers. All right, so if you're going to have a cost-based strategy, you better be cutthroat with efficiencies, cutting costs, cutting labor expense, etc. All right, second, differentiation-based strategy is when your plan of action is designed to provide a product or service with unique attributes that are very valued by customers. And these features have to be something different than the cost. So the thing that keeps them coming back is something besides just the fact that you're cheaper than everybody else. And so it could be something like the design of the product or service. So, for example, iPhones, iPads, Mac computers, Apple Watches, all within the Apple ecosystem. The design elements of their products is a differentiating factor between everyone else. The user interface, the design of the actual hardware is all different different and differentiated from all their competitors, and is their strategy of simplicity and a beautiful user interface, a beautiful UI. Same thing, you could have a differentiation-based strategy through promotion or branding. So Red Bull is an example that I think of when it comes to using their branding and their marketing as a way to differentiate them from every other canned drink out there, every other energy drink. There's gazillions of them that are very closely affiliated, or like their recipe is similar to Red Bull. But the Red Bull Gives You Wings campaign and their alliance with extreme sports, with crazy stunts, like jumping out of space and motocross and all these crazy, athletics and all the rest of it is around an energy drink, but they use those crazy stunts and those sort of really high intense type of activities as a way to differentiate their product through advertising and promotion. So again, ask yourself, am I cost-based? Am I always going to be cheaper, or am I going to be differentiation-based? I would highly recommend you be differentiation-based. Okay, low cost or cost-based strategy, trying to always beat out the competitor with a low-cost strategy, is extremely difficult. And not only because it is, you potentially might be able to beat out a competitor or an incumbent or a big player in the market for a short amount of time, but with the amount of resources and money and people that they have, a lot of times they're going to just dominate, cost inefficiencies and tax things that they can get loopholes on and all the rest of it. They can find more people than you, hire more people than you, pay more for infrastructure around online. So differentiate based is what usually a small business has to focus on, and you have to figure out how you're going to get those customers to be loyal to you beside the price. Because if the only reason they come to me is a low price, that means I'm probably not going to have very good margins. That's why Walmart operates on like a couple % margin, is because they're attracting cost-based customers. I want to be able to have a healthy margin, 10, 20+% at least in profits in my pocket in the day. And to do that, I need a differentiated strategy that's going to allow my customer base to come to me, stay loyal to me, even though my price is not the thing that makes me different. So that's what I'd be having you focus on, is how do you make a differentiated based strategy for your business, and constantly be thinking about how can I be different than the competition, because different pays big dividends, and you don't want to be in a massive struggle always to keep your customer from going to the next person that might be willing to undercut you on your prices. All right, it's Module 8. It's time to turn you into a marketing machine. And so the very first episode, the very first lecture is going to be about something very boring that most of us as entrepreneurs don't like to talk about, and that is why the focus on existing customers is the most important thing when it comes to growing your business. All right, I'm going to talk about 5 reasons why focusing on your existing customers will prove to be much more valuable than trying to find new customers. Because we as entrepreneurs have the shiny object syndrome. We always want the next new thing, the next new business venture, the next new investment, and the next new shiny customer, and this job, and this service. Like, we always want the new customer when we got to start focusing more on what our existing customers. And we're going to talk about why, 5 reasons why your existing customers are worth more to you than new customers. Number 1, it costs much more to acquire a new customer than to hold on to an old customer. And you say, well, I don't want to send out gift cards to my existing customers. I don't want to send a thank you. I don't want to send a happy birthday card to my most important clients. That's just too much work. Well, it's a whole lot cheaper than going out and trying to find another customer to replace that customer. So when you look at customer acquisition cost, this is what I've seen some people do. Look at customer acquisition cost, and you ask yourself, is this approximately equal to what you're paying to retain a customer, all right? Because honestly, a lot of us will pay, let's just say $100 for a customer acquisition cost, but we would never dream of giving a customer a $50 gift card to a steakhouse because we messed something up on their account, right? But honestly, that's cheaper than trying to losing the customer and then having to go find a new one. So first thing is it's cheaper. It's cheaper to acquire. It's cheaper to keep an old customer than it is to acquire a new one. Number 2 is long-time customers trust you and thus will spend more money than new customers do. Now, over time, that new customer might catch up in terms of how much they pay, but it sometimes takes a couple years for them to trust you 100%. Maybe you're a retail store and they come in every single day, and then you lose that customer for whatever reason, and now you get a new customer, but they only come in once a week, and then maybe they come twice a week, week, after a few months. And then eventually they might, like your product, your service, your croissant that you make a lot, and they would then start coming in more often. But again, a customer has been with you for a long time, they trust you. And so they're going to spend more money with you than a new customer typically. And typically they're going to, this is number 3, happy customers will typically refer their friends and family, which even leads to more sales. Okay, so if I can just focus on my existing customer and make them happy and keep them happy by retaining them, maybe I have to do a little extra work for them. Maybe I have to go back and service their account, or I have to give them something for free, or give them a gift or a card. But if I can keep them happy, they're going to typically share that goodwill with their friends, family, colleagues, etc. And that's going to bring even more customers to me at a 0 customer acquisition cost. So keeping happy customers is much more important than finding new customers. Keeping them happy and letting them refer to friends and family. Number 4 is it costs less to process an order for established customers in comparison to new customers because they are already in the system and they know how everything works. So whether you're doing service or product-based businesses, this is the same. And that is, if you have a customer in your CRM, in your customer relationship management, you already have all their contact information. They've done work for you in the past, so they're not questioning how the invoice is going to be processed. They don't question how your return policy is. They don't question anything. The sales process is shorter. You don't have to pay as much in payroll to get the order processed. You don't have to worry about as many returns. The processing time is so much less for established customers in comparison to new customers, simply because they're already in your system and they know how things work. They know the next step of the process. Number 5, current customers buy without discounts, so they're actually willing to pay more for products and services. So a new customer might say, well, I want the only reason you might get this new customer is by advertising for, $20 off your first order, or buy your first one, get your second one free. You might have to do a bunch of discounting just to get this new customer, whereas a current customer, an established customer, isn't expecting any sort of discounts. They're not expecting price discounts or discounts on volume. They're typically just going to pay the full price and they're going to be happy with it. So why would I jeopardize an existing relationship, or potentially not spend a little extra money retaining my customers and keeping them happy in comparison to spending that money on advertising to go find a new customer? So always, 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 the best thing you can do, the best customer is the customer you have right now, because behind them is referrals to 5 more customers. Behind them is an upsell to a lot more other services. They're not going to question you on every single aspect of that second sale. They're going to always trust you, go forward with the project, and it's going to cost you less to actually fulfill that order, making more profits on an existing customer. All right, so first off, I want to talk about how customer service is so important to your small business. I'm going to talk about the 4 kind of steps of getting from the fact that customer service is important to the fact that it's actually going to help your business and make you more money. At the end of the day, we're in business to make money. So how do I create the 4 steps of you should have good customer service to it's going to make you more money? Here's the delineation. The first premise is that small business has a greater advantage than big business to create superior customer service for their customers. They have a much better opportunity. They have the potential to provide much better customer service. Again, potential, that's the key word, potential to create better customer service compared to a larger business. A lot of times that's just because it's more personable, they know the customer better, they can be more adaptive, they can make changes faster, etc. Then, because we now assume that customer service can be done better by a small business, I also then infer that a customer service leads to better customer satisfaction. So, customer service leads to better satisfaction. Typically, you can pretty much say satisfaction. You can pretty much say that someone who has better customer service is going to be more satisfied. Again, another assumption. The next assumption is that customer satisfaction results in a positive transactional relationship. So what that means is, if someone is satisfied, they are more likely to buy. All right. So likelihood to buy goes up. Likely to buy. So typically, if someone has good customer service, they're more satisfied. If they're more satisfied, they're more likely to buy and come back and buy again or buy more, be able to be upsold. And if someone is more likely to buy, likeliness to buy should correlate with increased profits, okay? So if you want to make your business more profitable, focus on customer service. And as a small business, we can actually do this better than big business. This is one of our advantages. All right, we talked at the very beginning of the whole course about how small businesses can be the cheetah compared to the massive elephant, that the cheetah can quickly adapt and change and jump from side to side in different angles and directions, versus the elephant that once it's going in one direction, it's hard to switch one. It'll fall over. It'll completely roll over. Whereas a small business can be much more adaptive. So customer service, satisfaction leading to greater likelihood to buy. Likeliness to buy increases your profits, and at the end of the day, that's why we're in business. The gold standard by which really everything when it comes to customer service is compared to is personal attention. It's really the quality that everyone's gonna judge you against when it comes to customer service. When you think about the companies that we think of having the best customer service, typically it's the ones that we can usually say gave us personalized attention. When you gave them a call, they actually listened to you. They actually cared about you as a customer. They actually made sure things got done, and they weren't just rushing through or like, oh, we got to follow protocol. So again, this is why a small business has an advantage, because typically we're going to be allowed to be able to and have the capacity to actually give personal attention. Now, giving personal attention requires that you listen to the customer and understand their needs. So whether you're going to do focus groups or surveys, or just listen to their comments and feedback and communication and listen to the subtones of what they're looking for or what they're disappointed by, that's extremely important. So what are the 5 different things that we're going to talk about real quick? I'm going to talk about these 5 things of what you can do to have this personalized attention in your small business, because this is the gold standard. This is the thing that everyone wants to be, and as time goes on and you get bigger, these are harder to do, if not impossible. But when you're small, these are the things you definitely want to be focused on. The first 5 things of customer satisfaction, again, leading to customer service. Again, the gold standard of that is personal attention. So how do we give personal attention to our customers? First thing is doing business on a first name basis. You're not going to be able to do this when you are a massive company. Apple and Google, they cannot contact their customers, or when the customer contacts them, know them on a first name basis. Usually you're talking to a stranger when you talk to their customer service department. So their customer service department is less personal, and it can therefore not have personalized attention to the customer. They do not know their business, know their customers on a first name basis. The second thing you can do to have personal attention in your small business is keeping in touch. It's extremely important to stay in touch with your customers. Now, you can send them one-off emails that are extremely bland, and most big businesses have still figured this part out. That's like, hey, we can email people on a monthly basis and try to upsell them or try to communicate with them. Maybe we can even get their birth date and therefore send them a happy birthday email on their birthday. These are all things that are data-driven, and a lot of times customers pick up on this and they know it's all being done by an algorithm. But what we can do with small businesses is realize that we have the ability to reach out to customers and keep in touch with them when the power goes out in our local area, when something in the local news is happening, and we're able to send a very personalized email. Or in our business, Augusta Lawn Care, we saw what we call one-click estimate emails, which is we're going to send an email based upon the localized climate, what services are needed each month, and we're going to stay in touch with them, and we're going to constantly be adding value in those emails and then upselling them to a specific service that is relevant to their area. This is not a bland email that's sent to the entire country. It's like their localized area. So staying in touch with people based around their birthday, and if they have family events happening, and being able to personalize that service, again, is extremely important. The third thing that you can do to have personal attention to your customers, which therefore creates that brand loyalty by having great customer service, is finding ways to help. Another thing that we do at Augusta Lawn Care is when we're on the customer's property, we're looking for areas that we could potentially help them in their property. So maybe it's the fact that we notice a window's broken. Well, if they're out of town, that's a very good indication that someone might have broken their house or there's something wrong. We're looking for rodents. We're looking for birds building nests on their house. Like, it's like, hey, we can look out for the needs of the customer, know what's best for them, and just find ways to help them. And that might mean that we actually get a transactional positive from that by finding more services, or it might just be the fact like, hey, we noticed your garbage can has been moved for like 3 weeks. Do you want us to pull that up to the garage? These are the type of things we're looking for, always finding ways to help that a big business is not going to be able to do, and that personalized attention is what will keep customers for years. We've had customers that we actually have taken to the hospital because our crew noticed that, hey, something seemed off. There was no one came out and said hello to us. They knocked on the door. They actually went into the house, found someone on the floor, and took them to the hospital. And sure enough, saved that person's life. That customer is going to be with us forever because of that personalized attention that they would not get from any massive business. But because we were small enough, we're able to give that personal attention. And that's the gold standard for customer service. Fourth thing is customization of service to meet customer preference. Now, as you grow your business, customer preferences, you cannot really amend your services and customize it to the needs or wants and desires of every single customer. But when you're small, that's your advantage. And if you can customize your services and products to every single customer, it's going to create better customer retention. They're going to feel like they've been attended to better, they've been listened to better, and therefore it'll lead to better customer service and better customer satisfaction. As your business grows, it's just impossible to do this. The bigger the business, the less customization and more you can look at their preferences and alter and change the way you are providing your service and products. But when you're small, this is your advantage. So all of these things as you grow are going to become harder to do, but the customers that are really big and still able to do some of these, that's why we know them as being such great customer service. That's why they are great. We look at they look at the customer first. Typically it's because they do one of these 5 things still when they're big. But as small businesses, we can do this all the time. Fifth thing that we can do to have better personal attention to our customers is address problems quickly. There's not a hierarchy. There's not a chain of command that we have to go through and get things approved. So as a small business, we can get problems solved faster because we have immediate chain of command where things are really quickly determined in terms of how we can take care of a customer better. We can quickly determine, if someone made a mistake on someone's property, if someone made a mistake on someone's account, that we can quickly make those changes, quickly fix them, quickly make a call like, okay, we'll refund you, or we'll be there tomorrow. And we don't have to go through a sequence of 5 different people to figure out what we're going to do to make sure that customer is happy and that we attend to that customer on a personalized basis. We can do it live, we can do it real time. At the very worst, you have a receptionist asking you what they should be doing or what they can do to address the problem and fix the problem, but typically much less chain of command, hierarchy, and much faster response time to fixing problems that are on a customer's account. Again, those are the 5 things to have personal attention to a customer, which leads to greater customer satisfaction, which leads to a customer being with you for a longer period of time and being more profitable in the long run. So another part of customer service is what we call customer experience management. It's like a whole branch. You could talk an entire course on just customer experience management, or CEM. It's really the fact that, hey, when we look at customer experience, there's an entire part of like, how do we manage every single part of the customer experience? And that can mean everything from how they walk into the store, to the way we greet them, to the smells and the design of the feel of the space that they're in, to the way that they check out, to the way that they get upsold, to the way that the products are laid out in the store. These are all different ways of customer experience, and we can manage that experience through CEM, customer experience management. So what you got to realize that 86% of customers, when surveyed, are willing to pay more than 25% more for a product. They're willing to pay 25% more for a product for an excellent buying experience. So the exact same product, the exact same features, the exact same price. But at the end of the day, if everything is held constant, but the customer experience is better, they're willing to pay 25% more. 86% of people. A great example of this is Chromebook versus MacBook. All right, so Chromebook is made by Google. It's a very cheap device, typically looked at the lower end of laptops, and you typically will buy this off of Amazon or a retailer. You just pick this up. Whereas a MacBook, you're gonna go to a Apple store where it feels totally different. The experience is totally different. You have geniuses Apple geniuses walking around. You have a completely different checkout experience. There's no like checkout area. Like people come to you and they do one-on-one with you and they'll swipe your card right in front of you and then you just walk out. Like it's a completely different experience the way that the store is designed, and they usually have great architecture and people come to them just to look at the incredible design and the way that it's all outlaid, the store. It's incredible. And so that's why people are willing to pay a lot more for that MacBook, where they're going to have a genius. They're going to have someone that talks to them about their device and walks them through how it's set up, and then they just swipe their card and walk out. They don't have a checkout line. They don't have to wait for anything. All great customer experience touch points, and that's why they're able to charge a premium. That's why Apple MacBook is going to be $1,000 to $2,000, where a Chromebook might be $200 to $500 on average for their devices. So the one thing to keep in mind though, a lot of times small businesses are like, well, I can't build this incredible store that has $1 million worth of infrastructure and architecture and incredible amount of employees just waiting to serve customers. I can't do that. Well, typically relationship enhancing interactions with our customers can begin with low tech, inexpensive gestures that customers will perceive as high touch. Because again, on the last part of the course, we talked about how being small, you can have those high touch interactions. You can have that connection with the customer. You can listen to the customer much better than a big company. So a lot of times doing those gestures doesn't require a bunch of money. Doesn't require a bunch of high tech. Yes, we can have algorithms to make sure that we are talking to the customer in a certain way and we know a lot about the, yes, but also we can have typically low cost, low tech solutions to actually having these interaction with customers that they perceive as high touch. Giving a customer a phone call just to check in with them, perceived as massive high touch, not a lot of technology, doesn't cost you a lot of money to call a customer and be like, hey, just wanted to see how your experience with us so far has been. Is there anything I can help with you? Help with the product or with you as a customer. We really appreciate you. These are things that are very perceived as high touch that no one else that's really, really big can do, and that you as a small business owner can make that connection and have that experience management with a very high touch point, not a lot of cost, not a lot of tech. Cool. So I want to give you a couple examples. A starting point to create this better customer experience is potentially the fact that you become more personal by, instead of having for example, on a website, you can have the company logo and then have a chat bot with a customer service rep, or to be, again, just not a lot of more money, not more expensive, just change the picture to the actual picture of the customer service rep, like their actual headshot. Again, more personalized, that better connection with the customer because you made a very low tech, doesn't cost you more to put the picture of the person versus the logo. These are the type of things you want to look out for when it comes to customer experience management. One example that really people hate when it comes to customer service and customer experience is waiting, all right? So how can we take a massive negative when it comes to customer experience and turn it into a massive positive? And what you want to do is look at your industry and say, wait, where are the pain points for the customer in terms of the customer experience? Where do they hate? What parts of the journey do they not like, and how can we fix those? So for example, people hate waiting. We know that. It's not good for the customer experience. So I'm going to give you a couple examples of different industries that have fixed this problem, or at least made it better by thinking about customer experience management. All right, so, well, we do oil changes. Well, we gotta have people wait for 20, 30 minutes. Why not have a dog washing service? So you need your oil changed, we can wash your dog while you do it. Great for the business, you can upsell them, get better customer lifetime value. You can also offer something no one else is doing, and they don't have to wait and burn time because they can park their vehicle, have the oil change while they go in with their dog and get the dog washed. By the time they're done, oil change is completed. All right, great solution. Another way you could do this is having, a dealership, a car dealership might have a Starbucks cafe inside of their waiting area. So if they're waiting on a customer service rep, or they're waiting on their car being fixed, or they're waiting on a sales rep because they're all busy with customers, well, they can have their, favorite blend of coffee. So all of these are things that kind of prevent this whole problem that is created by a customer waiting. How do we actually make that profitable? How do we make that where it's less bad for the customer, or actually is a highlight to becoming part of a customer of ours, is the fact that we've solved that issue with our industry-specific customer experience management flaw. All right, so look for the flaws in your industry. How can we fix those and therefore to create differentiation between us and our customers? Another example of this is a waiting room at a doctor's clinic. One thing we hate is you go to a doctor's clinic, you wait for 30, 40 minutes. Like, come on, like, can you just told me you guys were behind or busy? Well, one example of this is having an app for the customer to actually go onto and say, hey, is it red, yellow, or green? If it's green, there's no wait. If it's yellow, 15 minutes or less, you'll be in seeing the doctor. If it's red, it's like we're like 30, 40 minutes behind or more. All right, so again, now the customer experience, they can anticipate that delay, or they can show up a little bit later because they know everyone's already behind. But instead of showing up to the office early, like, hey, I gotta get to the doctor office 15 minutes early, and realizing they're gonna be waiting in the waiting room for an hour because it's just crowded and they're behind, like, that's not good for the customer experience. And if you're gonna look at customer experience and manage it, it's like, where are those pain points? What do people not like about the customer experience, and how can I fix those? Last example is in airlines. The one thing people don't like is waiting on an airplane, typically because they're delayed, or it's potentially they're just really early and they're waiting for 30, 40 minutes until they can board the plane. One thing that an airlines could do is make the lounge area, or make the waiting area inside the terminal more into like a lounge. Nicer seats, make it into more leg room, lots of plugins and outlets, maybe some TVs, maybe actually have people actually servicing their customers, like almost like flight attendants out in the terminal. These are things that are out of the box and potentially might take some money, but these are things that are going to differentiate them, because no one else likes to sit there and twiddle their thumbs because they can't find an outlet, or they can't watch the news, or they can't get any water because they don't want to leave the terminal. These are the type of things that could be solved when it comes to a big pain point in the customer experience management, and that is waiting. So I just took one example. It's people having to wait. People do not want to be delayed. They do not like long wait times, but you can turn these things into your advantage. So where are the customer experience management pain points in your industry? How can you take those pain points and make them your advantage by solving that problem? I took one example, long wait times, and created solutions in multiple industries of how they can take those wait times and actually make it their unique advantage that they're known for by doing that. So look at your customer experience, zoom out, and ask yourself, where are the pain points? How can I make those my advantages in my business? All right, so now we're talking about customer satisfaction after the sale. And I think there's a part that we as entrepreneurs really forget about a lot of times, but really research shows that higher satisfaction, customer satisfaction, and loyalty to you, your brand, and your business really exponentially grows when a customer receives that continued attention after that initial sale, especially when they are given that contact via in-person or via phone call. So customer service is great in order to get the sale. People are great at the sales process, but once that sale is consummated, realize that after that sale has been initiated, that there's more sales to come if you can keep customer satisfaction high. How do you keep satisfaction high? Is that after that first sale, you still care about the customer. So oftentimes we as entrepreneurs have what I call the next shiny customer syndrome, which is, I'm going after this new customer, and then this new customer, and then this new customer, and we're always looking for the next customer. We fail to realize that the warmest customer is an existing customer. The best customer is an existing customer. Someone who already has bought from you, that's the person that you want to be marketing to. The best way to market to them is make sure they're happy, make sure they're satisfied. And how can you do that? A lot of times it's the things that are unscalable. Gary Vaynerchuk talks about scaling the unscalable, and it's like, how can I take something that's unscalable, like giving phone calls, writing personal hand notes, and emailing my customers? How can I scale that? How can I make it where it's actually something I do in my business to keep existing customers happy and keep that point of contact? So again, making phone calls and doing one-on-one contact is really the best way to keep at customer satisfaction high after the sale. So for example, you might send packages of your goods and your products to your customers. Do you actually monitor the delivery? Do you monitor that they get that product and it's installed correctly and then it derives out defects? And maybe you call them just to make sure that that happens correctly. Checking with that customer via phone call, email, a handwritten note works great. Still to this day at Augusta Lawn Care, for every one of our customers, we have all of our crew hand sign a letter that says thank you and we appreciate their business. Everyone hand signs that and we send it out to them every single customer that's new. Why? Because a lot of times so much business is done over phone, over the internet. They can literally get on the website, do a chat bot. They could submit an estimate request form and then we do it over the phone, or we do it via satellite images and we get them a price and they get a card on file and literally we never see them. So that kind of in-person contact is lost in that relationship. So it's a really cool surprise to them when they all of a sudden get a handwritten envelope or letter in the mail. Kind of the old-fashioned way of communication is actually going to be really powerful to a customer, and it can kind of provide that wow factor. Like, wow, I've never had a lawn care service. Give me a letter. Like, whatever industry you're in. We do it at the gym. I do, even for the selling franchise, everything from $15,000 franchises, $20,000 franchises with a 10-year commitment. I do packages and I send a handwritten letter to, all the way to gym memberships that are $25 bi-weekly. We still send a postcard and welcome to the club, and that's just a form of after the sale, how do we make sure we still keep them satisfied, because your best customer is your existing customer. All right, so now we're gonna talk about evaluating your business when it comes to customer service. So what I want you to do is I'm gonna go through some things, and if you have an existing business, this is what you wanna do. I'm gonna mention a certain part of customer service, and you're going to potentially make a graph like this. So what we do really well at, doing well at, and then what we could improve. What we could improve. And so if you really want to take this seriously, go ahead and make a chart like this, and then I'm going to start naming off different categories that I made on my phone here. I'm just going to read them off my phone, and then literally you just make a graph like this. In this specific area, what are we doing well at, and then what can we improve at? And I'm just going to go through different questions that you could potentially ask yourself, okay? So the first one, so again, I'm going to ask a question, what are you doing well at in this category? What could you improve at? I made notes on my phone, so I'm just going to read them off, and hopefully it's helpful. So first of all, provide an exceptional experience throughout every transaction. So during this part, you're going to ensure that the customers are acknowledged, appreciated, and find it easy to do business with you. All right. So at every single transaction of the relationship, what are you doing well at? What can you improve at? Ensuring that the customer is acknowledged, appreciated, and find it easy to do business with you. So typically this is where you could list the typical chain of contacts between you and the customer, and also evaluate at this point your company's performance at each contact point. So where are the contact points? What are you doing well at? What could you improve on to make that exceptional experience throughout every single interaction with the customer? All right, number 2, provide sales material that is clear and easy to understand. So where are you doing this well? Where could you improve? You're gonna wanna include the website information, marketing materials, retail displays. If you have a retail store, what does it look like? Your sales conversations, all of those. Do you provide sales materials that are clear and easy to understand? Where are you doing well? What could you improve at? It's all part of customer service. Having a good, well thought out, clear marketing materials and sales materials, and that's easy to understand, it's part of customer service. You're gonna frustrate people if you don't have these things, okay? Number 3 is you respond promptly to customers' requests and concerns. This is where you should have a service recovery plan in place. All right, so number 3, you respond promptly to customers' requests and concerns. Where are you doing well? What could you improve at in your business? You gotta have a customer service recovery plan in place. When things go bad, when people have a concern or they have a complaint, where do you do well at versus when they complain, what certain segments of your business could you really have some improvement in? All right, listen to customers and respond accordingly. Okay, so again, Where do you do well at listening to customers and responding? Where could you improve? You solicit feedback, you encourage interaction, you stay engaged throughout transactions, and you take the appropriate action to please the customer. Okay, where are you doing well in that area? Where could you improve? Next one is stand behind products and services. This is where you would provide guarantees and warranties, ensuring customers that you deliver on your promises. Also, you can create products and deliver services that exceed expectations. Okay, so all of this is part of customer service. We kind of went through all of these already, but I just kind of made a list of them on my phone. Part of standing behind your product, standing behind your service, having warranties, having guarantees, and then following up on those, that's part of customer service. It's not a sales tactic. It's not a way to get people in the top of the funnel. It's a matter of having great customer service. Great customer service leads to brand loyalty leads to higher margins lead to a better business. All right, this is all part of growing a company. If you take care of your customer, they'll take care of you. All right, next one is treat customers as family members and best friends. Okay, and you can do this by valuing them the same way you honor and care for those you love the most. If you really thought that this product and service helped somebody, you'd probably want your family and friends to have it. If that person was your family or friends, you would care so much for them that you wouldn't want them to be disappointed. You would react fast when they had a problem. You would make sure that they got the best product, customer service, the best response time, the best setup process. That's the type of way you want to think about your customer, because the same way you would care for your family and friends, if you can do that for your customers, they'll be loyal forever. All right, that's great customer service. All right, last one. You stay in the hearts and minds of customers. Where are you doing well? What part of your business is doing well at staying in the hearts and minds of customers? Where could you improve at? You don't take them for granted, and you find ways to let them know you have their best interest in mind. Okay, so this is like the random thank you cards. This is the happy birthdays. This is the, hey, just thinking of you. I saw that your mom passed away. Our condolences. These are the crazy things that you can do that are unscalable, but reach out to customers and show that they still matter to you. Whether that be giving them a discount code because they're an existing customer, or a coupon to come back, or whether it be giving them a handwritten note, a gesture of, hey, we still see you, we still appreciate you, especially if they're a recurring customer that just keeps paying every month. Like, people want to be appreciated. They want you to realize that they're still doing business with you, and you should appreciate them. People want to be appreciated. They don't want you just to take their money every single month. Now, if you have a more one-off transactional relationship, sometimes it can be hard, because like, hey, I might do this for a long time of like reach out to this person and then maybe once a year or once every 5 years they buy from me. That can be a little more difficult. But especially if you're having a recurring revenue-based model where you depend on someone to stay engaged and stay a customer in order to keep getting their business, you better make sure that you're following up with them, that you're making them feel valued, that you stay in the hearts and minds of the customer. At the very least, to stay in the mind of the customer, you should be making contact with them at least once a month via email. Send them an offer, send them a community newsletter, send them an update about information or new products or services that you have. That's the way you stay top of mind. And if you want to be top of mind, great. If you want to be top of their heart, it's going to take a whole lot of customer service at every single one of those things I just mentioned. So I know most people will watch this video, they'll be like, oh, that's a great, nice thought. But if you actually want to dig deep, you're going to take each one of those things I just talked about and say, hey, what part am I doing well at? For example, am I doing a really good job of presenting sales material and information at the beginning of the transaction, but around the close, or potentially when I'm trying to get them into a recurring or upsell, I could really work on that there. I could make sure that the emails are changed a little bit, the automations are changed a little bit. Every single part of your business comes back to customer service, whether it be the sale, whether it be the delivery of the product or service, whether it be the after the sale and trying to get them to upsell or potentially just become happy, or potentially they're unsatisfied, and how do I actually make them back to becoming a satisfied customer. All extremely important. If you figure out those things before, during, after the sale, and then during and after when they're unhappy, you will nail business. Take care of customers, they'll take care of you. All right, so we're going to talk about what the consumer has in terms of options when dealing with a product or service that they're unhappy with and they've been dissatisfied with. And I want to talk about each one of these. There's actually 4 different ways that a consumer, what options they have to deal with dissatisfaction. So dissatisfaction happens with your product or your service. 4 different things that they can do. The first one is publicly take legal action. Publicly publicly take legal action. All right, so they're actually going to like sue you and take the legal route, probably get a lawyer and all the rest of it. And to do that, obviously they're going to go to court. They're going to use the court system. So basically, they're going to complain to a government agency. Okay. So I know this is a little bit longer. I'm writing a lot, but it's going to be important as you look at this. So first one, they can publicly take legal action. The next is to privately complain to the business. Okay. So this is them calling you saying, hey, I'm dissatisfied. Could you come back and fix this? Could you ship this? Could I return this? They're going to complain in some way, shape, or form. And so now this is going to be you as the business owner are going to privately readdress their concerns. All right, so this might mean that you got to get a refund or do some free work or fix a certain problem with your product or service, but you're going to privately readdress their concerns and hopefully seek to mend the fence and make right the dissatisfaction that occurred. The next two are actually the most common. And that is the first one is that the customer simply just stop buying from business. Okay, they just stop buying, and at first you don't hear from a little bit, but all of a sudden, really, there's two different things that this person can do. This person here, they stop buying from your business. They kind of have two options, and I think let me just redraw this because here they actually have two options when they stop buying from you. One is to warn friends and family. Okay, so they're going to tell everyone at their Thanksgiving dinner and Christmas, tell their friends and family, hey, you don't want to use this product or service. They did a bad job on my lawn. They sent me a damaged product. Their food was not good at a restaurant. Whatever product or service you have, they're just going to warn their friends and family at their occasions. Social media, though, this is a whole different ballgame because now they can actually post a complaint online. So post online complaint. This is what really, really hurts because now this really compounds. It's not just their friends and family at their local gathering and their family gathering or the people they know at church. It's now online. It can be shared thousands of times. It can go around your entire city. Posting those online complaints, not a good thing. Fourth, and the most common, is they simply take no action. Okay? So this, in my mind, is actually where mediocrity takes place, and that is they're dissatisfied and they don't do anything about it. They literally just stay, buying from you. They're not number three. They don't stop buying from you. They just take no action whatsoever, and they just are a complacent customer. I feel like this is actually a big opportunity because you can figure out issues from these customers who are not going to leave you. They're not mad. They're not leaving bad online reviews, but they need to be able to express their frustrations and their dissatisfactions so you can actually improve your product and service. So all of this being said, there's so many different ways that we can address each one of these. For example, publicly, we want to make sure that we are set up with an LLC, that we're protected, that we are set up with all government agencies in terms of registration, and legally we are licensed and registered. Number two, privately, when we complain to the business, we want to make sure we have a system in place that when we have a dissatisfied customer, what is the system to make sure that we make them happy again? What is our return policy? How can we make sure that our frontline staff that answer the phone and are going to actually get these complaints can deal with them quickly and efficiently and readdress the concerns of the customer as quickly as possible to make them a satisfied customer again? Stop buying from the business. Again, these two at the bottom are the most common, and I feel like a lot of times the reason we could snuff out a lot of these is simply by doing surveys. And when you're really small, you can actually, surveys might not even be the thing you need. You might just need to listen to your customers. Ask them, question them, like, why did you stop buying from our business? Instead of just like, okay, thank you for doing business with us. I know you just canceled. Okay, bye. Like, why? What could we have done better, right? Ask them. And again, surveys are great as you get bigger and larger and surveying your customers so that the way if they are in either number 3 or number 4, they can give you feedback because you can keep someone that's number 3, someone that stops doing business from you, you can stop them. You You can erase these by simply having a survey, figure out the problem, and maybe you can get them to come back and become a customer, but even still, at least you could address their concerns and hopefully them not spread the word to friends, family, or online. Same thing with taking no action. Again, get surveys, get feedback from customers, because even if they're continually buying from you, if they're not dissatisfied, those customers, you're probably losing out on upsales, potentially more lifetime value. You're missing out on them going from neutral, which is this is where they're at, because like they're dissatisfied, but they're not taking action, they're not leaving your business, so they're neutral. I can switch them into being a positive benefit to the company, and them being referrals, giving me referrals and spreading good word of mouth if I take into account their feedback, listen to their surveys, ask them questions, and try to improve the service. These are where most of your dissatisfied customers are going to live. They're going to stop doing business with you and then spread the word, or they're going to take no action. And if you listen, take feedback, and have surveys, a lot of times both of these can be massively reduced. I know we just talked about it, but I just want to reinforce the importance of doing surveys, especially as your business grows and you as the owner are not at the place of business all the time. If you are part-time at the office, or you have multiple different locations, or you have different stores or geographical locations, surveys are extremely important, especially as you become less and less attached and more removed from the frontline team, because you got to be able to keep data points. And as your business grows, it's easy to get wrapped up in meetings and growth and expansion and marketing plans and hiring, and you got to realize that serving your customer is the most important thing. And like we've talked about, customer service is extremely important. And so in order to keep a pulse on customer service, surveys are a lot of times the best way to do that. Now, you can't do a survey just based upon a giveaway. So a lot of times people will say, well, I did, based upon my reviews on Google, or my reviews on Yelp, or on Angie's List, or whatever, people really like me. The thing is, what you're cutting out is that category of people that just don't do business with you, or don't take any action, or they just leave. And they won't leave a bad review. They won't leave negative responses. They won't get all the way to that point where they actually leave negative comments and feedback online. And so a large part of your business that as you become more and more removed from your frontline team, the people answering the phone, the people talking to customers, the employees actually performing work on customers' property, the sales reps that are trying to actually make the sales happen with the customer. The more and more you become removed from that, the more important it is to have surveys that are not about giveaways. All right, you can't say, hey, leave us a 5-star, leave us a review, and we'll give you $20 gift card, or whatever it is. Part of it is that you're not really supposed to give people money for reviews. But even if you do that, or you do a giveaway, like a drawing, based upon giving a rating or a review or something like that, you got to remember that is not going to draw from the people that take no action. They're unsatisfied. So you actually got to figure out a way, how do I extract negative feedback and negative comments and negative survey from customers without them making them feel bad, without making it where they have to jump through a bunch of hoops, and making sure that feedback is then brought to me in a point that I can actually make a data-driven decision from those surveys. It's very difficult. People try to figure out this for years and trying to figure out how to make this better, because you've got to get that negative feedback, that critical feedback, and if you are on the front lines, it's very difficult to stay connected with the customers and their level of customer satisfaction. All right, so let's talk about CRM, Customer Relationship Management, okay? This is also the ticker symbol for Salesforce, which just happens to be the biggest CRM, but there's plenty of different CRMs based upon your industry that will probably actually serve you better than Salesforce. Salesforce is going to be great for enterprise level, massive companies. They do have smaller products for smaller businesses, but typically you're going to be able to find a CRM that is going to be much better for your industry specific needs, all right? So I'll give you some of my recommendations, but at the end of the day, this might be a little bit of a review for you, but you do not want to let your brain be your CRM. The CRM is the brain of your business, but your brain should not be the CRM, okay? So the brain of your business is the CRM that has all the information, all the customer intelligence, all of the information, all the sales transactions, and perhaps the marketing campaigns, the emails that have been sent to the customer, and all of that is stored there in the CRM, the Customer Relationship Management System. However, you usually are going to be looking for the CRM in industry specific. So literally, if you don't know what type of CRM you need to use, type in your industry like lawn care, CRM, landscaping, CRM, banking, CRM, retail, CRM, gym business, CRM, whatever it is, type that in and you're gonna find plenty of results. It's almost crazy to think that you need to build your own CRM, but what you can do now is purchase. If you ever got to the point where you needed to customize a CRM, you can pay services to do that. And there's a lot of companies now that have CRMs that are flexible and allow you to customize a lot of things with integrations and using integration tools like Zapier. All right, so Zapier is going to allow you to get into a CRM that is very flexible and allows integrations, and then you're able to use all sorts of different applications, from MailChimp to Stripe for payments, just a whole host of different applications you might use in your business, and they just integrate into the CRM. And Zapier just happens to be the software that kind of allows for that integration to happen between a whole host of different, Stripe, PayPal, just everything, every single software you can manage, QuickBooks. It will just integrate into most CRMs that way. So I've personally used several different CRMs. We've used Service Autopilot for lawn care and landscaping, as well as Lawn Pro. Again, this is industry specific to lawn care and landscaping. I've used Jobber, which is great for like home service businesses. I've used, recently we've actually tried several other ones like Real Green. Again, these are all specific, mostly specific besides Jobber, to lawn care, Real Green systems for their software. Now what we've done is do what I just talked about, and that is we are taking a much more flexible CRM like Zoho, for example, and building on top of that and using integrations to be able to integrate our phone system and our accounting system and our payment system, and we can actually customize our CRM a little bit more. But for most people, when you're just getting started out, you're going to look for an out-of-the-box CRM, something you pay usually a monthly subscription for that is specific to your industry and contains all of your customer data. All of your email communication goes through your CRM. All your payment information goes through your CRM. It is the brain of the business, and the brain of the business cannot be your brain. It cannot be your head. Everything is, all your customers and when you bill them and what they want. It needs to be in a software. Okay? And it needs to be a place, if you get hit by a bus, someone tomorrow could come read the software, read the client information, read the job notes, and know exactly what needs to be done. So make sure you get a CRM that's specific to your industry. Don't try to go after a massive one like Salesforce if you're a small business. And I'd much rather you go after a specific CRM that is going to be industry specific and serve your needs to the fullest. One part of your CRM, again, your customer relationship management software, that you need to think about is what I call customer intelligence. Now, this can include things really basic like contact information, but that's a really simple database. You can do that in Excel. I think the power of having a CRM software is having all the other touch points with your customer, everything from their birthday to their internet, like where are they clicking, like all of this stuff can be tracked now. Their preferences, when do they last buy certain things, what type of products do they buy, all of these things can be kept track of in your CRM. At the very least, have a place where you can keep customer intelligence notes. And these are really, really more flexible. And again, you're trying to scale the unscalable here. That is, if you're on a phone call with a customer and they say, hey, my wife just went in to have a brain surgery or a heart surgery or something like that, you could send them a card. Like, how can you make it where the intelligence, the brain of your business, the CRM, is able to actually act in a way that doesn't seem automated, doesn't seem super like a massive corporation that has everything is just completely through a filter of technology and there's no personal connection. So how can you do this? On your CRM, have different custom fields or areas to be able to put things like, what's their favorite drink? What is their birthday, like I mentioned? What are they going through? Did they recently have life events? Did they recently go through a divorce? That might be something that is important to put in your customer intelligence. So when the next person opens up their account or takes the phone call from them and the person's freaking out, maybe they'll have some context to the fact that maybe this person's just really stressed out, either their health or in family or personal relationships, that might be causing some distress that isn't actually about the product or service you performed or you and your business, but really they have other things going on that are causing them to act out of what's regular for them as a normal customer. So these are things that are important, and again, it gives you the ability to act in a personalized way, even as the business scales infinitely. As it scales and gets bigger and bigger, having a client information, client data is great. their email, their contact, their address, all of that good stuff, what they purchased last time, that's all important. Having their payment on file, that's all in a CRM. But customer intelligence, the ability to try to scale the unscalable and take things that they will be wowed by when you say, hey, by the way, I was just wondering, how did that surgery go with your wife a few weeks ago? They would be shocked, blown away that they're talking to someone different, or even the same person, but 3 weeks later, they're asking them about something that went on in their personal life. You have a customer forever. You've now created a personal connection instead of just being this corporate figure, this curtain of a corporation that they can't interact with. So highly recommend customer intelligence be the thing that you aim for when it comes to scaling your business past the point of you knowing everyone firsthand and knowing their name. You can go beyond that and keep a CRM to still keep that personal touch and that relationship with your customers. So inside of your CRM, now I want to talk about customer segmentation and tagging. So customer segmentation is basically, okay, I got all these customers. How do I group them together based upon similar demographic, psychographic, and lifestyle tendencies? So I'm going to give you a few examples from Augusta Lawn Care because they're just a myriad of different types of segmentations that you can have of your customers. But it's extremely important because if you can segment your customers based upon certain, their age or certain needs that they have, a certain type of products they've purchased in the past, or their buying tendencies, if you can group them a certain way, you can market to them much, much, much better. And remember, a warm lead is the people in your database. If they're in your CRM, they already know you. They already have done business with you in some regard. You've got their contact information. That's already a warm lead. Why would I go out and try to get cold leads when I already have people in my database? But they're useless if I haven't segmented them and I don't know what they've looked for, what they've asked for a proposal for, what they've purchased from me before, what their age, address. If I don't have that information, I can't really segment them. So the first step is get the information, right? That's why people have onboarding. That's why they make sure that they get their email and their contact information, etc. But then also the customer intelligence weaves into the fact that if you start getting enough customer intelligence, you can segment people based upon the intelligence that you have. So I'm going to give you a couple examples that we have at Augusta Lawn Care, different segmentation. And these are going to be binary, like one or the other, but you could have like 3 or 4 or 5 in each of these different areas. So one segment that we have in terms of like lawn care and landscaping is the fact that really most of our customers are falling in one of two different buckets. One is millennial professionals, and these people are usually tech workers or just professionals that make a pretty good living. They're middle class, and they don't want the bother of mowing their lawn or doing their landscaping. Typically, this customer is going to be very inclined to want to pay with their credit card on file. They want to do automations. They don't need to meet somebody in person to do an estimate. They just want it taken care of. They might not be the highest value customer, which we'll talk about in the next lecture, but keep in mind that this customer, for example, with lawn care, is they don't really need to do everything on their property, because like if they need to trim the bushes, they could do it, right? They don't care as much about like full service, like everything's got to be perfect, because they might not have a whole bunch of money and be super affluent at this point in their career. The second kind of major bucket or segment of the customers that we have at Augusta is going to be the retired affluent. Now, this person wants and needs are very different than this other customer segment, because the retired affluent, they're very different because they want full service. They want everything done on their properties. They're less likely to just call, ask for a quote, give us a credit card on file, and never talk to us again, and just have service all the time. That'd be the customer segment number 1. Customer segment 2 is going to want to meet us in person, learn about the company. They're going to want to meet some of the company representatives. They want like their gutters done, their bushes done, mulch installed, weeds pulled, bushes trimmed, mulch, lawn mowed, like everything done on their property typically. So the way that you treat these customers and the way that you market to these customers can be very different, because the top millennial professional, they don't really care about seeing anybody. They just want it taken care of off their plate. The faster you can get the estimate to them, the better. Whereas the retired affluent person is like, what's your presentation look like? Do you have an estimator that can drive around and meet them? That's again a complete completely different customer segment. The next customer segment for Augusta, again, there's a myriad, so I'm just using Augusta as an example, is we could segment our customers into who are snowbirds versus the people who are year-round. So who goes down south year-round? Which of our customers go down south during the winter versus the ones that stay year-round? Again, completely different how I'm going to market to them, because the snowbirds, I'm going to want to make sure that I pitch them that throughout the whole winter time, I'll be at their property, making sure, just checking on the property, trimming up the bushes, making sure any sticks from a windstorm are taken care of, checking on the house, letting them know if there's a report of any sort of damage. Whereas the year-round person, like, hey, if I'm at home and there's nothing grown and there's frost on the ground, I don't really need you to come over, right? So how I'm going to market to them is completely different. All right, the next one, again, there's like so many, but I'm just going to giving you some examples. The next one is residential versus commercial. Very different in terms of which customers, B2B versus B2C, right? So residential is going to be business to consumer, whereas commercial, this is going to be like malls, apartment complexes, etc. They're going to be business to business. Very different strategy in terms of sales, and the needs of these customers are very different. Residential customers, they're typically going to call you a lot more, whereas the commercial, you're dealing with like a middleman, which is the property manager, that as long as things are taken care of, they're happy. So a little bit less touch from them, but again, how you market them is completely different, because the residential customer, they see their property every single day. The commercial property is going to a property manager who might go to the property once a month if they're lucky. So a completely different way of segmenting the customers. Now the reason this is important is because of how I market to them, how I treat them, and when I'm wanting to send an email blast or I'm wanting to do a thank you card to a whole segment of the population, I might only do it to one or the other. And again, there could be 5, you could have 5 into the same segment, kind of like I did 1 and 2, 1 and 2, 1 and 2. You might have 5 different, you might have agriculture and government as well as residential and commercial. So you could have a whole bunch of different segments, but what's important is that in your CRM, you tag which segment of that grouping you are using. So for example, all my residential customers, I'm going to put a tag called residential. So that way when I want to send an email to all my residential customers for a specific service, I will simply be able to filter out by who has the tag for residential. When I'm wanting to email all the snowbirds and try to upsell them on winter services for while they're down south and they're not at their home, I'm going to want to be able to search by a tag that was assigned to every single customer database, every single customer entry that has that tag. Okay, so customer segmentation is what we talked about here. Use tags inside of the CRM to delineate those segments so you can market to them much more effectively, and when a customer call comes in, someone on the front lines answering the phone or a potential representative can immediately know certain things about them, like immediately know, okay, there's a year-round customer, they're retired and affluent, here's how my strategy is going to be when I now interact with this person. Instead of just trying to get that information new every single time, those tags also serve as a form of customer intelligence, all right? So get their contact information, get customer intelligence, segment the customers, and then based upon those segments, create tags inside your CRM to be able to create these segments so you can market to them more effectively and communicate better when they contact you for either service, sales, or just communication in general. Somewhat in relation to customer service, I want to talk really quickly about customer lifetime value, or CLV it's also known as. And the reason I want to talk about it now is because some people have skipped the customer service part of this course because like, oh, just customer service doesn't really matter to the numbers, I want to make money. Well, customer lifetime value is directly correlated, in my opinion, to customer service. And here's the reason why. Basically, CLV, or customer lifetime value, is the total profit expected from all future sales of a customer. So what that means is if I'm at a Pizza Hut and I'm selling a $12 pizza, okay? You say, well, this pizza wasn't done correctly, something was messed up, the customer was unhappy and gets mad. And they say, hey, I don't like this pizza. And they want to give it back to the employees. The question is, well, should I take this $12 loss, or should I say, hey, look, you paid for it, we did exactly what you wanted, here's the order, we can prove it, and you just got to deal with it. You're not getting a refund. Well, if I get that customer to walk away and never come back again, what if they came every single week for the next 10 years? There's a good chance that over the course of the lifetime value of that customer, that person could have spent $8,000 of profit could have come my way. Say this pizza has an $8 per pizza profit. Well, over the course of their lifetime, if they got 1,000 pizzas, so times 1,000, the lifetime value that the CLV, customer lifetime value of that customer is $8,000. I did not just lose $12 on a pizza. I didn't just lose the $8 of making them another pizza for free. I lost $8,000. And so what you have to keep in mind when it comes to customer service is it's not just today's loss, right? Losing a sale today might not seem costly until you factor in the likely loss of all future sales. So keep that in mind. It's not about today's loss or losing a customer here and like, oh, I lost 20 bucks on this, I lost 15 bucks. It doesn't matter. No, it's what do you lose out into the lifetime value of that customer. And when you treat it like that, that's why at Starbucks, literally, if they put one thing wrong, they'll give you the $4 or $5 coffee for free because they know that the lifetime value of that customer is probably tens of thousands of dollars. So why would they mess up on a $4 coffee and be like, oh no, you have to pay for it, or I'm not going to remake a new one? It doesn't make sense. Especially the higher margin your service is, the more important it is just to give free or do something like that. Like a coffee, for example, cost is probably $5. The cost of the coffee itself, like cost of goods, is probably like 20 cents. And so why would I not just give another 20 cents of free coffee to fix it for the customer, to make sure I save them and save the thousands of dollars that their lifetime value is? One quick thing you also want to keep in mind is if you can figure out your customer lifetime value and you know that number, and you also know your customer acquisition cost, which we'll talk more about in just a moment, if you know those two numbers, you can infinitely scale your business. What I mean by that is if you know that your customer acquisition cost, the price to get a customer is $5, using whatever ad method necessary, and the customer lifetime value of that customer is $20, you can infinitely scale this business because you can keep buying customers at $5, and then you know that their value is going to be $20, whether it be in a year or 2 years or whatever. Now you might need some financing if it's going to take 5 or 6 years to get this, but you can infinitely scale any business if you know your customer acquisition cost and that's nailed down, and you know that as you put more money on it, it's not diminishing returns. Like it would stay at $5, it wouldn't keep going up as you pour more money on it. But as long as you have that fixed customer acquisition cost and you know your customer lifetime value, if this number is greater, theoretically, if it's 1 penny greater than your customer acquisition cost, you should keep doing it because it's a return on your money. Now, that percentage of return is important, and you can determine whether or not it's worth trying to get pumping money into a system if it's going to take 5 years to become $20. That's something that you can debate. But anyways, customer lifetime value, great part of customer service, and if you know that number, customer lifetime value, and compare it against your customer acquisition cost, you can infinitely scale your business. All right, so we're going to talk about some of the influences on customer and consumer behavior, because they're going to be really important in terms of understanding why the consumer makes certain decisions. So first of all, let me kind of break down the 2 different ways you can break down consumer behavior. So the first influences that we're going to talk about are psychological, and the next ones are sociological. So sociological. Cool. So psychological influences are going to be things like, what does the customer or the consumer need? So needs. Then we got perceptions. How do they perceive the world? So perceptions. Then we have attitudes. These are all things that are going to change attitudes. They're going to affect, these are going to influence what the customer's behavior is. Also the motivations of the consumer are going to affect their buying decisions and their behavior. Now, sociological, there's going to be things like cultures. There's going to be social classes. Okay, and these are just some of the ones that I came up with. I'm sure there's other ones you could add to this, but reference groups. So people want to be referred to as a certain way. Again, this is all sociological. Opinion leaders. So again, politics. Who do they rally around? Leaders. Okay, so these are all sociological. This could be everything from a chief of a tribe. This could be everything to a political leader, a senator, a governor, a pastor, just so many different things that are going to have sociological influence on the behaviors of a customer. So these are the first things you have to realize, like these things psychologically and socially are going to impact and influence the buying decisions and decision-making process of your consumer. Now let's talk a little bit deeper about how this actually plays into the decision-making process when a customer is looking at potential brands or businesses they want to buy from. All right, so all of these things are going to feed into the decision-making process for a customer. So I kind of like to draw this out, this down here. So all of these different factors, all of these different influences are going to affect the decision-making process. Let's just write this in, decision-making process, okay? All these factors are going to come into play. Process. Okay, so what are these different things? Well, first of all, you're going to have the fact that they need recognition, okay? Now, some people, when you say this, are going to be like, oh, this is like so, trendy, and like, you gotta be like, you gotta recognize everyone's feelings. Like, look, people want to be recognized if they're in a certain sociological demographic, if they have a certain religion, a certain culture, a different race, whatever it might be. Same thing psychologically. They want to be recognized that they have certain needs. Like, for example, you want to be recognized that you are hungry. That's a need. And so if a business has the decision, hey, we gotta decide, we got to make these customers decide where they're going to eat. Well, probably a good thing to realize that they have a need for food, right? Then you got to ask yourself, well, what motivates them? What's their attitude when they're looking for this food? What's their perception of our brand? What culture would our food actually align with the most? These are all the types of things you want to think about, okay? So first of all, you got to have need recognition, and then you're going to have the info. This is what a customer is going to do. They're going to have info search, and they're going to evaluate, okay? So this is the process that they're going to use. They need recognition. I didn't spell it, recognition. Okay, so they need recognition of these things. Then they're going to get info. They're going to search that info and evaluate. Then they're going to make a purchase decision. And a lot of this just goes in like psychology and a lot of other stuff, but this is just the very top line of how to understand this. So purchase decision is next, and then after that is going to be post-purchase eval. Purchase eval. So again, these are the influences that are going to affect the decision-making process, all of these things. And then the process is, first they need recognition of this factor, one of these factors. Then they're going to search out information and evaluate which is the best option for them, which brand, which business, which service, which product. Then they're going to make a purchase decision, and then they're going to think about post-purchase evaluation. Like, did it serve my needs? Did the perceived value of this product actually meet what I anticipated? Did it actually align with a certain opinion leader, like my father, my mother, my church, opinion leaders, people that look up to, their reference group, social class? Like, did it actually, based upon my purchase decision, did it actually, my evaluation, live up to these influences that went into the decision-making process? So it's extremely important, and most great brands can lock in on one of these things and align themselves with certain groups or a certain need or a certain motivation and build massive brands. But you got to realize that the decision-making process of where to buy and what to buy boils down to these influence factors and this decision-making process. You could spend an entire course just on this graph that I drew up here, and I could talk about it for days in terms of what actually motivates people, how someone's attitude actually plays in their purchase decision, what they refer to themselves, sexually orientation, racial orientation, socioeconomic orientation, who they're born in their family, like which child they were born, like middle, the last child, the first child, like all that stuff can play into this stuff and then ultimately affect the decision-making process. But it's something really important to know, and then ask yourself, where do you align, and what things are you actually appealing to when it comes to these influences that go into a buying decision? So I want to talk about one of the most important levers in your business, and that is pricing. So when it comes to a lever in your business, it's something that once you change a small amount, it makes a big difference in the bottom line. So here, for example, if I can change this side of the fulcrum, so this is the fulcrum, if I change this by, let's say, I move this down half an inch, if I did that, move this half an inch, this would probably move out to about here. There'd be a massive delta on the profit side by making a small change over here. In this case, the lever is going to be price, okay? So if you can move price just a little bit in your business, it moves the bottom line, your profit margins dramatically. To illustrate that, I want to talk about an example from a numerical standpoint, and then also something we did with my gym. So let's say that business one sells a product and they sell 250,000 of them. So 200 items quantity, okay? 250,000 of them, and they sell every single one at $3 per. All right, so price is going to be $3 per. That's going to equal $750,000 in revenue, okay? Let's assume that this business does $100,000 in profit. The take-home pay for this owner is $100,000, and they're living a pretty good life. Now, business number two is going to sell the exact same number of items, okay? So we got to hold the quantity constant if we're going to see what the price does and what it does to the overall structure of the business. If we charge just 20 cents less, so $2.80 instead of $3, sorry, we charge $2.80 instead of $3. Now our total revenue is going to be $700,000, and our profits are going to go from $100,000 down to $50,000. Literally, we're going to half our profits simply by reducing the price by 20 cents. So what does that mean? That means that price is a massive lever, because guess what? I could also raise this to $3.20, and all of a sudden now I would be making $800,000 in revenue. I have $150,000 in profits, and that is the proof that price is a lever. And I think sometimes we overlook just how many customers we're going to lose when we raise our prices. And recently at the gym, for example, we had a big price change. Like, this is a very small incremental change, right? The reason is because large quantity of items, small numbers of price make a big difference when it comes to profitability. The same thing can be said though for a business like my gym, where, let me show you these numbers. So before 2020, before the pandemic, we would charge $99 per month for team group training, right? So these would be groups of 3, 4, 5 people, $99 a month. They'd get 3 sessions per week. And we had about, I want to say about 30 to 40 people. Let's just say 40 for the sake of this example. So 40 clients, okay? So that comes out to $4,000 in a month. Literally hardly enough just to pay one trainer, okay? $4,000 per month in revenue. Now, we talked about the lever on profitability, but I also want you to think about in terms of quantity of customers that is required. Because serving 40 clients is pretty difficult as a personal trainer. And just accommodating all their schedules and billing them and invoicing and admin work, and you gotta sell 40, and then there's more attrition and all the rest of it. Then what we did after the pandemic is we started charging $399 per month. Okay. Now, we ended up only losing about 15 or 20 of these clients by quadrupling our price. But let's just say that we actually lost 75% of them, and we only had 10 clients. Well, guess what? We are now earning the same exact per month as we were before. So literally, we can lose 75% of our customers, but at this new price point, we can literally have these 10 clients, and you say, well, that's crazy, you're quadrupling the price. Yeah, but guess what? Now that I only have 10 clients, I can get really, really personalized service and still have plenty of capacity. So what did we do? Well, we got about 25 clients, about 15 of them left because of the price increase. But now we have less clients, and they generated, if you do the math on this, $10,000 per month, allowing the trainer to get more commissions, allowing them to spend more time on the client, so it became a much better service, having nutritional meetings, having check-ins with their trainer, etc. So the question is, how can I produce so much value? Because remember, we talk about price versus value. We're going to talk about it more in just a second. But when we look at increasing the value, the price, how can I make sure that I raise the value? Well, I'm reducing the number of customers so much to the point where I now have more time to be one-on-one with these clients, and literally, you say, well, it 2x'd, you could say 4,000 to 10,000, we had a 2.5 increase in revenue. But this is what's crazy. On this, we had like a 0% profit, okay? Over here, we have a 50% profit margin, all right? So it's not just a matter of raising price, increasing revenue. It dramatically affects your profits. It is a lever in your business. Price is a lever. Move it a little bit, and it has massive effects on your profits. Most of us in our small businesses always think about losing these customers when we realize that we can lose a lot of them and still be more profitable by raising our prices. So price is a massive lever. Let's talk about how you're going to now figure out what your pricing is and where you're going to position yourself when it comes to pricing in your market. All right, so when it comes to setting a price, you got to ask yourself if you're going to use price as a differentiation. So if you're going to do that, you've got to realize that there's a continuum in any industry, any product, any service of high to low prices. Now, if you're going to, if you're going to use price as a differentiation, you've got to realize that the average price, you do not want to be in this middle game. You want to either be the low price competitor or the high price competitor. Now, that's fine if you're inside of this area. It's not to say that this is unprofitable or anything. It's just that price differentiation, and when people think about your brand and they think that prices somehow makes you different, you've got to be either really low or really high. Okay, so a couple examples. So down here, we got Walmart. Okay, this is also going to be an example of something like an Android phone. Okay, so these are really low price. Walmart literally just had a quarterly report, a quarterly call with their shareholders, and they literally said, hey, we are keeping prices low, not because we need to, but because we were basically trying to, everyone else is raising our prices because their prices because of inflation. We don't need to, we're not going to. We could probably get away with it, and we could probably make more margin, but we're gonna keep our prices low because that is our price differentiation. Everyday low prices is the motto at Walmart. So in order to be the price differentiator, they are going to keep their prices low. Android, they have high priced phones, but they also have phones that are $40, $50 that work just fine. On the alternative, we think of Apple as being really expensive. They have computers that are literally $50,000. It's ridiculous. And then in terms of, if you think about like Versace or other retailers that are extremely expensive, and you look at a handbag and you're like, oh, like that might be a few $100s. And like, yeah, it's like $8,000. Like, what in the world? What are they doing is they're differentiating themselves by having a high price. Does it cost 30 times more to make that handbag compared to a leather nice handbag that is maybe $200? No, but they're differentiating themselves by having a very high price, premium brand, and then allowing that extra margin to be used in the way of really nice outlet stores, really well-trained and high-paid staff, lots of other things, advertising, marketing costs, to allow them to keep that high value, perceived value, by having a high price. So it's not to say that it's right or wrong to be high or low, and it's not even wrong to say that you want to be here. You might want to be the middle of the road price in your market. Just realize that's not going to be the differentiating factor, and you're going to need to use other things in your business to differentiate yourself. But price is a really easy way to differentiate yourself. Be really the highest price person, like we just talked about with the gym, $399 a month. We always all of a sudden have to start figuring out how we're going to produce that much value, or you're going to be really, really low. You're going to be the $5, $10 per month gym, and again, completely different model, completely different quantity is going to be a big game down here. Walmart sells billions and billions of dollars of product and has a 1 to 3% profit margin, right? Where Versace is going to sell much, much less quantity, but they're probably going to have a 60 to 80% gross profit margin on the products that they sell. So hope that was helpful. Just realize that if you're going to use price as a differentiator, you either want to be really high or really low. Anything in between is not bad. It just means that price is not your differentiation. All right, so when it comes to setting your price, there's also things called loss leaders. And in most industries, there are going to be loss leaders inside of your business. And depending on your availability of capital, is probably going to be whether or not you actually leverage loss leaders, because loss leaders imply that you're going to lose money or potentially make less margin on a specific product or service, but you're doing it because the long run benefit of being able to get new customers. So a couple examples of that would be grocery stores. And every industry has these, but I'm just going to give you a couple. So things like milk, eggs, cheese, they might make 1 or 2% margin on those. They might even do promotions where they would lose money on a gallon of milk. They might say, hey, $1.99 for a gallon of milk, and it cost them $2.99. They're literally losing money to get people in the door for something like milk. But their plan is the fact that when someone comes and gets these low margins or even loss leaders, these products, that while they're going and getting the milk, they also pick up a bag of chips and a thing of soda pop and a pack of gum and maybe some beans and some rice, like a whole bunch of other food, and that's where they make up for the loss leaders, is other higher margin products. So that's a product-based kind of example. Same thing with Amazon. You go on Amazon, there's certain loss leaders that they have. And then let's do an example of services. So lawn care. Okay, well, mowing is usually the loss leader, typically. And that is the lower margin or potentially even losing money on mowing, so that way we can get fertilization, so that we can get weed control, so we get shrub trimming, so we can get landscape jobs where their margins are going to be higher. And the goal is, hey, I want to get the gateway into this customer's pocketbook by offering something low-hanging fruit, most common, a lot of times like staples at a grocery store, lawn care, mowing is the most common service. Give that away as a loss leader and hopefully get them in the door, be able to upsell them into other products and services that are actually going to produce higher margins and is going to allow you to actually make more profits. So loss leaders you'll see in every business. Whether or not you're able to take advantage of it usually comes down to your access to capital. If you can leverage capital, because you cannot operate a really sustainable business where every single time you sell a gallon of milk, you're losing $1. You can't do that for a very long time if you don't have access to capital. But if you know that when that person comes in and you lose $1, they also buy $50 worth of other products that have a 10% margin, therefore I lost $1 on the milk, but then I gained 10% of 50, which is 5, so therefore the net of that transaction was $4 because I had a loss leader plus other products and services that were purchased, leading to a net result that was still positive. So get people, it's all about getting people in the door, getting them to be a customer, getting them into your database, and trying to upsell them into other services and products that are higher margin and have more profit. All right, so when it comes to setting your price, another model that can be used, we've already talked about when you have like loss leaders to try to get people inside your store, to come to your actual location or a website, or come call you because of a loss leader. But another way of setting your prices and your pricing strategy is going to be what's called a freemium model. All right, so freemium obviously is a blend of the word free and premium. And what that means is I start everyone off on free, and I hope that they upgrade to a premium model or premium subscriber or a premium customer. And so this typically works, it's most often in software, because the incremental variable cost of having one more person as a customer is very low, if not zero. Adding one more user on Facebook is basically cost them nothing. Therefore, they offer the user, you're able to start an account on Facebook for free. Their hope is that you obviously do other things and buy things, you look at ads, you click on ads, etc., and therefore they are able to get revenue. This is also really popular with apps. Again, there's another form of software where you get the app for free, but then you can upgrade to other things and pay for those premium features, those premium parts of the product. So this is not super popular in service-based businesses where 40-50% of the revenue you earn for a product or service is found in the way of cost of goods sold, in the form of making the product or the labor that goes into the service. You can't give that away for free. For a long extended period of time. You might do a promotion, but it's very rare that your pricing strategy will be freemium, where you are giving everyone's allowed to come do X for free, and then you hope that a percentage convert to Y, and you actually make money on the customers you convert to Y. when it comes to the freemium model, everything revolves around one thing, and that is the percentage of customers that convert into premium. All right, or start actually paying you for the access or the products or services that actually cost money. So the goal is, hey, I want to give away something for free, get as many people into that, but you've got to make sure that some percentage, and that's the key part of the freemium model, is what percentage of free convert into premium. That is the thing, the metric that you're going to stay focused on the most. So whether it be subscribers, this is where you see the most subscribers, free trials, they're able to have up to 10 users, but then after 10 users, they have to start paying. Well, what percentage of users convert or have more than 10 users and actually end up paying to becoming a premium paid customer? Those are what you got to stay really focused on. But again, for most small businesses outside of software, we have incremental costs when we have another customer. With software, it's somewhat infinite in terms of once you have a server, you can basically scale it infinitely. So adding one more person is extremely cheap. I can give a free value to a customer with the expectation that some percentage is going to upgrade to the paid product or service in the premium model. All right, so let's talk about elasticity of demand. Sometimes it's also referred to as price elasticity, but technically it's supposed to be called elasticity of demand. So what this basically means is the degree to which the change in price affects the quantity demanded. All right, so really simply, this is the easiest example in my mind, is if I raise my price today by 50% and everyone still continues to buy from me, very inelastic demand. Now, elastic demand is that an increase in price, that 50% increase, no one wants to buy my product or service anymore. All right, so elastic demand is that when you have an increase in price, it lowers the demand of the product or service, whereas inelastic demand means that if demand, the demand is basically not going to change regardless of what you put the price at, within reason. So if I raise price, demand goes down, whereas this is going to be an elastic demand. Whereas if I raise price and the demand also goes up, this is inelastic. Elastic. How I like to think about it is here I'd be stretching an elastic band, whereas here the elastic band just moved that direction, right? So elastic demand is if I move up price, the demand for that product will go down. And this is a place you don't want to be typically. Typically you do not want to be in industries that you cannot charge a premium price. You raise your price by a few pennies and people just like walk away. I don't want to be in that kind of business. I can't have high margins typically. Typically elastic demand, industries with elastic demand is going to be a race to the bottom. It's going to be extremely low margins. All right. This is why things like places like Walmart and retailers that are big boxers might have 1%, 2%, 3% margins. It's because they have very elastic demand when it comes to their pricing. They can't raise prices by 20% and make more money this week, because their customers will just leave. So another example is from a product standpoint is what is elastic versus inelastic? Well, inelastic demand is going to be something like milk. Whether or not you have milk is not going to change dramatically if the gallon of milk goes from $3 to $4. Okay? Or actually, let's do actually the opposite, because the opposite is true, and that is for discounting, all right? So if I have a $3 gallon of milk and I reduce that down by 50%, I do $1.50, people are not going to be like, oh, I'm going to go buy more milk because it's 50% off. Because you either get milk or you don't. You're not really price sensitive. You're not really, there's no elasticity of demand. It's not like you consume more milk because price went down. And you're not going to consume less milk if the price goes up. You're just not. You're typically pretty inelastic in terms of your demand. Whereas electronics are typically, again I say typically, because elastic demand, because people will go and they will spend so much money on Black Friday and Cyber Monday. Why? Because the price went down. So as the price went down, demand went up. Elastic. As the price goes up on electronics, typically demand for them will go down dramatically because there's a lot of competition. There's other brands that they can go out and buy. So why would I go pay 50% more for that flat screen TV when there's 100 other options that are cheaper? So typically demand is going to increase dramatically when price is changed with this model. Electronics, Cyber Monday, Black Friday, typically what do retailers do? They slash prices on electronics because that is the most elastic demand when it comes to products typically. Now you can make an incredible business by trying to create a brand that allows you to have electronics, for example, or a product or service that is typically elastic, but then make it inelastic. For example, Apple products. If an Apple product, if the next iPhone comes out and it's $300 more than it was last year, guess what? People are still gonna buy iPhones. They're still gonna buy iPhones. What did they do? They took an industry, electronics, cell phones, that is typically very elastic, where you can't raise price too much without losing customers, and they made a brand that allows them to charge a premium price. And we're gonna talk about that in the next video, because that's a completely different pricing model. But right now, you just gotta realize that they have taken what is typically an elastic demand type product, electronics, and because of a brand, made their customers inelastic, the demand inelastic to their customers. So another thing you want to keep in mind is, well, what's the goal? The goal is to increase the value of your product or service, the perceived value in the mind of your customers, so much that a small price increase does not change demand for your product. So I do not want it to be that if I change the price by just a little bit, customers leave, demand goes down. I want it to be where I produce so much value that I can increase my price a little bit over time, and the transaction goes through. Remember, the transaction will go through as long as value is higher than price. So what my goal should be is, how do I increase value as much as possible so I have price that I can move up, and the demand for my product, the transaction still takes place. The demand does not go away. There's still that value gap allowing the transaction to happen. Another thing that is somewhat interesting is called surge pricing or dynamic pricing. And this has become popular where there are industries where demand does change a lot. Elastic. It's very, very elastic. Something like Uber, for example, they changed their pricing. It's called surge pricing, or even also called dynamic pricing, which is to say our demand is so elastic, it changes so much, it moves so much that we're actually going to move our prices with demand. So when you go into Uber, if it's in the middle of the day, that ride might be $10. Whereas that night, late in the evening, when everyone else is wanting Uber and the demand is very high, what are they going to do? They're going to increase price dramatically. So that same $10 trip might be $30 now. Literally a 3x price difference. So what that means is they're going to match they're going to match their pricing to demand, because it's a very elastic thing. Now, if you charge $30 in the middle of the day on that Uber, guess what? They're probably going to go use Lyft. They're going to use a different company. They're going to go get a taxi that has very inelastic pricing, that has a set dollar amount per minute, because it's cheaper. So the goal here with surge pricing is to match demand to the pricing. All right, and so just keep in mind that you want it, the goal is to create a business, a product and service that is inelastic. That as you raise prices, the demand for your product and service does not go down. If you can do that in any industry, even what is typically considered something like electronics, like extremely price sensitive or elastic demand, those are kind of the same things, by the way. When I say a product has elastic demand, I'm basically saying equal to price sensitive. Okay. So these are just inverses of the same thing, all right? Whereas over here, inelastic demand is going to mean that they are price insensitive, all right? So if you hear those terms, that's what it means. As price goes up, does demand change? If not, it's inelastic. If demand dramatically drops off when you increase price, that is elastic demand, and that customer is considered price sensitive. All right, so I kind of referred to in the last video, but prestige pricing is something that a company like Apple, prestige pricing, is going to use. This is also going to be like, Louis Vuitton. You got like companies like Bugatti for cars, that their goal and their differentiation, their pricing strategy is, we are going to be so high in price, but it's going to convey an image of high quality or uniqueness, right? So sometimes what they'll do, they'll only make, 10 cars. They'll only make 100 different 100 handbags of that model, right? So there's limited supply. Typically when you reduce supply, that increases demand, which therefore increases price, but a lot of times it's also due to the fact that just because it is a Louis Vuitton, just because it is a Bugatti, that brand, they're trying to convey an image of being very high quality and very unique. So what are they going to do? High price. So if you are doing a product or service that you want to serve only the highest net worth clients, only a less number of clients, but very high value, very high dollar amount, and you typically you want high margins, and those high margins are going to be spent on typically advertising and branding to reinforce that perception and that thought process of being a high value, very unique brand. That's what's going to allow you to have prestige pricing. And typically, if you have prestige pricing, your customers are not very price sensitive. In other words, there's inelastic demand. If Bugatti added another $200,000 to their next vehicle release, they'd probably still sell out. If Louis Vuitton added another $100 to their next handbag, that's $5,000, probably not going to change the demand very much. So inelastic demand, very price insensitive customers when you start getting into prestige type pricing models. This is what Apple's done. They've taken electronics, like we talked about, that is typically very elastic, and based on price, people will make a purchasing decision, and they've made it basically inelastic by having a prestige brand. They charge extremely high prices. You can get a comparable Android phone for like $200, $300, and the same phone, high-end, whatever, Apple is like $1,200, $1,300, $1,400. What are they doing? They're trying to create a prestigious brand and much higher margins, and customers are willing to pay an extra $200, $300. They would not care. They'd still buy it. So very inelastic demand, very price insensitive customers, and this allows them to have higher margins, allows them to reinforce the fact that they are high value, high quality, very unique by using that money on advertising to reinforce that brand image. So there's another model, not to say it's always the best thing. I'm sorry, but you're not going to make a big business if you're trying to make the prestige, you're trying to make this prestige around something like pens. Well, I'm going to sell a $5,000 pen. Great, but like how big is the demand? Like not very much, because most people are pretty price sensitive. They have a very elastic demand to the cost of a pen. And so you got to ask yourself, is there actually room in the marketplace? Is there people willing to pay a premium price for a prestigious brand? Or is it a commodity that people are simply looking at price and they're extremely price sensitive? It's important when you're setting a price to really think about just how much price does impact the entire business and the customer experience, customer service, the layout of your store, how you train your staff. It just affects everything. The reason for that is what I like to think of is Walmart versus Whole Foods, right? So over here we got Walmart, over here we have Whole Foods. So on this continuum, what I think about is what they differentiate themselves by. Walmart is by price. Whole Foods is by quality. Now, this is going to lead to is the fact that because Walmart is differentiating themselves on price and their slogan is literally everyday low prices, over here, it's a matter of volume. That's their goal. In order for Walmart to run and to make a profit, they have to have lots and lots of volume at a very low margin. Whereas Whole Foods, their game of how they're going to make money is margins. They're going to have much higher margins on the bag of chips. At Walmart, they're going to sell a bag of Frito-Lays for maybe $2 or $3, whereas at Whole Foods, they're going to sell an organic, potato chip bag for $7.99. Much less volume, much higher volume for Walmart. So what I want you to keep in mind though is that price differentiates everything in the business, because at Walmart, when you go there, it's all about volume. Bigger stores, much bigger stores, bigger selection. The aisles are typically more narrow because they gotta get more SKUs, more products into the building. Whereas Whole Foods, they're much more open layout. They have much more design elements. So the produce section has a really nice mural, and they have different paint colors. Whereas this is like a warehouse. You walk in there, it's like, hey, we are not trying to make this a super enjoyable experience. We just want to keep our prices as low as possible. And in order to do that, we're not going to be able to have wide aisles and staff just wandering around ready to ask answer any questions you might ask, or people that have the bakery and all of these people that can just answer your questions like a Whole Foods might. So by having higher margins, you make a very deliberate decision that, hey, I'm not going to necessarily have as many customers, but I'm going to focus on the few customers I do have at a higher margin. There's not to say that either of these businesses are good or bad. It's just a matter of realizing that the price that you determine, we've talked about the last couple videos here, is going to affect everything from your store layout to the colors of the paint to how you staff your employees. And it all comes down to, are you focusing on volume, which is not a bad thing. There's plenty of massive businesses that just focus on volume with a low profit margin. Walmart on their retail products is you can be between 1% and 3% net profit margin, whereas Whole Foods is going to be like 5 to 10% on profits. So the bottom line though is Whole Foods doesn't move a fraction of the volume that Walmart does. So just keep in mind that choosing your price is not making you good or bad. I'm not saying everyone should be Whole Foods or everyone should be Walmart. It's a matter of knowing that setting your price affects everything in the business, from what you can afford for advertising to how many staff members you have per dollar of revenue. It just trickles down and down and down. And at the end of the day, we gotta make profit. How you do that can come in a lot of different forms, and price many times is the differentiator between a volume versus a margin-based business. All right, so all of that might have made no sense to you, and so I'm going to do a graph about setting price and just showing more graphically why price is so important and why how it changes everything in the business. So I kind of made some sketches on my phone, so bear with me for a second, but I'm going to explain this graph. On the bottom here we have units in thousands, so 20,000, 40,000, 60,000, whatever unit you want to call it, but these are in thousands. Over here, we have the cost in thousands of dollars. So everything 100,000, 200,000, all the way up to $800,000 in revenue. And also for cost, it's the same x-axis here. So here we go. So what this is this angle right here is price. Okay, so we're going to assume $12 per unit. This angle right here is the cost to produce these units. Now this right here is the fixed cost. Right here, this is the fixed cost that we are going to have to use because of insurance, rent, things that it doesn't matter if you sell 0 units or if you sell 120 units, there's a fixed cost. Okay, now the question is, what's the break-even point? How many units do I need to sell just to break even if I price my product at $12 per unit? Well, in this example, I'm going to have to sell $500,000 worth of revenue right here, which is potentially going to be 70,000 units. So in order to make any profit, break even, I need to sell above 70,000 units if I'm going to price my product at $12 per unit. Now, if I sell, say, let's just say, what is this, maybe 100,000 units? Well, then now my cost is going to be here. My profit is going to be right here, which means $100,000 of difference between the 600,000, let's say $600,000 cost is right here, and then this right here is the price. Therefore, the difference between this and here is my profit margin, okay? So that is determining at $12 per unit. Now the question here is, what happens if we change from $12 to, let's say, $20? Well, this is what's going to happen. Instead of this angle being here, this is our price, we're going to change this now to where it's like this. Okay, I'm actually going to draw this solid, boom, so you can see. So this is going to be $20 per unit. So what's going to happen? Well, our break even now, we don't need to sell as many units. We might only have to sell 25 or 30,000 units in order to break even on our break-even point. So our break-even is here, but again, our price is $20,000 per unit, and the question is, can you actually get $20 per unit, or is this unachievable, right? It's great to draw lines on a graph, but the question is $20 per unit achievable, and can you actually get that value? But if you can, you don't actually need as many units in order to hit break-even. Literally, we're gonna sell 25,000 units at $20 and break even, or we're going to sell 70,000 units and break even if our price is at $12,000. Literally 3 times as many units in order to hit the exact same break-even point. Now what happens if we price this product at $8? Okay, so we actually cut the price. Then what happens? Well, maybe it looks something like this. I know it's not straight, I'm sorry about that. Try to make it a little bit straighter here. But now what we've done is we have priced the product at $8 per unit, okay? So let me just get a red marker here. So now our price per unit is $8 per unit, okay? And that's this one right here, okay? Try to redraw this for you. Red, got it. Cool. Now we've actually moved the break-even point all the way here, which means we might have to do like 130,000 units and $1 million in revenue before we actually even hit break-even, simply because as our costs are going up, we create more units. Great. We have a fixed cost down here, $12 per unit. Break even is going to be around 70,000 units. If we raise the price to $20 per unit, our break even is much less units, and we can make much higher profit margins if we sell, if we sell say 50,000 units. Well, all of a sudden our margins are massive here. So this is the power of pricing. Being able to have a premium product allows you for higher profit margins. Like, think about it. I could literally do $1 million, let's say $1.1 million in revenue. But if I price this product at $8 per unit, I could literally make like $10,000, $15,000, $20,000 in profit with that much revenue. Whereas I could do way, way less in terms of volume, but because I have a higher price, my margins are so much better. And as I do scale the business, I get very, very beefy margins. So this is what you want to keep in mind. I'm a big believer in trying to be premium and trying to get this graph to be as vertical as possible, so that as I scale the business, I actually see economies of scale. This is economies of scale. Once you break past break even, and as you get bigger and bigger and bigger margins, a lot of times it's going to be a higher priced product. Otherwise, you're going to race to the bottom. And what is that race to the bottom? It is a matter of just making this lower and lower and lower. And as you lower your price, it takes longer and longer and longer before you make up for that low price in volume and actually begin to make a profit. And your break even becomes super, super high, and you have to build a massive business before you actually see any profit. And that's why companies that are making millions and even billions of dollars still never make a profit, because they're trying to play the volume game. And that works maybe in the long run, but for most small businesses that don't have public funding or don't have venture capital, we're trying to get to break even as soon as possible and then keep our prices high enough to where we can actually make a healthy margin. If I look at this right here, if I look at this price here, this is all profit margin because I'm above my cost. I'm doing a $20 per unit, and then this would be all cost, total cost to produce the good. I'm about a 35, maybe 33% profit margin right here. This is all profit. This is my total price. This is my total cost. You can see that's the type of business I want to be running. And as a small business owner, as someone in the local market, this is where I would recommend you stay, is on a higher priced unit, higher price per unit, so you have a lower volume, a faster break even, and once you pass that, you actually get to see profit. Typically, this part right here, where you're trying to grow the business and get up to break even, takes a couple years. We've talked about before, year 3 is a lot of times where businesses start to see traction, start to see profit. What is that? Usually they're getting past that break even point. They're getting past that point right around year 3, year 4, year 5, and that's what I want you to focus on. Create high value, keep your prices high, so after 1 or 2 or 3 years, you can break into profit instead of taking 5, 10, 15 years trying to grow the business simply because you have a low priced, low margin business. All right, so now you're like, great, I love the fact that I saw that chart, but what is my break even point? So I created kind of a quick equation. You could make this equation simply by looking at the chart, and that's what I did. But here it is. It's break even point equals total fixed costs and expenses, divided by the selling price per unit. So the cost per unit, this is the price that you're selling that each unit for, minus the unit variable cost. Okay, so you're like, whoa, like that's a lot of numbers and things like that. Okay, well, let's break it down. So this is going to tell me how many units I need to sell to break even. All right, so this could be how many shirts do I need to sell? How many cookies do I need to sell? What is my break even point? What is the unit? How many units do I need to sell in order to break even? All right, well, first off, let's assume that our total fixed operating cost, our total fixed expenses are going to equal $300,000. Okay. So these are fixed costs. The next thing is, well, what is my selling price per unit? Well, I'm going to sell this shirt at $12 per shirt. And the cost of goods sold, the variable cost in this case, is going to be $5. So if you do the math on this, you could do 300,000 divided by 12 minus 7, or minus 5, which is 7. So you can do 7 here. So 300,000 divided by 7 equals 42,857 units. Okay, so in this case, if I'm going to have a $12 price per unit as my price point, and my cost of goods sold, my variable cost is going to be $5, I have to sell almost 43,000 units in order to break even. Now, the thing that I'm bringing out here is the fact that this part we didn't talk too much about in the last chart, because remember that last chart we just said a flat $100,000 fixed expenses all along the board. That's great. That is the number one way to reduce your break-even point. Okay, we talked about price. That is a big part of it, right? It's part of the equation. You can reduce the cost of creating the shirt. You can increase the price of the shirt. Great. That's on the denominator. But on the numerator, the top part of this fraction, the most important thing is how do you reduce your fixed expenses? And I just can't overemphasize the importance of a small business to reduce fixed cost expenses. Operating costs like a big warehouse or a big insurance bill because you got all this equipment and you got a bunch of loans. These are all fixed expenses that do not change. Regardless if you sell one shirt or 1,000 shirts, you still got to pay for the warehouse, which is bad because if I sell 2 or 3 shirts, I'm not even breaking even that day. So your break-even point is going to get higher and higher the higher your fixed expense and fixed costs and operating costs are. That's why I'm a big fan of lean and clean. Lean, mean, clean machine. And that is, I'm not going to have a bunch of big warehouses. I'm not going to have a bunch of equipment that I don't use every day. I'm not going to have a bunch of machines that I only use once a week. I'm going to rent them until I need them, because that will keep my operating costs, my fixed expenses down. The goal of creating a lean business is keep this numerator, your fixed expenses, down. It will allow you to get to break even faster, and if you double that up with high price, high margins, so increasing the price and then decreasing the fixed expenses. These are things that do not change regardless of how many units you sell. If you can reduce that, that leads to a much lower break-even point and much higher margins once you cross that break-even point. All right, so we're going to go back to our break-even analysis graph because there's one part we didn't talk about, and that is the fact that people are not willing to pay an infinite price, and demand for your product and service is also not infinite. So we have to realize that there's going to be a demand curve inside of this graph. So I can't just be like, oh, well, I'm going to charge $100 a unit because then I'm going to make profit, break even sooner, and I'm just going to make tons of profit. Theoretically, yeah, but the problem is, will people actually buy your unit at $100? If that's is that even likely? So the demand curve is something that we have to add to this graph, and again to figure out what our price is going to be and how do we maximize profit in order when we do price our product. So here is the demand curve. It's like, hey, look, we need X amount of units, but eventually, as there's just less demand for our product because we have so many units. Like, not everyone needs our product or service. Eventually, there's going to be decay in the amount of demand that is for our product. Well, the question is, well, what price should I be putting this at? Well, theoretically, based upon this graph, $20 a unit won't even sell because there's no one inside of that demand curve. Whereas this part right here is profit. This part right here, above our total cost line and inside of the demand curve, which means if I want to maximize profitability, I want to be like right here on my demand curve, which means I'm probably going to have a price that's maybe slightly less than $12, and my number of units is going to correspond with whatever is here on this chart. And then that's probably going to be about where I'm most profitable in terms of my revenue. Okay, so you have to keep in mind on this break-even analysis, you can't just keep raising your price because there's not going to be any demand. No one's going to want your product at that price. And eventually, eventually in time, like these lines don't just keep going on forever. Eventually, you're going to fulfill the need in your market. That's why total addressable market is important. The larger your total addressable market, the further you can go up this graph, and this demand curve would just keep going up and up and up and up. The amount of demand for this product would not wane. So that's why total addressable market is important. But you got to realize there is always a finite number of customers that you can serve. There's a finite addressable market, and therefore, over time, as you increase units, it's going to reduce demand. Okay, and we're gonna get into supply and demand, but basically as you keep increasing supply of your product and service, the demand for it is gonna come down. And so eventually that demand curve will come down. To maximize profit, you're gonna see how much of this is above my total cost line, and where can I maximize that, and that's gonna be the number one determining part of your price. Because there's no reason to price at $8 a unit over here, sell more units, but because I've had to lower my price in order to get those units sold, I'm now actually losing money here. I'm below my total cost, but my volume is higher. So you have to realize in a finite market where you don't have infinite total addressable market, that this demand curve will bend down, and there's an actual money spot where you have the highest level of profitability on size and number of units created. So keep that in mind. If you don't have an infinite total addressable market, then eventually it's going to come down. But that's why it's so important. If you want to build $1 trillion business, you better make sure that your total addressable market, that this demand is going to keep going up for a very long time so you can keep growing the business. Another pricing strategy that a lot of times is pretty common in the retail world is going to be markup. All right, so basically they determine a percentage that they want to make in profit, and it doesn't really matter how much volume, or it's like, hey, we just gotta make 30% or 50%. So a lot of times, like in retail, you'll sell to them and you'll have a suggested retail price, or MSRP, as it's also known as. But hey, this is the suggested retail price that we recommend you using, and a lot of times they're gonna want 50% markup, which means it doesn't really matter how many units. It's like, hey, if we sell 100 units, we wanna make 30%. So this would be their profit right here, right? 30% margin. And if we go over here, we still want 30% margin right here, right? So we still want this 30%. So this would be 30%, this would be 30%, and this is what's considered the markup pricing method. All right, so it's simply just a straight percentage. If we get all of our inputs and our costs at $30 and we want 100% markup, we're gonna go to $60 for the cost of the price for that. So that means it's very much less tied to units, because, for example, if I want a 30% margin at this price, I'm going to have a very different price than if I have a lot more volume. I'm going to have a similar percentage of profit, but the price will actually be lower, because here I'd have to have this price, whereas at this volume I can have a much different price. It'd be under $12 in this case. So that's why a lot of times companies that use the markup of material, or the markup method for their pricing, they're going to require a certain minimum volume, because they can't have a 30% margin and only have a few of your products. It doesn't make any sense for them from a profitability standpoint. So markup on material, markup on products, markup to get a certain percentage profit is going to be like, hey, here's our total cost. We want 30%, we want 10%, we want 50%, whatever percentage profit markup they want is what they're going to tack onto. Most commonly used in retail, where they have a whole bunch of wholesalers and producers, and they have a percentage markup that they want in profit. All right, so I'm going to talk about 6 different pricing strategies. The first 3 will go in this video, next 3 in the following video. The first one is what we call penetration pricing. And as the name infers, the goal here is to penetrate the market and take over. This is typically going to be used by startups that have massive amounts of capital behind them, venture capital, private equity, public stock market, companies that are trading on the public stock market. They have a lot of money and they can move into a market and basically set a price that's lower than really anyone can compete with, or even just lower than normal, so that they can increase the speed and the uptake and really just hasten the market acceptance of their product or service. And they're only doing this to increase market share. So there's a few reasons why you would do penetration pricing strategy. And the first one is just to discourage competitors. Like if you can get into and penetrate into a market, take over massive market share, no one wants to compete with you. It's like, why would I try to take out someone who already owns 80, 90% of the market? So they won't even, just to discourage competitors, that's the first reason. Massive moat built around your business because the amount of capital to just try to take you down. You've already taken so much market share. And then another reason is like, hey, if we really want to become number one in this market, we're going to penetrate the market using really low pricing. So penetration typically not used by small businesses because we can't afford to have massive losses or take down competitors or secure a monopoly or a massive market share on a market because we have to lose all that money. We usually don't have that kind of capital. So usually small businesses don't use penetration pricing, honestly. The next one is price skimming. And this is not super common, but definitely possible in a localized market for small businesses. The example I would use is Tesla. And they first created the Tesla Roadster. It's like a $150,000 car. Then they made like the Model S, which is like $80,000. Then they made the Model X, which is like $60,000. Then they made the Model 3, which is like $30,000 or $40,000. What they were doing is constantly bringing that price down. And basically what price skimming is when you set very high prices for a limited period of time before reducing them to lower levels. And when you reduce them to lower levels, you actually gain market share. You actually get more wider adoption of the product or service because more people can afford it. Mainstream people can afford it. And that's what Tesla did, right? Selling really high margin, extremely expensive product to early adopters that were willing to pay that premium price. They had, were to get all that margin, but then as time goes on, they need to gain market share. They have to lower the price. And so this price skimming is like, hey, we're going to take all the people on top who are willing to pay this premium price and cash in on them. And typically, this is going to require a prestigious brand. And this is why the goal for small business is typically to do this in a localized market. And that is create a prestigious brand like Tesla. Obviously, they spent billions of dollars, making this massive brand and building infrastructure and tons of employees around the world. But you can do this in a localized market because the reason Tesla was able to sell a Roadster, sell an $80,000, $90,000 vehicle is because the prestige of their brand. They did it without marketing. They don't spend a bunch of money on advertising. They simply built a great product. They price skimmed people at the top, the early adopters, and they really have higher margins. They have some of the highest margins in the automotive industry because they're a prestigious brand. So what you can do in a localized market is try to create a brand, try to create a service, try to create a product. Everyone in that market, whether it be a geographical or potentially a niche in the universe that you're going after, try to become that premium brand that people are willing to pay a premium price for, especially the early adopters. That's how you can get into a new product line, a new service offering, is by saying, hey, I have a prestigious brand, I'm going into this new market, people are willing to pay a higher price for your brand. It's a great way to be able to have higher margins and higher profits in your small business. The third, and my least favorite, pricing strategy is going to be follow the leader. Unfortunately, this is the most common in small business, and that is, hey, I want to get started in my business, I'm going to go find some of my competitors and see what they're charging, and I'm going to kind of be in that range. And it's a great place to get started. I'm not hammering on it, but basically all you're doing is using a particular competitor as a model to set your prices. And follow the leader is most commonly used in like commodities, like oil and lumber and things like that, because they sell it's the exact same thing. Like oil, from a well in Michigan is the same oil as if it was in Texas. It doesn't really matter. So that's why the commodity price is actually like a dollar amount that everyone sells that commodity at, because it's the same thing. So the goal is, how do I create differentiation to where I can do more price skimming instead of follow the leader? Because if you're selling a commodity, if you're selling an undifferentiated product or service, then you're going to have to follow the leader. You're going to have to see what the range in your market, in your competitors' kind of landscape is, and just fall within that if you're selling a commodity. But if you're able to differentiate your product, create a brand, you're able to create a better service, a better customer experience, then you can start getting out of this third pricing method, which is follow the leader. Because the average business goes out of business pretty quickly. The average business doesn't have great profit margins, doesn't have a great business. You got to be above average. And if you're going to be above average, you've got to charge higher prices. You've got to be able to do price skimming to some extent and have higher margins. And so if you want to do that, you've got to focus on creating that prestigious brand so you break out of the commodity commodity type, hey, this is a fixed price, and customers actually try to come. Like, you want to be so high priced that customers can't even compare you to everyone else because they're like, well, there must be something different about this company. Like, they're a higher premium priced. Like Tesla, there's got to be something different about this car that looks like a Mazda Miata, but it's 10 times more expensive. Well, yeah, it's electric. Like, it's a revolutionary. It's the next thing. Like, that's how they pitched it, is they created something different than every other vehicle on the road, and therefore they're able to charge a higher price. It didn't become a commodity of car versus car. It became car versus like technologically advanced, future. And so how can you, in the world of automotive where it's just car versus car, like Toyota Camry versus Honda Accord, apples to apples. How do you create a premium product, premium service, something that's so different than all of your competition that you can't compare the two. It's like apples versus oranges. You can't compare the two. And because of those higher margins, because of those higher prices, you're able to then afford better service, afford better customer experience, be able to do surprise and delight and do things that your competition can't. You can only do that if you have higher premium profit margins. So following the leader is a recipe for disaster long term. Might be a good place to get started on your entrepreneurial journey, get started in your business, but the goal is to create a brand that you have a premium price with premium profit margins in the future. All right, the next 3 pricing strategies, the first one being variable pricing. So this is our 4th method here, variable. So this is gonna really be like, hey, we don't have a set price. There's certain factors that we're gonna move our price, and this could be things like quantity. If you get 10 pallets, you get a discount. If you get 5 pallets, you don't get a discount. If you get 1 pallet, no discount. Right? Variable pricing based upon quantity. You could have variable pricing based upon demographic. Like, hey, if you're on the East Coast, it costs us way more for shipping and handling, so we're gonna have to increase your price. You have different pricing based upon the target market. Like, hey, we really want to go after people that are between 20 and 30 years old. So what are we gonna do? We're gonna lower price for those people. So you get a variable pricing based upon your target market. So variable pricing. This is like when people say, hey, we're gonna give a veterans discount, or we're going to give a seniors discount. You might be doing the senior discount because your ideal customer is 50 to 75 years old, and that's who you want, for example. So variable pricing based upon different factors. 5th pricing model is price lining, okay? So this is common, especially, I like this when you productize your services. So this is kind of where the better, best line, this is where the better, best, the good, better, best model kind of fits in. Let me just spell this correctly, lining. So in this pricing strategy, you set a range of several distinct merchandise price levels. So whether you're selling products or services, you kind of have a good, better, best model. Now, sometimes people have 4 or 5 different ranges, but in general, it's like, hey, we have different categories based upon certain ranges of price. So what's nice about this is it simplifies the buying decision for the customer. Because like, hey, look, do I want the $10, the $50, or the $100 pair of shoes, right? It's simpler. It's not like, hey, we change price variably. It's not like we are trying to sell you a $100 pair of shoes and then it's gonna become $10 down the road, which would be price skimming. That's not what we're doing. We're just saying, hey, look, we're price lining. We're creating a line that's good, better, best, and allows you to categorize and kind of bring in certain characteristics that are good, better, and best quality. Good, better, and best services. So for mowing, for example, hey, we can just mow your lawn, that's $10. We can mow and edge your beds, $15. Or best, we can $30, and we're gonna do weeding your beds, we're gonna trim your bushes, whatever, right? So price lining, kind of creating that line. And what's nice too, not only does it simplify the buying decision, it's always, also if you have product-based businesses, it's easier to do inventory because you can base what your inventory needs are based upon the income levels and buying desires of your customers. If I'm going into a market and I have a whole bunch of stores and I'm selling a bunch of merchandise, I'm going to a market where it's very affluent. Everyone's making $150,000, $200,000 a year. I'm probably going to stock more of my best line, right? That highest price product, highest price merchandise, because that's the demographic I'm selling into. And it's very easy for me to see which of these lines are working the best, and then choose, hey, I'm gonna hold more of that inventory. So it's a lot easier in comparison to having all these different prices, all these different types of products all over the place. Price lining, very, very simple. Similarly, what can also be used is what's called product line pricing. Okay, line pricing. And this is going to be where the same company uses different labels or names to differentiate prices that compete with each other. So it's like, hey, we're not selling mowing versus bush trimming. We're literally selling mowing and mowing, but this brand, this product line is going to have a different price than the other mowing service. Another example is like food products. This happens all the time. Costco has like Kirkland Signature brand, and then they have this other like specialty brand that's like going to be twice as much. Same, almost the exact same product, like very comparable, but the brand, the product line differentiates on pricing, right? So again, you can have premium products and then less premium products based on the product line, what brand name you use. The different way of labeling, our packaging, is the only way of differentiating these two different product lines. Highest quality, different product line. We're gonna have a premium product, premium service, premium price on this brand. Same company, we're gonna create a different brand for this. Okay, so this is another way of using product line as a way to differentiate in price so that customers begin to affiliate the fact that, hey, this business, I can get a really premium product with this other inside of this company, a different brand name versus a different brand name where I can get a cheaper price. Kind of allows you to get more market share. Your total addressable market goes up because I have a cheaper brand and I have a more expensive brand. And this is why there's massive conglomerates like Coca-Cola and other food products companies that have many, many brands inside of them, and some of them compete with each other. These brands compete with each other, but they're different brands, and therefore they're able to have different pricing, and therefore they address a different part of the market, which allows them to have a wider net of their total addressable market. So product line pricing is the sixth way to do your pricing method. All right, so I want to talk about price versus value. I think this is actually the best way to find a pricing equilibrium or a price point for your product and service, and that is focusing more on value than price. What I mean by that is any transaction in the economy will take place as long as value, perceived value to the customer, is higher than price. Okay, so I look at these things as moving continuums. As long as value is slightly higher than price, the transaction will be consummated. It'll take place. For example, if I am very, very thirsty and I'm in the middle of the Sahara Desert, the perceived value of a bottle of water is like $20. So therefore, as long as the price is under $20, I'll go buy it. Now, if someone's like, well, I'll sell you the water for $50, then the price goes this high, so much higher than what I value it, well, now I'm not going to buy it because the price is higher than the value I've attributed and perceived it to be. Whereas if somebody is, I now am swimming in the ocean, I just had a whole bunch of lunch and water, jumped in the ocean, or in a lake, for example, and all of a sudden it's like, well, what's the value that you've now putting on that water bottle? Well, like $1. I wouldn't even pay $1 for that water bottle. Well, now the price has got to come so far down in order to actually make the sale go through. So the first thing you want to do when it comes to figuring out your pricing, getting a good value proposition, and maximizing your profit, is you want to find a starving crowd. Who's going to pay the most for food? A crowd that's starving. After a football game, you want to be the guy selling hot dogs right after the football game. When people are starving hungry, they're willing to pay whatever, and they'll pay $10 for the same hot dog that they would spend $1 on if you were just sitting out next to the road selling hot dogs. $1 next to on the sidewalk, same hot dog, someone's going to pay $10 at the end of a football game simply because they're hungry and you're selling to a starving crowd. Why? Because they've put so much value on that hot dog, you can increase the price. Now, when it comes to figuring out pricing for your business and for your product, your service, what you can do is to make the transaction go through, you can either lower the price and make the sale go through, or you can increase the value and also make the transaction go through. And what I find so many small business owners do is the first thing they will do when they're trying to make more sales and get more customers is they will lower price. Because as soon as they lower price, the sale will go through. But guess what? Then someone else is like, well, I don't really value your service. Okay, we'll lower our price again. And all of a sudden you're in a race to the bottom. And this is where industries like lawn care and landscaping, where it's just a race to the bottom in terms of price, because at the end of the day, you can always make a sale go through if you lower the price enough. If you gave away your product and service for free or kept moving in that direction, 100% of people would accept your product. 100% of people would accept your estimate proposal for your services because you basically have dropped the price all the way to the ground. And again, as long as value is anywhere higher than price, the transaction will take place. What I would recommend you do is ask yourself, how can I charge a premium price in my marketplace, but provide so much value compared to my competitors that the transaction still goes through and there's still a surplus of value? And so I'd really recommend that you start thinking about, instead of how can I lower price to make the transaction go through, how do I have a better website? How do I have a better sales process? How do I have a better estimate process? How do I have better follow-up? How do I train my crew and my team and my employees? How do I make sure that I have the best advertising, the best marketing, the best branding, and create so much value that I'm actually able to charge a premium price and the transaction still goes through. So the bottom line is focus more on increasing value instead of always lowering price. Because as long as value is just a bit above price, the transaction will go through. Everyone focuses on the easy thing, the thing you can do in immediacy, and that is drop prices. I want you to think about more, how can I raise value to my customer in the form of intangibles, in terms of branding, in terms of customer service? How fast do I answer the phone? How quick do I get back to with the proposal? How do I treat customer service? Do I have great online reviews and a great website? All of those things produce value in the eyes of the customer. Showing up to if you go into a customer's house, have a uniform, look clean cut, have a good sales presentation. All of that is value in the eyes of the customer, perceived value, and that's what you want to focus on so you can maintain that premium price. Now, let's talk about one more thing, and that is the fact that when we look at three different things in the customer in terms of pricing. Here we have the price to the consumer. Here we have the value. Again, we're going to assume that this customer has accepted this proposal because the value is higher than the price. And then say here is the cost to fulfill, okay? So when we talk about this, these are the three different things you need to know in your business. Like, hey, what's it cost to fulfill? What's the price? Okay, this differential right here is your profit margin. Very, very important. This part right here is something I call, this is not from a book or anything, I call virality. Okay, so this is your profit margin. This is virality. Okay. The reason I call this virality is if you have a massive differential between value and price, people are going to talk about you. They're going to share you with their friends and their family. They're going to post you online. They're going to make an online review. They're going to tell all of their coworkers that you got to do business with you because there's a massive discrepancy between value and price. Value is so high compared to price that it becomes viral. This is why there's like viral videos and viral social media, is because the price is like zero. It's like literally the cost of opening and looking at it. There's no price to sharing it. There's no price to consuming it. And if the value is I laugh, I think it's funny, it makes me cry, it makes me happy, it produces value for me, value, education, information, whatever it might be, that the bigger value is, this bigger discrepancy between price and value creates virality, and that's where people share you, and you get good word of mouth, you get good press, you get good people just talking about you and sharing all about your company without you have to pay for ads, without you have to spend money on customer acquisition. But again, I don't want my price on the flip side to be so low. I don't want to be like, oh, well, I've got to create virality, so I'm going to lower my price so I have this happening. So people like me more. So I get more of my estimates accepted. People don't question me on price as much. Well, yeah, you've done that, but now you've shrunk your profit margins by what, almost half. So this is the balance in business. You want to maximize price while still staying undervalued. That way the transaction takes place, but you don't want to do it too much to where you reduce your virality to the point where no one talks about you because you haven't created excess value. And then on the flip side, you don't want to create so much virality and so much differential between value and price that you actually are hurting your profit margins. This is the balance of business. This is the fun of the game of figuring out your pricing. But at the end of the day, this is what you want to be thinking about. And that is if I'm trying to maximize profits and I'm not trying to grow my business, I might increase my prices and have less virality, but I don't care because I'm not trying to grow, but better profit margins. Whereas if I'm just starting to grow my business and I'm trying to focus more on growth and getting more customers, I might artificially lower my prices somewhat just to keep my virality as high as possible so I get more better word of mouth, people talking about me, but I'd rather you focus on how do I make this blow off the top? How do I take value through the roof by doing things that my competition cannot do, will not do, and how I differentiate myself to where the perceived value goes higher instead of just lowering my price to create this virality. Hope that's helpful, and when it comes to pricing, this is how I think about it. All right, so possibly the most impacting thing that I ever learned in my MBA class was supply and demand curves. If you ever want to sound really smart when it comes to anything in business, you can basically always say, well, comes down to supply and demand. And you're actually almost always right. If people are talking about like the supply chain shortages, our prices going really high, or the real estate market is really high, or anything is high in prices or low in prices or good deals or anything, you can always just say supply and demand. And you're right. So this is a supply and demand curve. And basically on the y-axis, you have price. On the x-axis, you have quantity. And so what happens here is you have your supply, the amount of supply that you have, and then you have the amount of demand. So really simply stated, as demand increases, you're going to have a higher price. As supply increases, you're going to have a lower price. You say, well, how do you come up with that? Well, the part that these two lines match up or cross over, intersect, that's called the equilibrium. That is the price that is determined, okay? So it means that, hey, right here, that's the price. Well, what happens if we move demand forward? In other words, tons of people want a certain product. Let's just say it is iPhones. Everyone wants an iPhone. Well, theoretically, what's going to happen is we're going to shift this demand curve forward to this direction. It's going to draw this here. And so what's going to do, we're going to draw this next line right here. That's the new demand curve. Well, what's happened is we've moved the equilibrium from here to here. What's that done? It has raised the price from this level all the way to this level. This is the new price. Price has increased because demand was increased. Now, the same thing can be said if supply goes down. All right, so that we just moved the demand curve. More people wanted iPhones. Let's go ahead and erase that real quick, and let's show you what happens when supply is affected. Okay, so if we're like, hey, you know what? We are going to ramp up production of these iPhones. We're going to build more factories. We're going to increase supply. Okay, so now we're going to increase supply. The same thing can be said. I increased demand. I'm increasing supply. The same thing can be said for reducing both of these. But now we're going to increase supply. So what's going to happen? We're going to have a new supply curve right here. What happened now is our equilibrium, I always say equilibrium, there you go. Equilibrium fell from here to here. And now our new price is right here. So it's always a function of either your demand has gone up or down, or your supply has gone up and down. And now if you talk about something that happened like in 2021, and that is and even going beyond that, is we had a massive issue in our economy with inflation simply due to the fact that two things happened at the exact same time. Number one, demand went up. And we just showed that what happens when demand goes up, price went up. That was our first line, right? We moved this direction, and that made the equilibrium went up. But at the same exact time, we had supply chain shortages because of COVID-19, which actually made the supply go down. And when you have supply go down, you actually raise the price. And it makes common sense, right? If you have less of something, it's going to increase the price. And this is how you can actually artificially have very expensive things. There's a reason why Bugatti and really nice car manufacturers or watch collectors will only make 10 of them. Why? What they're doing is they're reducing supply. They're like, hey, we're bringing supply way down. And that's why they can charge a premium price, is because they bring supply like, hey, we're only making like 5 of this certain type of watch. What that's going to do is going to move the price equilibrium all the way down here because we made the supply way less. So you can artificially somewhat make sure that you have a very high price by simply reducing supply. And the bottom line is there's always a point of maximum profitability, because I might only make 10 watches and therefore get a really high price, but maybe I can make 1,000 watches and maybe not make as much price, but because I'm still 30, 40% of the profit I'm able to get, I actually make more profits because I've lowered the price. So your price equilibrium is very important, and furthermore, your profit maximization comes to the fact that, hey, I want supply to be high enough in order to meet demand, but if I don't want too much supply to where actually now I'm way over here, I've pushed supply so far that my price actually has to come down. This is why people have to have like big sales once they have too much stock. They buy too much stock, there's too much supply, they have to reduce the price in order to meet demand and have the transaction take place. So this is like the coolest thing ever. There's a whole bunch of things that you can talk about in terms of surpluses, and then when you have, surplus would be you have too much supply, and then if you have where you have shortages, like a labor shortage, you can have all sorts of shortages in your business and you can't find parts and things. That's going to be the opposite of having too much supply. It's going to be not enough supply. So there's just so many cool things you can do in this. I'm not going to dig too deep into it. The basic just is I want you to understand how the supply and demand curves work, and realize too, again, that this has a lot to do with profit maximization, because the cool thing is for most of us, we get to control supply. We get to control how many employees we hire for our service business. We get to control how many manufactured units of our product we create. Therefore, what you want to make sure you're doing is, am I keeping supply down enough to where I don't have an oversupply? I don't have a surplus, because surpluses create downward pressure on price. Shortages create upward pressure on prices. And when you have something like a labor shortage, along with a bunch of people having a ton of money because of COVID-19 stimulus, and so you have a massive amount of demand because everyone's trying to buy everything, and at the same time you have a massive shortage of labor, and you have a massive amount of supply going down, that's what just crushes price up. Because supply coming down, increased price. Demand going up, increased price. When you put those two things together, you have a massive amount of inflation. And that's what's happened over the past couple years, and will probably be inflated more than usual for the next few years. All right, so we're gonna talk about promotions, and honestly, when I think about promotions, it is a fancy word for marketing, but it's important to note that when you have a marketing mix, you might have different promotions inside of it, right? And so there's several different factors that will determine what type of promotions you use. So for example, geography will determine what type of promotions you use. For example, if you are trying to sell something very specific to a certain location or a specific person, you're gonna have a very different mix of marketing. For example, I'm not going to run a Super Bowl commercial if I'm trying to sell to people in Bellingham, Washington, and I'm trying to sell them a certain type of coffee. Like, it'd be better if I took a different promotional route in terms of like sampling. I could be very specific. I'm literally selling, my promotion is the one person in front of my little stand where I'm selling my coffee to. Very different localized strategy compared to, I'm going to throw something across the whole world and the whole country to watch and pay a bunch of money on a Super Bowl ad, okay? So geography is a big deal. Promotional budget, obviously a big deal. Again, Super Bowl commercial versus, am I gonna spend, $20 on a bunch of sampled coffee in a different market? So promotional budget is gonna have a big factor, is gonna be a big factor in terms of what type of promotion you use. Also, like product characteristics will also determine what type of promotion you use. So for example, if I'm selling massive equipment for an industrial supplier, right? Like maybe it is conveyor belts and very complicated mechatronics and all the rest of it. Well, if I'm selling that, it's probably gonna be a very personal selling process. I'm gonna go visit the customers. I'm gonna have inside sales reps that go in and talk to these people and give them information and look at their warehouse and all the rest of it. Different promotional, different way of promoting my product, different promotions that I'm gonna run in order to get more customers, versus if I'm selling something like really non-personal, like disposable shaver blades, right? I could sell those online. I could sell them on like mass across a Facebook ad or Google, or use online media and social media. I do not need to go very personalized. So your type of promotion is also going to be determined by what your product characteristics are, and if it's very high ticket, very personal, that sales process is going to be, the type of promotion you're gonna run is totally different, because if I'm running a promotion for industrial equipment, I might run an ad inside of a very trade-specific magazine. I'm not going to run it though on the front of the New York Times, because like 0.0000001% of the people reading the New York Times is going to be in my market, right? So again, all those things, those are going to be factored in terms of what promotions you use. Do not underestimate just how much you can learn from your competitors. Most people do fail to realize that their competition has tried different promotions before. They've tried the buy one get one frees. They've tried doing things that are funny. They've tried social media. They've tried different types of stuff inside the mail. They've tried different ways of promoting those things. So like, just observe and research before you do a promotion, because most of the time someone in your industry, let alone potentially even in your market locally, has already tried a certain promotion and either found it to work well or not work well. So you might as well learn from their mistakes, and you also might as well learn from what's working well for them. And the best form of flattery is, copying somebody else, and not necessarily copying their exact picture, their exact video or something like that, but maybe you take certain elements, like why did that ad work? Maybe it's in a completely different industry, but ask yourself, why did this specific ad work? And then learn from that. I think we just waste a lot of money trying to figure out what ad platform works, figuring out what type of promotion works. Should I do buy one get one free? Should I do get your first mow free if you get a spring cleanup? Like all that sort of thing, has been tried and tested, and you can usually learn from other people. Also, keep in mind that you can really listen to customers. They're going to tell you what promotions work the best. And in this very digital environment, comments, feedback, reviews, online reviews, all of those things are going to be very easily garnered from a promotion. If people are thinking that your promotion is sleazy because it's super salesy, or you do some sort of a discount, or some sort of funky deal or promotion, you might want to listen to that and maybe present it in a different way. So listen to your customers. It's never been easier with the whole online way of collecting online reviews and getting comments on a post. You can literally post a promotion, and within a couple hours, if you have a decent following, get some pretty good feedback in terms of what customers think. Do they think it's funny? Do they think it's educational? Would they buy based upon this behavior? Do they click on certain links based upon that promotion? So you can test it out pretty quickly. Listen to your customers, that's the biggest thing, and quickly pivot. And don't put all your money in one basket without doing that. Test things out, see what's working, and then if you want to pour money or pour gasoline on that fire, just make sure you've actually proven it out and listen to customers before doing it. So the big question is always, how much should I spend on promotional activity? What should my budget be for planning for what I'm going to spend on promotions? So there's 4 different ways of creating a promotional budget. The first is determining it by percentage of sales. So it's literally like, hey, we're going to take a certain percent of sales and spend that on promotions. And that might be 2%, 3%, 20%, depending on what you're trying to do. But that percentage is fixed. It's like, hey, regardless of the time of year, regardless of whether we're selling a lot or we're not selling a lot, whether the economy is good or bad, regardless of whether or not we have a bunch of back orders or not, we're going to spend a certain percentage of our money on sales. And this can be useful because you can look at your industry as a whole and actually get percentages of like what on average people spend on marketing in your industry. And like, hey, we're just going to match that, right? It's worked well. That's the average, or certain firms that we look up to, or whatever number. But that's the percentage of sales. The thing I don't like about that is it's not adaptive. So, for example, there's no reason. Like, do you really need to be spending 5% of sales on promotions if you have a massive backlog and the economy's booming and you can't get enough supply in, to create the products? And why would I keep spending money on promotions if there's a backlog and I can't even get enough product out? The second way, and there's no right or wrong way to do a promotional budget. These are just the pros and the cons. The next method is what I call the leftovers. And it's literally like, hey, we're just trying to pay all our expenses, pay everything off, and whatever's left over, we're spending on marketing. We're spending on trying to make more promotions and get more eyeballs on our product or service. And this is not a bad way to do it when you're first getting started. Oh, drop the pen. Not a bad way to get started, and most small businesses do get started with the leftover method, because it's like, hey, I've got to provide for my family, take certain expenses out, pay for the business, and whatever's left over, I just want to grow this business. Also a great method. However, I really think you should have a plan and objectives for the money you're spending. Because what happens is if you're really profitable and all of a sudden you're spending all the money that's left over, and that money's not being spent on objectives that are actually useful. The money's not being spent efficiently because you're literally just taking whatever's left over and smashing it into something. Why not have at least something like, hey, the first $5,000, if I have leftovers, it's going to go towards this. The next $10,000 will go towards this. Then I'm going to spend money on this. And based upon how much comes over in leftovers, instead of just saying, hey, whatever's left over, I'm just going to spend it. You got to have an objective. And that leads me, that's going to be the fourth one, which we'll talk about in a second. But the third one is also pretty common, and that's match competitors, okay? And this is not a bad thing too when you're first getting started, to match other competition that you look up to, and like, hey, they're spending money on these certain type of ads at this time of year, let's just go ahead and do that. Not bad, but keep in mind that just because your competitors are doing it, and that's what they've always done, and they've been successful with it, doesn't mean there's not a better way to do it, right? So you could test things out. Maybe you have a smaller budget, but your percentage, you're trying to match like the percentage of sales that they're using. You match them, their time of year, who they're trying to promote these, they're making their promotions for. You just basically copy them. Again, you're leaving in the vulnerability to the fact that you are settling for someone else's status quo when you could potentially be innovating, right? So that's the downside of matching competition, is you're going to get ho-hum results if they're getting ho-hum results. If they're getting great results, you might be able to match them, but you're never going to surpass them. You'll always be a follower trying to match them instead of them trying to match you. So if you're trying to lead your competition, might not be the best method. Now, the fourth way that is, I think, I really think most of your promotional budget, you'll do different things, right? You might say, okay, well, as a general rule of thumb, we're going to have this percentage. But if we have extra money, we might spend extra, a little bit more. And then if our competition is doing a certain thing, we might spend money on that certain type of promotion just to counter out them or fight them if needs be, and to try to take market share, whatever it might be. But then really, I think on all of these counts, you should really have objective-based promotional budgets. And that is like, hey, what is the objective? That's going to be the determining factor of how much I spend on marketing, on my promotion, right? Because again, promotions are a piece of marketing, right? So when we say marketing, inside of marketing is all these different promotions. So what am I going to have? What is my objective for this promotion? Do I want more eyeballs on my website? Do I want people to know who I am in my market? Do I want to have a certain number of views? Do I want a certain publicity? What is the objective, or is it sales based? It's like, hey, I want this promotion to drive, doubling of revenue. What are the objectives? That is what should determine the budget. Okay, in my mind. And again, this is going to be much more based upon internal. I'm a big fan of looking internally, asking yourself, what do I need, instead of looking externally. Externally, like leftovers is based upon what the bank statement says. Percentage of sales based upon your customers. Matching your competitors based on your competitors. Objectives based is like, okay, let's look inside and ask ourselves, what do we want for our business? Then let's create a budget around that, okay? So I'm a big fan of what's the objectives, what do we want from this promotion, and then what do we need to spend as efficiently as possible to get that objective and that result. And so you'll usually be guided in a much more creative direction than just being like, oh, we're going to match our competitors, or like whatever's left over, we're just going to shove into our promotions, or like, hey, we're just going to take us $100,000, we spend 2% per month, $2,000 towards promotions. Like, that's not really. What if there's a great opportunity? You make a great Facebook ad that's just dominating, and you're like, oh no, we're only going to spend 2% of sales. When if you just put, for that 1 month, literally 15% of your sales instead of 2%, you could have 10x the returns instead of just like, oh, we're only doing 2% per month, right? So I think the flexibility of objective base is great, because your budget is going to be much more based around what you're trying to get out, and it almost forces you to have a much more deliberate way of creating the promotion, because you really start thinking about, what do I want this promotion to do? Not just like, oh, let's just make a promotion because we have money left over, or because we need to spend the certain amount of money per month that we've always spent, or because our competition is doing it. I'm a big fan of looking internally. internal, not looking externally to the environment of competition or to what your bank balance is saying. Like, what is my promotion objective? What do I need to spend in order for that thing to happen? Whether it be gaining awareness, getting more eyeballs, getting more traction on your website, getting more sales. What is the objective? Create your budget around that. And that's usually going to come in the form of knowing your customer acquisition costs, knowing your cost per lead, knowing your cost per click, all of those things that we've talked about and we'll continue to talk about throughout the rest of the course, knowing your objectives, then creating your budget around that. Okay, so one of the best ways to promote your small business is through a website. And so, what is really interesting, especially in the past, is people would say, well, I don't need a website, I do all word of mouth, people know who I am. But what happened in 2020, in 2021, and in the whole pandemic is all the people that are 50, 60, 70, 80 years old that maybe didn't have an email, didn't have a credit card, all of them were almost forced to do so because they were locked up in their house for months on end, or potentially had to learn how to order from Amazon and use social media. During that period of time, the average daily usage of social media in that 40 plus cohort 8x. It multiplied by 8 times during that period of time because people were basically forced to. They had to learn how to adapt to a digital world. So having a website is imperative now. I don't care if you're selling to millennials or if you're selling to 80-year-olds. You gotta have a great website. So I'm gonna go through some of the things that I wrote down that I thought was an important thing for you to know when it comes to building a website. And we built hundreds of them at lawncarewebdesign.com. So I build a whole bunch of websites for landscapers, and so these are some of the things that I've picked up from that you can use. And you don't need to use us if you're a landscaper, even, or if you're not, it doesn't really matter. We also have home service webdesign.com as well. So we do home services and a whole bunch of lawn care and landscapers. But regardless, here's some of the things I want you to keep in mind. You got to really balance out at the end of the day the two most important things that come to your website. Design and speed. Design and then the function of SEO. These are two things, right? And so SEO, from an SEO standpoint, I could actually create a website that does really, really well, but looks horrible, right? On the flip side, I can make a really great looking website, but so heavy and it's so slow to load that the SEO is massively and dramatically affected, right? So again, we have design over here. We want design to look really good. This is always what we're trying to balance out when we're creating websites. And then over here we have SEO. And in the past, SEO used to be all about links and having titles and keywords and all the rest of it. Now it's less about that, even though it's still a part of it. And SEO, a big part of it now is speed. How fast does your website load? So a great website that I'd recommend, a free tool for you to use, is thinkwithgoogle.com. Go to thinkwithgoogle.com and you can put your website in and get a lot of information about how fast it loads, and it gives you a lot of suggestions in terms of what to make your website better for SEO. What it doesn't really give you a whole lot is like what looks good. Okay, this is where it's usually worth it to have a designer build your website, because they know it looks good, and the animations of things flying in and how text, visuals of pictures and video should be integrated correctly, tabs, icons, etc. So you obviously want your design to look really well. You want it to be premium looking. It's a big part of your brand. It's a big part of having a premium design of your website leads to a premium perceived value, and if you have perceived value that's high, you're able to charge more. Right? So I'm a big believer in design, but you got to balance it out with the fact that SEO is extremely important. And when we talk about SEO, search engine optimization, yes, it's important to have keywords, and it's important to have backlinks and links going to your YouTube and from other websites to you and all the rest of it. That's all great and fine. That's awesome. But speed is becoming a bigger and bigger part of it, because as Google and these search engines, especially Google, is trying to expand overseas and into places like Africa and China, where there's not 5G, where there is not high-speed internet. They are making sure that these websites load faster. So you've got to make sure your design elements are created in a way that it can still load very quickly and still look good. So you can't have images that are 20 megabytes on your front page. And I've seen it before where people have this really big picture as their home screen, and then there's like maybe some text about their company and their logo. But that background background image is literally 20 megabytes and takes 10 seconds to load. That's way too long. So you've got to make it light enough to where it actually loads quickly. So you're always trying to balance out design and SEO, and a big part of SEO is the speed. Because hey, if I'm trying to optimize keywords, I could just write lawn care, landscaping, just keyword after keyword after keyword for pages on end of my website. Guess what? Not gonna look great. It's gonna look like a scam. It's gonna look really bad. So you're always trying to balance these two things out. You wanna make sure that the website is mobile friendly, extremely important. We really focus on this most at Lawn Care Web Design and home service webdesign.com a lot, because most of your traffic is going to come from your cell phone, all right? From cell phones, from people's mobile devices, their tablets, and their phones. It's not going to come from desktop. So if you have a website, you might want to think about, okay, maybe I have a background video playing if they're on a desktop where it's a stronger, more powerful piece of device, but on a mobile device where potentially they're on data, they're traveling, they're moving, they're in between networks, maybe I don't want to have certain features or certain videos moving and graphic animations that would slow the website down and hurt my SEO. So mobile friendly, very important. You don't want people having to like pinch in on their mobile device to see how to contact you or anything. It should be mobile friendly, a different design completely for web on a development on a desktop versus a mobile device like a cell phone. You do not want people having to pinch in or not having tabs, or they're trying to find the link and it's moving around because they're scrolled way into your website. It's got to be mobile friendly. Obviously, we got to think a lot about SEO in terms of how many times can we get people to link to us and then we link back to them. That's the strongest type of link, is when they link to us and we link to them. So if you can get your competition, you can get your suppliers or your customers to link to your website, try to link back to their website, because that will create a really strong SEO link between those websites. Try to keep your website fresh. Try to keep things updated all the time. With lawncarewebdesign.com and homeservicewebdesign.com, we actually have a subscription where it's just a flat monthly fee. The reason we do that is because we want people to constantly update their website. You know, if you have a seasonal business, change the banner, change the text, change the main title, the main promotion, the main offer on the website at the top based upon the seasonality. Like, do not be pitching snow plowing when it is the middle of summer and people are thinking about their projects for their fireplaces and their outdoor living spaces. Be relevant to the time of year. Be relevant to current events. Be relevant to the weather and holidays or whatever it is. Keep your website fresh. Keep things moving. Keep things updated all the time. And that's why, like with those subscription services I mentioned that we have for website, we charge a flat monthly fee, and it includes unlimited changes because we want people to make changes. Change things as you need to change your promotion. You want to include a call to action on your website. I've seen it so many times where at the end of the day, all their website is really a glorified business card. It's like, hey, yeah, our website is this, and it has our phone number and our address, and it's great. Make it where it has a call to action, where you're trying to get people to do a specific thing. For most of us, it's to call us, it's to fill out a certain form, it's to check out if you're trying to sell a product online. Like, make it clear what your call to action is on your website, and don't just make it like, hey, it's just a place where you go and contact us and that's it. Like, well, there's no point, right? Have it where there's a call to action. They've probably seen you on social media, heard about you from a friend. So like, why would they just be coming there to see what you're all about, an About Us page? They're probably coming to your website to do something, like initiate service, to buy and check out, getting something from you. So have a very clear call to action. Try to stay consistent in your website in terms of design. Try to make it where your colors, your brand is very thematic, and it's not like, oh yeah, our logo is pink and then we have all these random other colors and shapes and like different fonts. Try to keep your design, again, this is the number one way you're going to have a premium product and a premium brand image in the mind of the customer, and they're going to elevate value, and therefore you'll be able to raise prices. The number one way they're going to, when they're looking at your website, you've got to have great design if you're ever going to try to have that perceived value bump. If your competition doesn't have a website, if they have a flimsy looking website, if their website doesn't have an SSL, which is a big issue. Like, if you don't have an SSL, I'm going to just write this out. This is basically if you look on when you're in Chrome browser, for example, you're going to see a little lock up next to the URL if they have an SSL. And if Also, when you look at a website, you know that it has HTTP, whatever. If there's an S here, that means that they have an SSL. Having that S right there means that they have an SSL, and that is a big determining factor now, even in terms of SEO. So these are all little things that, hey, design's got to be in point. I've got to have a secure website so people don't mind putting in bank information, checking out. If you do not have an S behind the HTTP, you do not have an SSL. You need to contact your domain registrar. Ask them, I need to buy an SSL. Can I get this set up? You've got to do that. Otherwise, when people come to your website, they're gonna get alerts from their browser blocker and from their scam blocker that basically says, hey, this is an unsecured website. You might not want to buy anything from here. You might not want to submit your information on here. You might not want to submit an estimate request form. You might not want to click any links to call this person because they don't have an SSL. So these are all important things when you're building your website. Design and SEO is the balance, all right? And you've got to, really be clear on the fact that, hey, I'm going to make a really good looking website, but I might, take some lesser design elements at the stake of SEO, because SEO is extremely important. You can have a great looking website, but if you don't get in front of people because they can't find you on Google, that's a problem. If you're number one on Google, but they come to your website and it looks like trash, also not good. So there's always that balance between design and SEO, but at the end of the day, you've got to figure this out. You've got to make sure you do it right. And if you're just getting started, hey, try Weebly, try Squarespace. These are like basically free sites. You can do it like $5, $10 a month. You can hire people like us. We charge $400 a month. You can find people that pay, will charge you $10,000 or $15,000 for the initial, and then you just don't have to pay anything forever. Again, the only reason I'm against that last one is because I do feel like you should be updating your website every few months at least, putting new customer reviews on there, putting new pictures based upon the time of year, putting new promotions, new offers on the front page, tweaking and adjusting things based upon what's working and what's not. So that's why we have a set monthly fee, but you don't have to be there, right? I kind of look at different stages. One is you're going to start with something basically free, $10, $15 a month on something like Weebly or Squarespace. There's a whole bunch of different other companies. And then you want to get a company like ours that's going to be a subscription based. You don't have a big upfront because you don't want to spend that money on that. You'd rather spend that on driving traffic to the website, get the subscription, and then if time goes on and you're doing millions of dollars in revenue, you might end up actually getting someone's, hey, they're going to build you a $20,000 website, and then you're going to hire them, literally hire them full time, and you might spend $4,000 or $5,000 for them to always be updating it, changing it, tweaking your e-commerce. Like that's again a company that's much more developed. So those are kind of the three different stages I see. Very, very cheap, subscription based like we have at Lawn Care Web Design and Home Service Web Design, and then owning and actually having someone in-house to have your website constantly being changed full time. They're inside there tweaking things, split testing things, etc. So hope that was helpful. Make sure you always keep in mind design and SEO. There's that perfect balance, and sometimes you do things at the cost of the other, but you gotta figure this out in order to have a premium product, premium brand, premium value, and perceived value in the mind of customer, so you can charge ultimately a premium price. Every dollar I've ever spent on web design and making them better has always returned back to me many times fold over, because if I can improve that value proposition and the perceived value of the customer based upon having a web chat, based upon having an estimate request form, based upon having automations on my website, based upon having an easy checkout, if I can produce value there, I can charge a lot more premium price, and that scales infinitely as I grow customer base. So hope that's helpful, and we'll see you in the next one. When it comes to social media, for most of our small businesses, it is going to be extremely important for us to use that channel to engage with customers and really drive traffic to our websites, and really just it's almost like an introduction to customers in a place that they're commonly at. For example, if you wanted to get to know people at a church, you'd probably need to attend their church, where they're at, go to their school, go to, if you want to get to know this person, you would want to be all the places they're at. The customer is on social media, and so you need to be there, and you need to have a business page, you need to have a personal page, depending on what you're trying to sell, what services you are trying to offer. You need to be in the places that your customer is at. And in the past, that might have been television, radio, billboards, but for small businesses, the beautiful thing about today is that our customer is on social media, and we can get to them at a very low price. And so what you would have spent years ago, tens of thousands of dollars on a big TV ad, now $1,000 spent on Facebook in a very localized market can do a lot more for your business. So social media is important, but one thing I think it's very important to remember is you would much rather connect and engage instead of always trying to use social media to sell, all right, or promote. Okay, so it's not to say that you can't sell or promote on social media, but I've found that people go onto social media in order to connect with other people, to look at their family and their friends' pictures, to typically connect and engage with other human beings. And so to be selling and promoting just seems weird. It'd be like going to a church event in order to get to know somebody, and you get there and you're wanting to like party and get drunk. It's like, hey, this is the wrong place for that. And so when it comes to social media, I look at it the same way. You want to get to know somebody, and if you're going to come to that certain platform, don't be doing things that they didn't come there for. They didn't come to always hear you selling on social media. They came to engage, connect, get informed, maybe laugh. And so the question is, how can I engage? How can I connect with my customers on social media? And then they're going to go click on my link to my website. They're going to go and be interested in what I'm actually selling, but it's of their own, they're searching for it. And the thing about social media is people do not come to social media in order to try and buy things. It's much more common that they're going to go search for it, but when it comes to looking through their social post on their feed, they're not going to be like, oh, someone's wanting to sell something, great, that's always what I've always looked for. No, like they're going there to look at the cat pictures, or their relative's baby that was just born, or someone's wedding, or whatever is happening in the social sphere that they live in. That's why they're going to social media. So how can you connect on that level, whether it be showing the human side of your business, showing the behind the scenes, showing funny things. All of that on your social media is going to usually engage and connect much better. And the reason this actually plays into it from a numerical standpoint is the fact that when people go to Facebook or Instagram or whatever platform is going to come up down the road, TikTok and all the rest of it, is the algorithm is measuring how engaging your posts are. And that's why someone with maybe 5,000 followers or 5,000 likes to their page might only get that post might only be seen by 50 people. Why? Because when someone logs onto Facebook, for example, Facebook has to determine, okay, they have 5,000 friends, and that means that there's 3,000 posts we need to show this person today. Well, guess what? On average, this person's only going to be on social media, on this Facebook platform, for 6 minutes or 7 minutes, for example. We've got to decide, the algorithm has to decide what is the most relevant, engaging, connecting post that we could possibly put in front of them on the top of their feed in order for them to stay the longest. So they're not going to put boring posts. They're not going to put posts that no one's liked, no one's commented on, no one's engaged with, no one's shared, because they know that's not going to keep them on the platform. So you've got to think in the mindset of, okay, if I'm Facebook and I want people to stay on my platform, how can I create content that creates engagement? People comment on it, they like it, they share it. These are the type of things that you want on your social posts, so that way when you do post, it's actually seen. Especially on more mature platforms like Facebook, you can have tens of thousands of people following your page and liking your page, and literally it only being seen by 100, 200 people. And so how do you get that higher? You get a post that is going to engage with the customers. They're going to like it. They're going to share it. They're going to comment on it. That's the type of engagement that you're looking for. So it's actually seen by people, and you get that free impressions from customers without having to pay for anything. That's the beautiful thing about social media, is if it can go somewhat viral, even on a very localized level, you don't have to pay for that. The problem is, are you creating connecting, engaging content? That's the determining factor of whether or not it'll be shared, commented on, liked, and that's the deciding factor of whether or not it'll even be seen by the people that like your page. If it's engaging to the point where Facebook, Instagram, these social platforms will use their algorithm to actually push it onto the feed of your followers. Whereas if you're trying to always sell and promote, people don't usually like those posts. They don't usually like to share those posts if it's like, hey, buy this now. Get one, buy one, get one free. Get our special offer today. Those are much less likely to be shared, commented on, etc. And that's typically why someone will pay ad money, and they'll spend money to get those posts in front of eyeballs, because honestly, the algorithm's pretty good at realizing this is not very engaging or connecting with the audience, and is not going to promote those to all the people in their social feeds. That is prime real estate. When they go to the feed and they start scrolling, and so what Facebook has to do is say, hey, we want to get people on this platform as long as possible. We're going to put the most engaging content. We're not going to put someone just going on their social media every single day talking about what they're going to sell. So what I recommend is always shoot for connecting and engaging on a daily basis, and then once in a while, maybe once a week, once a month, you do an offer. You do some sort of sale, and that's when you can convert. But if you do it too often and your engagement starts to slip and all you're doing is selling and promoting, you will find that your social posts don't really get much traction, and that's usually the people who say that social media doesn't work, is the people that use it to always sell and promote, and therefore no one actually even sees their posts. And they'll have literally thousands of followers, and people, 10, 15 people will see their post. Why? Because the algorithm knows this person does not make engaging content. They do not make posts that are going to be highly valuable and keep people on our platform. So what are we going to do? We're just not going to show them to the people that follow their page. So keep that in mind, and just know that I recommend use social media to connect and engage, and let your links in your bio, let the occasional post, the right hook of asking for a sale, let that be the times where you actually try to drive traffic to your website. But trust me, if you engage and connect with someone, eventually they're going to want more, and eventually they're going to follow, eventually they're going to see what your website is and go to your e-commerce store, give you a call, or fill out an escrow request form. That eventually happens if you build up the relationship to where they know, like, and trust you. Focus on doing those things on social media. They know you? Great. You, first of all, got to show up on their feed. You've got to actually create content where it shows up through the algorithm. They got to know, like, okay? They've got to like you. They've got to actually see this content and be like, I like this stuff. I'm going to follow their page. I'm going to support them, whatever. And they've got to trust you. And that usually comes with time of seeing this over and over and over. That's what builds that know, like, and trust is what builds that relationship that one day, when you do ask for the sale, they will actually convert. One thing that's really important when it comes to social media is making sure that the content you do create is pertinent and custom tailored to the platform you're putting that content on. You cannot make a 20-minute video and just plaster that to like 15 different social media websites and think they're going to do well. Long form content is going to do much better on a platform like YouTube than TikTok, all right? So the platforms change all the time, right? So I'm going to give you some examples of platforms, but like the names of the platforms and which app they are using changes all the time. Whether you talk about Snapchat or TikTok, used to be called Musical.ly, you got Facebook, Instagram, like all these different platforms. The platforms will change, right? It'll be on the fashion show of the next social media app will always be changing. But what you want to make sure you always have context to what platform are you posting on. That's how your content should be tailored. So for example, if I am doing long form video, all right, like I already mentioned, going to be probably more pertinent to putting that on YouTube, maybe on Facebook, okay? But then if I am doing, visual, so pictures is a big part of your branding. This is like fashion, pets, whatever it might be, pictures, cute photos of children, whatever it is, pictures, that's going to be probably Instagram, right? If pictures you're really very centric, then you want to go Instagram. Facebook and potentially even a little bit of Instagram can be used for, really, this is what we really highlight in terms of those 30 to 180 second videos, all right? So little clips, they do really well on Facebook, Instagram, as well as some pictures and things. Facebook is currently a very mature platform. So pictures, they have reels now, and so you can kind of mix it up. But then, again, I'm just kind of making generalizations in order to be able to say, hey, like TikTok is going to be short form video, right? So they just recently increased the length. You can do like up to 3 minutes, but majority of their videos are under 60 seconds. And so that's going to be, again, a different demographic. So you got to ask yourself, number one, who is on this platform? Older people are going to be on Facebook. Younger people are going to be on TikTok. Right now, as time goes on, older people will get on TikTok. So usually, I usually like to say every 5 years, the platform ages 10 years. Every year the platform ages 10 years. So if today it's a bunch of 10 and 20-year-olds on a platform, in 5 years, their grandma's gonna be on it, right? And so that's what's happened with Facebook. You have an older demographic on there, and then the younger demographic moved to Instagram, and now they're moving to TikTok. And there'll be another one, but you just gotta remember that fashion show will always change the platform, but it's about what type of content you're creating and then matching it to the correct platform. Do not expect people to go on TikTok and watch a long form video. That's going to be YouTube, okay? Do not expect to do pictures on YouTube and do really well. No, that's probably going to be better on Instagram. So make platform specific content, and if that means, hey, I got to shoot a video 5 times, one for YouTube, one for Facebook, one for TikTok, one for Instagram, and make different content for the exact same thing that's in front of me. You know, a cute dog, okay? That's a 15-second reel. It's also a 30-second TikTok. It's also a picture on Instagram. It's also a 20-minute video with cuddling with the dog and talking about on YouTube. All of that same piece, same thing you're trying to sell, potentially, but it is the platform-specific content that is going to move the needle for social media. Do not think that just taking one picture and posting to everything is going to solve the problem. Be platform-specific and let the medium match the platform. The next question you really need to ask yourself is, which platform is my customer, my target customer, on? If you're trying to sell to people that are younger, are they going to be on TikTok? Whereas if I'm trying to sell someone that's older, 50, 60 years old, they're probably not going to be on TikTok doing dances. They're probably going to be on Facebook, right? And potentially maybe the millennial 30, 40-year-old mom is going to be on Instagram. So you got to ask yourself, where is my customer? And not only do I have to create content that is relevant to the platform, but I have to create content for the platform that is relevant to my customer, okay? So just keep in mind, as I said, you're always going to have the fashion show of the next app for social media, but you got to ask yourself, is my customer even here? Now, that's not to say you might not get involved and understand TikTok now, so that in 5 or 10 years, when your customer is on that platform, because again, I always say, you know, it ages 10 times faster. So next year, the average age of people on TikTok will probably be 10 years older, because the older generations start to come onto the platform. And you know, it started off, whereas Facebook was like college kids and young kids. Well, now it's literally the 50 and the 60-year-olds that are on that platform. 7-year-olds, that's the social media platform they really respond to. That's why a lot of the money is here right now, is because the baby boomers are the people who have money to spend. They have a retirement. They have money to spend. Therefore, they're the most really the highest value social media user is that older clientele, that older person, and they're really on Facebook right now. Again, it's going to always change. As time goes on, they'll probably move towards Instagram. As time goes on, they'll probably move towards TikTok. And there'll probably be 5 other apps by the time they get there that the younger generation has moved on to. All right, so typically the young person is going to lead the way, and then behind them is going to come the older population. So you've got to ask yourself, is my customer here? Again, not a bad thing to figure out TikTok and in 5 years be relevant on that platform, so when your target customer gets to that platform, you can actually sell to them and you're actually relevant on that platform. That's not a bad thing, but just know that spending money on a platform too early, you might as well be flushing money down the toilet, because there's no one is there. They're not your target customer if you're trying to target an older clientele. If you're trying to target a really young audience, you're going to be on TikTok. You're going to spend money on TikTok. Although you might have a Facebook page, you might make content for Facebook, but you're going to spend your money on TikTok. So how I look at it is, hey, I want to be on as many platforms as I can be, but I'm only going to spend money for eyeballs on the platform where my target customer is on that platform. So again, make your content specific to the platform and make your content specific to the platform that your customer is on. That's the thing you got to think about, and you got to think about now and in 5 years, where will my customer be? Most likely your customer, if they're 50 and 60 years old, is going to be on the platform that currently the 10, 20, 30-year-olds are on now. So I'm a big believer in thinking ahead, being relevant on those future platforms if you have an older clientele. But just know that when you spend your money and you're actually going to get business results, it's probably on the platform they are currently most attracted to. So usually after I talk about social media and potentially getting customers on those platforms, people are like, great, I'm going to go spend a bunch of money on getting paid ads on Facebook and Instagram, and I'm going to do Google ads, I'm going to do Google local services, I'm going to run all these ads online because I can get my customers because that's where they're at. And that's great. But what I want you to think about is really this kind of continuum / balance between the fact that whether or not you're going to spend money on ads is really this balance between time and money, okay? I'm not a believer that time equals money. That's why I believe in P for P. That's a whole different subject. It's very dangerous, I believe, to think that time is money, because it's not. Money is based upon production and efficiency and what is produced. But anyways, time and money. When it comes to advertising, you're either going to have time or you're going to have money. This is very much of an and or statement, okay? And so when you're first starting your business and you don't have much money, if you're watching this, you're like, man, I just want to get started. I don't have any customers. I'm not super busy. But then you have a lot of time probably and you don't have very much money. In that case, you're probably going to do things that take a lot of time but not a lot of money. You're going to door knock. You're going to send emails. You're going to cold call people. You're going to go onto Facebook groups and just add value and try to communicate with people. You're going to go to local events and do networking. You have a lot of time, not much money. You might need to print out some door hangers, some business cards, and you're like pounding the pavement. If you're trying to do home services, you're going to go talk to property managers. You're going to knock on doors. You're going to do door hangers. You're going to pass out flyers. You're going to email all your friends and family. You're going to start a Facebook group, a Facebook page for free. Like all of that stuff you're going to do. It's time. It's free. You're also probably going to do things for free, like services for free. You might mow someone's lawn for free. You might do a community project for free. Again, you have lots of time, you don't have a lot of money though, but you can invest your time. Whereas what's gonna happen is as your business grows and that time that you've invested becomes customers, you get really, really busy, you're not gonna have any more time, but you're gonna be producing enough revenue to where you can afford to spend money on ads. And that's when you have money. So do not think that in order to get started with getting more customers, you need money. You can start with the time. That's gonna be the grind, it's gonna be the door knocking. Some people are very afraid of spending their time and going more hand-to-hand combat, pounding boots on the ground, pounding pavement. That's the hard time of growing your business because you don't have money just to like throw into advertising. It's easy to literally get customers when you're like, oh, I got lots of money, I can just throw it in advertising. And someone that's getting started and they have a bunch of money, they can grow faster because they are not constrained by their physical restraints of time because they have plenty of money just to throw into marketing and get tons of leads. But if you don't have that luxury, just know it's fine. You can start with no money. Just realize you're going to have to invest time. The things that people don't want to do, you're probably going to have to do to get started. Then you'll get busy. You'll get busier and busier. You'll get more and more customers. And now you're booked out several weeks. Like, oh my gosh, I almost need an employee. Well, I don't have time to keep knocking on doors and pounding pavement. I'm then going to take a portion of my money based upon like what we just talked about, like a percentage, or based upon my growth, what I'm wanting to do in terms of growing my business. Whatever that budget is, I'm going to invest into marketing online so I can spend that money towards getting more customers instead of spending my time getting more customers. So it's always simply a matter of time or money. Which one do you have? If you're super busy, you're probably going to be taking a portion of your money and pumping into marketing if you're wanting to grow your business. And if you're just getting started or you don't have money, you're probably going to need to invest your time. All right, so I want to talk about real quick, and that is the temptation to constantly be adding a bunch of coupons and discounts when it comes to your promotions and your advertising. The example I want to use for this is Bed Bath & Beyond. And what Bed Bath & Beyond really struggled to do is pivot past the discounts and the coupons that were always so attributed to their brand. And the reason for that is because they literally would spend hundreds of millions of dollars sending out big postcards. You probably remember them still. Big blue postcards, 20% off, at least 20% off. And what that did is it really capped them from being able to charge premium prices or charge the price, the sticker price, and get a higher margin on the products that they sold, simply because people basically would not shop there if they did not have a coupon, because they always looked at it as like, hey, every month I get a coupon in my mailbox for 20% off my whole order. So like, why would I go there and spend full price if I can get 20% off? And so my recommendation, or like the thing that I would say to you is, I found so often is that customers will usually get addicted to discounts. Whereas if you want to give away things, or you want to close a deal because you need to fill some time, or there's excess inventory, or you need to fill someone's schedule, if you're in a service business, just keep in mind, addicted to discounts, customers will do that. Whereas when it comes to free, they know it's temporary. All right, because At the end of the day, a customer knows you can't give everything away for free. So what I would recommend, if you're trying to get rid of a certain inventory item, you're trying to fill up the schedule because you know, a big job canceled and you're trying to fill the schedule, I would rather give away things for free. Now that does not mean you need to give the entire invoice for free. You don't need to give their whole order for free. But what I would rather Bed Bath & Beyond do is say, hey, when you come in and you spend $100, you're gonna get $20 towards you know, this product, right? You can get this free chair. This free chair if you spend $100. Right? And the value of the chair is maybe $20, the same exact as if you would have had a discount of $20 on that $100 purchase. But most customers realize, hey, that there's value to that chair. I don't expect me to get a free chair every time. I've got to go spend $100 in order to get it. And they don't expect next time they come in when they spend $50 and be disappointed by not getting the chair. All right, so I find people usually get addicted to discounts. I'd stay away from discounting and couponing all the time. Buy one, get one free, this, and always giving those promotions that when it comes to price is very dangerous, because then what happens if you give 10%, 20% off to close the deal today, and then you give them a 10% off, 20% off the next time, well, guess what? The third time, when you're really busy and you're backed up with orders and all the rest of it, they're still gonna expect the 10 to 20% off. And so customers get addicted to discounts, and it can be very dangerous for your brand to be affiliated with always coupons and discounting, because it's a slippery slope to unprofitability and very, very thin margins. What you want to focus on is higher margin products, but then occasionally if you want to give away things for free or pieces and parts of an invoice or an estimate, like if you're doing a big project on someone's landscaping, for example, don't give them the whole project for free, but if you really want to close the job, don't discount it. I'd rather you say, hey, if we're going to do this $5,000 job, this $400 item, we can go ahead and give that part for free, or we'll upgrade the mulch, or we'll upgrade the type of plants that we're going to install, or upgrade the design of the paver, that's a $400 value, or whatever it is. I'd rather you give away things for free, because customers know it's temporary. They know it's not sustainable for you to give them things forever for free. But discounts, they get addicted to it and they think you need to keep doing it, and that will start becoming an actual barrier to even making the sale and then making a purchase decision is, well, where's the coupon? Where's the discount? And that's a slippery slope to profitability.